Hello friends, I hope you are all doing good. Welcome to this amazing class wherein we will be discussing about marathon. We'll be covering the marathon in this video. We'll be taking the CA Intermediate Marathon for your upcoming examination, which will this marathon which you are seeing will be applicable for your May exam, September exam, and January 26 examination. May and September 25 as well as January 26 examination. And the notes which we are going to use over here, they are fully amended notes. You don't have to worry about any type of amendments or should I study anything extra. Answer is no. Already I have made, anyways, I have made the amendment video which is already uploaded. But sir, I want one full revision of the entire topic, full discussion on the entire topic with amendments. If you want that, then this is the video which you have to watch. Now, before I start, there is one, there may be some questions which you may have. Sir, where will I get the material, sir? This material will be attached in the description. I'll ask the team to please attach the material also under this description. You can definitely take the material from there. Now, sir, apart from that, sir, should I purchase because I heard that there are a lot of amendments which are applicable for the May examination, September examination, and January examination, and I have heard that there are a lot of changes which is made under income tax law. Should I take a new course, or should I purchase the course and should I read for my examination, or if I watch these amendment lectures, will it be sufficient? See, what I would recommend you to do is watch this amendment video. If you have already done with your classes, no problem. Watch this amendment video. Go through the entire video. You will come to know about your confidence, whether the amendments which are there, the changes which are there, whether you will be able to cope up with them or not. Meaning whether you will be able to answer those amendments properly or not. You will come to know about that. If you feel that you have not understood the amendments properly, or if you feel the changes which are made are some changes wherein I will have to need some extra question for practice, then better go for a video. But my personal recommendation is first watch the entire amendment, correct? Watch the entire marathon class. So once you watch the entire marathon class, take this material which I'm going to share with you. This also has questions, meaning I have, say for example, this is the concept of tax rates which we are seeing over here. With tax rates, I have done questions also. These questions are what's completely amended questions which is applicable to you for your examination. So this is not only with this chapter, for all the chapters, okay, for all these chapters. So if you see, for direct tax only, the notes which you are going to get will be almost around how many pages, sir? The notes which you are going to get will be almost around 370 pages notes. So this is a very comprehensive notes wherein we'll be covering the entire the theory part, and we will be covering the practical questions also, and all these are fully amended. So you can definitely, my personal recommendation, instead of me telling you that directly go purchase the course, you watch the new recordings, etc., my recommendation to you will be, please watch this marathon completely, because it is fully amended. Please watch it completely. Then you you download this material which is there. You try solving the questions, try understanding the questions. If you feel that this is sufficient, then very good. After that also, if you feel that no, I need a little extra confidence, sir, I have seen the questions, but I want to still know what approach did you follow, then I would recommend you to go purchase the course. See, majorly there are changes in two chapters, major chapter, which is your tax rate topic and your capital gain topic. So even if you if you want to if you are purchasing course, definitely you can go to our website, and hardly it will cost you 1,250 rupees. You can definitely go to our website. So I think this is something which you will already be knowing, so but I'll just show it for your knowledge purpose. So please note, what is my personal recommendation? First, see the marathon classes, then solve the questions from the material. After that, if you feel that it is required, then only go for it. So you can go to our website, and if you click on this online ArivuPro online mode, over there you will be able to find the courses which they are offering on recorded mode. So you can take that, and it will cost hardly 1,250 rupees. So if you feel that investing 1,250 rupees is worth and I can afford to invest so much, then definitely go for it. Okay, so shall we start now? Yes sir, we'll start now. So sir, this marathon is for whom, sir? This marathon is for CA Inter students, group 1 students, and this is for what topic, sir? Your paper called as paper number 3, which is taxation. This taxation paper which is there, that is there for 100 marks. This has two parts in it, direct taxes and indirect taxes. So direct tax is for how much marks? 50 marks, and indirect tax is for how much marks? Indirect taxes is also for your 50 marks. Wherein you will have 15 marks MCQ question and 35 marks descriptive questions. So meaning what, sir? For income tax, you will have 15 marks MCQs and 35 marks your practical questions. And for GST also, you will have 15 marks MCQs and 35 marks will be your practical or descriptive questions. Sir, that I understood. Sir, what will be my question paper pattern in my examination? Your question paper will have two parts. One is your part 1, which will cover your MCQs, which is for 30 marks. Part 2 will be your descriptive question, which will be for remaining 70 marks. In part 2, there will be two sections. Section A, income tax, section B, which will talk about GST. Now, sir, how will my MCQ questions come in the examination? Normally, you will have case study based questions. So there will be totally 4 questions which will be case study based question, meaning they will give some story to you. Based on that story, they will give you some questions, and you are required to answer those questions based on the story which they have given. And other questions will be so now normally what we have seen is in each case study, normally there will be 3 questions, and in some cases there can be 4 questions in one case study, and there will be other MCQ question for 1 or 2 or 3 marks, which is the leftover marks. Now case study based question, normally one question will carry 2 marks. Okay, so this is with respect to MCQ, and with respect to what, sir? With respect to your section 2, which is 70 marks question paper, which is your descriptive paper or practical paper which you have. You will have section A, income tax, and section B, which will contain your GST. Section K, income tax questions, normally meaning your 90% of the questions which are asked in the income tax, 90% of the question, meaning almost you can say 30 marks questions which are asked in the examination. Descriptive income tax is for 35 marks and GST is for 35 marks. So 30 marks questions which are asked in the examination. No, these 30 marks question which are asked in the examination will be completely practical question, meaning they'll ask you to compute something, they'll ask you to solve something in your life, correct? Sir, what about MCQ questions? MCQs will be practical based questions, as well as there will be some theoretical questions also. Basically case study based questions will be given in MCQs. But under income tax law, the descriptive paper which is there, that they will ask you to compute the income, they'll ask you to compute the tax, they'll ask you to find the income from house product, etc. Whatever that different topics they are asking. Sir, what about GST, sir? GST also it will be same. No, GST practical will be, say 50% will be practical and 50% will be case study, or I can say 30%. If I want to be exactly perfect, then 30% of your questions will be practical questions, 30% of or 40% of your questions will be case study based question. Under GST law, the questions which are there will be normally what's a case study based questions, and the remaining 30% which is there will be straight away lifted theory question. Under your GST law, straight away 8 mark question, they will directly lift from the book and ask you. That is complete theory question. They'll give some points to you. You just have to write the theory for that point. That is under GST. Sir, what is the question paper pattern in part 2, sir? Part 2, it will say, now for example, if I talk about income tax as well as GST, they will have totally 4 questions, wherein question number 1 is compulsory. Out of other 3, you are supposed to answer 2 questions. So for example, under income tax law, it will contain in part 2, question number 1, 2, 3, 4 will be income tax questions. 1, 2, 3, 4 will be income tax question, wherein question number 1 is compulsory question, and out of 3 questions you have to answer any 2 questions, which will be for 10 marks. Sir, under GST will be question number 5, 6, 7 and 8. These 4 questions will be from for GST. Question number 5 is compulsory question, and out of remaining 3 you are supposed to answer 2 questions. Sir, one more question I have, sir. What is the other question which you have? Sir, what are the amendments which are applicable to for my examination, sir? So there are a lot of changes which Nirmal aunty is making every now and then. Whether all those changes which Nirmal aunty is making every now and then, is it applicable to for my examination? Answer is no. Our institute says normally whatever changes are made 6 months before your examination will be applicable to you for your examination. Sir, what? All the changes made 6 months before your examination will be applicable to you for your examination. So if you're writing your examination in May, it is 30th October. For example, if you're writing your examination in May 25, for you the cutoff date is what, sir? 30th October 2024. If I am writing in September 25, sir, for you it is 28th of February 2025. If you are writing in January 26, for you the cutoff date is 30th September, 30th of June 2025. Okay, so this is the cutoff date for your examination, meaning that these changes will be applicable to you for your examination. Now, you don't have to worry about the changes, because changes under income tax law normally are made during budget only. Well, normally it will be only once in a year, and that will also be during budget normally. However, under GST, the changes will keep on happening because it is a new law. The GST Council will have some meetings which they'll do, and based on that meeting, they can also make the changes. Now, sir, we have understood about this. Shall we start the discussion on the topic, sir? Okay, first point is, what do you mean by tax? Tax is important source of revenue to the government. It is a compulsory payment which you'll have to make to the government. So basically, there are two types of taxes. One is called as direct taxes. Another one is called as indirect taxes. In case of direct taxes, the incident and impact is on the same person. Whereas in case of indirect taxes, the incident and impact of the tax is on two different person. In case of direct tax, they are progressive in nature, meaning as and when your income is increasing, the amount of tax which you have to pay will also increase. And indirect taxes which are there, they are regressive in nature. Sir, what do you mean by this, sir? Meaning, I don't care how much you are earning, the amount of tax which you have to pay will remain same, because indirect taxes are on goods and services. On each and every product they have given the tax rates, and whatever tax rates is given in the law, that will be applicable to you for your examination. Indirect taxes are on goods and services, whereas direct taxes are on what, sir? Income. Now, the board which is taking care of direct taxes is called as CBDT, Central Board of Direct Taxes, and the board which takes care of indirect taxes is called as CBIC, Central Board of Indirect Taxes and Customs. Sir, okay, sir, this is clear, sir. Now, what are the constitutional provisions with respect to taxations? So there are three articles in our Constitution of India which are important from taxation point of view: Article 265, Article 246, and Article 245. Article 265 says no tax can be levied or collected unless there is an authority of law. And Article 245 gives the power to central government and state government to make the law. Article 245 says central government has the power to make law for whole or any part of India, and the state government has the power to make law for whole or any part of that particular state. And we have one more article called as Article 246. Article 246 has a schedule called as Schedule number 7. In this schedule, there are three lists: union list, state list, and concurrent list. Whatever is there in union list, whatever matters are contained in union list, who can make the law? Only central government has the exclusive power to make the law. Similarly, whatever matters are there in state list, only the state government has exclusive power to make the law. And similarly, whatever matters are there in concurrent list, the central government and the state government can jointly make the law. In your union list, there is an entry called as entry number 82. This entry 82 of your union list is giving power to central government to collect taxes on income. This entry number 82 says that central government has the power to collect taxes on income except agricultural income. And sir, can we collect taxes on agricultural income? Yes. Entry number 46 of state government of state list has given the power to the state government to collect tax on agricultural income, but as of now, no state government is collecting tax on agricultural income. Okay, not okay. Yes, sir. Sir, what are the sources of income tax law, sir? What are the components of income tax law? Income Tax Act 1961, Income Tax Rules 1962. Income Tax Act will have your main provisions of the law. Income tax rules are supporting the main provisions, meaning it is supporting the act. Then you have Finance Act for your examination who are writing in May 25, September 25, and January 26 for your examination. What is the Finance Act which is applicable to you? Finance Act 2024 is applicable to you. Then notification and circulars will be issued by department, that is also one component, and also the judicial decisions or case laws. These are the different components, meaning when I say income tax law, it contains all these different things. When I say income tax law, you have to study, that means you have to study Income Tax Act, Income Tax Rules, Finance Act, notifications, and judicial decisions. Now, please. Sir, what do you mean by income? Income means receipts, but all receipts are not income. Receipts can be of two types: capital receipts and revenue receipts. Revenue receipts are normally treated as income unless they are specifically excluded, whereas capital receipts are normally not treated as income. Capital receipts are normally not treated as income unless until they are specifically included. Sir, all this is fine, sir. Is there any difference between sources of income and heads of income? Yes. Sources of income means the place from where the income is earned. Heads of income are the place where you will put that income. Sources of income can be many. All the different sources of income, no, you will put in 5 different heads. So there are totally 5 heads of income under income tax law: income from salary, income from house property, income from business or profession, income from capital gain, and income from other sources. Whatever different income which you are earning, no, that will go under these 5 heads. Sir, what do you mean? What do we do under income tax law, sir? You do 2 things under income tax law. First, you compute the income and then tax on that income. So you have to compute the total income of the assessee or the person and the tax on that total income. Sir, how do I compute the total income? You should take all the 5 heads of income. Once you take all the 5 heads of income, you will get something called as gross total income. Of course, you are required to do adjustment of clubbing and also the provisions with respect to set off and carry forward. Then you will get your gross total income. From the gross total income, you subtract your deductions under chapter 6A, you will get your total income. Sir, yes, sir. What is the next point, sir? What is the next point? Section number 4 is the charging section of income tax law. Section 4 says income tax is charged for every assessment year on every person on the total income earned by such person in the previous year at the rate specified in Finance Act. What is this point telling? Income tax will be collected from by the government from you in every assessment year. From whom they will collect, sir? From every person they will collect. When they, which type of person, sir? On what amount, sir? On the total income of that person they will collect, which he has earned in which year, sir? In the previous year. At what rate will they collect, sir? At the rate specified in Finance Act. See, basically, when I talk about year, a financial year under income tax law is divided into two categories. One is called as previous year, another one is called as assessment year. Sir, what is previous year? Previous year is the year in which income is earned, and assessment year means the year in which tax is required to be paid. Hey, what is previous year, sir? Once again, can you please repeat? A previous year means the year in which income is earned, and assessment year means the year in which the tax has been paid. So the year in which the income is earned is called as your previous year. For your examination, what is the previous year? 24-25. And what is the assessment year for your examination, sir? It is assessment year 25-26. Okay, not okay. See, normally the previous year is a period of 12 months. Normally, what is previous year? It is a period of 12 months. Starting from, normally it is a period of 12 months, but in two cases, the previous year will be period less than 12 months. Previous year, in which two cases, sir? See, normally previous year is 12 months period, correct? 1st of April till 31st of March. But if you are starting any business in the middle of the year, or if you started earning any income from middle of the year, then for that income, for that business, the previous year will start from that date from where you have started earning that income. So where a new business or profession is set up in the middle of the year, or where a new source of income is generated in the middle of the year, the previous year for that particular income and source will be that date in which you started earning it. Then, sir, what do you mean by persons? You said that in total income of a person. What do you mean by a person, sir? Person includes. It is an inclusive definition, meaning apart from what you generally understand by the word person is a person. Apart from that, these people are also included in person. Who are these? Person includes individual, like you and me. We are all individuals, natural person. Then person includes what, sir? HUF. HUF means what, sir? HUF means what? Hindu undivided family. Person will include partnership firm, including LLP. Person will also include a company, body corporate, private limited company, foreign company, domestic company, whatever type of company. And a person will include AOP or BOI. And person will include local authority. Person will also include artificial judicial person. Your universities are there. No, Bangalore University is there. We have Chennai University, Madras University, etc. Different universities which we have, or deities, God, etc. They are also person in the eyes of income tax. Sir, what do you mean by assessee, sir? I have heard this somewhere, sir. There is something called as achachi. What do you mean by achachi? Achachi means a person who is liable to pay tax or any other sum under this act. Who is an assessee? Assessee means a person who is liable to pay tax or any other sum under this act. And it will include deemed assessee, representative assessee, and assessee in default. Sir, what do you mean by representative assessee, sir? Representative assessee means, for example, I have a daughter who is 10 years old. Now, my daughter is a very good singer. So my daughter is a very good singer. So because she is a very good singer, I have she went to Super Singer competition. She went to Indian Idol competition and she won some awards over it. Now in this case, my daughter is there too. She has earned 10 lakh rupees. She won the event and she won 10 lakh rupees. Now my daughter cannot file her income tax return. I will file her income tax return. I am going to be her representative assessee. I am going to represent her. So I am her representative assessee. Sir, what do you mean by deemed assessee? Sometimes what happens is income tax department will send a notice to you. Say there are some transactions which is happening in your bank account. Income tax department is sending a notice to you telling, hey, how come you are getting so much money in your bank account? Now, though you are not a person who is liable to pay tax to the government, but because there is a notice which is sent to you and asking the income tax department is asking some clarifications from you, you will be called as what, sir? Deemed assessee. Sir, what do you mean by assessee in default? Assessee in default means a person. See, he has filed his income tax return properly. He has paid his tax also properly, but he filed his income tax return late. Because he filed his income tax return late, he had to pay something called as late fee. He did not pay late fee. He will be called as achachi in default. Then, sir, Now come to the main topic, sir. What is the main topic? Sir, now come to our main discussion, sir. What is your main discussion? Sir, now come to our discussion with respect to tax rates. Sir, what are the tax rates which are applicable to for my examination, sir? Please note, tax rates are basically divided into two types. One is called as special tax rate, another one is called as general tax rates. Special tax rates are also what, sir, called as slab rates, and we have something called as special tax rates. General tax rates are also called as, general tax rates are also called as slab rates, and we have special tax rates for special types of income. See, normally special tax rates will be given under income tax law, whereas the general tax rate will be given in the Finance Act itself. And general tax rates are applicable on all the incomes except special income. So which are the special incomes for which special tax rates are applicable? It is your long-term capital gain under section 112 and 112A, short-term capital gain under section 111A, casual incomes such as lottery betting, gambling, betting, horse racing, TV shows, crossword puzzles, then online money games income, and also your undisclosed income. On all these incomes, what is the tax rate applicable? Special tax rate, which is listed over here. Anyways, we will see these special tax rates in detail later. Now, if there is any income, any other income apart from this, if there is any other income apart from these incomes which you are seeing over here, what tax rate is applicable? Slab rate is applicable, or special tax, general tax rates are applicable. Now, the slab rates are basically of two types. There are two regimes. A person can either follow optional tax regime, or a person can follow something called as default tax regime. The other names for these two regimes are, optional tax regime is called as old tax regime, and default tax regime is called as new tax regime. One common question which students ask in the classroom is, sir, which regime should I study? Should I study the old regime or should I study the new regime? Answer is, you should study both the regimes. You are supposed to study both the regimes. You should study the old regime also as well as the new regime also. So we have to study the optional tax regime as well as the default tax regime. First, we will see what is the tax rates under optional tax regime or old regime. See, the SAB rates. If you are an individual HUF, AOP, BOI, artificial judicial person, individual, who is individual, sir? Resident individual whose age is less than 60 years, or if you are a non-resident person, irrespective of your age, then for you guys, the tax rate is what, sir? Up to 2.5 lakhs, you don't have to pay any tax at all. Sir, up to 2.5 lakhs, no tax. Yes, up to 2.5 lakhs, you don't have to pay any taxes. And for income from 2.5 lakhs to 5 lakhs, 5% you have to pay. From 5 lakhs to 10 lakhs, 20% you have to pay, and more than 10 lakhs you will have to pay something called as 30%. This is the tax rate applicable to you. Sir, can you please repeat? If you are an individual, who is an individual, a resident person, age less than 60 years, or a non-resident person irrespective of his age, or if you are an HUF, AOP, BOI, artificial judicial person, up to 2.5 lakhs, no tax. 2.5 to 5, 5%. 5 to 10, 20%, and more than 10, 30% is the tax which you have to pay. Sir, what if I am a senior citizen, sir? What do you mean by senior citizen? Senior citizen means resident individual whose age is 60 years or more. So if you are a senior citizen, then up to 3 lakh rupees, you don't have to pay any taxes. For you, basic exemption limit. Basic exemption limit means the limit up to which you don't have to pay tax. For you, the basic exemption limit for senior citizen, the basic exemption limit is what, sir? It is 3 lakh rupees. And from 3 lakhs to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%, and more than 10 lakhs, 30% is the tax which they have to pay. Sir, what about a super senior citizen? What do you mean by super senior citizen? Sir, the super senior citizen, resident individual whose age is 80 years or more. Yeah. So if you are a super senior citizen, you, for up to 5 lakh rupees, you don't have to pay any taxes at all. From 5 lakhs to 10 lakhs, 20%, and more than 10 lakhs, 30% is the tax rate applicable to you. Sir, what about surcharge, sir? Sir, what is this surcharge? Surcharge is an extra tax which you have to pay. It is an extra tax which you have to pay on your total income, extra tax which you have to pay on the tax amount. You will pay this extra tax called as surcharge. Surcharge is applicable only if your total income is more than 50 lakh rupees. Sir, when is surcharge applicable? Can you please repeat? Surcharge is applicable only when your total income is more than 50 lakh rupees. Sir, tell me how much is a surcharge, sir? If your total income is from 50 lakhs rupees to 1 crore, it is 10% on tax amount. If your total income is from 1 crore to 2 crores, it is 15% on the tax amount. If it is from 2 crores to 5 crores, it is 25% of the tax amount. And if it is more than 5 crores, 37% on the tax amount you will have to pay surcharge. Sir, what do you mean by tax amount? Whatever tax you have calculated under slab rates as well as special rates, the total of tax, on that you will have to pay surcharge of 10%, 15%, 25%, or 37% as the case may be. Now, additionally, apart from this surcharge, you'll also have to pay something called as health and education cess. This health and education cess is 4% on tax amount, meaning the total tax amount including your surcharge. So whatever amount is coming on that, you will pay what, sir? You'll also have to pay something called as health and education cess. Now I have given question over here. Say if my income is around 15 lakh rupees, how will I do the computation? Up to 2.5 lakhs, there is no tax. From 2.5 lakhs to 5 lakhs, I'll have to pay 5%. From 5 lakhs to 10 lakhs, on 5 lakh rupees, I'll have to pay 20%. And for more than 5 lakhs, I'll have to pay 30%. So this is the format in which you are supposed to do. And you are required to add on this tax amount, you will pay what's a surcharge. And you will find the total tax. On this total tax, whatever you have found over here, you will pay health and education cess. And finally, you will get your net tax liability. You will get what you are? Your net tax liability. Sir, what if the question has surcharge? Sir, can you do a question with respect to surcharge? You see this question. My income is 83,50,000 rupees. Correct? If my income is 83,50,000 rupees, that means for me because the income is more than 50 lakhs, surcharge will also come. Correct, sir. See, up to 10 lakhs, your income will be up to 10 lakhs of your income, your tax is fixed. How much is that income tax? 1,12,500. And for income more than 10 lakhs, it is 73,50,000 into 30%. The tax amount comes to 22,05,000 rupees. The total of this will be 23,17,500. Now, on which amount? On this amount, because your total income is more than 50 lakhs, you will have to pay a surcharge of 10%. So 10% of what? 10% of this tax amount. So tax amount into 10% will be your surcharge. Find the total tax amount. On this total tax amount, you will pay 4% as your health and education cess. You will get your net tax liability. Okay, sir. Okay. Sir, I heard that they will give also rebate under section 87A. Yes. You will get rebate under section 87A. Sir, who will get this rebate, sir? You will get the rebate. Who will get rebate? Rebate will be given to a resident individual. Rebate will be given to whom? A resident individual if his total income is up to rupees 5 lakhs. A rebate will be given to the resident individual if the total income is up to rupees 5 lakh, and rebate will be given under which section, sir? Under section 87A. How much rebate will be given? The tax amount or 12,500 rupees, whichever is less. How much ever tax you are supposed to pay, or rupees 12,500, whichever is less, will be the rebate which will be given to you. Now please note, rebate is required to be given before adding your surcharge and health and education cess amount. Okay, the rebate is required to be given before this. Now, you see these questions I have done. And one more thing, which is anyways written on the later point, rebate will not be available against the income taxable under section 112A. That anyways we will see when we are discussing special rate income. Then, sir, what is this margin relief, sir? I have heard that there is something called as margin relief also. Sir, what do you mean by this margin relief? A margin relief is applicable whenever your income is slightly more than surcharge limit. So whenever your income is slightly more than the surcharge limit, then a concept of margin relief will come. So you are required to, while taking this margin relief, you are required to see how much, what is the limit which is there. So whether it is slightly more than 50 lakhs or 1 crores or 2 crores, accordingly you will have to calculate tax on that 50 lakhs, 1 crore and 2 crores and find the increase in tax which you are paying and find the extra income which you have earned. The difference between your extra tax and extra income is given to you as marginal relief. So there is one question over here. See, my income is 50 lakh 10,000 rupees. So because my income is 50 lakh 10,000 rupees, my income, if it was 50 lakh rupees, I would have not paid surcharge. Please note, if it is 50 lakh rupees exactly, I would have not paid surcharge. Now because I earned 10,000 more, I am paying a surcharge of how much? I am paying a surcharge of 1,31,500. So just because of a small increase in my income from, see, my income tax liability, if my income is 15 lakhs, I have to pay tax of 13 lakh 12,500. But if my income, because my income became 50 lakh 10,000 rupees, just extra 10,000 I earned, my tax liability increased by how much? 14 lakh 47,050 rupees. Meaning my income has been increased only by 10,000 rupees, but the tax amount has been increased by 34,550 rupees. So you see, if you see, there is, the tax amount has increased drastically when compared to the increase in income. Now the difference between both of them will be given to you as marginal relief. Okay, not okay? Yes, sir. Sir, apart from that, what else is there in tax rate, sir? Now, one clarification which is given by the CBDT. What is this clarification, sir? So, if a person is born on 1st of April 1965, will he be treated as senior citizen? If a person is born on 1st of April 1945, will he be treated as super senior citizen? Because he is going to celebrate his birthday on the first day of the assessment year. So, by the end of previous year, what he will be treated? So, see, basically what government says is, say if you're celebrating your birthday on 1st of April 2025 on first of April, if you're born on 1st of April 1965, then on 1st of April 2025 you will be celebrating your 60th birthday. That means you have completed your 60 years of life as on which date? 31st of March 2025. Therefore, accordingly, you will be a senior citizen for previous year 24-25. And similarly, if you are born in 1/4/1945, you will be treated as super senior citizen for the previous year 24-25. Now, there is one more tax regime. I told you, default tax regime or new tax regime. Sir, what is this default tax regime or what is this new tax regime, sir? This is applicable for an individual. To whom is it applicable, by the way? Sir, it is applicable to an individual, HUF, firm, AOP, BOI, artificial judicial person. Meaning all those people for whom slab rates are applicable, for them this is also applicable. And section 115 BAC is applicable. Then what else, sir? Section 115 BAC is applicable to resident and non-resident. It does not make any discrimination at all. Whether you are a resident or non-resident, you can both follow. Now, what is the tax rate under 115 BAC? Up to 3 lakh rupees, there is no tax which you have to pay. From 3 lakh rupees to 7 lakh rupees, you will have to pay 5%. From 7 lakh rupees to 10 lakh rupees, you will have to pay 10%. From 10 lakhs to 12 lakhs, you will have to pay 15%. From 12 lakhs to 15 lakhs, you will have to pay 20%. And for more than 15 lakhs, the tax rate is 30%. Sir, can you please repeat? Yes. Hey, up to 3 lakh rupees, no tax. From 3 lakhs to 7 lakhs, 5%. From 7 lakhs to 10 lakhs, 10%. 10 to 12, 15%. 12 to 15, 20. And more than 15, you will have to pay tax of 30%. Okay, sir, are they also liable to pay surcharge? Yes, if the total income is more than 50 lakh rupees, they will also have to pay surcharge. How much, sir? If it is from more than 50 lakhs up to 1 crore, 10% on tax. If it is more than 1 crore up to 2 crores, 15% on tax. And more than 2 crores, they'll have to pay 25% on tax. Okay, sir, this is something which I got to know, sir. Sir, what about health and education cess? Compulsorily it will come 4% on tax, including surcharge amount. Health and education cess will come. Sir, what about rebate, sir? Are they also liable to, will they also get the benefit of rebate? Yes, they will also get. The new tax regime, people also will get a benefit of rebate. In fact, for them, the limit is also too high. Hey, for them, what, sir? For them, the limit of rebate is also too high. Sir, what is the limit, sir? So, if you are a resident individual, you can claim rebate under new tax regime if your total income is up to 7 lakh rupees. Sir, how much rebate, sir? Your tax amount or 25,000, whichever is less. Also, you will get an extra benefit if your income is slightly more than 7 lakh rupees. See, normally rebate will be given to you if your income is 7 lakh. But if your income is slightly more than 7 lakh rupees, then a rebate will be given to you under 87A. And what is that rebate, sir? That you see what is the extra income which you have earned. So take the difference between the total income and 7 lakh rupees. What is extra which you have earned from 7 lakh rupees? Then compute the tax on your entire income, total income. Now, if your total tax is more than the increase in income, then the difference between your tax amount and extra income which you have earned, that will be given to you as rebate. So I have solved a question for that. Please see that question, because I feel, but that with respect to that rebate, no question can be asked in examination. Sir, where is the question? But yeah, see this question. Mr. Kannan has a total income of 7,10,000. Compute his income tax liability under 115 BAC. So first, his income tax liability came to 21,000 rupees. Now, since his income is slightly more than 7 lakhs, what will come? Rebate will come. How much is the rebate? Whatever income, extra income he has earned, which is 10,000. Income above 7 lakh. And now tax on 7 lakh 10,000. How much is it coming? 21,000. We have already done the computation. So what is the difference between this? It is 11,000 rupees. This is the rebate which is going to be given to him. Correct? So 21,000 minus 11,000, 10,000 plus 400 rupees is the tax which he has to pay. Now see, this is the format of computing the tax. First, you should take the tax amount, subtract rebate, you will get some amount, then add surcharge, then subtract margin relief, it is applicable, and then add your health and education cess, that will be your total tax liability. Now, tax rates. Sir, what are the other tax rates? The tax rates for company. What is the tax rate for company? Sir, we heard somewhere that if I am opting for 115 BSE, lot of benefits will be taken from us. There are a lot of benefits which will be taken from us. No, yes. That we'll see under total income topic. We'll discuss again this point in our total income topic. Right now we are seeing what, sir? Basics of income tax law and tax rates. So this is sufficient for tax rate. Now, next point is what, sir? Sir, what are the tax rate for a company? For a company, the tax rate is 30%. For a company, what is the tax rate? For the company, the tax rate is 30%. For a company, the tax rate is domestic company. If you're a domestic company, the tax rate is 30% for you. And if you're a foreign company, the tax rate is 35%. There is an amendment over here. Tax rate is what, sir? 35%. Now, for domestic company, the tax rate will be 25%. If the total turnover or gross receipts of that domestic company in the previous year 22-23 is up to 400 crores. If the turnover or gross receipts in the previous year 22-23 is up to 400 crores, then the tax rate for this year will be how much, sir? Which year? 24-25, it will be 25%. Sir, is surcharge applicable for companies also? Yes, surcharge is applicable. If the total income is more than 1 crore up to 10 crores, then for domestic company it is 7%, for foreign company it is 2%. Sir, what if the total income is more than 10 crores? Then for domestic company it is 12% on tax amount is surcharge, and for foreign company it is 5% on tax amount is the surcharge. Sir, is health and education cess applicable? Yes, health and education cess is applicable. Sir, how much is it? Sir, 4% on tax amount including surcharge amount. Sir, what about margin relief, sir? Is margin relief applicable for companies also? Yes, the concept of margin relief is applicable for companies also. Sir, what about partnership firm, LLP, local authority? What is the tax rate applicable to them? Flat 30%. Flat 30% of your income you have to pay tax. Surcharge will be applicable if your total income is more than 1 crore. How much is the surcharge applicable? 12% on tax amount is surcharge applicable. Sir, are they also liable to pay health and education cess? Yes, 4% on tax. See, health and education cess is compulsory. Whoever you are, whatever type of income you are earning, 4% health and education cess will also always come. And for them also the concept of margin relief is applicable. Sir, what about cooperative society, sir? What is the tax rate for cooperative society? If you're a cooperative society, for income up to 10 lakh rupees, income up to 10,000 rupees, you'll have to pay 10%. 10,000 to 20,000, you'll have to pay 20%. And more than 20,000 of your income, you'll have to pay tax of 30%. Surcharge is applicable to them if the total income is more than 1 crore up to 10 crores. How much is the surcharge? 7% on tax. And if the total income is more than 10 crores, they'll have to pay surcharge of 12% on tax. Health and education cess of 4% is applicable, and margin relief is also applicable to them. Now comes important thing, which is special tax rate. Here, there is a major change in your capital gain tax rates. There is a major change in what, sir? Capital gain tax rates. Sir, what are the special tax rates, sir? Can you please tell us? See, long-term capital gain is taxable under section 112. So for long-term capital gain, if the transfer is made, which is taxable under section 112, if the transfer is made by you before 23rd of July 2024, it is 20%. And if it is after on or after 23rd July 2024, it is 12.5%. Please note, there are a lot of variation which we will see in detail in which chapter? Capital gain chapter. Apart from this also, there are some variation which we will see in which topic? Capital gain topic. Major amendment is made in capital gain chapter. Okay. So long-term capital gain under section 112, if the transfer is made before 23rd July 2024, it is 20%, and it is on or after 24th July 2024, it is 12.5%. So for long-term capital gain taxable under section 112A, the tax rate, if the transfer is before 23rd July 2024, it is 10%. It is on or after 23rd July 2024, it is 12.5%. And this long-term capital gain under section 112A will be applicable on income in excess of 1,25,000. So this 1,25,000 limit is for the entire year. This 1,25,000 limit is for the entire year. Whether it is before or after, you can take the benefit of 1,25,000. So if it is a short-term capital gain taxable under 111A and the transfer is made before 23rd July 2024, it is 15% which you have to pay. And if the transfer is made after, on or after 23rd July 2024, you will have to pay how much? 20%. And for casual income, which is lottery betting, gambling, TV shows, crossword puzzles, horse betting, etc., 30% Online money games 30%, your rummy circle, etc. And if it is an undisclosed income, it is how much, sir? 60% is the tax rate. Sir, which are the items which are covered under 112A and 111A? It is listed equity shares, equity oriented mutual funds, and unit of business trust of India. These are the three items which are covered under which, sir, section 111A and 112A capital gain. Now this is your capital gain topic. Now I have done very good question over here. Please note. Please have a look into this question. I have solved under both the regimes. How to solve under optional tax regime and default tax regime, wherein I have taken a question wherein you have income taxable at slab rates, you have income taxable at special rates. Sir, you tell us the flow once, sir. Before we see, you please tell us the flow. See, what is the flow? How, when the total income has an income, if you see, this is the total income 19,20,000 rupees. This 19,20,000 rupees has income taxable at slab rates as well as special rates. How do I do the computation, sir? Lawmaker says, first, how should I solve this question in examination, sir? First, compute the income tax on income taxable at slab, the special rate. First, compute the tax on income which are taxable at special rates. Then do the total of whatever income is taxable at slab rate. You do the total, so total comes to 10 lakh rupees. For this 10 lakhs, calculate the income tax by applying slab rates. For example, if you see over here, so first I have computed tax separately for each of this special rate income. Then I have written something called as balance total income. So all the incomes which are taxable at special rates, whatever is left over is called as balance total income. For this, I have done a working. I should calculate tax under slab rates. Whatever tax is coming, add to this. You will get the total. On this, add surcharge if it is applicable. And whatever amount is getting, add 4% health and education cess. Now, other important points with respect to your, which topic, sir? Other important points with respect to your total income topic. Sir, what are the important points? Now, your total income and the tax amount is required to be rounded off to the nearest multiple of 10. It should be rounded off to the nearest multiple of 10. So who is telling this? Section 288A says for total income and section 288B says for tax amount. They both are required to be rounded off to the nearest multiple of 10. So if the last digit is 1, 2, 3, 4, then round it off to the previous multiple of 10. If the last digit is 5, 6, 7, 8, 9, round it off to the next multiple of 10. I have given one example over here. Then rebate under section 87A is not available against income taxable at long-term capital gain taxable at 112A. And normally, please note, very important point. Normally the basic exemption limit which you have, no, that is 2.5 lakhs, 3 lakhs or 5 lakhs, etc. Normally that basic exemption limit should be adjusted with income which is taxable at slab rates. With whom are you supposed to adjust the basic exemption limit? Income taxable at slab rates. However, if the income taxable at slab rates is less than the basic exemption limit, then that unadjusted basic exemption limit will be there. No? Whatever unadjusted basic exemption limit is there, no, that you can unadjusted basic exemption limit can be adjusted with income taxable at special rates, except your casual income and undisclosed income. Except these incomes, whatever unadjusted amount is there, that you can adjust with income taxable at special rates. So yeah, apart from that, one more point, last point. The maximum amount of surcharge which you are required to levy on long-term capital gain, on taxable under 112 and 112A, on short-term capital gain taxable under 111A, and deemed income. For all this income, how much is the maximum amount of surcharge you can levy? It is restricted to 15%. It is restricted to what, sir? 15%. So if I have an income, if I have an income which is more than 2 crores, more than 2 crores also, if my, say for example over here, my this incomes is 1.5 lakhs and other income is 2.5, sorry, this income combined together is 1.5 crores and other income combined together is 2.5 crores, so total income is 4 crores. So what is the surcharge which is applicable, sir? Since the total income is more than 4 crores, so more than 2 crores, should I levy a 25% surcharge? Yes, you should levy 25% on other incomes, but on these incomes, maximum surcharge which you are going to levy is how much? 15%. Okay? Yes, sir. Now comes the next topic. What is the next topic? Oh, sir. Oh, sir. What is the next topic? The next topic for our discussion is agricultural income. Agriculture income is exempt. Section 10 is a section which talks about exempt income. Section 10 clause 1 says talks about agriculture income. It says agricultural income is exempt from payment of tax if that agricultural income is from a agricultural land located in India. Agricultural income is exempt from payment of income tax if such agricultural income is from an agricultural land in India. Sir, what do you mean by India? India means, please see. Now, India means that land region of India. Then from this land region up to 12 nautical miles is called as territorial waters. Up to 200 nautical miles it is called as exclusive economic zone. So when I say India, the area up to 200 nautical miles is covered as India. It is called as what, sir? India. Now, what do you mean by agriculture income, sir? You say agriculture income is exempt. What do you mean by agriculture income? Agriculture income means any rent or revenue which is derived from agricultural land in India. Whatever rent you are receiving, whatever rent you are deriving from an agricultural land which is located in India and which is used for what purpose? Agricultural purpose. The income from agricultural operations. Any income which you are receiving for what, sir? From what purpose, sir? Agricultural operations which you are undertaking. And income from farmland or dwelling unit which is located in agricultural land. And any income which you are receiving by way of plantation, nursery, seedling, etc. That is also your agricultural income. Sir, you said income from farmland, etc. is also exempt. If it is also called as agriculture income. Yes, only if the this farm house which is there or dwelling unit which is there, that is located in rural area. It should be a rural agricultural land. It should be located on what, sir? Rural agricultural land. Sir, what do you mean by rural area? Rural area means something which is not an urban area. Sir, what do you mean by urban area? Urban area is an area where the population is more than 10,000 or more. Okay, if your area's population is 10,000 or more, then that means you are staying in urban area. And if your area's population is more than 10,000 up to 1 lakh, your area is definitely urban area. From your area up to 2 kilometers area is also urban area. If your area's population is more than 1 lakh up to 10 lakhs, then your area is urban area. Up to 6 kilometers of area is also urban area. If your area's population is more than 10 lakhs, then your area is an urban area. From your area up to 8 kilometers is also an urban area. Sir, how do I measure this distance? Sir? You are required to measure this distance aerially as the bird flies. Now, agricultural activity or agricultural operation has been is not defined under income tax law. But however, the Supreme Court gave the understanding in this case law called as Raja Binoy Kumar Sahas Roy case. You don't have to remember the case law, wherein Supreme Court told that in agricultural activity, there are basically two types of operations. One is called as basic operation, one is called as subsequent operation. What type of operation the person is doing, you should see. If the person is doing only basic operation, then the income which is generating is an agriculture income. If he is doing only subsequent operation, then it is not an agriculture income, therefore not exempt. But sir, what if I am doing both subsequent operation and basic operation? Then your income is agriculture income, therefore it will be exempt. Sir, what do you mean by basic operation, by the way? All the work which you are doing up to the stage of germination of seed, sowing, harvesting, etc. All the work which you are doing up to the stage of germination of a seed, that is basic operation. Now, in agriculture income, majorly asked question is what, sir? On composite income. In agriculture income, what is the majorly asked question, sir? Composite income. Composite income means what? A person. One second. Sir, what do you mean by composite income, sir? Composite income means, let us say I am a person who is cultivating potato. I am a person who is cultivating what? Potato. Now, the potatoes are cultivated by me on my agricultural land. From this potato, I am not selling in the market. I am using this potato to make potato chips. And now I sell these potato chips. So basically the money which I am getting is for chips. But can I say for these chips, whatever potato is required is also grown by me only? So now this whatever amount is there, no selling price what I have received, this will have agricultural income portion also in it, and it will have what income portion also in it? It will have agricultural income as well as your non-agricultural income portion in it. Sir, how will I do the computation? Now what lawmakers are telling is, whatever agriculture produce is there, whatever agriculture produce you have produced, you check how is it sold, whether it is sold in raw form or is it sold after putting some process. Meaning whatever potato is cultivated by me, that potatoes are sold like that only, raw form. Then if it is sold in raw form, then the entire income is called as agriculture income, therefore it will be fully exempt. But If this agriculture produce is sold after some process, after applying some process, if these agriculture incomes are sold after applying some process, then check whether those process are required mandatorily to be applied to sell that agriculture produce, or is it not mandatory required process. Meaning, for example, potato, once I take it out from the agricultural land, now on that potato I will have to all the mud will be attached on that, so I wash those potatoes before selling it in market. I wash those potatoes. So is it required that I should wash those potatoes before selling in the market? Answer is yes. So it is a mandatory process. So I have applied that process, and after that I am selling that agriculture produce. Now also whatever income you are getting is an agriculture income, therefore fully exempt. But if the process which is there is not a mandatory process, I'm cutting the potatoes and making potato chips and selling it, then lawmaker says in this case two types of income will come. One is your agriculture income, another one is your what, sir? Business income. What is my agriculture income? These potatoes which you have used for making potato chips, if you would have sold these potatoes in the market, how much money you have earned? Take that, subtract the cost of cultivation of these potatoes which you have used for further processing. The difference is your agriculture income, which is exempt. What is business income, sir? Sale price of that potato chips, whatever amount you have got by selling that processed product which is potato chips, from that subtract the cost of potato. If you would have purchased the potato from the market, see, you have only cultivated the potato, right? So this potato, if you would have purchased from the market, how much you would have paid to the market? You subtract that, and also subtract the cost of processing. Whatever processing cost is required, you subtract that also. That will give your business income. Yeah, okay, not okay? Oh students, there are some beautiful questions which I have solved over here. You can just go through these questions, very self-explanatory questions. And I have also taken this question number 5, which is an exam question which is asked in your last examination. Now, in case you are in the business of growing and manufacturing tea, coffee and rubber, you don't have to do that rule 7 adjustment. So this whatever story you saw over here, this is given in what rule, sir? Rule number 7. But if you are in the business of growing and manufacturing tea or coffee and rubber, lawmaker says instead of doing that arrow mark, etc., straight away do one thing. I will only tell you how much is agriculture income, how much is business income. Please note, I should be growing and manufacturing tea. If I am only growing tree and selling the tea leaves, then it is agriculture income. If I am selling only the tea powder, then it is business income. If I am growing and selling tea, then this will come. Growing and selling coffee, this will come. Growing and selling rubber, this will come. If I am growing and selling, growing and manufacturing tea, then 60% of the amount which I receive, the final price which I receive, is treated as agriculture income, and 40% is business income. If you're growing and manufacturing coffee, coffee is grown and cured by you, 75% is agriculture income, 25% is business income. If you're growing and manufacturing coffee and that coffee is grown, cured, roasted and grounded by you, then 60% is agriculture, 40% will be your business income. In the case of rubber, if you're growing and manufacturing rubber, 65% is your agriculture income and 35% is your business income. And please note, whenever you have agriculture income in your total income, then the concept of partial integration will apply. What concept, sir? The concept of partial integration will apply. Partial integration is applicable to whom, sir? Individual HUF, AOP, BOI, artificial judicial person. When will it be applicable? If the agricultural income is more than 5,000 rupees and the non-agricultural income is more than basic exemption limit. Now tax payable will be how much, sir? Step number 1, compute the tax on agriculture as well as non-agriculture income. Compute the tax on total income, which is agricultural income. Compute the tax on both agricultural income and non-agricultural income combined together. You take agricultural income, add non-agricultural income to that and compute the tax. Then step number 2, take your agricultural income, add it to the basic exemption limit which is applicable to you and compute the tax. Whatever tax you have computed in step 1, subtract it from step 2 tax. This is the tax which you have to pay. Of course, you will have to add health and education cess if it is not yet added. So I have given one very good question for solving purpose. This is all about your agricultural income. So that is your first chapter of your institute material. The next chapter of your ICAI material is what, sir? Residential status. Residential status. Please note, residential status is important for understanding the taxability of income. So whether an income is taxable in India or not, if you want to know that, you will have to check the residential status of the person whose income you are computing. If that income is taxable, if that income is taxable, if a person is a resident of India, then he will have to pay tax in India. If he is a non-resident of India, he will not have to pay tax normally in India. Okay, so we will see on what income he has to pay tax and what income he does not have to pay tax in our future discussion. Let us first understand residential status. So basically section 6 talks about residential status. Section 6 has 6.1 which talks about residential status of an individual, and this is most important for your examination. Residential status of an HUF is given in 6.2, for companies 6.3, and for others it is given in 6.4. Section 6 subsection 1 talks about residential status of an individual. Basically section 6.1 gives the basic condition. Now an individual, first he has to satisfy the basic condition. If an individual is satisfying basic condition, he will be called as resident, and if he does not satisfy the basic condition, he will be called as non-resident person. Now once the individual is satisfying the basic condition, I will check for what's an additional condition which is given in section 6 subsection 6. I will check for additional condition. Now, if once an individual is satisfying basic condition, I will go for additional condition. Either that individual will satisfy additional condition or he may not satisfy additional condition. If he satisfies additional condition, he will be called as resident and ordinary resident. If he is not satisfying additional condition, he will be called as resident but not ordinary resident. And if he does not satisfy the basic condition at all, he is anyways non-resident. Sir, but tell us the conditions are, what stories you are telling, resident, ordinary resident, resident, not ordinary resident, non-resident. Tell us what are the conditions. Basic conditions are given in section 6 subsection 1. What are the basic conditions? Section 6 subsection 1 says a individual will be treated as a resident of India. An individual will be treated as resident of India if he satisfies any one of the following basic condition. If he satisfies any one of the following basic condition. Which conditions, sir? If he stays in India for 182 days or more in the previous year. So in the previous year, he is staying in India for how many days? 182 days or more. Or he is staying in India, or meaning any one of the basic conditions he should satisfy. Or he is staying in India for 60 days or more in the previous year and 365 days or more in 4 preceding previous years. Or he is staying in India for how many days? 60 days or more in the previous year and 365 days or more in 4 preceding previous years. So in the previous years, he should stay for more than 60 days or more, and in last 4 years, he should stay for 365 days or more. Now, sir, date of coming to India and date of leaving India, should I take into consideration while checking the number of days stay in India? Answer is yes, it should be included for calculating the number of days stay in India. Sir, what about place, sir? Should he stay at one place only continuously in India? No, he can stay at any place in India. It should be in India. And sir, continuous stay is important. Meaning I stayed here for 2 months, then I went back outside India, then again I came after 3 months, then I stayed again. Is it important that I should stay continuously? No, it is for the entire previous year. Sir, what are the additional conditions? Sir, you said once I satisfy basic condition, I will be a resident. If I don't satisfy basic condition, I am a non-resident. Once I satisfy basic condition, you said I should check for additional condition to check whether the individual is resident and ordinary resident or resident but not ordinary resident. These additional conditions are given in section 6.6. What is the additional condition telling? The additional condition says you will be called as resident and ordinary resident if you satisfy the additional condition. Correct? So what is the additional condition? He should be a resident for a period of 2 years or more. Okay, he should be a resident for a period of 2 or more previous year out of last 10 preceding previous year. Out of last 10 previous years, for at least 2 years you should be a resident, and both the conditions should be set. And your stay in India should be for 730 days or more in last 7 years. See, in last 10 years you should be resident at least for 2 years, and in last 7 years you should have at least stayed in India for 730 days or more. Then there is one more point over here. Following are the exception to second basic condition, meaning in these cases you should not see second basic condition. So if I should not see second basic condition, what should I see, sir? You should see your first basic condition, that is 182 days condition. Which cases, sir? If you are an Indian citizen who is leaving India during the previous year, for what purpose are you leaving? For the purpose of employment outside India, or you are leaving India as a crew member of Indian ship. In these two scenarios, if you are going out of India, why are you going? Because you got an employment opportunity outside India, or you are a crew member of Indian ship. In both these cases, I will see what's the first basic condition to check whether you are resident or not. I am going to see 182 days condition. To check whether you are a resident or not, which condition will I see? 182 days condition. But however, if you are an Indian citizen who is coming to India, if you are an Indian citizen or a person of Indian origin who is visiting India, and if your total income from Indian sources, if your total income from Indian sources is less than 15 lakh rupees, for you I will see 182 days condition. Sir, what if my total income is more than 15 lakhs? I am a Indian citizen who is coming to India, or a person of Indian origin who is coming to India, and I have more than 15 lakh rupees income from Indian sources, sir. Then you will be treated as a resident of India if you stay in India for 182 days or more, or you will be treated as a resident of India if your stay in India is for 120 days or more in the previous year and 365 days or more in 4 preceding previous year. Meaning, for him, there are two conditions. It is just like your basic condition. Instead of 60 days, they have replaced it by 120 days. Now, very important point to be noted over here is, if you are a crew member of Indian ship, then the date mentioned in continuous discharge certificate as date of joining the ship and the date of signing of the ship should not be taken into consideration. It should not be taken into consideration for calculating number of days stay in India. You should not take them into consideration. Okay, sir. Section 6(1) capital A talks about deemed resident. What is this point telling? If you are a resident individual who is if you are an individual, sorry, not resident individual, we are seeing residency status over here. If you are an individual who is citizen of India and who lives in India and who is who lives outside India. If you are an Indian, if you are an individual who is a Indian citizen and who is living outside India and who comes to India for a visit during the previous year, and you have more than 15 lakh rupees total income during the previous year from Indian sources, and you are not a resident of any other country. If you are not a resident of any other country, and if you follow all the other conditions, then you will be deemed as a resident of India. I'm going to assume that you are resident of India. Then for HUF, what is the residential status, sir? For HUF, what will I see, sir? For HUF, I'll see control and management. If the control and management of the HUF is fully in India, that is wholly in India or partially in India, that HUF will be called as resident of India. If the control and management is wholly outside India, then the HUF is called as non-resident of India. Now, once the HUF becomes resident, I will see for additional condition. Additional condition for whom, sir? Karta. Once HUF becomes resident as per section 6(2), I will see additional condition for whom? Karta. If Karta satisfies additional condition, then HUF will be treated as resident and ordinary resident. If Karta does not satisfy additional condition, HUF will be treated as resident, what? Not ordinary resident. If for company, what is it, sir? Indian company or a domestic company is always a resident of India. And for other companies, for all other types of company, I should see the place of effective management. I should see what, sir? Poem, place of effective management. If the place of effective management is in India, it is resident, or else it will be non-resident for India. Section 6(4) talks about residential status of all other types of person. For all other types of persons such as firm, LLP, etc., I will see control and management. If the control and management is wholly in India or partially in India, they are resident. If the control and management is wholly outside India, it is non-resident. Then scope of total income. Now, the main reason why we study residential status is to check whether a person will have to pay tax in India or not. A person will have to pay tax in India or not. So we have divided an individual and HUF into 3 categories: resident, ordinary resident, resident but not ordinary resident, and non-resident. Now, these people will always have to pay tax on Indian income. All these 3 categories of people, whether you are a non-resident or you are a resident and ordinary resident, resident but not ordinary resident, you will always have to pay tax on what, sir? Indian income. And on foreign income, only resident and ordinary resident will have to pay tax. On foreign income, non-resident will not have to pay tax, and resident but not ordinary resident also will not have to pay tax. But there is one such foreign income on which resident and ordinary resident also will have to pay tax, if that foreign income is because of income from business controlled from India or profession set up in India. Sir, what is this Indian income, foreign income? Can you please tell us? What do you mean by Indian income, sir? What do you mean by foreign income? See, Indian income, basically 4 things are there over here. If there is an income which is received in India, that means it is an Indian income. If there is an income which is deemed to be received in India, then that means it is an Indian income. If there is an income which is accruing or arising in India, that it is an Indian income. If there is an income which is deemed to accrue or arise in India, then it is an Indian income. If it is an Indian income, it is taxable in India. Now, a very important point for resident and ordinary resident, the global income is taxable in India. And if there is any past untaxed profit, if there is any profits of previous years which is not taxed, now if you are bringing them to India during previous year, means last few years, profits are there, incomes are there, which was not taxable in that year when I earned, but now I am bringing them to India. Should I pay tax now? Answer is no. Now we'll start our discussion. So this one small, if you see over here, chart I have given about taxability of scope of total income. Sir, shall we start the next topic? Shall we start the next topic? Yes, sir. Which topic are you going to start next? I'm going to start with heads of income. Please note, I have a different flow for teaching this subject. What is your flow, sir? In my flow, no. In my flow which I have, I teach. I'll just show you the flow. In my flow, I take up income tax like this, and I recommend students also to study in the same manner. You'll start loving the subject. I take basics and tax rates, then agriculture income, then residential status. This is something which you have revised as of now, correct? After this, I start with income from house property, income from capital gain, other sources, salary, business profession, then your other chapters which are there, that is clubbing of income, set off carry forward, deduction, total income, advance tax, TDS, TCS, and return of income. So this is the flow which you are going to do the marathon also. So now I am going to start with the head of income called as income from house property. Come on, sir. Let us start, sir. Yeah. Income from house property, from exam point of view, its importance is around 4 to 6 marks question can come from this topic. Section 22 to section 27. These are the different sections which you are going to learn under this chapter. Now, see, from a house property, you can have two types of income. You give this house property on rent, the income will be income from house property. And if you sell this house property, you will get a capital gain. It will be taxable under the head income from capital gain. Section 22 is the charging section of income from house property, which says, section 22 says, charging section says what, sir? The rental income or the annual value of the house property will be taxable under the head income from house property if two conditions are satisfied. When will the rental income be taxable under income from house property? If two conditions are satisfied. Which are these two conditions? There should be a house property and assessee should be owner of such house property. There should be a house property and the assessee should be owner of such house property. Sir, what do you mean by house property? House property means building and land appertaining to that building. Building and land attached or appertaining to that building. Sir, what do you mean by owner? Owner includes your deemed owner, beneficial owner, and legal owner. So, if you are a beneficial owner, deemed owner, or legal owner, whoever you are called as owner. Now, very important, one recent clarification which has come over here is with respect to if the assessee is involved in the business. This is important. If the assessee is involved in the business of renting the house property, then the income should come under business, no? The income should come under business, so because his business is only giving the house properties on rent. Here the lawmaker says, if the assessee is involved in the business of renting of house property, then I'll check whether he is renting commercial properties or residential properties. If assessee is involved in the business of renting of commercial property, the income will go under business or profession. However, if the assessee is involved in the business of renting of residential house property, the income will go under income from house properties. It will go under what, sir? Income from house properties. Now, for our taxation purpose, we divide the house property into two categories. One is called as let out property, another one is called as self-occupied property. Let out property is a property which is always taxable and it is fully taxable, under which head, sir? Income from house property. Now, self-occupied property, no, the taxability will depend upon its use. Whether you are self-occupying the property for your business purpose or you have self-occupied the property for your residence purpose. Meaning, if it is a self-occupied, what do you mean by let out property? A property which you have given on rent. That is a let out property. Correct? No? Yes, sir. Correct. The property which I have given on rent is a let out property. Now they say let out property is always taxable. Why? Because you are receiving some rent from the property. Whereas the self-occupied property is there. No. Self-occupied property. The self-occupied property, the taxability will depend on whether you are earning some whether it is self-occupied for business purpose or residence purpose. They say if it is self-occupied for business purpose, you should ignore. Why, sir? Why should I ignore? Because you are already generating an income under business. See, when you are self-occupying for business purpose, when you prepare a profit and loss account for your business, you will not show any rent over here. Why will you not show any rent? Because you are doing business from your own property. So when you are doing business from your own property, to whom will you pay rent? So here you will not show the rent. But if it is a self-occupied, so therefore you should ignore it. But if it is a self-occupied property for your residence purpose, if you have a property which you are self-occupied and it is occupied by you for your residence purpose, lawmaker says, I'll see how many properties you have. If you have up to 2 self-occupied properties, take exemption. If you have up to 2 self-occupied properties, take what, sir? Exemption. If you have more than 2 properties, more than 2 self-occupied properties which you are using it for your own residence, for 2 you can claim the benefit of exemption, but for remaining properties will be deemed as let out property. A remaining properties will be deemed as let out property, and deemed to be let out property is taxable. It is treated as, it is deemed as let out. That means you are assuming that it is let out, therefore it will be taxable as let out property only. Now, sir, what if I have 2 properties but one property is not occupied by me? It is just there vacant, sir. No one is occupying it. That is as good as it is a self-occupied property. Now, sir, for computation of income from house property, whatever amount I say, will the government accept it? No, I didn't get you. Sir, how do I compute the income from house property? Whatever actual rent I am earning, if I say that amount to government, will the government accept it? Lawmaker says no. Whatever actual rent you are earning, no, that will be compared with expected rent by government. Whatever actual rent you are earning, they are going to compare that actual rent with what, sir? They are going to compare that actual rent with a government expectation. They are going to compare with government expected rent, and they are going to take whichever is higher. Sir, repeat, sir. Whatever actual rent you are earning, it should be compared with your expected rent, and you should take whichever is higher. That whichever is higher will be taken as your gross annual value. Sir, how do I find this expected rent? Sir, actual rent is nothing but the rent which I am receiving. Correct? No, sir. Correct. Sir, but what is this? What is this expected rent, sir? Expected rent is your municipal value or fair rent, whichever is higher. Compare your municipal value with fair rent, whichever is higher you take. Then that whichever is higher should be compared with your standard rent, and then you take whichever is less. Once you get this, whichever is less, which is there, that is your expected rent. This expected rent you should compare with your actual rent. You will get your gross annual value. From this gross annual value, please subtract your municipal taxes. You will get your net annual value. From the net annual value, please subtract deductions, which is 2 deductions are there. Deductions on the 24A and 24B, which is standard deduction and interest on loan. You will get your final answer, which is income from house property. Sir, you have taken different amounts over here. Can you please repeat once again? Yes. First, take your municipal value, compare that with fair rent. Take whichever is higher. Now, this whichever is higher, you should compare with standard rent. Take whichever is lower. Now, this whichever is lower amount you have got, no, this is your expected rent. This expected rent you should compare with whom, sir? Your actual rent. You compare both of them and take whoever is higher. Whichever is higher you will take, and then subtract from that municipal taxes. Whichever is higher when you are taking, no, that amount is called as gross annual value. From this gross annual value, subtract your municipal taxes, you will get your net annual value. Then subtract your deductions, you will get your income from house property. Sir, what do you mean by municipal value? Municipal value means the value of the property as per municipal records. As per the government records, what is the value of the property? Sir, what do you mean by fair rent? Fair rent is a reasonable amount of rent. Reasonable amount of rent for similar kind of property in the same locality. For similar kind of property, what is the reasonable amount of rent they would have got in the same locality? And what do you mean by standard rent, sir? Standard rent is the rent as per the Rent Control Act. So many states have this act called as Rent Control Act. As per that, whatever the rent is there, that is called as standard rent. That is the maximum amount of rent which you can legally recover from a property. Then, sir, what is actual rent? Actual rent is rent received plus rent receivable minus unrealized rent. What is this? We will see in 2 minutes. Now, what about this municipal taxes, sir? You see, municipal taxes are the taxes which you have to pay to the state government for the property. So, municipal taxes is the taxes levied on the house property by local authority or municipality. It is also known as house tax, property tax, sewage tax, etc. It is allowed on payment basis, meaning only if you have paid municipal taxes, you can claim the deduction. If it is payable, can I claim, sir? No. If it is not paid by me, can I claim, sir? No. Only if it is paid by the owner, it can be claimed as deduction. Municipal tax is allowed as deduction only if it is paid by owner. Sir, what if tenant is paying it? You cannot claim the deduction. Now, if municipal tax is given in percentage form, then I should take what, sir? You should take municipal tax. If it is given in percentage form in the question, then you should take it as a percentage of your municipal value. So if it is given 10%, 10% of municipal value should be taken by you. Now, sir, you are talking about actual rent. No, sir. Yes. Sir, what is actual rent? Actual rent is rent received plus rent receivable minus unrealized rent. Whatever rent you have received, add to that whatever rent is receivable by you. Subtract unrealized rent. Rent which you are never going to receive is unrealized rent. So unrealized rent can be subtracted only if you satisfy these 4 conditions. What are the 4 conditions? The tenancy should be bona fide. Genuinely, you should have given the property and rent to someone. The person who has not paid the rent to you, you should have genuinely given the property to him on rent, and the tenant should have vacated the property. He should have left the property, and he should have not occupied any of other property of the same assessee. You should have not occupied any other property belonging to you, and you should have taken reasonable steps. You should have taken reasonable steps to recover this unrealized rent. If these conditions are satisfied, only then your unrealized rent can be subtracted from your actual while calculating your actual rent. Sir, deductions. You said there are 2 types of deductions, correct? No, sir. Yes. What are these 2 types of deduction? 24A will give you standard deduction. What is the standard deduction? Flat 30% of NAV. Flat how much? 30% of NAV. Whatever net annual value you are getting, into 30% will be given you as deduction. Meaning lawmaker says you don't have to maintain invoices for repairs, electricity, water charges, etc. Don't maintain any invoices. Directly 30% of NAV will be given to you as deduction. Sir, but if the house property is self-occupied, then I will not have an NOV only. No, sir. Yes. So you will not get this standard deduction. There is one more type of deduction which is most important deduction called as interest on loan. Sir, one more type of deduction is what, sir? Your interest on loan. Interest on loan is allowed as deduction. Yes, interest on loan is allowed as deduction. Sir, how much is allowed as deduction, sir? Interest on loan. Interest on loan. If you are taking loan for construction, purchase, repairs or renovation of an house property, and if you are taking the loan from bank or financial institution, family members or friend, it does not matter. Whatever interest you are paying on that loan is allowed as deduction under section 24B. Please note, the loan should be taken for the purpose of house property. Then that loan should be that loan can be taken from any person. That interest will be allowed as deduction whether you have paid that interest or not. Then interest on interest, that is penal interest, will not be allowed as deduction. Interest which you are paying on the fresh loan which is taken by you for repayment of existing house property loan, that is also allowed as deduction. Any interest which you are paying to non-resident will also be allowed as deduction provided TDS is deducted on that interest. Now, sir, tell me what is the amount of interest which I can claim as deduction, sir? That is important for me. The interest which you can claim as deduction in case of let out property or deemed to be let out property, the interest which is allowed as deduction to you will be how much, sir? There is no limit. Whatever amount of interest you are paying, you can take full deduction of that. But if it is a self-occupied property, and if it is self-occupied for your residence purpose, in normal cases, you will get 30,000 rupees, and in some special circumstances, you will get 2 lakh rupees deduction of interest. Sir, when will I get 2 lakh rupees? If the loan is taken on or after 1/4/1999, if the loan is taken for construction or purchase of the property, and the construction is done within 5 years. Now, please note. For self-occupied property, maximum amount of interest which you can claim as deduction is restricted to 2 lakhs. So if you have self-occupied property, 2 self-occupied property, and both combined together, you are paying an interest of 6 lakh rupees. How much can you claim? Only 2 lakh rupees is the maximum interest which you can claim as deduction. Very important is what, sir? This point. If an assessee is opting for default tax regime, sir, repeat. If an assessee is opting for default tax regime, then he will not get any deductions for interest under section 24B for self-occupied property. So if an assessee is opting for default tax regime, you remember the default tax regime or new regime which we discussed. So if you are opting for default tax regime, then you will not get the benefit of 24B interest, meaning interest if it is a self-occupied property. So what about let out property? You can claim interest deduction. No, please not. So in summary is, assessee opts for optional tax regime. For LOP and DLOP, he will get full interest amount deduction. For SOP, he will get deduction of 30,000, 2 lakh. But if the assessee is opting for default tax regime or new tax regime For SOP, he cannot claim any deduction for interest. For DLOP and LOP, full interest allowed as deduction. Full interest is allowed as deduction. Then we have a concept called as pre-construction period interest. What is pre-construction period interest? Pre-construction period means the years before the year in which construction was completed. All the years before the year in which construction was completed is called as pre-construction period. So pre-construction period is allowed, interest is allowed as reduction in 5 equal installment. This is allowed as reduction in 5 equal installment starting from the previous year in which construction was completed. From which year can I claim deduction? From the year in which construction was completed. Sir, how much deduction can I claim, sir? So the interest amount, the deduction which you can claim will be the deduction, the interest for that particular year in which the construction was completed plus pre-construction period interest share, that is 1/5. You will take that. So if it is SOP, maximum you can claim only 2 lakh rupees. For LOP, you can take full amount of interest as deduction. Concept of vacancy. What do you mean by vacancy, sir? Vacancy means empty. Vacancy means what, sir? Vacancy means the house property is not occupied, or it is available for rent, but it is not occupied by anyone. The house property is empty. Please note, unrealized rent and vacancy rent is not same. So in case of normally, what do we do? Gross annual value, we take it as actual rent or expected rent, whichever is higher. But whenever there is a concept of vacancy, when you are taking gross annual value, you will have to do one small extra change. What is that change, sir? Your gross annual value will be equal to your expected rent. Compare that expected rent with your actual rent and vacancy period rent. You should compare that with whom, sir? Actual rent plus vacancy period rent. Now see who is higher, whether expected rent is higher or actual plus vacancy is higher. If your expected rent is higher, then that expected rent will be taken as gross annual value. If your actual plus vacancy period rent is higher, then your actual rent, which is there, no, that will be taken as gross annual value. Sir, what if both are equal? Then your actual rent will be taken as gross annual value. Then, sir, what else is there? Then what if the property is partly let out and partly self-occupied? What if it is partly let out and partly self-occupied house property, sir? If it is a partly let out and partly self-occupied property, then check whether it is partly let out, partly self-occupied, area-wise or time-wise. Sir, area-wise means what, sir? Say first floor is let out, ground floor is self-occupied, or 60% of house is let out, 40% is self-occupied, etc. Any of these. And time-wise means what, sir? For 8 months it is let out, for 4 months it is self-occupied. Now in this case, when it is a partly let out partly let out and partly self-occupied area-wise, you are required to take everything. Everything means municipal value, fair rent, standard rent, municipal taxes, and interest in the proportion of let out. You will have to divide or in the proportion of how much is let out and how much is self-occupied. In our example, 60% and 40%. So compute the income from house property separately for let out portion and self-occupied portion by taking municipal value, fair rent, standard rent, etc. proportionately. Now please note, actual rent you will take only for the let out portion, and very important is interest reduction. For self-occupied portion, you can claim maximum 2 lakh rupees, and for let out portion, you can take fully. For example, I have given one example over here. Sir, what if it is let out time-wise? If it is let out time-wise, lawmakers are telling compute the income from house property as if the property was let out for the entire year. You treat that the property is let out for the entire year and do the computation of income from house property. Now, once you compute this income from house property, your actual rent should be taken only for let out period. When I say compute as if it is let out for full year, that means what, sir? Your municipal value, fair rent, municipal taxes, standard rent, interest, they should be taken for the entire year, full year, and do the computation. Actual rent will be taken only for let out period. Sir, what about co-ownership, sir? If the house property is co-owned or jointly owned, then if a single house property has more than 2 owners, that means it is co-owned property. So in case of co-owned property, each of those owners are called as co-owners. How do I do the computation? You'll have to compute the income as if there is no co-ownership. You ignore the concept of co-ownership. Whenever there is co-ownership concept, compute the income from house property as if there is no co-ownership. Once you compute, whatever final answer you are getting, that you should divide between each of the co-owner in the ratio of ownership. And here one very big advantage is each co-owner will get the limit of 30,000 rupees and 2 lakh. Each co-owner will get 30,000 and 2 lakh benefit for interest. Now please note, what if the ratio is not given, sir? Whether it is the co-ownership ratio is not given, assume it to be equal. Sir, what if I have more than two self-occupied property. If you have more than two self-occupied property, then you can take exemption only for two properties. Self-occupied benefit exemption you can take only for two properties, and other properties will be taken as deemed to be let out. So in this case, no, for example, if I have three houses which are all self-occupied by me, you will have to find the answers in three options by considering each of the property once as DLOP. For example, in first case, I'll consider house 1 and house 2 as SOP, house 3 as DLOP. In second case, house 1 and house 3 I'm considering it as SOP, and house 2 I'm considering it as DLOP. In last case, I'm considering house 1 as DLOP, house 2 and house 3 as SOP. I'll have to do the computation of income in all these three cases. Now, wherever my income is least, that is the option which I'm going to select. Yeah, these are the major topics. Yeah, one more point is there. Section 25A. 25A talks about taxability of arrears of rent and unrealized rent. If you have any arrears of rent means what, sir? Rent under dispute. Or if you have any unrealized rent, the rent which you did not receive in any past years. Now, if those rent are received, if arrears of rent and unrealized rent is received, then it is taxable in the year in which it is received. How much is taxable? The taxable amount will be whatever amount you have received into 70%. Now, please note, they are taxable in the year in which the rent of received, and it will be taxable even if you are not the owner of the property. Now, other theory points are there. Now, in case of composite rent means what, sir? You are renting the house property with other assets. If the amount of composite rent is separable, you can separately tell how much is for house property and how much is for other assets. Then whatever is for house property will be taxable under house property, and whatever is for other things which you have received is taxable under PGBP or other sources. But if you cannot separate the composite rent, then the entire rent will be taxable under business or income from other sources. Then, sir, what if the house property is held as stock in trade? What if the house property is a stock in trade for me? I am a builder. Whatever income you are getting by sale of property will be treated as business income, and whatever income you are getting by renting of the property will be treated as what, sir? Income from house property. Now, please note, if you are a builder and if you are not selling all the properties and you are keeping some properties with you only as a stock in trade, if those properties are kept for more than 2 years as stock in trade, lawmakers are telling, I'm going to assume that it is deemed to be let out property. If a self-occupied property, if a builder is keeping the house property as a stock in trade and it is not been let out during the previous year, then the NAV will be taken as nil for 2 years from the end of the financial year in which construction was completed. And after 2 years, what will happen, sir? It is deemed to be let out property. Sir, what if the property is located outside India? And what if the property is located in India? If the property is located in India, irrespective of whether you are resident, non-resident, you will have to pay tax in India. But if the property is located outside India, resident and non-resident definitely has to pay the taxes. But if you are a resident but not ordinary resident or a non-resident, you will have to pay tax in India only if the rent is received in India. Sir, what do you mean by owner? Owners are of three types: legal owner, beneficial owner, and deemed owner. Deemed owner means they have given the meaning of deemed owner under a section called as section number 27. So if I am transferring the house property, if the house property is transferred by individual to his or her spouse without consideration, free of cost, or for inadequate consideration, then the individual who has transferred the property will be deemed as owner of that property. Though the legal owner is the spouse, the individual who has transferred will be deemed as owner. Exception is there: transfer in connection with agreement to live apart. So if there, in case of divorce or in case you have an agreement to live apart, then the deemed owner concept will not come. If next point number 2 says, if you're transferring a house property, if there is a transfer of house property by individual to his minor child, to his what, sir? Minor child, without consideration or for inadequate consideration. Minor child shall not include minor married daughter. If you're transferring it without consideration or for inadequate consideration, then the individual who has transferred them will be deemed as owner. And if you are a holder of impartable estates, whoever is the holder of that estate will be deemed as owner. And in case you are a member of cooperative society, for example, apartments, etc., each and every person is the owner of the flat, correct? They will get something called as membership certificate. Now in that case, those who are having that membership certificate, those who are owning those flats, they will be deemed owner of those flats. In case of transfer of property, as per Transfer of Property Act, if you are transferring possession of an house property according to the Transfer of Property Act, then the person who is holding the possession will be deemed as owner. And if you are giving any property on long-term lease, then the lessee will be deemed as owner. Okay, so these are the points with respect to income from house property. Some extra points, that SOP benefit is there. The 2 houses you can claim SOP benefit, that is available only for individual and HUF. And municipal tax which you are paying outside India also is allowed as reduction. Now roof is not necessary for calling something as house property. It should be a building and land appertaining to that building. So even if it is a stadium or a swimming pool, you can claim the benefit of income from house property. Sir, what if a building is containing different flats? Then each and every flat will be called as single house property. And sir, what if there is a refund of municipal taxes? Refund of municipal taxes is taxable under income from other sources, not income from house property. If the house property is acquired by the person by paying amount in installment, then each and every installment you will have to pay interest also. That interest also can be claimed as deduction by you. Now, one point says, if you are renting any house property to your employee, because of which your business is running smoothly, then now whatever rent the employee is paying, no, that will be taxable under income from business or profession. Similarly, if a partner is renting a house property to the partnership firm, then it will be treated as self-occupied property for business purpose. Correct? So this is all about your income from house property. We'll start income from capital gain after a short break. I'll take a break. For you, the video will continue. Welcome back, students. Welcome back. So yeah, we have discussed our 3 topics. Which are these 3 topics, sir? Which easy topics? One is tax rates we discussed. Then we discussed residential status, agriculture income, and income from house property. Now comes the most important topic for your attempt. Which is the most important topic, sir? Income from capital gain. This topic is the topic wherein the maximum amendments have come. The entire tax structure only from this topic, if you see, is completely changed. So we'll be discussing this topic now. What is this topic called as, sir? Income from capital gain. So section 45 to section 55 are the different topics which are covered over here. Please note, we will do extensive discussion over here. We'll see questions also. We'll see what are the changes made properly. We'll see everything. Okay. Now, what is this topic telling? Income from capital gain says, if you have a capital asset and if you have transferred that capital asset, and by transferring that capital asset, if you have got any gain, if you have a capital asset and if you have transferred that capital asset, by transferring that capital asset, if you have got any gain, that gain will be taxable under the head income from capital gain. If you have a capital asset and if you transfer that capital asset, by transferring this capital asset, say for example, I had this house which I purchased for 10 lakh rupees, I sold it for 50 lakh rupees, I got a gain of 40 lakh rupees. This gain will be taxable under the head income from capital gain. Section 45 subsection 1 is the charging section, which says any profit or gain arising from transfer of a capital asset, any profit or gain arising from transfer of a capital asset shall be taxable under the head income from capital gain in the year in which transfer took place. When will it be taxable, sir? In the year when transfer took place. Now, sir, what do you mean by capital asset, sir? 2 important items. Capital asset should be there and transfer should be there. What do you mean by capital asset? Capital asset means property of any kind held by the assessee. What do you mean by capital asset? Property of any kind held by the assessee, whether connected to the business or not. Any type of property which is held by whom, sir? Assessee. Any type of property. It does not matter whether that is movable property or immovable property. It does not matter whether it is a tangible property or intangible property. Any type of property held by the assessee. Whether it is connected to his business or not connected to his business, it does not matter. It will be treated as capital asset. Sir, then everything is capital asset only. No, sir. Every kind of property, if they are telling is capital asset, then everything is capital asset only. No, sir. Is there anything which is excluded? Yes. There are few things which are excluded. What are those things, sir? Stock in trade. Stock in trade will not be regarded as capital asset. Sir, what do you mean by stock in trade? Say for example, I am a person who is dealing in sarees, correct? I am a person who is dealing in sarees. I have Priya sarees. So can I say for me sarees are stock in trade? These are not capital asset. Sir, what if you are selling a saree which has say golden or silver threading which is done, sir? Is it a capital asset for me? Answer is no. Why? Because this is a stock in trade for me. So, sir, what if you are a jewelry dealer, sir? If I am a jewelry dealer, can I say all the jewelries which I have, they will be stock in trade for me? So if I sell jewelry, what is going to come, sir? Business income is going to come. So they will not be regarded as capital asset. Okay, not okay. So stock in trade will not be regarded as capital asset. Then movable personal effects will not be regarded as capital asset. Sir, movable personal effects means what, sir? Movable personal effects means those items which are movable and which you are using for your personal purpose. Those items which are movable and which you are using for your personal purpose. For example, my t-shirt. This is a movable personal effect. This is a movable item which I am using for my personal purpose. So this is a movable personal effect. Okay, not okay. Then, sir, then what else, sir? Movable personal effect is done, sir. Sir, then what else is capital asset, sir? Once again. Okay, movable personal effects. Movable personal effects are not treated as capital asset. Sir, movable personal effects, my mobile phone is not a capital asset. See this pencil which I am using for writing purpose. This is not a capital asset. Why, sir? Because this is something which is movable and I am using it for my personal purpose. Movable personal effects are not treated as capital assets. Sir, what about my car, sir? Is this car treated as capital asset? Answer is no. Movable personal effects. Sir, what about this TV? Answer is no. Sir, what about this AC? Answer is no. What about this water bottle, sir? Answer is no. Because they are all movable items which I am using for my personal purpose. But this house, if you see, it is an immobile property. Can I call it as a capital asset? Yes, sir. This sofa which you are telling, can I call it as a capital asset? Answer is no, sir. So specs which I am wearing, the t-shirt which I am wearing, are they all capital asset? Answer is no, sir. They are not capital asset because they are movable personal effects, movable property which I am using it for my personal purpose. However, lawmaker says, see, normally movable personal effects are not capital asset. Normally, movable personal effects are not capital asset except DJ Paso BV. Sir, repeat. Normally, movable personal effects are not capital asset except DJ Paso BV. Sir, what do you mean by this? Meaning, see, normally movable personal effects are not capital asset, but however, if that movable personal effect is your DJ Paso BV, if that movable personal effect is what, sir? If that movable personal effects is your DJ Paso BV, then this DJ Paso BV will be treated as capital asset. Sir, what is this DJ Paso BV? If the movable personal effects is a drawing, jewelry, painting, archaeological collections, sculptures, shares and securities, any other work of art. Drawings are treated as capital asset. Paintings are treated as capital asset. Jewelries are treated as capital asset. Archaeological collections, sculptures, shares and securities are treated as capital asset. Any other type of artwork is also treated as capital asset. Bullion means what, sir? Your gold biscuit, silver biscuit, they are all treated as capital asset. And your virtual digital asset, cryptocurrencies, they will also be treated as capital asset. Sir, they are all movable. Please note, jewelry is movable. Though you are using it for personal purpose, the jewelry which you are using, which you are wearing is your movable personal effect, but still it will be called as capital asset. Similarly, Mona Lisa painting is there, that will be treated as capital asset. Then what else is not a capital asset, sir? Rural agricultural land. Sir, rural agricultural land means agricultural land located in rural area. Sir, what do you mean by rural area? Rural area means something which is not an urban area. Sir, what do you mean by urban area? Sir, urban area means an area whose population is 10,000 or more. So if you are staying in an area whose population is 10,000 or more than 10,000, exactly 10,000 or more than 10,000, that means you are staying in urban area. Sir, what if my area's population is more than 10,000 up to 1 lakh? Then your area to definitely is urban area because your area's population is more than 10,000. Now, from your area up to 2 kilometers area is also treated as, from your area up to 2 kilometers area is also treated as, what, sir? It is treated as urban area. Sir, what if I am staying in an area where my population, where the population is more than 1 lakh up to 10 lakhs, sir? Then of course your area is an urban area because it is more than 10,000. From your area up to 6 kilometer area is also treated as urban area. Sir, what if my area's population is more than 10 lakh? Then your area is definitely an urban area. From your area up to 8 kilometers of your area is also treated as urban area. Then gold bond, deposit certificates, etc., they are also not treated as capital asset. Then any securities which are held by foreign institutional investor. Please note, normally if you're a foreign institutional investor, for you the shares and securities which you are holding, they will normally be a stock in trade for you because you are going to deal in that. But still specifically they are mentioned, if you are a foreign institutional investor, whatever type of securities you are holding, they will always be treated as what, sir? They will always be treated as capital asset. Then ULIP, which is not exempt under section 1010D. So the ULIP means what's a unit linked insurance policies. So there are some unit linked insurance policies which are issued after 2021. These unit linked insurance policies are not exempt under section 1010D. Normally, whatever life insurance money you get at the time of retirement or upon the death of the policy holder, whatever money you get, no, that is exempt under section 1010D. But if that policy is an unit linked insurance policy, then the exemption will not be given to you. So those unit linked insurance policies for which exemption under section 1010D is not available, what are they, sir? They are treated as capital asset. They are treated as what, sir? They are treated as capital asset. Okay, sir. Sir, what do you mean by transfer? Oh, sir, what do you mean by transfer? Transfer includes sale. What do you mean by transfer, sir? Transfer includes what? One second. Transfer definition says transfer includes sale of a capital asset, then exchange of a capital asset, relinquishment, you are giving away your right, you are surrendering your right, relinquishment of capital asset, extinguishment of capital asset is destroyed, conversion of capital asset into stock in trade, compulsory acquisition of capital asset, allowing possession of immobile property, then transfer of shares in cooperative society and redemption of zero coupon bonds. They all are the different categories of transfer. If you are selling something, if you have a property and you are selling that property, that is called as sale of a capital asset. If you are exchanging, I am giving you my building, you give me 1 kg gold, that is also treated as transfer of capital asset. Relinquishment of capital asset. I have some rights on some right issue has been made by the company. I have rights. I have some rights with me. That rights I am giving away to someone else. That is relinquishment of capital asset. Extinguishment of capital asset. My capital asset is destroyed. Transfer of capital asset. Conversion of capital asset into stock in trade. So whatever jewelry I had now, that was my capital asset. Now I am starting my own jewelry business. Now I am starting my own jewelry business. So this capital asset is converted into stock in trade. That will be regarded as transfer. Compulsory acquisition of capital asset under any law. What do you mean by this, sir? Meaning, say for example, I have a property. Now the government comes and says we want to do some construction activity over here. So please, we will compulsory acquire your property. So this is called as what, sir? Compulsory acquisition of capital asset. This is also treated as transfer. Allowing possession of immobile property as per Transfer of Property Act. So there is a act called as Transfer of Property Act, wherein if you transfer the possession, you're not transferring the ownership. If you're transferring the possession, even if that possession is transferred, and if that possession of the property is transferred as per Transfer of Property Act conditions, then it will be regarded as transfer. Transfer of share in cooperative society and redemption of zero coupon bonds. Zero coupon bonds are those bonds which are issued at a discount and redeemed at par. So when you are redeeming those zero coupon bonds, it will be regarded as transfer, and accordingly capital gain tax you are required to pay. For the purpose of income tax law, for the purpose of this chapter called as capital gain, your capital assets which are there, no, capital asset, they are divided into two categories. One is called as long-term capital asset. Another one is called as short-term capital asset. Sir, what is this long-term capital asset? See, to check whether a particular capital asset is long-term or short-term, you will have to see the period of holding of that capital asset. What should you see? You will have to see the period of holding of that capital asset. If the period of holding of the capital asset is, what is period of holding? If the period of holding is the period from the date of purchase or date of acquisition till the date of transfer. From the date of purchase of that capital asset till the date of transfer of that capital asset, the period is there, no, that is called as period of holding. If the period of holding of a capital asset is more than 1 year, 2 year or 3 year, it is treated as long-term capital asset. If the period of capital asset is less than or equal to 1 year, 2 year, 3 year, it is treated as short-term capital asset. Now please note. So capital asset can be basically of two types, long-term capital asset and short-term capital asset. If you are transferring long-term capital asset, you will get something called as long-term capital gain. And if you are transferring short-term capital asset, you will get something called as short-term capital gain. So capital assets can be of two types, long-term and short-term. If you transfer long-term, it is long-term capital gain. If you transfer short-term, it is short-term capital gain. Sir, how will I come to know whether it is a long-term capital asset or short-term capital asset? You will have to see the period of holding. How long you have holded the capital asset for. Whether you have hold it for more than 1 year, 2 year, 3 year, if yes, then it is a long-term capital asset. If you hold it for a period less than 1 year, 2 year, 3 year, then it is short-term capital asset. So say for example, for what are the, sir, you said 1 year, 2 year, 3 year, no sir. For which assets it is 1 year, sir? See, please note, our institute material uses 12 months, 24 months and 36 months instead of 1 year, 2 year, 3 years. So for which assets it is 12 months or 1 year, sir? Any securities any securities which are listed in recognized stock exchange of India. So if there are any securities which are listed in recognized stock exchange of India, for them I'm going to see 1 year. Other than units, please note, units are not covered over here. Only securities should be taken. Any listed securities like listed shares are there, listed debentures are there, they should be taken, but not listed mutual funds. Okay, units of equity oriented mutual fund should be for that also it is 1 year. Then units of business trust of India also it is 1 year, and for zero coupon bonds also the period of holding which you are supposed to see is 1 year. So if you are any listed securities, units of equity oriented mutual fund, units of business trust of India, and zero coupon bonds, if these items are transferred and if they have if someone has holded this for more than 1 year, then it will be treated as long term capital gain. If they transfer and they get some gain, that is called as long term capital gain. And for immobile properties and unlisted shares, that means the shares which are not covered above, so for immobile property and for unlisted shares, the period of holding is 2 years. And any other type of capital asset apart from these two types, apart these two categories, for them all other type of capital asset, it is 3 years. What are covered, sir? Jewelry is covered, painting is covered, drawing is covered, archaeological collections are covered. All the other type of capital asset, what is the period of holding which I'm going to see? I'm going to see the period of holding of 3 years. Note, if the transfer is after 23rd July 2024, the period of holding will be what, sir? 2 years. Now, there is an amendment in capital gain chapter. The major amendment is because of two budget which happened last year. Last year means the year 2024 was a year of election. As you all know, in the year of election, what will happen, sir? In the year of election, two budgets will happen. One is before election, one budget will happen, and after election, one budget will happen. Before election, the budget which is going to come is called as what, sir? The before election budget is called as interim budget, and after election, the budget which is going to come is called as final budget. Correct? So now, when did the first budget happen? On 1st of February 2024. After that, there was one more budget which came into existence on 23rd of July 2024. So major changes have been happened in capital gain topic on this particular date. Which date? On 23rd July 2024. What is the change talking about, sir? First change which they are talking about is the period of holding. Now there is no 3 years category for checking the period of holding. So if you have holded any type of capital asset, or if it is sold on or after 23rd July 2024, then I am going to check the period of holding of 2 years. Okay, not okay? Sir, what if the transfer is made before 23rd July, sir? Then I will see 3 years category. Meaning for jewelry and all, I will see what, sir? For jewelry and all, I will see 3 years categories. So the period of holding will be what, sir? The period of holding will be 3 years. The period of holding will be 3 years. Now this 3 years category has been removed. If any transfer is made on or after 23rd July 2024, the period of holding which I am going to see is what, sir? 2 years. Now, how do I compute the capital gain? Computation of capital gain. Sir, tell me, sir, how do we compute the capital gain? For computing capital gain, what should I do, sir? Computation of capital gain. See, capital asset can be of two types, short-term capital asset and long-term capital asset. The computation mechanism is both same for both. You should take full value of consideration. You should take what? Full value of consideration, subtract expenses incidental to transfer, you will get your net sale consideration. From this net sale consideration, subtract cost of acquisition and subtract cost of improvement, you will get your gross capital gain. Then subtract exemptions under section 54 series if it is given in the question, and then you will get your taxable capital gain. The only difference in long term and short term is that in case of long term capital asset, instead of taking cost of acquisition and cost of improvement, you will take index cost of acquisition or index cost of improvement, meaning you will give the benefit of inflation. What lawmaker says is, because you are holding some asset for a longer period of time, I will give you the benefit of inflation. Sir, how will I get index cost of acquisition and index cost of improvement? You should take your cost of acquisition. So whatever cost of acquisition is there, multiply that with index for the year of transfer. Multiply it with what, sir? Index for the year of transfer. In the year in which transfer was made, what was cost of inflation index? Multiply it with that and divide it by index for the year of acquisition. And divide it by what, sir? Cost of inflation index for the year when the property was acquired. Okay, you will get your index cost of acquisition. Similarly, for getting the index cost of improvement, take your cost of improvement, multiply it with the index for the year of transfer, divide it by the index for the year when the improvement was made. Now, very important point, if the capital asset is acquired by you before 1/4/2001, if you have purchased the capital asset before 1/4/2001, then lawmakers, what they have given is, for index, the index values which they have given, the base year for that is the year 2001-2. So if any capital asset is purchased before 1/4/2001, for that index values are not there. So in such cases, what they are telling is, if any capital asset is acquired by you before 1/4/2001, you should take the cost of acquisition to be equal to the actual cost of that capital asset or the fair market value of that capital asset as on 1/4/2001, whichever is higher. What will you take? The actual cost of that capital asset or the fair market value as on 1/4/2001, whichever is higher. Now please note, there is a concept called as stamp duty value, concept of stamp duty value under section 50C. Now we'll discuss those other concept, but while discussing that concept, we'll come across this point telling, if the fair market value as on 1/4/2001 should not be more than stamp duty value as on 1/4/2001. Meaning, in case in the question, if they have given, see, if the property is acquired before 1/4/2001, and if in the question they have given along with fair market value, if they have also given the stamp duty value of that property as on 1/4/2001, then I'll compare the stamp fair market value with stamp duty value and take whichever is less first. This amount, whatever I got, I will compare with my actual cost and take whichever is higher. Normally what will I do? Normally if the property is acquired before 1/4/2001, I will take its actual cost or fair market value, whichever is higher. Normally if the property is acquired before 1/4/2001, I will take its actual cost or fair market value, whichever is higher. But as on 1/4/2001, if along with fair market value they have also given stamp duty value, I'll compare these two now. I'll compare stamp duty value with fair market value, take whichever is less. This whichever is less, I'll compare with actual cost and take whichever is higher. We'll see questions, don't worry. And any improvement done before 1/4/2001 should be completely ignored. Any improvement done before 1/4/2001 should be ignored by you completely. Now, what are the amendment which is there in this category, sir? Is there any amendment? Yes. Major amendment, most important amendment. If any capital asset, sir, what? If any capital asset is transferred, if any long-term capital asset is transferred on or after 23rd of July 2024, if any long-term capital asset is transferred on or after 23rd July 2024, the benefit of indexation will not be given. You will not get any benefit of indexation for all types of capital asset which is transferred on or after 23rd of July 2024 for computation. Oh, please note. This is for what purpose? This is for computation purpose, for computation of capital gain. Above point we wrote no, for computation. For computation of capital gain, when you are computing capital gain for long-term capital asset, you will not get what? You will not get the benefit of indexation. You will not get the benefit of indexation if the transfer is on or after 23rd of July 2024. Now here I have explained the concept of indexation, etc. That is not required. Now, what is the most important amendments? What is the most important amendment? I'll come to the most important amendment which we have. What is that, sir? With respect to tax rate. Now, instead of discussing it through what is written over here, I will write and explain you so that it will fit in your brain. Correct? That will be better. I will just write and explain you the most important amendment so that when I'm writing, you will be able to grab it even easily. See, now, normally what happens is, your capital gain which is there, no. Normally, whatever capital gain you have, that capital gain is taxable either under two sections. It can be taxable under section 112 or it can be taxable under section 111. So, if it is a long-term capital gain, then it will be taxable under section 112. And if it is a short-term capital gain, then it will be taxable under which section, sir? Under section 111. Now, we all know if it is a short-term capital gain, which is taxable under section 111, it is taxable at slab rates. What is the rate applicable? It is taxable at slab rate. So, it does not matter when the transfer is made. If it is a capital asset, if it is a capital gain, which is a short-term capital gain under section 111, then it is always taxable at slab rate. Always taxable at slab rate, irrespective of when the irrespective of what, sir? Irrespective of when the transfer is made. Always taxable at slab rate. Which? Short-term capital gain, always taxable at slab rate. Short-term capital gain under section 111 is always taxable at slab rate. Then we have long-term capital gain under section 111A. Sorry, we have long-term capital gain under section 111. Sorry, long-term capital gain under section 112. Now, what is this long-term capital under 112 telling? Now, is it an immobile property which you have transferred? What lawmaker says, is it an immobile property which you have transferred? What do you mean by immobile property? Have you transferred a capital asset which is a land or a building or both? Or have you transferred any other type of capital asset? Have you transferred what? Have you transferred immobile property or have you transferred any other type of capital asset? If you have transferred any other type of capital asset other than immobile property, I will check when have you transferred it. I will check when have you transferred it. Sir, is the transfer before 23rd of July 2024 or is the transfer on or after 23rd of July 2024? If the transfer is before 23rd of July 2024, the tax rate will be what, sir? It is taxable at 20% and you will also get the benefit of indexation. Meaning for computation of capital gain, you can take the benefit of indexation. So if the capital asset is transferred before 23rd July 2024, the tax rate which will be applicable will be 20%. And you can also take the benefit of what, sir? You can also take the benefit of indexation. Sir, but what if the capital asset is transferred on or after 23rd July? And if it is not a immobile property, sir, what is covered over here, sir? When you say it is not an immobile property, then what is covered over here? For example, jewelry is there. For example, unlisted shares are there. For example, paintings are there, etc. Okay, so if the capital asset, if it is a capital asset, if it is a long-term capital asset, taxable under section 112, then check whether it is immobile property or other. If it is others, then check when the transfer is made. If the transfer is before 23rd July 2024, tax rate will be 20% and you will also get the indexation benefit while computing the capital gain. But if the capital asset is, if the transfer is on or after 23rd July 2024, then it will be taxable at 12.5%. Then it will be taxable at 12.5% and you will not get indexation benefit. Meaning no indexation benefit will be given for you if the transfer is after, on or after 23rd July. This point to just now we studied, no, this point to just now we studied that no indexation benefit will be given. Yes, sir. Now, sir, why have you written immobile property separately, sir? Is there any other separate treatment for immobile property? Yes. So in case of immobile property, I am going to check who is transferring that immobile property. In case of immobile property, I will check the person who has transferred falls under which category. If the person who has transferred, whether he is an individual or an HUF, or is that person and any other person. Okay, I will check whether that person who is transferring is an individual or HUF or is it any other person. Now I am going to check when the transfer is made. If the transfer is made before 23rd July 24, then no problem, the tax rate will be same 20% and it will be with indexation. However, if the transfer is on or after 23rd July 24, for computation of capital gain, you cannot take indexation. For computation of capital gain, you cannot take indexation. But for computation of capital gain, you cannot take indexation. But for paying tax, you can opt either 20% with indexation or B 12.5% without indexation. You can select now whether to pay tax at 20% with indexation or 12.5% without indexation, whichever is less. At your option, you can, while computing the tax, please note, while computing the capital gain, indexation benefit will not be given to you, but while computing the tax amount, you can compute the tax at 20% with indexation benefit or 12.5% without taking indexation benefit. Sir, what if I am not an individual or an HUF? And if I transfer immobile property, then it does not make any difference. For you, the tax treatment will be same. If the transfer, if for you, the tax treatment will be same. If the transfer is before 23rd July, for you the tax rate will be 20%, and if the transfer is after 23rd July, then it will be 12.5% without indexation benefit. Okay, so if you're any other person, the treatment will be same for you. Sir, here you have told only 112 and 111. No, sir. But we have studied that capital gain is also taxable under 112A and 111A. Yes. Sir, this is only for 3 assets. Which are these 3 assets? Listed equity shares or equity oriented mutual fund and units of Business Trust of India. So only for these 3 assets, this section is available. This subsection is applicable. So now, if you have understood this, because this is one major amendment wherein, the impact will be huge. If you have understood this, now I'll go for the entire bigger chart and I'll start explaining the entire taxation system under capital gain. Please note, first thing you should understand before we go to this taxation system, first thing which you have to understand is what? The first thing which you have to understand over here is that you are not going to First thing which you have to understand is, if the transfer is made by you on or after 23rd of July 2024, you are not going to get indexation benefit. If you are making a transfer on or after 23rd July 2024, you will never get indexation benefit for computation of capital gain. Correct? Not correct? Correct, sir. Now, so type of capital gain. So here what are we doing? Discussing? Are we discussing about computation? No, here we are discussing about the tax rate for income from capital gain. So you can have either long-term capital gain or short-term capital gain. So for short-term capital gain, the transfer can be made by you before 23rd July or after 23rd July. Now I'll check what is the type of capital gain. If it is a short-term capital gain taxable under 111, always it is taxable at slab rate. If it is a short-term capital gain taxable under 111A, then the rate was 15%. However, if the transfer is made on or after 23rd July, if it is 111, of course, slab rate. And if it is 111A, the tax rate is now 20%. So in case of 111A, from 15%, it has been increased to 20%. And if the transfer is before 23rd July, you should be very careful with the dates in the question. I will take 15%. If the transfer is after 23rd July, I will take 20%. Okay, not okay. Okay, sir. Sir, what are covered under 111A and 112A, sir? Equity shares which are listed, equity oriented mutual fund and units of Business Trust of India. Now, sir, what about long-term capital gain, sir? Long-term capital gain also transfer can be made before 23rd July or on or after 23rd July. Sir, what if I make the transfer before 23rd July? Very simple. If you are making transfer before 23rd July, check whether it is 112 or 112A. If it is 112, that means 20% and you will get indexation benefit. If it is 112A, then the tax rate will be 10% for gain in excess of 1.25 lakhs. And of course, you will not get indexation benefit. Sir, but what if the transfer is made on or after 23rd July 2024? If the transfer is made on or after 23rd July 2024, for 112A, the tax rate will be 12.5% and for income in excess of 1,25,000 and no indexation benefit will be given. For 112 capital gain, for 112 long-term capital gain, the tax rate will be for other categories of for all properties, for all capital assets other than immobile property, it is 12.5% and no indexation benefit. But however, if it is an immobile property for individual or HUF, 20% with indexation, 12.5% without indexation, whichever is less, and for others it is 12.5% without any indexation benefit. So this is the entire summary of your capital gain taxation. Okay, I hope this point is very clear to you. Now, let me show you a question to make you understand. In examination, when question is asked, how should I answer? See this question now. See this question. What is important? What is important? What is the thing which you have to check while reading the question? Mr. Champak purchases a house property for 3 lakh rupees on 26th of May 1989. So that purchase was made before 1/4/2001. The following are the expenses incurred by him. He incurred a construction cost before 1/4/2001. That construction cost incurred before 1/4/2001 should be ignored. Then cost of construction of second floor he incurred on 3/4 5,30,000, and he incurred another reconstruction cost in the year 910 for 2,90,000 rupees. The fair market value of the property as on 1/4/2001 was 9,50,000. Meaning, so what will be my cost of acquisition? My cost of acquisition will be actual cost, which is 3 lakhs, or fair market value, which is 9.5 lakhs. Fair market value as on 1/4/2001, which is 9.5 lakhs, whichever is higher. So my cost of acquisition of this property will be how much, sir? 9,50,000 rupees. Now please understand this carefully. Please understand this carefully. The property is sold by Mr. Champak on December 10th, 2024. When was it sold, sir? Please note. This was an extra question which I had given to the students. Okay. This is extra question which I had given to the students in the classroom to solve. Now, what is the question telling? The question says the house property was sold by Mr. Champak on 10th of December 2024 for 85 lakh rupees. And expenses incurred incidental to transfer was 60,000 rupees. Fantastic question it is. Now please note, this is a perfect case of the amendment which we just now saw. Now please note, this person is Mr. Champak. So can I say he is an individual? So for individual, he's selling what, sir? He's selling a house property. That means, can I say he's selling an immobile property? So if an individual is selling immobile property and that sale is made after 23rd July 2024, now how do I do the treatment, sir? How do I do the computation of capital gain? As I told you, for computation of capital gain, no indexation benefit will be given. For any transfer made on or after 23rd of July, for computation of capital gain, indexation benefit will not be given. Indexation benefit will be given only for checking the tax amount. Only for checking the tax amount. Now here the question is, what is the capital gain and what is the tax liability? So how will I solve this question, sir? Now please see. So we should write the name of the SSC. So very important is, what is the date of transfer? So the date of transfer is after 23rd July 2024. That means while computation of capital gain, I should not give indexation benefit. While computation of capital gain, I should not give indexation benefit. Okay, not okay. While computation of capital gain, I should not give indexation benefit. So what is the answer, sir? What is the answer over here? So computation of capital gain. Please check only the blue part. Please check only the blue part. Okay. Please check only the blue part. Ignore this pink color whatever I have written. So Mr. Champak, particulars. What is full value of sale consideration? 85 lakh rupees. Expenses incidental to transfer is 60,000 rupees. So my net sale consideration came to 84 lakh 40,000 rupees. From that, I'm going to subtract my cost of acquisition, which is 9 lakh 50,000, and my cost of acquisition, which is whatever 9 lakh 50,000. How did you get 9 lakh 50,000? Because it was purchased before. Then I got fair market value as on 1/4/2001, or actual cost, whichever is higher I should take. So 9 lakh 50,000. Improvement made before 1/4/2001 should be ignored. And improvement of second floor I have taken as it is without indexation, and reconstruction improvement also I had taken as it is without indexation benefit. Therefore, I got total capital gain of how much, sir? 66 lakh 70,000 rupees. Please note. Can I say because the transfer was made on or after 23rd of July 2024, while computing the capital gain, I have not taken indexation benefit. I have directly taken the cost of acquisition and cost of improvement, and therefore I got a capital gain of 66 lakh 70,000 rupees. Okay, not okay? Okay, sir. So this should be your answer for capital gain. If they ask you what is the capital gain amount, this should be your answer. Now, the next question which they have asked is, what is the tax which he has to pay? Now, for paying the tax, this person has two options. Either pay tax at 20% with indexation benefit, or pay tax at 12.5% without indexation benefit. Now see, if you see over here, now whatever capital gain is there into without indexation, if I do, because the transfer was made after 23rd July, the tax rate will be 12.5% on 66 lakh 70,000, which comes to 8 lakh 33,750 rupees. But he also has an option to pay tax at what rate, sir? 20% by taking indexation benefit. So only for the purpose of tax, please note, students, only for the purpose of finding this tax, what am I doing? I am computing the capital gain again. I'm computing the capital gain again to check what would be the capital gain with indexation. So see over here in my answer, what have I written separately over here? This is like a working note for me. Capital gain with indexation. This is only for tax purpose. Only for tax purpose. Only for the purpose of computing tax. Your actual answer of capital gain is this much. This is only calculated for the purpose of tax. So 85 lakhs minus 60,000, you'll get 84 lakh 40,000 rupees. And from that, you will subtract your indexed cost of acquisition. You will subtract your index cost of improvement. You will get your capital gain. On this amount, you will apply what rate, sir? 20%. You compare both of them now. Whichever is lower is the tax which you have to pay. Okay, not okay. Whichever is lower is the tax which you have to pay. Now, in examination, you are supposed to write note also. First note will be, why have you taken 9,50,000 as cost of acquisition? So first note will be that. And note number 2 is very important note. Since the transfer was made after 23rd July 2024, capital gain is computed without taking benefit of indexation. Okay, not okay, students. I hope this point is very clear to you. Very important amendment. This is very important amendment. Okay, I have showed you how to solve it in examination. I'll show it once again for one more question which I had given physically to the students to solve. Sir, tell me. Sir, you have given extra question to students. No, sir. What will be the answer if the transfer is made on 10th of May? Meaning, what will be the answer if the transfer is before 23rd July 2024? Now, in that case, can I say the answer will be this amount only? Because if the transfer is made before 23rd July, can I say I can directly take indexation benefit? Therefore, my answer will be this. And what will be the capital gain amount? Capital gain amount will be this. I'll not take whichever is lower. I'll directly take this amount because 20% is the tax rate. Correct? Not correct? Yes, sir. Now see, one more question. See how the impact will be of this in examination. This is a beautiful question which will explain that. And please know, please see this question. You solve this question. After I explain, you can again solve this question and see this question carefully because I expect this type of question to come in examination. Mr. Dilip purchased a house on 14th of February 2004 for 10 lakh rupees. This house was sold by him for 60 lakh rupees on 15th of August 2024. So can I say it is after 23rd July? Yes, sir. Expenses incident to transfer is 2 lakh rupees. Following are the details of other incomes of Mr. Dilip. Business income I have 8 lakh rupees. Other sources income I have 4 lakh rupees. Compute the total income of Mr. Dilip and his tax liability. What is my total income and what is my tax liability? So here they have asked you what is the total income. So your main answer should be what, sir? Computation of total income. That should be your main answer. So computation of total income, they have given business income, they have given other sources income, and capital gain income I should find. So I have given working note number 1 for computation of capital gain. So if you see over here, so here working note number 1, computation of income from capital gain. I'll take my full value of sale consideration, subtract expenses incidental to transfer. I will get my net sale consideration over here. I'll get what, sir? I'll get my net sale consideration. From this net sale consideration, I'm subtracting my cost of acquisition. Please note, index cost of acquisition is only for tax purpose. So I'm subtracting my cost of acquisition. I will get my capital gain as 48 lakh rupees. So what I have done, I have added 48 lakh rupees over here. So my gross total income came to 60 lakh rupees. There is no deduction information. Therefore, my total income will be 60 lakh rupees. Now, please note, in examination, of course, they can ask you this question with deductions also, with chapter 6 deductions also. Okay. So the total income is what, sir? 60 lakh rupees. Now, what is the tax on total income? So to find the tax on total income, I should first take what, sir? I should first find the tax on special rate income. The tax on special rate income, Dilip is an individual. He has sold an immobile property. Therefore, for him, tax rate will be 12.5% without indexation, 20% without with indexation, whichever is less. So 12.5% of 48 lakhs. What is my capital gain amount? 48 lakhs into 12.5% is 6 lakh rupees. Or with indexation, what is the capital gain? So I should recompute my capital gain with indexation. Capital gain with indexation only for the purpose of tax. 60 lakhs, subtract 2 lakh, you'll get 58 lakhs, and 10 lakhs into whatever index cost you do, you'll get index cost of acquisition, and you got your capital gain, which is 24,69,725. This is only for tax purpose. So this into 20% rate, you got some answer. Take whichever is less. So what is less, sir? 4,93,000 is less. So tax on my capital gain will be 4,93,945, and tax on the balance total income will be 1,72,500 rupees. So which is with the total of which is 6,66,445. To this, I will add 10% surcharge. I'll add what, sir? 10% of this will be added by me as surcharge. I will get some amount now, 7,33,089 rupees. To this I'll add health and education cess, and I'll get my final answer, which is required to be rounded off to the nearest multiple of 10. This is how I will have to solve the question in examination. Very important. Now please note, what is the impact of this? The impact of this is now when you are computing the capital gain, you should not take indexation if the transfer is after 23rd of July. Indexation benefit should be taken only for the purpose of computing tax on capital gain, and only for whom, sir? Only for individual and HUF if they have transferred immovable property. Now let us continue and go forward. Exception to section 45(1). Section 45 subsection 1 says normally capital gain is taxable in the year in which transfer took place, correct? But however, there are some exceptions. What are those exceptions? First exception is conversion of capital asset into stock in trade, then compulsory acquisition of capital asset under any law, and insurance claim for damage and destruction of asset. For example, I have purchased a capital asset. I had purchased a capital asset 100 acre land in the previous year 2001-2 for 10 lakh rupees. Now this is converted by me. So this was a capital asset. Now I have converted this capital asset into my stock in trade. When did I convert, sir? I converted this in the previous year 17-18 when the market value of this asset was 40 lakh rupees. Now this became my stock in trade. Now please note, we all know conversion of capital asset into stock in trade is treated as transfer. Because it is a transfer, the year of transfer will be taken as 17-18. Now the stock in trade was sold by me in the year 24-25. Now what lawmaker says? Whenever you are converting a capital asset into stock in trade, I will call it as a transfer. Transfer will take place in the year when conversion happened. However, capital gain tax you will have to pay in the year in which stock in trade is sold. Capital gain tax, when will you have to pay? We'll have to pay in the year in which stock in trade is sold. So can I say in the year in which stock in trade is sold, I will have two types of income. So when was stock in trade sold? 24-25. In this year, I will have two incomes. Which are these two income? One is your capital gain income. Another one is your business income. Sir, how much will be capital gain income, sir? Your capital gain income will be, for finding capital gain, you should take full value of sale consideration, which is nothing but the fair market value of capital asset on the date of conversion. On the date of conversion, what is the market value of capital asset? You take that. Then subtract expenses, if any. You'll get net sale consideration, and subtract index cost of acquisition. Sir, why have you taken index cost of acquisition over here? Because the transfer is before. The transfer is before what, sir? 23rd July. So always indexation will be given if the transfer is before. So I took indexed cost of acquisition, and the long-term capital gain was 12,80,000 rupees. Please note, it does not matter when the stock in trade is sold. It does not matter when the stock in trade is sold. The stock in trade may be sold before 23rd July, after 23rd July. It does not matter. What matters is, for checking whether indexation will be available or not, what matters is when the capital asset was sold. The capital asset got transferred on which date, sir? In the year 17-18. Therefore, it is before 23rd July. And business income will be what? Your sale price minus market value as on the date of conversion. You will get your business income. Now, sir, what if the stock in trade, now whatever the stock in trade is, no, sir, you sold the entire stock in trade for 90 lakh rupees. What if the stock in trade is sold in installment or parts? Say, for example, I sold only 70 acre land. Only 70 acre I sold. Instead of selling entire 100 acre, I sold only 70 acre. Lawmakers, in such case, computation of capital gain will remain same, meaning the capital gain amount will remain same, but however, the taxable amount will be only that portion which is sold. So our capital gain amount will remain same, which is 12,80,000. How much was sold? 70 acres was sold. Oh, so 70 divided by 100, the taxable capital gain in the year of sale is how much, sir? 8,96,000. Sir, what about balance 30%? When it will be taxable, sir? It will be taxable when 30% land is sold. Similarly, your business income will be only, you take your sale price of that 70 acres, expenses with respect to that, cost of acquisition will be 40 lakh. Cost of acquisition will be what? 40 lakh rupees, meaning the market value of the entire asset into only 70% was sold. So I'll take 70%. So you'll get your business income. Similarly, we have one more provision called as compulsory acquisition of capital asset. So there are some questions which I have solved over here. I mean, very easy questions. You'll definitely get through these questions while reading it from the material, and definitely you can find the link of the material in the description box, and you can download and use it for your reference purpose. Now please note, this is a chapter where good amendments are there. So I mean, as I told you, you just watch this completely and watch this lecture completely, this part which we are discussing, and read it from the material completely once. Okay, only after that, if you feel that no, I need extra confidence, I need to see the entire this chapter completely, then only go decide on purchasing the classes. Okay, so you don't have to purchase anybody's class, you don't have to do anything, you just watch this. If you are understanding, very good. And if you feel no sir, I have to solve some extra questions because these questions you have not discussed over here, I just want to solve these questions sir, I'm not able to understand, I got some doubt here and there sir, then you can definitely go and purchase the class, and you can, I mean, study it again from that part. Next, section 45(5), compulsory acquisition of capital asset under any law. Now what happened over here? This was my house property. This house property was compulsory acquired by government. This was purchased by me in the year 2001-2, and I paid how much sir? 10 lakh rupees. And this house property was compulsory acquired by government in the year 1718. Government told I want to do construction of some highway over here, so I'm compulsory acquiring your property. So they compulsory acquired. On that date, the market value of this property was 70 lakh rupees, but the government decided to pay me a consideration only of 50 lakh rupees. Okay, what was the market value on that date? 70 lakhs, but they decided to pay me 50 lakh rupees. Now please note, compulsory acquisition they did on 1718. However, they paid me the money on which year sir? In the year 24-25. So lawmaker says compulsory acquisition of capital asset will be treated as transfer, and transfer will take place in the year in which compulsory acquisition happened. However, capital gain tax you will have to pay in the year in which compensation is received by you. In the year in which government is paying you compensation, that time you will have to pay capital gain tax. Okay, not okay? Now please note, now here sometimes it may happen that, see, government has given me money only of 50 lakh rupees. I can fight in the sense I can go to the court and ask for extra money. So if I ask for extra money, see, when the market value is 70 lakh rupees, if you are paying only 50 lakh rupees, that is not unfair. So I can put a case against the government on the court, and if the court decides the case in my favor, I may get some extra money. So let us say I put a case and I got some extra money. Sir, what about this extra money? Will this also be taxable? Answer is yes. See, government first paid me how much? 50 lakh rupees. I put a case and government paid me additional 15 lakh rupees. Is this also taxable, sir? Yes, this is also taxable, and it is taxable under capital gain only. So for initial compensation, which is our 50 lakh rupees, that is my first compensation or initial compensation, your full value of consideration will be 50 lakhs less expenses incidental to transferable, nothing is there, net sale consideration will be 50 lakhs. Now here I'll take index cost of acquisition. Why sir index cost of acquisition? Because compulsory acquisition happened in 1718, therefore transfer took place in which year sir? 1718. From this I'll get my long-term capital gain. Now please note, whenever you are getting extra money, enhanced compensation or additional compensation, from that extra additional compensation you can subtract only one thing, which is legal expenses. You cannot subtract anything else. You cannot subtract anything else from that additional money. You can subtract only the money which you have paid to the court, lawyer, etc. Only legal expenses can be subtracted. Okay, not okay? So compulsory acquisition of capital asset. So initial now sometimes it may happen that you may receive the money in installment, meaning this compensation which government is paying, no, they may paying in installment. For example, 50 lakh was decided to be paid to me. Now government may say I'll pay you 20 lakh rupees now and 30 lakh rupees after 2 years. So whenever I receive the first installment, that time only I will have to pay capital gain tax. If initial compensation is received in installment, whenever I receive the first installment, that time only I'll have to pay the tax. However, if additional compensation is received in installment, you will have to pay tax as and when it is received. So I have written the theory part over here. You can read it later. Now, one important point. See what has happened in our example which we took. 1718 government took the property, but it paid the money to me in 24-25. Correct? It was 1718 when the money was taken. However, 24-25 was the date when the money was given by government to me. Now, don't you think there is a huge delay? There is almost a delay of how many years, sir? 8 years delay is there. So because there is a 8 years delay, government says I will pay you interest. So if there is any delay in payment of consideration by government will pay me something called as interest. For that interest, that interest is taxable under income from other sources. So whatever interest you receive for delay in payment of consideration by government, it will be taxable under the head income from other sources. And how much will be taxable, sir? 50% of amount received. Whatever amount you are receiving into 50% only will be taxable. Only how much, sir? 50% of amount received by you will be taxable. Yeah. Only 50% of amount received will be taxable. Next, we have one more. Insurance claim on damage or destruction of capital asset, not that important from exam point of view. So if there is any capital asset which is damaged or destroyed because of any four reasons, which are four reasons? Because of natural calamities, enemy attacks, riots, or fire explosion. And if you have received insurance claim for because of the damage and destruction of your capital asset, if you have received insurance claim, now it will be taxable. It will be treated as transfer and it will be taxable. It will be taxable when, sir, see, transfer will take place in the year when damage and destruction happen, and capital gain tax you will have to pay in the year when insurance claim is received. So very simple question it is. I mean, simple topic it is. So nothing much to worry on that. Next, there is one more important concept called as section 50C. Section 50C talks about what, sir? Concept of stamp duty value. Sir, what is this concept of stamp duty value? Sir, what is this concept of stamp duty value, sir? This concept of stamp duty value, sir, see, normally, I'll directly come to the provision over here. See, concept of stamp duty value, it is applicable only for immovable property. It is applicable for whom, sir? It is applicable only for immovable property. See, normally, what is my full value of sale consideration? See, when we compute the capital gain, we take full value of sale consideration less expenses incidental to transfer. So normally, what is my full value of sale consideration? Can I say it is the sale price, the price at which I sold the immovable property or capital asset? So normally, your full value of sale consideration is the price at which the capital asset is actually sold. However, section 50 says, if the stamp duty of immovable property which you are selling is more than 110% of sale price. If what? If the stamp duty value is more than 110% of the same sale price of the capital asset, that stamp duty value will be taken as full value of sale consideration. Sir, repeat. See, normally at the price at which I am selling the capital asset, that will be taken as full value of sale consideration. However, if the stamp duty value is more than 110% of sale price into 110%, then the stamp duty value will be taken as full value of consideration. For example, I'll give one example. Say my sale price is what, sir? 20 lakh rupees. Stamp duty value is 21 lakh rupees. So what is my full value of consideration, sir? For computation of capital gain, what will I take full value of consideration? Sir, I'll take 20 lakh rupees. Why? Because, sir, stamp duty value is not more than 110% of sale price. Case number 2. Sale price is 20 lakhs. 110% of sale price is 22 lakhs. What is my stamp duty value? 23 lakhs. Is 23 lakhs more than 22 lakhs? Yes. So therefore, what is my full value of consideration? 23 lakhs. So whenever my stamp duty value is more than 110% of sale price, then that stamp duty value will be taken as full value of sale consideration. So here, second case, what is the sale price, sir? 20 into 110%. How much is it? 22 lakhs. Is stamp duty value is how much? Stamp duty value is 23 lakhs. Is 23 lakhs more than 22 lakhs? Answer is yes. Therefore, 23 lakhs, which is stamp duty value, will be taken as full value of sale consideration for computing capital gain. Sir, what if it is less? Then I will not take stamp duty value. What if it is equal? Then also I will not take stamp duty value. Only when it is more, I will take stamp duty value. Okay, stamp duty value will be taken only if your stamp duty value is more than 110% of sale price. Now, sometimes it may happen that you have genuinely sold the property for a lower price. When you have genuinely sold the property for a lower price, it is not fair on the part that you pay tax on more money. So at that time, what lawmaker says is, if you feel that the stamp duty value is too overpriced, you can always go and make a request to the assessing officer, and assessing officer will transfer your case to the valuation officer. You can make a request to assessing officer, and assessing officer will transfer the case to whom, sir? Valuation officer. Now, the valuation officer's value is more than stamp duty value. then you should of course take stamp duty value. I went to valuation officer because the stamp duty value was more. Now valuation officer is telling even more value, then what will I follow? I will follow stamp duty value. Sir, what if valuation officer's value is less than stamp duty value? Then I'll agree with whatever valuation officer is telling. When valuation officer is telling that whatever, when valuation officer is telling, blur, hello. When valuation officer is telling what, sir? When valuation officer is giving a value less than the stamp duty value, I'll of course follow valuation officer. Sir, what if the valuation officer's value is less than the sale price only, or it is equal to sale price? Then I'll follow the sale price only. I'll take sale price. Now please note, sir, which stamp duty value should I take? Should I take the stamp duty value as on the date of agreement, or should I take the stamp duty value as on the date of transfer? You should take the stamp duty value as on the date of transfer. Normally, you should take the stamp duty value as on the date of transfer. However, on the date of the agreement, if any money is paid through account pay check, account pay demand draft, or any other electronic clearing system, then the stamp duty value as on the date of agreement should be taken. If any money has been paid, then stamp duty value as on the date of agreement should be taken. Now, one more concept is there, advance money forfeited. So if you receive any advance money, for selling a particular capital asset, and if that advance money is forfeited by you, if it is kept with, say for example, you came to me to purchase my property. Okay, I told that I will sell the property for 50 lakh rupees. Now you told, okay, I'll come back in one week and I'll pay you the money. Now I told, okay, but give me some advance. You gave me an advance of 1 lakh rupees. Now after 1 month, I was waiting, 1 week I was waiting for you, you didn't come. I waited for 1 month, you didn't come. You didn't come for 3 months, 4 months, 2 years, 3 years. So what will I do with this money? I will keep it for myself. This is called as advance money forfeited. So whatever advance money is there, if you forfeit that advance money, section 51 says, I will check when was the advance money forfeited. Is the advance money forfeited before 1/4/2014, or is the advance money forfeited after 1/4/2014? If the advance money is forfeited before 1/4/2014, then you should reduce it from cost of acquisition. So whatever your cost of acquisition is there, from that cost of acquisition, subtract your advance money which is forfeited by you before 1/4/2014. Sir, what if advance money is forfeited after 1/4/2014? Then you please treat it as income under section 56(2). You please tax it as under income from other sources. Under section 56(2). Okay, in the year when forfeiture has happened. So I'll just give one example. Here there is one more important concept. What is that which I have already discussed? Please note, one important point says that the fair market value as on 1/4/2001 cannot be more than the stamp duty value as on 1/4/2001. What is this point telling? The fair market value as on 1/4/2001 should not be more than the stamp duty value as on 1/4/2001. Meaning, if your capital asset is acquired by you before 1/4/2001, then your cost of acquisition will be actual cost. Okay, that is actual cost, whatever price you purchased. Now you first compare fair market value with stamp duty value. Compare fair market value as on 1/4/2001 and stamp duty value as on 1/4/2001. Take whichever is less. Now whatever amount you have got, you compare with your actual cost and take whichever is higher. That will be your cost of acquisition. Okay, that will be your cost of acquisition if the property is acquired before 1/4/2001. Now see this question, Mr. K. I'll just check which question is a. This is a better question. Now this is a better question. I'm taking this question number 12. Mr. X purchases a house property in December 93 for 5,25,000 rupees, and amount of 1,75,000 was spent for improvement in March 1997. I should ignore this because it is before 1/4/2001. The property was proposed to be sold to Mr. Z in the month of May 2006, and an advance of 40,000 rupees was taken from him. As the entire money was not paid in time, Mr. X forfeited and subsequently sold the property to Y for 58 lakh rupees. So Z came first to purchase and he paid 40,000 advance, but he did not honor the contract, and therefore this advance money was forfeited. After that, what happened, sir? Finally, this property was sold to Mr. Y, and for how much it was sold, sir? It was sold for how much? It was sold for 58 lakh rupees. They are giving you fair market value of the property as on 1/4/2001 is 1,90,000, and stamp duty value of the property as on 1/4/2001 is 12,90,000 rupees. And the stamp duty value as on date of sale is how much? 64 lakh rupees. Now, first question is, what will be my full value of sale consideration? I should see whether stamp duty value is more than 110% of sale price. What is my sale price? 58 lakhs into 110%. What will be 110% of 58 lakhs? 63 lakh 80,000 rupees. Now, what is my stamp duty value? 64 lakh rupees. So, can I say stamp duty value is more than 63 lakhs 80,000? So, can I say stamp duty value is more than 110% of sale price? Yes, sir. Yes, sir. Yes, sir. It is correct, sir. It is more, sir. Therefore, what will be my full value of consideration? What will be my full value of consideration, sir? Sir, my full value of sale consideration will be, as per section 50C, it will be what, sir? 64 lakh rupees. So, I'll take my full value of sale consideration to be equal to what, sir? 64 lakh rupees. You please ignore this with without indexation, with the indexation category. Why have I done this with indexation, without indexation in this question? Because why have I done, sir, in this question with indexation, without indexation? Because to find the tax amount, my actual answer will be what, sir? My actual answer will be, because the transfer was made in the month of March 2025, my correct answer is what, sir? Without indexation, capital gain without indexation. So I'll take 64 lakh rupees. Then I'll take cost of acquisition. So net sale consideration is 64 lakh. My cost of acquisition will be 11 lakh 50,000 rupees. Sir, how, sir, in 11 lakh 50,000 you are getting? How you are getting 11 lakh 50,000? Are very simple. My cost of acquisition, see, I'll compare first fair market value as on 1/4/2001 with stamp duty value as on 1/4/2001. Who is less? Sir, stamp duty value is less. 11 lakh 90,000 rupees. That I'll compare with my actual cost 5,25,000 and take whichever is more. Who is more, sir? 11 lakh 90,000 rupees. Now from this I'll subtract 40,000 rupees. Sir, what is this 40,000 rupees? Why are you subtracting 40,000 rupees? This is advance money forfeited before 1/4/2001. So I'll subtract that. I'll get 11 lakh 50,000 rupees. So I'll subtract 11 lakh 50,000. My capital gain amount will be 52 lakhs 50,000 rupees. Okay, not okay? Sir, what if the transfer was made before 23rd July? Then I would have taken indexation also. Now, please note, in examination for this answer, you will not get full marks. You will have to write extra notes. What is that note? Note number 1, concept of stamp duty value has been applied. So, if the stamp duty value is more, section 50C says, if the stamp duty value is more than 110% of sale price, stamp duty value will be taken as full value of consideration. In the present case, stamp duty value is 64 lakh, sale price is 58 lakhs, 110% of sale price is 58 lakhs into 110%, 63.8 lakhs. Since stamp duty value is more, therefore stamp duty value is full value of consideration. Then, since the immobile property was purchased before 1/4/2001, my cost of acquisition will be actual cost. Compare actual cost with FMV or SDV, whichever is less, and take whichever is higher. So cost of acquisition is 11 lakh 90,000 rupees. Any improvement done before 1/4/2001 should be ignored. Advance money forfeited before 1/4/2001 should be reduced. 1/4/2014 should be reduced from cost of acquisition. These 4 notes are mandatorily required to be given by you in the question. Okay. Okay, sir. Okay. Section 47. I'll take one break. 2 seconds break I'll take. So next section is what's the section 47. Section 47 talks about what? Transactions which are not regarded as transfer. Transactions which are not treated as transfer. So where the capital asset became, so there are some transactions, okay? In these cases, even though you will see that there is capital asset moving from one person to another person, but it will not be treated as transfer. Which are those situations, sir? For example, distribution of asset upon partition of HUF. HUF is getting divided. There is an HUF having father, son, daughter, etc., etc. Now, whatever property HUF had, they are dividing between all the members of HUF. Now, though there is the property is getting transferred from HUF name to individual people's name, it will not be regarded as transfer. Similarly, if you have got any capital asset by way of gift or will, now this here there is a small change, there is a small amendment telling that the gift is available. Now if the gift is made only to an individual, then only it is covered over here. So before it was like, before 23rd July, it was like if the gift is made by any person, it is covered. But now the provision says if the gift is made only by an individual, then only it is covered over here. So if any individual is gifting any property to you, for example, I have a property, I wanted to gift that property to you. So in this case, for me, it is not a transfer. So gifting of an proper capital asset by an individual to you is not regarded as transfer. Then if you are getting any capital asset by way of succession, inheritance, etc., or there is any asset which you got because of distribution of asset upon liquidation of a company is getting liquidated and it is distributing asset, and or you have got any property under transfer of revocable or irrevocable trust. So you are transferring under a trust, and whether it is revocable or irrevocable, it does not matter. It both are covered over here. What do you mean by revocable, irrevocable? Revocable means that kind of transfer wherein you transfer the asset and you tell that I will. If I want to take back this property from you, capital asset from you on a future date, I will have all the rights. That is revocable. Irrevocable means I have given that asset to you and told I will never take it back from you. So if there is any holding company giving the assets to 100% subsidiary company, or amalgamating is giving to amalgamated company, or demerged company is giving to resultant company, etc. In all these cases, what will happen, sir? In all these cases, it is not treated as transfer. Now, if it is not treated as transfer, then how? What about capital gain, sir? Capital gain will not come. Of course, when it is not treated as transfer, only capital gain will not come. Now here, what is important is with respect to the person who is getting the asset. From his angle, if you see, then the importance will start. For example, so there is a person, one person, say Simbu gifted his capital asset. He gifted his capital asset to Nayantara. Simbu gifted his capital asset to Nayantara. Now Nayantara, please note, Simbu gifted his capital asset to whom, sir? Nayantara. Simbu gifted his capital asset to Nayantara. Can I say it is not a transfer? Why, sir? Because gifting of capital asset is not regarded as transfer. Just now we saw. Therefore, no capital gain will come in the hands of Simbu. Yes, sir. Now, what Nayantara did? Nayantara sold the same asset which Simbu gifted her. She sold this asset to whom, sir? Vignesh. She sold this asset to Vignesh. Now, can I say because there is a sale, there is yes transfer, and therefore capital gain will come in the hands of Nayantara? Now, while computing the capital gain for Nayantara, what will be the cost of acquisition is the question over here. See, the sale price is 75 lakh rupees, the price at which she has sold. Expenses are not there, no problem. Net sale consideration I got. Now, when I take cost of acquisition or index cost of acquisition, what will be that cost of acquisition? Because Nayantara to got it for free, no? Arey, Simbu gifted it to Nayantara, that means Nayantara to got it for free. So, what should be the cost of acquisition or index cost of acquisition in the hands of Nayantara? What it should be? What should be the cost of acquisition or index cost of acquisition in the hands of Nayantara? Lawmaker says for Nayantara, the cost of acquisition will be the cost to previous owner. So whatever was the cost of asset to Simbu, that will be the cost of asset for Nayantara. Similarly, what will be the period of holding, sir? The period of holding means whether it will be treated as long term or short term. How will I come to know? So lawmaker says the period of holding of previous and present owner both is required to be counted for checking whether it is a long term capital asset or short term capital asset. So period of holding of present as well as previous owner should be taken into consideration. Now, sir, what will be the cost of improvement? Should I take cost of improvement done only by Nayantara, that is the present owner, or can I take the improvement done by the previous owner also? Lawmaker says improvement done by present as well as previous owners both can be taken into consideration. Sir, what about indexation, sir? From which date will I get indexation? See, law says indexation will be available from the date when the assessee first held the property, from the date when the assessee first became the owner of this property. However, you can always take advantage of this case law called as Manjula J. Shah. Manjula J. Shah says indexation benefit will be available from the date when the capital asset was first held by previous owner. See, normally what is the law telling? See, now please note. Acquisition I'll take of the cost of acquisition of previous owner. Period of holding from previous owner I'll take. Indexation improvement I'll take from the previous owner. But when it comes to indexation, lawmaker says you can take indexation. Nayantara, if you want to take indexation, you take indexation from the date when you became the owner. From the date when you became the owner. But however, so indexation benefit will be available from the date when the capital asset was first held by the assessee. Who is the assessee in our case? Nayantara. But however, there is a case law called as Manjula J. Shah. What is Manjula J. Shah telling? Manjula J. Shah says indexation benefit shall be available from the date when the capital asset was first held by previous owner. It will be available from the date when capital asset was first held by previous owner. Okay, the benefit of fair market value. Sir, what if the property is acquired, Simbu has acquired the property before 1/4/2001? Then benefit of fair market value as on 1/4/2001 will be available. Okay, very simple, concept it is, but important from exam point of view. For example, Mr. Rakesh purchased a house property on 14th of April 1999 for 1,05,000 rupees. He entered into an agreement to sell. Now, please note here, if there is any advance money forfeited by previous owner, please understand this carefully. If there is any advance money which is forfeited by the previous owner, so if Simbu has forfeited any advance money, that should be ignored. Previous owner has forfeited any advance money, it should be ignored. Yeah, so see this question. Mr. Rakesh purchased a house property on 14th of April for 1,05,000 rupees. He entered into an agreement with Mr. B for sale of the house property on 15th of September 2002 and he received an advance of 25,000 rupees. However, Mr. B did not remit the balance amount and Mr. Rakesh forfeited the advance money. Later on, he gifted the property to his friend Mr. A. So now what is happening over here? So there is a gift of property by Rakesh to Mr. A. Following are the renovations taken by Rakesh and Mr. A. What are the renovations, sir? Rakesh took in the year 2000 and 2001, which is before 1/4/2001. So I'll ignore this. And then Rakesh did one more improvement for 50,000 rupees in 2003-04. A did in the year 2013-14 for 1,90,000 rupees. The market value of the property as on 1/4/2001 is 1,50,000 and the stamp duty value is 1,40,000. So what will be my actual cost, sir? Actual cost will be this or this, whichever is less, which is 1,40,000. That 1,40,000 should be compared with the actual cost. So my whichever is higher, I'll take. So my cost of acquisition of the property will become 1,40,000 rupees. Mr. A entered into an agreement to sell the property to C on 1st June 2022 and received an advance of 80,000 rupees. Now please see this. This advance money he has received from Mr. C, and when was this advance money received, sir? After 1/4/2014. After 1/4/2014 he has received this advance money. Okay, the said amount was forfeited by Mr. A. Since C could not fulfill the terms of the agreement. So this advance money forfeited after 1/4/2014. What will I do? Sir, this will be taxable in the year 2022 only under income from other sources. Okay. Finally, the house was sold by Mr. A to Mr. Sanjay for on 2nd of July for a consideration of 25,000 rupees. Compute the capital gain chargeable to tax in the hands of Mr. A. So what I have done in this question, I have done under both the methods, Manjula case also and what is that, 49(1) also. 49(1) says indexation benefit you will get from the date when you became the owner. Manjula says you can take indexation benefit from the date when the asset was first held by the previous owner. Okay, so I'll take full value of consideration which will remain same, net sale consideration I got. So Manjula says, see, cost of acquisition, as I told you, 1,40,000 rupees. Now Manjula says indexation benefit you can take from the date when the asset was held by previous owner. But however, 49(1) says you can take indexation benefit only from the date when the asset was first held by the assessee Mr. A. Correct? So here I am taking 100, here I am taking 122. 122 is what, sir? 122 is the index for the year 2006-07. Then you got your index cost of improvement. Similarly here also, when you take index cost of improvement, you should take it from the benefit will be given from which date, sir? If it is done before 1/4 if it is done before the property is gifted to you, then you will take it from the date when the property was gifted to you. Okay. So accordingly, we got this two separate answer. Of course, it is always better to take indexation. It is always better to follow Manjula. Correct? It is always better to follow Manjula because you are going to get indexation from a longer period of time. Now, next there is one more concept called as section 50B, slum sale. A question has been already asked about this in January 25 examination, and I don't expect any question in either May 25 examination or September 25 examination, and I don't think they'll ask a question in January 26 examination also, because these questions are asked once in 5 attempts or they ask question on slum sale, or once in 6-7 attempts they ask question on slum sale. Very easy topic it is, slum sale. Slum sale means what's a transfer of an undertaking without assigning values to individual assets and liabilities. If you are transferring entire undertaking without assigning values to individual assets and liabilities, that is called as slum sale. How do I compute the capital gain in case of slum sale, sir? Slum sale, you should take full value of consideration, which is nothing but fair market value as per Rule 11 UAE. From that subtract expenses incidental to transfer, you will get your net sale consideration. From that subtract cost of acquisition. What is cost of acquisition? Net worth of the company. You will get your capital gain. It can be long term or short term. Sir, how will I come to know whether it is long term or short term capital gain? You should see period of holding of the undertaking which is transferred by you. So whichever business you are transferring, whether that business was more than 3 year old, or it was less than or equal to 3 year. So if it is more than 3 years, then it is long term. If it is less than 3 years, then it is short term. Now this period will become what, sir? If the transfer was made after 23rd July, this period should be seen as 2 years instead of 3 years. Okay. Now, sir, you said fair market value is a rule. Sir, you said full value of sale consideration is fair market value as per Rule 11 UAE. What is this Rule 11 UAE, sir? It says you take, there will be two fair market values which will be given. One is the market value of the business which you are transferring, and market value of the consideration which you are receiving. So you should compare the fair market value of unit transferred with the fair market value of consideration received. Take whichever is higher. This will be your full value of consideration. Then, sir, you told cost of acquisition is net worth of the business. Yes, net worth means assets minus liabilities. Now, when you're taking assets, when you're taking depreciable assets, no, when you're taking depreciable assets, please take the WDV of that asset. And when you're taking other assets, please take the book value of those assets. Similarly, when you're taking liabilities, you should take the liabilities at book value. And while taking liabilities, you should not take shareholders' funds. Now, very important point. When you're transferring anything under slum sale, entire business is getting transferred, therefore stock is also getting transferred. So that stock which is transferred under slum sale, they will be taxable under capital gain only. So when you're taking your assets over here, you should take your stock in trade also. Any revaluation of asset which is has happened, you should ignore. So if any asset is revalued, upward revalued, downward revalued, you should reverse that effect. No indexation benefit will be available in case of slum sale. No indexation benefit is available. Section 35 AD, asset is transferred on slum sale. Okay, if section 35 AD, section 35 AD is a business income section which says capital expenditure incurred by you will get 100% deduction. So if you are transferring the under slum sale, if you are transferring any asset for which you have claimed deduction under section 35 AD, then the cost of acquisition of that asset should be taken as nil. And in case of intangible assets, which is like goodwill, brand name, etc., if it is self-generated, take the cost to be nil. And if it is purchased, then take the cost to be purchase price. So slum sale question is there. Now, please note this summary. See, there are some assets called as Devgans, debentures, equity shares, which is listed equity shares, virtual digital assets, global depository receipts, and non-resident who is dealing in shares for whom you are computing the capital gain in foreign currency. And in case of slum sale, in case of Devgans, normally you will never get indexation benefit. You will never get indexation benefit. So if you are transferring these assets before 23rd July or after 23rd July, it does not matter, indexation benefit will not be given to you. Now, as you all know, if the transfer is made on the above capital asset, indexation benefit will never be taken. However, for all the above, for all the other assets except immovable property, indexation benefit will be available if the transfer are made before. I think I have written for all other capital asset, indexation benefit will be available if the transfer is before 23rd July 2024. So for Devgans, it will never be allowed. It will never be allowed. For any other type of capital asset, if it is before 23rd July, indexation will be allowed. After 23rd July, indexation will not be allowed. And for immobile property, indexation will be available only for whom? It is available only for individual and HUF. Now, capital gain in case of shares. In case of shares, also computation of capital gain is very simple, same. So it is unlisted shares. You can you compute the capital gain normally, and you will get indexation benefit. But if it is a listed shares, you should compute the capital gain normally. You will not get indexation benefit. So that is the only difference. Now, if the normal shares, unlisted shares are sold after 23rd July, then indexation benefit will not be given to you. Now, what is important in these shares is, what if I get bonus shares? What if I get right shares? In such case, what should I do? So cost of acquisition for bonus shares and right shares. In case of bonus shares, you should check whether the bonus was issued to you before 1/4/2001 or after 1/4/2001. If the bonus was given to you before 1/4/2001, then the cost of acquisition of those shares will be actual cost of the shares, which is 0, or the market value as on 1/4/2001, whichever is higher. However, if the bonus share was given to you after 1st of April 2001, then the cost of acquisition will be nil. The cost of acquisition should be taken as what, sir? 0 or nil. Then we have something called as right shares. Please note, any bonus given after 1/4/2001, cost of acquisition is 0. Before 1/4/2001, actual cost or market value as on 1/4/2001, whichever is higher. Now we have something called as right shares. Right shares means what, sir? You get right to purchase the shares of a company at a lower price. When compared to the market value, you get the right to purchase the shares of a company at a lower price. So in case of right shares, what happens? Now check whether the shareholder has exercised the right or he has renounced his right. If the shareholder has exercised the right, then whatever money he is paying, right issue price, money which he is paying, that will be the cost of acquisition of those shares. Meaning, if I am exercising the right, if I am buying the those shares which are issued under right issue, then whatever amount I paid to company, that is called as right issue price, that will be taken as my cost of acquisition of those shares. Sir, what if I am not accepted the shares? Sir, what if I have renounced the right? I have given my right to someone else, I have transferred the right, sir. In that case, it will be treated as relinquishment of capital asset, and therefore whatever amount you are getting, renouncement price, that is called as, that will be your short-term capital gain. And the person who is purchasing right from you, for him cost of acquisition will be whatever money he is paying to the company and whatever renouncement price he paid to you. Now, in case of foreign see, normally this concept they'll not ask in the examination. See, in case you are a foreign, if you are a non-resident who is investing in Indian stock market, then you will there is a proviso to section 48 which says you will have to pay capital gain tax only when you will have to pay capital gain tax only when you make any profit, you make any capital gain while computing your income from in foreign currency. See, normally what happens is, whenever a foreigner is investing in Indian market, no, there will be loss or gain which he is going to incur because of fluctuation in foreign currency. Because there is increase or decrease in foreign currency, because of that reason he is going to incur loss. So what lawmakers has told, if a non-resident person will have to pay capital gain only when he makes any profit, only when he makes any capital gain, while computing the income from capital gain, only when he's making capital gain in foreign currency. You should do the computation in foreign currency, and only when he makes profit in foreign currency, then only you should convert that money into Indian rupees and pay the capital gain tax. So what will I do, sir? So please note, while taking your full value of consideration, you should take average exchange rate as on the date of transfer. While taking your expenses, you should take average exchange rate for the date of transfer. Meaning what? Please note, because that foreigner has invested in Indian market, all the dealings which he is going to do, it will be in Indian rupees only. All the dealings which he is going to do, it will be Indian rupees only. So on the date of sale, what was the foreign currency rate? You apply that and you find the sale price. On the date of purchase, what was the foreign currency rate? Accordingly, you apply that and you will get your purchase price. Okay, so you should take average exchange rate as on the date of transfer to find the sale value. You should take average exchange rate as on the date of transfer to find the expenses amount, and you should take, for finding cost of acquisition, you take average exchange rate on the date of acquisition, and therefore balance will be your capital gain. Now average exchange rate means what, sir? TT buying rate, TT selling rate divided by 2. TT means what, sir? Telegraphic transfer buying rate, telegraphic transfer selling rate divided by 2. So there is one good question which I have given over here, not that important. Section 50 CA 50D, not that important from exam point of view. Now in case of unlisted shares, normally our full value of consideration is sale price, but in case of unlisted shares, if the market value of those shares is more than your selling price, then you will take full market value as your full value of consideration. And if the full value of consideration is not determinable, then the fair market value of that capital asset which is getting transferred will be taken as full value of consideration. Then comes the last topic under capital gain, which is exemption. Section 54 says exemptions for residential house property. So if you are an individual and HUF, if you have a residential house property, if you transfer that residential house property, by transferring that residential house property, if you are getting a capital gain, and if that capital gain is a long-term capital gain, then this long-term capital gain will be exempt. This long-term capital gain which you are getting will be exempt if you acquire another one residential house property in India. Now, when should I acquire this another one residential house property in India? Within 2 years from the date of transfer, you should purchase it, or within 3 years from the date of transfer, you should construct it. And if you want to do it before, you can do it before, but within 1 year before the date of transfer. Okay, how much will be the exemption? The exemption will be the amount of capital gain, or the amount invested by you in the new property, or amount invested by you in the capital gain account scheme. So if you are not able to invest the money within the date of filing income tax return, because you have a limit of 2 years and 3 years, if you are not able to invest money in the new property, no problem, you invest the money in capital gain account scheme. You put that money in a bank account telling that I am going to use it for purchase of new property or construction of new property. So if you invest that money in capital gain account scheme also, you will get the benefit of exemption. How much is exemption, sir? Whatever capital gain amount is there, or amount invested by you, or the limit whichever is less will be allowed as exemption for you. Will be allowed as what, sir? Exemption for you. Now this limit, now please note, normally I should purchase one more house property, but what lawmaker says, if the capital gain amount is up to 2 crore rupees, instead of one, you can purchase 2 residential house properties. If your capital gain amount is up to 2 crore rupees, you can purchase 2 residential house properties instead of 1 residential house property. Now, if I want to explain this, say for example, Ravi owns a residential house property. Now, computation will not change. Only thing is, one extra point will come with respect to exemption. So, taxable capital gain amount will change. Ravi owns a residential house property which was purchased for 80,000 rupees in 1975. The market value of this property is 1,90,000 rupees, and stamp duty value is 2 lakh rupees is the market value as on 1/4/2001, and stamp duty value is 1,90,000 rupees. And this property was sold on 16th of July 2024 for 27 lakh rupees. So it is before 23rd July for 27 lakh rupees. Compute the capital gain. So what is happening over here? 27 lakhs minus expenses incidental to transfer. I'll get my net sale consideration less indexed cost of acquisition. I'll get my capital gain amount. Now they have told he compute the capital gain amount if he invest 5 lakh rupees in new house. So he has invested the 5 lakh rupees in new house. Therefore, how much ever amount, whatever his capital gain amount is there, or whatever amount he has invested, or 10 crore rupees, whichever is less, will be the amount of exemption which will be given to him. So the taxable capital gain will be 14,95,000 rupees. So from 19 lakhs, 5 lakh rupees, because he has invested, that will be exempted. Now what will happen if this property is sold, sir? What if this new property which I purchased, this new property which I have purchased, I should not sell it for a period of 3 years. There is a lock-in period of how many years, sir? 3 years. If I sell it within the 3 years, then whatever cost of acquisition I had taken, from that cost of acquisition, whatever exemption I had taken earlier, that will be subtracted. Sir, repeat. See, normally the new property which you have purchased, that should not be sold by you within a period of 3 years from the date of purchase or date of construction. If it is transferred or sold by you within 3 years from the date of purchase or construction, then whatever capital gain was exempted earlier will now be subtracted from the cost of acquisition of this property. Meaning what, sir? Now see, I purchased a new property for 5 lakh rupees. Now I sold it for 9 lakh rupees. So when I take my net sale consideration will be 9 lakh. When I take cost of acquisition, my actual cost was how much? 5 lakh rupees. Correct, not correct? This 5 lakh rupees was given to me as exemption before. Now, because I sold it within a period of 3 years, this exemption will be taken back from me, and my meaning whatever cost of acquisition is there, from that exemption amount you subtract whatever is left over, that will be my cost of acquisition. Subtract that cost of acquisition from your net sale consideration, you will get your capital gain. So that one condition is there, lock-in period condition. Now, section 54B. Section 54B talks about what's an exemption for an urban agricultural land. If you have an urban agricultural land, then it is exempt under section 54B. So if you are an individual and HUF who is having agricultural land in urban area, if you are having urban agricultural land, if you transfer that urban agricultural land, on transfer of that urban agricultural land, you get a capital gain, whether it is short term or long term, it does not matter. This capital gain will be exempt. It will be exempt. When will it be exempt, sir? It will be exempt if you purchase another agricultural land in India. If you purchase another agricultural land in India. Now, what is the lock-in period for purchasing another agricultural land? Whatever new land you have purchased, no, that should not be transferred within a period of 3 years. Please note. If you are an individual and HUF, if you have an urban agricultural land, if you transfer that urban agricultural land, by transferring that urban agricultural land, if you get a capital gain, whether long term or short term, this capital gain will be exempt if you purchase within 2 years another agricultural land. It does not matter whether it is in urban area or rural area. If you purchase another agricultural land, that will be exempt. How much exemption you will get? Whatever amount of capital gain you have, or the amount invested by you, whichever is less, will be exempt. Now, the new agricultural land which you have purchased, there is a lock-in period of 3 years. So within a period of 3 years, you should not transfer it. If you transfer it, what will happen? The whatever exemption was given to you earlier, that will be reduced from the cost of acquisition. In the sense, whatever happened in the previous case, no, section 54, same thing will happen in this case also. Now, please note, what do you mean by urban agricultural land? Urban agricultural land means the agricultural land which is located in the urban area and which is used at least for 2 years before the date of transfer. It is used for agriculture purpose. It should be used by either individual of his parents or the members of HUF should use it for agriculture purpose. Then section 54D, compulsory acquisition of what, sir? Compulsory acquisition of industrial land or building or both. So this is applicable for all type of assessee, because anybody's property can be compulsory acquired. So they say any type of assessees whose industrial land and building is compulsory acquired by government under any law, not government, any person under any law, then it will be regarded as transfer. On the transfer, whatever capital gain he is getting, whether it is short term or long term, this capital gain amount will be exempt if he purchases another industrial, agricultural land or building or both within 3 years. If he purchases another industrial land or building or both within 3 years, and this property should not be transferred within a period of 3 years. Okay, so there is a lock-in period of 3 years. Please note, for purchasing the property, how many years I have? 3 years I have, and the new property which I have, industrial land and building which I have purchased, that should be holded for minimum period of 3 years, or else whatever exemption was given to me earlier will be reduced from cost of acquisition. So what is the amount of exemption? Capital gain amount or amount invested by you, whichever is less. Section 54EC, important section. Section 54EC says what, sir? Exemption for transfer of an immobile property. So what is section 54EC telling? If you are transferring any type of immobile property, irrespective of who you are. So this section 54EC exemption is applicable to everyone, all types of assessee. If they transfer immobile property, and on transfer of immobile property, if they get any capital gain, and if it is a long-term capital gain, then that long-term capital gain will be exempt if they invest their money in government bonds. Which are the government bonds? There are 4 bonds which are given over here: NHAI bond, RECL bond, PFCL bond, IRFCL bond. So if you are any type of assessee selling or transferring an immobile property, then that capital gain which you receive, that will be exempt. If you get a long-term capital gain, it will be exempt if you invest money in government bonds. Which bonds, sir? NHAI bond, RECL bond, PFCL bond, or IRFCL bond. Now the condition is that you should invest the money in these bonds within 6 months from the date of transfer. From the date when you have transferred, within 6 months you should invest the money in these bonds. Sir, what if I invest after 6 months? Exemption will not be given. Sir, what if I invest little money before 6 months, little money after 6 months? You will get only for whatever you invested before 6 months. Sir, how much is the exemption under this section, sir? The exemption under this section is your capital gain amount, or the amount invested by you, or rupees 50 lakhs. The limit over here is 50 lakhs, whichever is less. Sir, is concept of this capital gain account scheme applicable over here? And answer is no. Now here the government bonds which you have got, there is a lock-in period of 5 years, meaning these government bonds which you have got, no, you should not sell these government bonds, or you should not convert these government bonds into money within 5 years from the date of transfer. Sir, what if I sell it or convert into money, sir? In such cases, whatever capital gain was exempted earlier will now be fully taxable. No, now here there is no concept of reducing from value. Whatever exemption I had given you earlier will now be taxable. Section 54F, one more important section. So there are three sections which are important under exemptions: 54, 54EC, 54F. 54F says you transfer any long-term capital asset and invest in residential house property. So if you are an individual or an HUF, for them only this is available. And if you are transferring any type of long-term capital asset except residential house property, because for residential house property there is already a section called as 54. So if you are an individual and HUF, if you are transferring any type of long-term capital asset except residential house property, and upon transfer of that long-term capital asset, if you are getting a long-term capital gain, then this long-term capital gain amount will be exempted if you purchase or acquire another residential house property in India. What is the time limit? The time limit is 2 years from the date of transfer for purchase, or 1 year before the date of transfer to purchase. If you want to do the construction, then within 3 years from the date of transfer, it should be constructed. Sir, how is the exemption calculated? Very important. That is very important in this case. Calculation of exemption is very important. What do they say? What do they say? Normally, we always spoke about if you are investing capital gain amount, it is exempt. But here they say if the amount invested by you is equal to or more than net sale consideration amount. What is net sale consideration? From your full value of consideration, if you subtract expenses, you will get something called as net sale consideration. So if you invest 90 lakhs or more than 90 lakh rupees, then the entire capital gain amount will be exempt. Please note. If you invest how much, sir? If you invest the net sale consideration or more than net sale consideration, your capital gain amount will be exempt. Sir, what if I invest amount less than 90 lakh rupees? Then capital gain amount will be exempt proportionately. So if the amount invested is more than or equal to net sale consideration, full capital gain amount shall be exempt. If the amount invested is less than net sale consideration, then capital gain amount will be exempted proportionately. How will I calculate that? Whatever capital gain you have into amount invested divided by net sale consideration amount. Now here also your capital gain account scheme benefit will be available. Now here there is a maximum limit of exemption. How much maximum exemption you can take, which is 10 crore rupees is a maximum exemption. And here at the time when you are purchasing this new property, when you are purchasing this new property, you should not have two properties with you, meaning you can have maximum 2 properties in total. So if you want to take the benefit of this exemption, if you have one and you are purchasing one more, then allowed. If you have 2 and purchasing one more and taking benefit under 54F, I will not give exemption. So at that time, assessee should not have more than one residential house property on the date of transfer. Now section 1037, one last section. Section 1037 says exemption for compulsory acquisition of urban agricultural land. If urban agricultural land is compulsory acquired by government, by that whatever type of capital gain you are getting is fully exempt. You don't have to invest money anywhere. Whatever capital gain you are getting on compulsory acquisition of compulsory acquisition of urban agricultural land, whether it is long term or short term capital gain, it does not matter, it is fully exempt. Okay, not okay, students. Now taxation of amalgamation, merger, demerger, they'll not ask in the examination. So let us not break our head understanding what is given over here. And let us go to the next topic, which is an important topic called as income from other sources. Here also there are 2 amendments which are very good amendments and important amendments. So let us discuss this. Hardly it will take a few minutes for us to complete this, but amendment is very important. Income from other sources. Now what is this income from other sources? So if there is any income which is not taxable under any of the 4 heads, then it will come under income from other sources. So majorly here there are 2 incomes which are most important. Which are those 2 incomes? One is taxation of gift and one is deemed dividend. Okay, these are the 2 points which are mostly important over in this chapter. Now gift taxation we will discuss first. Section 56 to 10. Section 56 to 10 says what, sir? If you receive any gift from any person, gift received by any person, I am receiving gift from any person. Okay, gift received, I am receiving gift. Okay, so gift received by any person or asset acquired by any person for inadequate consideration. I am either receiving anything for free of cost, or I am receiving something for a lower price. For a lower price, in such cases, lawmaker says it will be taxable under section 56(2)(10). Now it depends. The taxability will depend on from whom you are receiving. Are you receiving at the time of your marriage? One second. This call I'll have to take. Okay, so yeah, taxation of gift. Now, gift you are receiving at the time of your marriage, or from your relative, or upon death of some person. He's transferring, say he is dying and is giving, or inheritance, will, local authority, trust, university, hospital, no transfer case or COVID case, then it is fully exempt. If you are receiving gift at the time of your marriage from your relative, at the time somebody is dying, will or inheritance, local authority, trust, university, hospital, then it is fully exempt. You don't have to pay any cap gain tax. Sorry, any income. It is not taxable under income from other sources. However, any other type of gift which you are receiving, any other type of gift means what, sir? If it is not under following cases, someone is just like that gifting you, then it will fall under other categories. Accordingly, it will be taxable depending upon what is it. Now, sir, what do you mean by relative? For me, my relative will be who, sir? My father, mother will be my relative. My brother, sister will be my relative. My son, daughter will be my relative, and my spouse will be relative. Apart from that, my father, mother's brother, sister will be my relatives. My spouse, father, mother, and brother, sister will be my relative. And my lineal ascendant and lineal descendant will be my relative. And for HUF, the members of HUF will be treated as relative. Now, sir, let us come to the main point, sir. How do I tax in case of gift? When is it taxable? So in case of gift, no. If you are receiving money from different people, and in a year, if the total money received by you is more than 50,000 rupees per annum, in a year, if the total money received is more than 50,000 rupees, then it is fully taxable. Sir, what if you are not receiving money? What if you are receiving movable property? If you are receiving movable property, then only DJ Paso BV is covered. If you are receiving movable property, who is covered, sir? Only DJ Paso BV is covered. Sir, what is DJ Paso BV? Drawings, jewelry, painting, archaeological collections, sculptures, shares and securities, other work of art, bullion and virtual digital asset. Only these items are covered. Check whether you have received it without consideration or for inadequate consideration. Have you received it free of cost? Yes, sir. Then it will be taxable if the total items which is received by you in a year, the fair market value, aggregate fair market value is more than 50,000 rupees in a year. Aggregate fair market value is more than 50,000 rupees per annum, then it is fully taxable. If it is received for inadequate consideration, if it is received for what consideration, sir? Inadequate consideration. Then inadequate consideration means, say 1 lakh rupees item I am receiving for 20,000 rupees. That means inadequate consideration. So in this case, lawmaker says if the total aggregate difference between the market value and consideration is more than 50,000, if the difference between market value and consideration is more than 50,000, then that difference is fully taxable. Whatever difference is there. So in our case, 1 lakh and I paid 20,000 rupees. Difference is how much? 80,000 rupees. So is the difference more than 50,000? Yes, then this is fully taxable. 80,000 rupees is fully taxable. Sir, what if I receive immobile property? If you are receiving immobile property, I will check whether you have received without consideration or for inadequate consideration. If you have received the immobile property without consideration, I will see the stamp duty value. If the stamp duty value, so in case of immobile property, I should check for each and immobile property separately. So if the stamp duty value is more than 50,000 rupees of that immobile property which you have received, it is fully taxable. If the stamp duty value of that immobile property is more than 50,000 rupees, it is fully taxable. Sir, what if I have paid consideration, but it is an inadequate consideration, less amount I have paid? In that case, lawmaker says if the stamp duty, I will see the difference between stamp duty value and consideration. That difference should be more than 50,000 rupees. And one more condition I'll check. And the stamp duty value should be more than 110% of your consideration. Stamp duty value should be more than 110% of your consideration. If both conditions are satisfied, then that difference amount is fully taxable. Okay, the difference amount will be fully taxable. Now, please note the provisions of section 56(2)(10). Gift provision is applicable only when you are getting any item as gift. That item is a capital asset for you. So if you are purchasing anything for a lower value and that item which you have purchased, if it is a stock in trade for you, then this provision is not applicable. Now, this amendment of COVID is no more applicable. I mean, they'll not ask that amendment, etc. Now please note, if you are receiving money from friends, it will be taxable. Gold bracelet from sister's friend, taxable. 3 BHK house from mother's brother is relative, therefore exempt. Gold ring from ex-girlfriend, yes, taxable. Mercedes car, can I say not taxable? Why, sir? Mercedes car, 70 lakh rupees car, sir, from girlfriend, sir, not taxable. Why? Because it is not a, movable property covered under DJ Paso BV. Okay, so only DJ Paso BV is taxable. So I have, see this question over here, I have beautifully given over here, how should I present in examination? You should separately present what is the money received. From whom have you received? From friends, how much you have received? From others, how much? From, I mean, whomever you have received. From mother or from family members, if you are receiving, you should write, but amount should be 0 because it is not taxable, it is exempt, and write a note about that. Similarly, so you'll give 5 breakups of money received, movable property received without consideration, movable property received with consideration, immovable property received without consideration, immovable property received with consideration. So these 5 breakups will be given. Accordingly, you will find the values and you will get your total income from other sources. Okay. So these are different questions with respect to same concept. Now here, if you remember in our previous example, we discussed about this concept. In our previous chapter, capital gain chapter, we discussed about a concept called as section 47, no transfer case. So if we discussed about Simbu gifting something to Nayantara and Nayantara selling it to someone, correct? So let us take an example wherein Chota Bhim has gifted a capital asset to whom, sir? Chutki. On the date when it was gifted, the value of this was 50 lakh rupees. The value of this was 50 lakh rupees. Therefore, can I say, because the stamp duty value is 50 lakh rupees, now 56,210 will apply. Because the stamp duty value is more than 50,000 rupees, 56,210 will apply, and Chutki will have to pay the tax under income from other sources because she is receiving an immovable property for inadequate consideration. Correct, not correct? So lawmaker says she'll have to pay tax under income from other sources on that whatever inadequate consideration was there, or whatever free of cost she has received, she'll have to pay capital gain tax under income from other sources. Okay. Now tomorrow when she is selling this property, what we studied over there, I should take cost of previous owner. What we studied over there, we should take cost of previous owner. But now what lawmakers are telling, if Chutki has paid the tax under 56,210, if Chutki has paid the tax under 56,210 on the stamp duty value, that is at that time when she purchased this, when she got it for free, she has paid the tax. Then at the time when she is selling this to Kalia, for her cost of acquisition will be the amount on which she has paid the taxes at the time of receipt. Sir, no, I didn't get it, sir. See, normally, if you are gifting, for you it is not a transfer, therefore no capital gain. But the person who is receiving the gift, no, for him, he will have to pay tax under 56,210 as a gift. Income from other sources, he'll have to pay tax under 56,210. Now, what lawmakers are telling, Chutki while paying the tax, will see the stamp duty value. If the stamp duty value is more than 50,000 rupees, Chutki will have to pay the tax on that amount under 56,210. Now, since Chutki has paid the tax at the time of receipt of gift, tomorrow when she sells this property to someone, for her the cost of acquisition will be the stamp duty value on which she had paid the taxes. Okay. So over here 80 lakh rupees she sold it to Kalia. Normally we take the cost of acquisition as cost to previous owner, but because Chutki has paid the tax on 50 lakh rupees over here, I will take 50 lakh rupees as my cost of acquisition, and accordingly I will take income from other sources. So basically this is just 2 line, but the diagram I did. If any capital asset is received as gift or without consideration or for inadequate consideration, and the recipient has paid the tax under 56,210, the stamp duty value of such capital asset shall be taken as cost of acquisition for that capital asset in the hands of recipient. Now comes our taxation of dividend. Now, whatever type of dividend which you are receiving, okay, whatever type of dividend which you are receiving, whether you are receiving from domestic company or foreign company, the dividend is always taxable, and it is taxable in the hands of shareholders. It is taxable under which head, sir? Under income from other sources. It is taxable under which head? Income from other sources. Okay, whatever company, type of company it is, does not matter whether it is foreign company or domestic company. If they are giving you any dividend, the dividend will be taxable under the head 50 under income from other sources. always in the hands of shareholders. Now there is also a concept of deemed dividend. There is also a concept of deemed dividend, and here there is one important amendment. Before you had section 222, section 2 clause 22 subclause A, B, C, D, E. Now they have added a new section called as section 222 F. Okay, so this is some important point over here. So deemed dividend, section 2 subsection 20 section 2 clause 22 subclause A says if a domestic company is distributing any asset to its shareholders, then it will be treated as dividend in the hands of shareholders to the extent of accumulated profit which the company has, whether it is capitalized or not. If the domestic company is distributing assets to whom, sir? Its shareholders, then it will be deemed as treated as dividend in the hands of shareholder to the extent of accumulated profit, whether it is capitalized or not. Okay, so if domestic company is giving any asset to the shareholders, what is the reason of why is the domestic company giving assets to the shareholders? There is no proper reason at all, right? So they are telling, because you are giving the asset to your shareholders, I am going to treat it as deemed dividend. And how much am I going to treat it as deemed dividend, sir? To the extent of accumulated profit. Whatever accumulated profit you have, that much extent I am going to treat it as deemed dividend. Similarly, there are other deemed dividend concepts over here. Section 222B says distribution of debenture or deposit certificate. If domestic company is distributing debenture, stock or deposit certificate to any of its shareholders or bonus share to its preference shareholders, then it will be deemed as dividend in the hands of recipient to the extent of accumulated profit. 222C says if there is a liquidation of a company happening, if there is a liquidation of a company happening, a domestic company is getting liquidated. Upon liquidation, if the domestic company is giving anything to its shareholders, then it will be deemed as dividend in the hands of the shareholders to the extent of accumulated profit. Accumulated profit means what, sir? Whatever profit is shown in their books of accounts, meaning balance sheet. Then if there is any reduction in share capital, to the extent if the domestic company is reducing its share capital and distributes assets to the shareholders for reducing the capital, then it will be deemed as dividend. Similarly, if any person, if a closely held company is giving loan to any person who has more 10% or more equity shareholding or profit sharing ratio, or if any closely held company or private company is giving loan to any concern where the shareholder has a substantial interest, or if the closely held company is giving loans or advances to any person where the share for the benefit of the shareholder, then in such cases, basically, if a private limited company is giving loan either to the shareholder himself or any other company or a partnership firm or any other person for the benefit of shareholders, then it will be deemed as dividend in the hands of shareholders. Please note what type of shareholders are covered over here. Only equity shareholders holding more than 10% or 10% or more equity shareholding, or they are only covered over here. Now please note, this loan amount whatever is given to the shareholder will be deemed as dividend either to shareholders or the company or any other person which they are giving. It will be taxed in the hands of shareholder only. Please note, even if it is giving it to someone else where the shareholder is having substantial interest or for the benefit of shareholder, then it will be taxable in the hands of shareholder only to the extent of accumulated profit. And please note, all these are something which are very old provisions. What is important is something which is newly added over here. What is that newly added provision, sir? Section 222F. Hey, where did that point go? One second. Section 2 clause 22 subclause F. Yeah, this is one thing which is newly added and which is most important: taxation of buyback. Now please note, what is the amendment, sir? Most important amendment has happened over here. So this question on this topic can either be asked in May attempt or September attempt or Jan attempt, definitely, but question will be asked. Buyback of shares by the company. So buyback up to, if any company is buying back its shares, what is buyback of shares? Say for example, I am Reliance Industries, I have given my shares to the shareholders. Now I am purchasing back the shares from my shareholders, then it is covered over here. So now if the buyback is happening before 30th September Before 30th September means up to 30th September means on 30th September or anytime before 30th September, then it will be taxable in the hands of company. If the buyback is happening up to the period of 30th September 2024, then it will be taxable in the hands of company. How much amount will be taxable, sir? Your buyback price minus issue price. Whatever amount the company has bought it back, or whatever amount it has, and whatever price the company is giving for buyback, and whatever price the company sold the shares at the first place, the difference will be taken as taxable amount. Sir, repeat. If company is buying back its own shares from the shareholder, if it is buying back, then the buyback price minus the issue price of the share will be taxable in the hands of company. However, now the tax treatment has changed. If the buyback is happening anytime before, if the buyback is happening anytime before 30th September, then the buyback was always taxable in the hands of company, and in the hands of shareholders it was exempt, Now, what is the new tax treatment, sir? If the buyback is happening anytime on or after 1st of October, or after 1st of October, it will no more be taxable in the hands of company. If the buyback is happening on or after 1st of October, it will no more be taxable in the hands of company. It will be taxable in whose hands, sir? In the hands of shareholder. And it will be taxable under which head? It will be taxable under the head income from other sources. It will be taxable as what, sir? Deemed dividend. It will be taxable as deemed dividend. So whatever total money which the company is giving, total buyback price which the company is paying, which is nothing but number of shares which is bought back by the company into buyback price, the total buyback price will be deemed as dividend in the hands of shareholders and taxable in the hands of shareholders under income from other sources. Total money which the company is giving for buying back, it is taxable in the hands of shareholders under income from other sources in the year of buyback. Please note, if the buyback is happening on or after 1st of October 2024, it will be taxable in the hands of shareholders. In the hands of company, it is no tax treatment, nothing will happen. And sir, if the company is buying back, that means my shares are also going, no sir. So capital gain also will come, no sir. Yes, capital gain will come. For capital gain purpose, no, please note, because you have already paid the tax under other sources. For capital gain purpose, you take the cost of this asset to be, you take the sale value to be 0 and subtract only the cost of asset, and whatever amount you get will be a loss. Full value of sale consideration should always be taken as 0 if the buyback is happening on or after 1st of October 2024. So if the buyback is happening on or after 1st of October 2024, my full value of sale consideration which is there over here, that will always be taken as 0. Expenses will not be there. Net sale consideration will come. And my cost of acquisition I'll subtract over here. At whatever price I had purchased the shares at the first place, I'll take it, and that will be my loss. It can be long term or short term, and that will be adjusted according to set off and carry forward chapter. Sir, can you please explain this with an example, sir? Now let us say Dilip purchased shares of Priya Sarees Limited at rupees 75 per share in the year 1718. Priya Sarees bought back 400 shares at rupees 180 per share. Now please note, how many shares did I purchase? 1000 shares. But company bought back how many shares? 400 shares at rupees 180 per share on 15th of January 2025. The remaining shares were sold by me at rupees 250 per share on 20th of March. So 400 shares were bought back, 600 shares were sold by me. What is the tax treatment? Buyback of shares by the company, Priya Sarees Limited, income from other sources. Now tax treatment in the hands of whom, sir? Dilip. The tax treatment is in the hands of Dilip, correct? What is the tax treatment in the hands of Mr. Dilip, they are asking. In the hands of company, so there will be no tax treatment. Why, sir? Because the buyback is happening after 1st of October 2024. So in the hands of company, income from other sources. How much will be income from other sources? Deemed dividend will be in the hands of Dilip. Deemed dividend will be whatever buyback price is there into number of shares bought back. What is the buyback price? 180 rupees. Number of shares bought back is 400. 72,000 will be the income from other sources. And how much will be capital gain for this shares which is bought back? Sir, for this sale value will be 0. Expenses will be 0. Net sale consideration will be 0. Whatever price he purchased for. So I purchased for 75 rupees. 75 rupees into 400 shares. So total is how much? 30,000 rupees. So this 30,000 will be taken as cost of acquisition, and this will be my long-term capital loss because I purchased in 1718. Now what about the shares which you sold in the market, sir? For the shares which I sold in the market, I sold 600 shares in the market for 250 rupees. I'll take its sale price. And for this, I'll take cost of acquisition. How much, sir? 600 shares I purchased for 75, and I'll take that cost of acquisition. I'll subtract that, and I'll get what? I'll get my long-term capital gain. Therefore, my net impact is what, sir? This loss I can adjust with this gain, and my net capital gain taxable is 75,000 rupees. Please see this question carefully again. You please see this question carefully again. Okay, you'll get the point. But it is important because it is an important amendment. You can just pause and see it again, or anyways, you are having the material, you can see it from the material. Okay. Now, one last point with respect to income from other sources. Now, please note, there are some incomes which are taxable only under the head income from other sources. Which are those incomes? There are some incomes which are taxable only under the head income from other sources. Which are those income? Dividend income, your casual income, lottery, betting, gambling, crossword puzzles, gift income, share premium. If you're selling a share at a price, if you're selling private limited company shares at a price less than its fair market value, if you're receiving any interest on compensation or enhanced compensation, any advance money forfeited after 1st of April 2024, any money you're earning by owning and maintaining racehorses. These incomes will always be taxable under their capital gain, and there are some incomes which will be taxable under capital gain if they are not taxed under PGBP. Normally, these incomes are taxable under PGBP, but if you have not paid taxes under PGBP, if it is not taxable under PGBP, then it will be taxable under capital gain. Employees' contribution to PF, ESI, superannuation fund, interest on securities, income from letting out of plant machinery, or whatever composite rent you are receiving. Now, there are some income which will be taxable under income from other sources if they have not been taxed under salary or PGBP. There are only two incomes covered over here. See, normally these incomes are taxable either under salary or under PGBP, but if it is not taxed over there, it will come under other sources. So some received under Cayman insurance policy, or compensation received for termination of employment or modification of terms of employment. Now, other incomes which are taxable under income from other sources are income from subletting. I gave the property to you, you gave the property to someone else. Income from subletting, income from bank deposit, you have money in your bank account, interest the company is giving, remuneration for paper checking given by ICI, renting of vacant land, insurance commission given by the company, undisclosed income, then private tuition I'm conducting, interest on income tax refund, family pension I'm receiving, sitting fees director is receiving, or stipend director is receiving. Agricultural income I'm receiving from a land outside India. If agricultural land is in India, then it is exempt. Then royalty if you are receiving, any income of MLA, MP, MLC, etc. Family pension if you are receiving, then how much you will also get an exemption, which is 1/3 of pension, or 15,000 rupees. But if you are following default tax regime, the exemption will be 1/3 of the total pension, or 25,000 rupees per annum. If under default tax regime, so this is also an amendment. Under default tax regime, the limit will be what's at 25,000 rupees. And any award given by government, exempt, any other person is giving you the award, it is taxable. Now, please note, with respect to interest income, if you are receiving interest from because of compensation or delayed payment of compensation on compulsory acquisition of property, then whatever amount you have received, only 50% of that will be taxable. If that interest is because of post office saving bank account, then 3,500 rupees of that interest amount will be exempt. Only balance amount will be taxable. If it is a joint account, then 7,000 rupees will be exempt. Now, following interest are always exempt: PPF interest, Sukanya Samriddhi interest, gold bond interest, deposit certificate under gold monetization scheme interest, they are always exempt. What is important is PPF and Sukanya Samriddhi. Any other type of interest, whether it is fixed deposit interest, saving account interest, interest on any loan given by you, recurring deposit interest, they are all fully taxable. This is all about this fantastic chapter called as what, sir? Income from other sources. This is all about your income from other sources. Now, further, section 57 talks about deductions from income from other sources. If the income is taxable, lawmaker says the expenses will be allowed as deduction. If the income is exempt, expenditure will not be allowed as deduction. For casual income, you cannot claim any expenditure. And for dividend income, which you are earning from any mutual fund company or any unit trust of India, then only interest will be allowed as deduction. That interest is whatever actual interest you are paying, or 20% of income earned, whichever is less will be allowed as deduction. So I given one example over here. Then whatever expenses you are incurring for personal purpose, for for earning casual income, whatever expenses you have made for which you have made payment more than 10,000 rupees, whatever unreasonable payment you have made to your relative, they all will not be allowed as deduction. If you are making payment to non-resident in foreign currency, not allowed as deduction. All these things you will see again in your PGP topic. Now section 59, which is the last section of your other sources topic, which says expenses allowed earlier will be deemed to be income if it is ceased. For example, if there is any expenses for which you have claimed deduction 2-3 years back, now that person says you don't pay this money. You have already claimed the deduction while computing the income. Now that person to whom you are supposed to pay the money says you don't pay me the money now. That amount will be treated as income in this year. For example, I sold sarees to you. So can I say you have to pay the money to me? So for you, it is an expenses. Or I'll take ulta. I purchased sarees for rupees 1 lakh rupees from you. So can I say I have to make the payment to you of 1 lakh rupees? Now, I purchased this 2-3 years back. I have not yet made the payment to you. Now, if today you told me, sir, you please ignore, sir. You don't make the payment. I have already claimed the deduction in 2-3 years back when I purchased this product from you. Today you are telling you don't want the payment against this saree. Now, today, because you told that you don't want this money anymore, this expense is no more there. So this expense is no more there. Lawmaker says this expense will now be treated as income because you had claimed the deductions earlier. Now, because you are no more liable to pay this will be treated as your income. Okay. So this is all about this fantastic chapter called as income from other sources. Now, please note one more point, concept of grossing up. That also I'll just clarify this point. Now, normally what happens is this some incomes which you are receiving, you will receive net income. In the question, no, they will give you net income. For example, I purchased a lottery ticket. I won 10 lakh rupees. Now, the government deducts TDS of 30% and they'll pay the balance amount to me. So, how much money am I going to receive? I am going to receive net 7 lakh rupees. See, please note the TDS rate is 30%. Therefore, I am going to receive how much, sir? 7 lakh rupees I am going to receive. So, what is the taxable income, sir? Is it 7 lakh rupees the amount which I have received or 10 lakh rupees the amount which I have won? The answer is 10 lakh rupees the amount which you have won. So, in the question when they give you that the lottery income net of TDS is 7 lakh rupees, you should take the full income. You should not take 7 lakh rupees while computing your total income. You should take 10 lakh rupees, meaning gross income should be taken by you. How do I apply this concept of grossing up? See, 100 rupees you are supposed to receive, 30% is given as TDS by you, 70% is received. So if 70% is for 100%, for 7 lakhs, how much will it be? It will be 10 lakh rupees. So this 10 lakh rupees is required to be added while computing income from other sources. Okay, yeah. This is all about this. Now we'll take a chota sa break and discuss our next topic, which is income from salary. Till that, take care, enjoy. We'll meet you in short time. Welcome back, students. Welcome back. So let us continue our discussion. The next topic for our discussion is income from salary. Sir, what about amendments in this chapter, sir? Are there a lot of amendments in this chapter? Answer is no. So that means this chapter is same, sir. Yes. And please note, this is one of the important chapter. For your examination, one question pakka will come from salary, because salary topic they are going to test only at a normally they will test only at intermediate level. They don't test during final level. So 6 marks question for sure you are going to get from this chapter. Beautiful chapter called as income from salary, one of the most important chapter. So section 15, 16 and 17, there are only 3 sections. Section 15 talks about the charging section, 16 talks about the deductions which you have, and 17 talks about what is the meaning of salary. So shall we start the discussion? Yes, sir. Salary chapter says one of the most important thing, if you want to see in me what is the most important thing, sir, the most important thing is relationship. There should be a relationship. What type of relationship? Employer-employee relationship. There should be a relationship of master and servant, wherein one person is giving an order, other person is executing that order. Okay. So, and who should be the pay? The relation should be of payer and payee. The employer should be the person who is paying the money. He should be a payer, and the employee should be the payee of that transaction which is happening. Now please note, there should be a relationship. What type of relationship? Employer-employee relationship, and all the payment should be made in the capacity of employer. Whatever payment you are making, that payment you should make in the capacity of what, sir? You should make the payment in the capacity of employer. For example, see, there is a person who is my employee, and the same person is giving me services also, separately, independent services. Okay, now the person who is giving me, the person, say Priya Sadis is there, and this Miss Colin is there, who is an employee of Priya Sadis. So what is she doing, sir? She is selling sarees and she is getting salary. So this relationship which I have with Colin is called as employer-employee relationship. Now Colin is also a chartered accountant. She is filing my income tax return. Now please note, I am not asking any other employee of mine to file my income tax return. I am asking only Colin to do that because she is a chartered accountant. Therefore, now we have a relationship. What type of relationship? Service receiver and service provider relationship, wherein Colin is the service provider, I am the service recipient. Now whatever payment she is making now is not covered under salary. Why, sir? Because the relationship which we have is not of employer-employee. Only when there is an employer-employee relationship, and if the payment is made because of that relationship in the capacity of employer, then it will be covered under salary. Now there can be principal agent relationship, which is not again taxable under salary. Here commission income will come, which will go under other sources. If you are employer-employee relationship, salary will come into picture. Now there are different points which you should keep in mind. If you are a sole proprietorship concern, then whatever sole proprietorship concern is giving, the salary which is given by sole proprietorship concern to the proprietor, that salary will not be taxable. Why, sir? Because the owner and the employer as well as the employee is same. So the owner and the person who is paying the money and the person who is receiving the money is same. So lawmaker says the sole proprietor cannot take salary from his own establishment. He should be interested in the profits of the company. He should not be interested in what? He should not be interested in the he should not be interested in the he should be interested in the profit of the company. He should not be interested in the salary which he is receiving on monthly basis. Then in case of partnership firm, whatever salary the partnership firm is paying to the partners, that salary will be taxable under the head PGBP. Now, section 28 is the charging section of PGBP, which says whatever salary is paid by partnership firm to the partners will be taxable under the head profits and gain from business and profession. It is not taxable under the head income from salary. Similarly, company has directors of the company. Now, company has directors of the company. The director can be employee director or non-employee director. So, whatever salary is given by by the company to the employee director will be taxable under salary, and whatever amount is paid by the company to the non-employee director will be called as sitting fees, and that sitting fees will be taxable under income from other sources. Similarly, MLA, MC, MP, etc., they are not receiving salary. They are not government employees. MLA, member of parliament, etc., they are not government employees. Therefore, whatever they receive is not a salary. Therefore, it is not taxable under income from salary. It will be taxable under income from other sources. Now, please note, these are additional points. They may not have huge impact on whatever topic we are going to discuss, but if by chance they ask a question on MCQ, so I have covered this point. Now, similarly, judge of Supreme Court, High Court, though he is a government employee, whatever amount the judge is receiving is not taxable under the head salary. These are the different clarifications which was given by the law. Correct? Now, there is something called as contract of service and contract for service. Sir, what is the difference between this, sir? What is contract of service? Contract of service means an employment contract. Contract of service means what, sir? An employment contract. There will be employer-employee relationship over here. And contract for service means what, sir? I am entering into a contract to give a services to you. For example, I am a teacher, you are the students. So I am entering into a contract for giving the services to you. That is contract for services. It is a professional contract. Contract of service is an employment contract. Contract for service is a professional contract. Now, CA Dilip, 2 arrow marks. CA Dilip, 2 arrow marks. He is an employee of Infosys. So here it is employment contract. I am a chartered accountant in practice. I give services to different companies, Infosys, Adani, Reliance, etc. Now, in this case, I am entering into a contract for giving services to these different companies. So when I am acting as an employee of Infosys, I will be entering into a contract called as contract of service. Now, salary, section 15 says salary is taxable under due basis or written basis, whichever is earlier. Section 15 says, what's the charging section? Salary is taxable under due basis or on receipt basis, whichever is earlier. On the date when you are receiving it or when it becomes due to you, whichever is earlier, it will be taxable. Now, salary can be in cash or it can be in kind also. Sometimes the company will give you washing machine, refrigerator, or sometimes the company will give you shares, and sometimes the company will give you house to stay. So salary can be in cash or it can be in kind also. Now, so this is the basic format for computation of salary. What is the format telling, sir? Format says you will have basic pay. These are the different components of salary. So you will have basic pay, dearness allowances, bonus, commission, advance salary, arrears of salary. Then you will have lot of retirement benefits such as gratuity, pension, leave salary, retrenchment compensation, VRS compensation, allowances, provident fund, superannuation fund, and 80 pension fund. And you will have what, sir? Perquisites. All this combined together will give you your gross salary. From the gross salary, you are required to subtract deductions, standard deduction, entertainment allowance, and professional tax. Now what you are going to get is called as your taxable salary or net salary or income from salary. Okay, so this is your taxable salary. Now let us understand each and every component. Once we understand each and every component, this topic is over. So first component is what's our basic salary. Basic pay is your base salary. That is the base salary. So apart from that, you will get extra amounts like dearness allowances, etc. This is something which you are definitely going to get. So basic pay is your base salary. It is a taxable component of salary. Sir, is the basic salary, if they are giving me basic pay, is it taxable, sir? While computing, should I include in my computation? Answer is yes. It is a taxable component of salary. And how much is taxable? It is fully taxable. So if the company is giving a basic pay, so for example, some company says the CT is 50,000 rupees per month, that will have basic pay, dearness allowance, HRA, provident fund, telephone allowance, etc. All this combined together will give you what, sir? This basic pay of 50,000, the CTC of 50,000. Now here the base salary is how much? 20,000 rupees. Is it taxable? Yes, it is a taxable component of salary. Now, always in question, you should be very careful with what, sir? Always when you are doing any question, you should be very careful with respect to what is the date of joining of the company? When did you join the company? What is the date of resignation? What is the date of retirement? What is the date of retirement? Yeah, resignation, date of joining, retirement, and resignation is very important, because salary is required to be computed from the date of joining till the date of resigning or date of retirement if it is happening in the same year. Now, sometimes in question, no, they will give you grade pay or grade scale pay. Sir, what is this grade pay or grade scale pay? For example, they may give you salary as 20,000-2,000-30,000. What does this mean? This means that at the time when you are joining the company, your salary will be 20,000, and for every year, when there is an increase in salary, they will give you how much, sir? For every year you complete in the company, they will increase the salary by 2,000 rupees. At the time when you are joining your company, what is the salary, sir? The salary is 20,000 rupees, and for every year you complete in service, how much extra you will get? You will get extra 2,000 rupees, and this will be till which limit, sir? This will be till the salary reaches 30,000 rupees. Okay, for example, one example will take Mr. Dilip has joined Priya Sarees on 7th of July 2021 with a grade pay of 20,000, 2,500, 25,000, 5,000 and 50,000 rupees. Compute the salary for the previous year 24-25. So what does this question? What is this question telling? When I joined the company, my salary was 20,000 rupees. For every year I complete. So when will I complete 1 year? From 1st July till 30th of June 2022, I will complete 1 year. So once I complete from 1st of July 2022, my salary will be what, sir? 22,500. Similarly, I will complete another year, my salary will become 25,000. Once it reaches 25,000, then the increment will increase by 5,000 rupees. Then the increment will increase by how much, sir? 5,000 rupees. Compute the salary of Mr. Dilip for the previous year 24-25. So they are asking you what is the salary for 24-25. So the salary for 24-25 is nothing but this period. We have done the computation over here. You can do the computation yourself. So we have done the computation over here. So for every year there will be an increment by 2,500 till the salary reaches 25,000. Once it reaches 25,000, the increment will be by 5,000 rupees. Then dearness allowance. Next component of salary is what, sir? Dearness allowances. The dearness allowance which is there, that is also a taxable component of salary. And how much is taxable, sir? It is fully taxable. So if the company is paying you dearness allowances, so what will you do? You will take your basic pay, you will take your DA also. Whatever DA they are giving, DA can be divided into DA in terms or not in terms. That entire amount of dearness allowance, which is given by the company, whether it is in terms or not in terms, full amount will be taxable. So dearness allowances, what is dearness allowances, sir, by the way? So dearness allowances is given to meet the cost of inflation. To meet the cost of inflation at a particular place, they will give you dearness allowances. So it is a taxable component of salary. And how much is taxable? It is fully taxable. Now DA can be in terms or it can be not in terms. If it is a DA in terms, then that means it is a dearness allowances which is forming part of retirement. If it is DA not in terms, that means it is dearness allowance not forming part of retirement or salary. So DA can be in terms or not in terms. If it is a DA in terms, it means it is a dearness allowance forming part of retirement. If it is DA not in terms, it means dearness allowance is not forming part of the retirement or salary. Now please note, sometimes DA will be given in percentage format. They'll tell DA is 10% or DA is 50%, DA is 30%. It is 30% of what? So whenever DA is given in percentage format, you should always make sure that you should take it as a percentage of your basic pay. You should take it as what, sir? A percentage of the basic pay. Now, many times it may happen that the question is silent about DA, whether the DA is in terms or not in terms. If the question is silent about the DA, whether it is in terms or not in terms, then assume that that DA is not in terms, and accordingly write a note about this assumption. So if the question is silent, they are telling the dearness allowance is 5,000 rupees. Now what should I assume, whether it is in terms or not in terms? You should make an assumption that this dearness allowance which they have given in the question is not in terms, and also write a note that it is assumed that DA is not in terms. Now bonus. Bonus is also what, sir? Bonus is a taxable component of salary, and it is fully taxable. But the beauty of the bonus is normally salary is taxable on due basis or on receipt basis, whichever is earlier. But the beauty of this bonus is what, sir? The beauty of bonus is that the bonus is taxable on receipt basis. The bonus is taxable on what basis, sir? The bonus is taxable on receipt basis. See, bonus is a taxable component of salary and it is fully taxable. Bonus is taxable on what basis, sir? Bonus is taxable on receipt basis. Now bonus can be contractual bonus or it can be voluntary bonus. So it can be written in the agreement that I'll give bonus to you, or it can be voluntary given by the company. Now you should check in the question whether they have given bonus paid. If they have given bonus paid, that means it is paid. Therefore, add it while computing, include it while computing your salary. If they are given only bonus, nothing else is given, bonus paid or not paid, etc., nothing is given, then also please include it. Because if they have given bonus, that means they would have paid it. But when the question says bonus declared, be very careful. The question is telling that the bonus is declared. Now be very careful, because they have not told you whether it is paid or not paid. So now you cannot make an assumption telling yes, it is paid, therefore I will include in salary. Answer is no. Okay, so now if it is bonus declared, then please ignore it. Don't include in your salary. Then similarly, company may pay you something called as commission or fees. So commission or fees, it is a taxable component of salary and it is fully taxable. How much is taxable, sir? It is fully taxable. And it is taxable. A component of where is this? Yeah, commission can be profit based commission, turnover based commission, product based commission. It does not matter. If the question is silent, no, you should not make an assumption that it is turnover commission. So whenever question is there, you should just see the question what type of commission it is. If it is given as a percentage of turnover, then it is a turnover commission. If they are just telling that commission will be 15,000 rupees per month, now we don't know whether it is turnover commission or not. So you should not make an assumption that it is a turnover commission, because normally what happens, that commission which the company is paying will be based on the turnover. If nothing is given in the question, lawmaker says please don't make your own assumption. Unless until it is specifically mentioned, don't assume anything. Then advance salary. Please note, all these extra checkpoints which I have written, that is not there in the law. These checkpoints I have I have considered all these checkpoints only after seeing so many questions. What is the adjustment which they have done in the question when they have given bonus paid? What is the adjustment when they have done in the question when they have given only dearness allowance and not mentioned whether is it in terms or not in terms? Therefore, that is how this all checkpoints, extra points which I am writing over has come. Next is advance salary. Advance salary means what, sir? Salary received in advance. Advance salary in simple words is what? Whatever salary you are receiving in advance. Now, advance salary is also a taxable component of salary. And it is how much, sir? Fully taxable. Fully taxable. It is fully taxable. However, advance salary is taxable on receipt basis. Receipt basis. If you are receiving, it will be taxable. Advance against salary is a loan. Please note, there is advance salary and there is advance against salary. So, advance against salary is a loan. Advance against salary is what, sir? It is a loan. Therefore, it should not include it. Please note. Advance salary means I am receiving salary in advance. Advance against salary. So against your salary, company is giving you an advance. That is a loan. So that is not written as salary. So advance against salary is not a advance against salary is a loan. Therefore, should not be included in computation of salary. Arrears of salary. What do you mean by arrears of salary? Arrears of salary means any past increment which is paid to me now. Past period salary which was not paid at that time because of some dispute, now it is getting paid. So any increment in the salary with a retrospective effect which is not taxed in earlier years is called as arrears of salary. This will be taxable on receipt basis on the year when you receive, and it will be a taxable component of salary. And how much will be taxable, sir? It will be fully taxable. Okay. Now let us enter into the main discussion. Now let us enter into what's our main discussion. Let us talk about the first type of retirement benefit which you can get. You can get something called as gratuity. Sir, what is this gratuity, sir? A gratuity means you would have seen people telling, no, I am very, you should show gratitude towards someone. You should show gratitude towards your teacher. What do you mean by this? Meaning a teacher who is teaching you, he's putting some efforts in his life. Therefore, you please be thankful to him. Gratitude is nothing but gratitude is nothing but being thankful. So gratuity is paid because the company wants to say thank you to you. You have spent almost 25 years, 30 years of your life working in this company. Because you have paid, stayed almost for 25 years in this company, 30 years in this company, the company wants to say you thank you. So how will they say you thank you, sir? By giving a money called as gratuity. So gratuity can be received by you when you are in employment, or it can be received by you when you are retiring from the company, or it can be received by the legal heirs if the employee has passed away or died. So if the gratuity is received during the time of employment, then it is taxable. How much is taxable? Fully taxable. Whether you are a government employee or non-government employee, it does not matter. If the gratuity is received at the time of employment, then it is taxable. How much is taxable, sir? It is fully taxable, irrespective of whether you are a government employee or not. But if the gratuity is received if the gratuity is received by the legal heirs upon death of the employee, now because the employee is no more there, legal heirs are receiving, in their hands it will be exempt. In the hands of legal heirs it will be exempt. Sir, what if I receive the gratuity when I am still working, sir, in the course of employment? Then it will be fully taxable, irrespective of who you are. Whether you are a government employee or non-government employee, I don't care, it will be taxable in your hands. Sir, what if the gratuity is received at the time of the retirement of the employee? If the gratuity is received at the time of retirement of the employee, no, then lawmaker says that gratuity is exempt under section 1010A. What am I talking about? I am talking about gratuity which is received at the time of retirement. So gratuity received at the time of retirement, check who is receiving it. Is it received by a government employee or is it received by a non-government employee? If it is received by a government employee, then it is fully exempt. If the gratuity is received at the time of retirement by a government employee, it is fully exempt under section 1010. If the gratuity is received by a non-government employee, if who is receiving the gratuity? If the gratuity is received by non-government employee, then I will check whether you are an employee who is covered under POGA. What is POGA? Payment of Gratuity Act. Or you are an employee who is not covered under Payment of Gratuity Act. So if you are a person who is receiving the gratuity at the time of retirement, if you are a non-government employee, I will check whether you are covered under POGA or not covered under POGA. So if you are covered under POGA, if you are covered under Payment of Gratuity Act, then how much will be exempt, sir? If you are covered under POGA, then the amount of exemption which you are going to get will be 15/26 into salary per month into completed years of service. Compare that with actual amount of gratuity received by you. Compare that with statutory limit of 20 lakh rupees. Whichever is less will be exempt. Sir. Repeat. I'll take what, sir? I'll take 15/26. I'll take how much? I'll take 15/26 into salary per month into completed years of service. Sir, this is a formula. Okay, this is the formula. Or I'll take actual gratuity received or the limit of 20 lakh rupees, whichever is less, will be the amount of exemption which you are going to get if you are an employee who is covered under Payment of Gratuity Act. Sir, what if I am not covered under Payment of Gratuity Act and I am still receiving gratuity? Then for you the exemption amount will be half of average salary per month. You will take half of what, sir? Average salary per month into completed years of service. Half of average salary per month into completed years of service, or actual amount received, or statutory limit of rupees 20 lakhs. You will take half of average salary per month into completed years of service. Please note, here you take 15 by 26 and here you take half. Here you take salary per month and here you take average salary per month. Sir, what is the difference? So or you'll take actual amount received or limit of 20 lakh rupees, whichever is less. Sir, what is the difference between 15 salary per month and average salary per month? When you are taking salary per month, no, you should take last drawn salary. Meaning in the month which you are retiring, before that whichever month was there, what is the salary for that month? You should take last drawn salary, last drawn salary. When you are taking the salary, you should take only basic pay and dearness allowances. You should take only what, sir? Basic pay plus dearness allowances. We just now saw in sometimes back that there can be different components of salary. It can be basic pay, DA, then other allowances, retirement benefits, all those different types of components are there. Now, what are we taking when computing the salary per month for calculation of the exemption for a POGA employee? What will I take? Basic pay plus dearness allowances, whether it is in terms or not in terms. Okay, we'll take this. This will give me salary per month. Sir, what do you mean by average salary per month? Average salary per month means I will take average of last 10 months. I'll take average salary for last 10 months. I'll take average salary for last 10 months. Now here what will I take, sir? I'll take basic pay plus DA in terms plus turnover commission. I'll take what, sir? Basic pay plus DA in terms I will take and turnover commission. The total of this is called as what, sir? Average salary per month. Now this average salary per month is nothing but last 10 month ka average I should take. Meaning I should take salary for last 10 months divided by 10. I'll get average salary for last 10 months. When I'm taking salary, what should I include? Basic pay I should include. I should include dearness allowances in terms and turnover commission. Please note there is a difference. For salary per month, I will take DA whether it is in terms or not in terms, but here I will take only dearness allowances in terms. So this is a little confusing, no sir? No, it is not confusing. It will be confusing to you only if you have not studied and watching the marathon. So this is a topic, this is the video which you should watch only after studying. And of course, I mean, in the classroom, if you have attended the class, then you will be, I mean, you don't have to see this at all. You will directly skip this part because you know what is the provision talking about. Now, sir, sometimes it may happen that there may be a fraction in completed years of service. You told 15 by 26 salary per month into completed years of service. So completed years of service means what, sir? How many years you have completed working in this company? Say you have completed working for 26 years 3 months. So now what will I take, sir? Will I take 26 months or will I take 27 months? So lawmaker says if there is any fraction in completed years of services for POGA employee, if there is any fraction in completed years of services and the fraction is more than 6 months, and if the fraction is more than 6 months, consider it to be a full year. If there is a fraction in completed years of service and if the fraction is more than 6 months, you treat it to be what, sir? One full year. For example, if it is 26 years 9 months, take it as 27 years. 26 years 4 months, it is less than 6 months. Therefore 26 years and 6 months exactly, sir, that is also not more than 6 months. So I'll take 26 years. What if the fraction has what if you are a non-POGA employee and there is a fraction, sir? Lawmaker says the fraction should be completely ignored. In case of non-POGA employee, I don't care whether the fraction is more than 6 months, less than 6 months, equal to 6 months. The fraction should be completely ignored. So how many years you have completed, that only should be taken. Now please note number 1. For calculating salary per month and average salary per month, the month of retirement should be ignored. The month in which you have retired, no, that month should be ignored. Now the limit of 20 lakh rupees is applicable for an individual as an employee throughout his lifetime. Meaning every time when you are calculating, for example, throughout my lifetime, I have joined 3 companies. And from all the 3 companies, I have received gratuity. So will I take 20 lakhs each time when I am computing gratuity exemption? Answer is no. Lawmaker says 20 lakh limit is for a single person for his lifetime. So if I have worked in 3 companies, say for example, first company I took the exemption of 5 lakhs. So now what is left over? 15 lakhs is left over. So when I'm calculating gratuity of the second company, I should take the limit as what? 15 lakhs. Now I have left the second company only also and I got a gratuity of 8 lakh rupees from them. Now how much is left over? Now only 7 lakh rupees is left over. So from the third company, when I'm taking the limit over here, I will take what? 7 lakhs. So this 20 lakh limit which is there, it is throughout your lifetime. Now let us take a question. This is your institute material question. Mr. Ravi retired on 15th June 2024 after completing 26 years 8 months of service and received a gratuity of 1,50,000 rupees. So they have given basic pay, they have given dearness allowances, and they have given 60% forms part of retirement. Now you understand why this DA forming part of retirement is important, because in case you are a non-POGA employee, I'll take only DA forming part of retirement, that is DA in terms. In case you are a POGA employee, I'll take whether DA is in terms or not in terms. Mr. Ravi retired on 15 June 24, etc. So salary base, dearness allowance, commission they have given. Now they have given 1% of turnover. That means what type of commission it is? Turnover commission. And they have given bonus. Calculate the taxable gratuity assuming he is a private employee covered under POGA, private employee not covered under POGA, and he is a government employee. So in all these different cases, you are required to find what? You are required to find the taxable amount of gratuity. So how will I compute? So our main answer will be computation of taxable gratuity. Mr. Ravi previous year 24-25, assessment year 25-26, particulars. So if he is a POGA employee, if he is a non-POGA employee, if he is a government employee. So all these three categories I have written separately. So I will first take amount received. I will take first what, sir? Amount received. From this I'll subtract what, sir? Exemption which you have got. So what is the amount exempt, sir? If you want to know that, you'll have to do calculation. Can I say for government employee, whatever amount you are receiving, it is fully exempt? We studied over here, no? If you are a government employee, then it is exempt under section 1010. How much is exempt? Fully exempt. If you are a non-government employee, only I will see POGA, non-POGA. Correct, not correct? So if I am a non-government employee and I am covered under Payment of Gratuity Act, then what will be the exemption which will be available, sir? 15/26 into salary per month into completed years of services. So 15/26 into salary per month is 50 plus 60. 50 plus 10 is 60,000 into 27 years. Or actual amount received, or 20 lakh rupees, whichever is less. Similarly, if you are a non-POGA employee, then half of average salary per month into completed years of service. Half of what, sir? 66,000 into completed years of service. How many years you have completed? 26. Sir, but here you have taken 27. No, sir. It is more than. If for POGA, if it is more than 6 months, I will take next period. No. Correct, not correct. And for non-POGA, I will ignore the fraction amount. So I have ignored the fraction amount and computed the salary for non-POGA. And for POGA, I have taken fraction because it is more than 6 months. So whatever exempt amount is there, you add, you take into consideration over here, you will get your taxable salary. So similarly, there are different questions. You can just, go through. You would have solved these questions. If not, then you can solve this question. Pension. Next is what, sir? Pension. Pension means what, sir? Pension is a money which is given by the company at the time of retirement. Now, pension can be of two types. It can be uncomputed pension. Uncomputed pension means the pension which you are receiving on monthly basis after retirement, or it can be a commuted pension. Commuted pension means what, sir? The pension which you are receiving in one lump sum. So now, the pension which you are receiving on monthly basis after retirement, whatever pension you receive on monthly basis, it is always taxable. Whether you are a government employee or non-government employee, does not matter. The pension which you are receiving on monthly basis is always taxable. But commuted pension means the pension which you are receiving in one lump sum, that is exempt under section 1010A. Sir, once again repeat, sir. Whatever pension you receive after your retirement on monthly basis, that is called as uncommuted pension. That pension will always be taxable. Whether you are a government employee or non-government employee, does not matter. But if you are receiving any pension which is an commuted pension, if you are receiving any lump sum pension, and that lump sum pension will be exempt under section 1010A. How much it will be exempt, sir? If you are a government employee, it will be fully exempt. And if you are a non-government employee, the exemption will depend on whether you are a person who is covered under, who is also receiving gratuity, or who is not receiving gratuity. Meaning, at the time of retirement, are you only receiving pension, or you are also receiving gratuity? If you are a person who is also receiving gratuity, then 1/3 of total pension will be exempt for you. If you are a person who is a non-government employee and who is not receiving gratuity, then whatever pension you have received, half of that will be fully exempt. So this is with respect to pension. Sir, can we do one question, sir? Yes. Say Mr. Sagar, who retired from his job on 1st of October 2024, receives 5,000 rupees per month as pension. Meaning what, sir? So he retired on 1st of October. From 1st of October, how much he will receive? 5,000 rupees he will receive every month. On 1st of February 2025, he commuted 60% of pension. So now he was receiving 5,000 rupees every month. 60% of this pension he commuted. So what happened, sir? By commuting, how much he received, sir? 3 lakh rupees he received. Now please note, he was receiving 100%, 60% he commuted. Now how much is left over? 40%. So going forward, how much is he going to receive? He is going to receive only 40%. So 5,000 rupees was received by him on monthly basis. From 1st of February, he will receive only 40% of this, which is 5 fours are 2,000 rupees. He will receive only how much, sir? 2,000 rupees. You are required to compute his taxable pension, assuming he is a government employee, he is a private sector employee receiving a gratuity of 5 lakh rupees, he is a private sector employee not receiving gratuity. Okay, so the simple point over here is, if he is a government employee, can I say it is fully exempt? Only monthly pension will be taxable, which is 5,000 into till February, October, November, December, January. For 4 months, you will receive 5,000 plus 2,000 you will receive for how many months? 2 months, February and March, 2 months. So how much is there, sir? 20 plus 4, 24,000. Sir, 1 second. How did you get 2,000 rupees? Are 5,000 I was receiving on monthly basis? No. Correct? No. Now I commuted how much? 60%. So what is left over? 40%. So how much will I receive now? 40% of 5,000, which is 2,000 rupees. Correct? Not correct. Now the commuted pension which I have received is 3 lakh rupees. Now if I ask you, I commuted 60% of my pension and I received how much? 3 lakh rupees. So tell me, what is the total pension which I was, total pension amount? Sir, it will be 5 lakh rupees. Hey, how did you get 5 lakh rupees? Sir, 3 lakh divided by 60% is 5 lakh rupees. You okay, not okay? So if you are a government employee, that commuted pension is fully exempt. If you are a person who is also receiving gratuity, then 1/3 of the pension will be exempt. 1/3 of 5 lakh rupees, because total pension is how much? 5 lakh rupees. If a non-government employee, half of total pension will be exempt. So commuted pension 24, 24, 24. That calculation I showed you. Uncommuted pension for government employee fully exempt. 3 lakh rupees you are receiving, 3 lakh is fully exempt. For non-government employees, 3 lakh you are receiving, 1/3 of the total pension is exempt. Total pension is 5 lakh rupees into 1/3. And for non-gratuity cases, half of total pension will be exempt, and therefore you found the taxable amount. Next is leave salary. Leave salary means what, sir? The company is going to pay you money even when you take leave. See, normally what company follows is, in a month you can take 1 day leave, 2 days leave, meaning that is paid leaves. In a month you can take 2 days leave. Even if you take leave, no company is not going to cut your salary. So that is called as paid leave. Now, if you don't take leave at all throughout the year, that means every month you are supposed to get, every month the company where I am working, they say that every month you can take leave for 2 days. Even if you take leave for 2 days, I will give you salary for that. So what have I done, sir? I have not taken leave at all during the entire year. So can I say 24 days, 12 into 2 days per month. So 24 days I could have taken the leave, but I have not taken. Now lawmakers are telling, the company is telling, now please note, because you are not taken the leave, you are a very nice employee, I want to reward you. So that company will give me something called as leave salary. For that leave, the company is going to pay me money now. That is called as leave salary or leave encashment. Whatever leave is there, I am now encashing that leave. Now this leave encashment will be taxable. How it is taxable, how much is taxable, we'll see that now. Now for example, the company says you will get, in a month you will get 2 days leaves. In 12 months, how much leaves I will get? 24 days leaves I will get. So 24 days leaves is allowed to me. That is the leave, total leave which I can take. Assuming I have taken leave for 4 days. So can I say for 20 days the leave is still available with me? It is a leave balance available, or leave available unutilized leave, or it can also be called as leave credit. Correct, not correct? This 4 days the leave which I have taken, that will be called as leave taken or leave availed by me or leave utilized by me. Can I write down this in a formula? Sir, how will you write, sir? Can I write it as leave credit? leave credit is equal to leave allowed minus leave taken. Meaning, what is the leave available with you? If you want to see that, can I say I will subtract from whatever leave the company is giving me, I'll subtract whatever I have taken. Leave allowed minus leave taken is leave credit. Now, leave salary means what, sir? Leave salary means encashment of leave credit. Leave salary means what, sir? Encashment of leave credit as per income tax law. Leave allowed is 1 month for every completed years of service. So, please note, leave allowed is how much, sir? 1 month for every completed years of service. Some companies may tell you that in a year I will give you 2 months leave. 2 months leave you can take. Okay, but income tax law says, as per me, it is only 1 month. In a year, how much leave can a company can give, sir? 1 month leave. In a completed year, how much leave company can give? 1 month. Who is telling? Income tax law is telling. So if the question says no, we have a policy of giving 4 months leave in a year, then whatever computation whatever computation is there, I will have to make it as per income tax perspective. Leave salary means encashment of leave credit. As per income tax law, leave allowed is 1 month for every completed years of service. Now let us see the taxability. Now leave salary, when are you receiving it? It is received during the employment or it is received at the time of retirement. If it is received during employment, it is fully taxable irrespective of whether you are a government employee or non-government employee. If you are receiving the leave salary at the time of your during your employment, it is fully taxable. But if you are receiving the leave salary at the time of your retirement, if it is received at the time of your retirement, then it will be exempt under section 1010 AA. It will be exempt under which section? 1010 AA. Please note, if you are receiving when you are working, when you are still in the company, lawmaker says it is taxable then. But if you are receiving at the time of retirement, because it is a retirement benefit, it will be exempt. If you are a government employee, it is fully exempt. If you are a non-government employee, then the exemption will be whatever leave credit is available into average salary per month, 10 months into average salary per month, and actual amount received or limit of 25 lakh rupees. Now here there is a limit of how much, sir? 25 lakh rupees. So first I'll take leave credit which is there with me. What is the unutilized leave which I have multiplied by my average salary per month. Similarly, I'll take 10 months average salary, 10 month into average salary per month, and I'll take actual amount received and 25 lakh rupees, take whichever is less. Sir, what do you mean by average salary over here? Average salary over here is basic plus DA interns plus turnover commission. And this salary should be, last 10 months should be taken till the date of retirement. Now leave credit which is there, no, it should be calculated as per income tax law, meaning by taking 1 month leave. And month of retirement should also be considered over here. Fraction in a completed year of service should be ignored. If there is any fraction, you should please ignore it. Now, for example, we'll see this question. Mr. Gupta retired on 1st of December 2024 after completing 20 years and he received a leave salary of 5 lakh rupees. Oh, 5 lakh rupees he received less leave salary. Basic pay is 5,000 rupees. This 5,000 is at the time of retirement. Please note, reading question is very important. This 5,000 rupees salary which they have given is at the time of retirement and the salary was increased by 1,000 rupees with effect from 1st of April. So at the time of retirement, he is receiving how much? 5,000 rupees. So before 1st of April, the salary is how much? The salary was 4,000 rupees. Dearness allowance is 3,000 rupees per month and 60% of dearness allowance is forming part of retirement. Commission is 500 rupees per month. Now the question is silent what type of commission it is. So what assumption should you make? It is just normal commission. You should not assume that it is turnover commission. Because here you take what, sir? Turnover commission. Correct. Here you take turnover commission. Unless until they mention in the question that it is turnover commission, you should not take it as turnover commission. And bonus they have given 1,000 per month. Leave availed by him is 480 days. Leave entitled is 30 days in a year. So in a year he can take 30 days leave. So 20 years he worked. 30 days leave is allowed by the company. So how many days leave he can take? 600 days. So leave allowed is how much, sir? Leave allowed is 600 days. And leave taken by him is how much? Leave taken by him is 480 days. The difference is called as leave credit. Or I can also call it as unutilized leave. This is the leave which I could have utilized, but I have not utilized. How much, sir? 120 days. For government employee, it is fully exempt under section 1010A. Okay, how much is leave allowed? We have just seen. For government employee, case number 1, it is fully exempt. For non-government employee, we should see the average salary per month, which is basic plus DA in terms plus turnover commission. This I should take for last 10 months. Correct? I should take say 5,000 into 8 months, 4,000 into 2 months. I'll get 48,000, 3,000 into 10 months into 60% and turnover commission. I'll get last 10 months salary as 66,000 rupees. Average salary per month is how much? 66,000 divided by 10, which is 6,600 rupees. Leave credit, which is exempt. How much is the leave credit exempt? Leave credit is equal to average salary per month. I mean, this formula, whatever formula is there, you take this and take whichever is less. So leave salary exempt is 26,400. Taxable leave salary will be 5 lakhs minus 26,400 for 4,73,600 rupees. I have given additional questions which you can definitely try and do it. So 2 extra questions I have given. Next is retrenchment compensation. Very small, easy. Maybe this MCQ question may come from this point. Retrenchment compensation and VRS compensation. Normally MCQ question will come because they are very simple. Retrenchment compensation is exempt under section 1010B. Now please note, there is something called as retrenchment compensation and then there is something called as VRS compensation. Now VRS means what's a voluntary retirement scheme. When you yourself tell the company, I want to leave the job before my actual retirement. Say normally the retirement age is 60. Now my age is 54. I am telling the company that I want to leave the job. That is called as voluntary retirement. But normally the age is 60. My age is right now 56. Now the company is telling Dilip, you please leave the job. No, Dilip, your efficiency has decreased. Now you please leave the job. That is called as retrenchment compensation. When the company is only throwing me out, it is retrenchment. When I myself I am leaving, that is called as retirement. Retrenchment compensation is exempt under section 1010B. How much is exempt? 15 by 26 into average salary per month into completed years of service, actual amount received or limit of 5 lakh rupees, whichever is less. Now when you are taking average salary per month, you should take last 3 month ka average salary. So which is basic plus DA in terms plus turnover commission. Fraction in completed years of service should be ignored. Whatever fraction you have, that should be completely ignored. Then VRS compensation or voluntary retirement scheme compensation. Exemption is available under section 1010C. What is the amount of exemption available, sir? Salary per month into 3 months into completed years of service. Salary per month into remaining months in service. Actual amount received or 5 lakh rupees. So this is for VRS compensation, exempt under section 1010C. Salary per month 3 months into completed years of service or salary per month into remaining, how many months are remaining. Please note, I should take it in months. How many months are remaining in service or actual amount received or statutory limit. For example, Mr. Datta received a retirement compensation of 7 lakh rupees, voluntary retirement compensation of 7 lakh rupees after completing 30 years, 4 months in service. He still has 6 years of service left over. At the time of voluntary retirement, he was drawing a basic salary of 20,000 rupees and dearness allowance of 5,000 rupees. Compute his taxable salary. What is the taxable salary? So I have received 7 lakh rupees. My exemption will be 5 lakh rupees. Taxable will be 2 lakh rupees. Sir, how did you get this 5 lakh rupees, sir? The computation is going over here. Salary per month into 3 months into completed years of service. Salary per month into remaining months in service. Actual amount received and limit. If you compare this, this is the least point. Whichever is less will be exempt. Next comes what, sir? Allowances. Allowances are divided into next which we have is what? Next we have is allowances. Allowances. What is allowances, sir? See, what happens is many times the company may either give you a house to stay. If the company is giving a house to stay, that is called as perquisites. But if the company is giving you money, so that you can buy a house of your own, that is called as perquisites. If the company is giving you money so that you can buy the house of your own, then it is called as what, sir? Perquisites. So allowances. Allowances are monetary benefit given by the company to meet a particular type of expenses. So it can be to meet any expenses, say for paying your uniform. Say for example, they have given the company has given this t-shirt to us, perquisites, or the company would have given us the money telling Dilip, you go purchase the t-shirt which you want. That is allowances. Okay. Now, so allowances, taxability of allowances. Now, please note, there is something called as commutation allowance, also called as transport allowance. Transport allowance is a fully taxable allowance, but exemption will be given only to handicapped employees, blind, deaf, handicapped employees. They will get exemption of how much, sir? 3,200 per month. Children hostel allowance. Children hostel allowance is exempt. How much is exempt, sir? 3,000 rupees per month per child is exempt. Similarly, children education allowance, the 100 rupees per month per child is exempt. And you can claim hostel allowance and education allowance maximum for how many children? 2 children. Now please note, sometimes it may happen is the limit over here is 100. The company has given me only 70. How much will be exempt? Whichever is less. 70 rupees will be exempt. The limit over here is 100. The company has given me 250 rupees. How much will be exempt? Whichever is less, which is 100 rupees. So the exemption will be the amount which is given over here, which is listed down over here, or what, sir? The amount which is listed over here, or the amount which is listed over here, or whatever is given, whichever is less. And this hostel allowance and education allowance you can take for maximum how many children? 2 children. And please note, even though you don't have a children, you can take the benefit of this exemption. If the company is giving you children hostel allowance, or the company is giving you children education allowance, you can always take the benefit of that even if you don't have children. Tribal area allowance maximum 200 rupees per month is exempt. Allowances for transport employee are also called as truck driver allowance. Truck driver allowance, actual amount into 70% or 10,000 rupees per month, whichever is less, is exempt. Underground allowance 800 rupees per month is exempt. Underground allowance. Now there are some exempts. There are some allowances like daily allowance, uniform allowance, conveyance allowance, helper allowance, academy allowance, travel allowance. These allowances are exempt based on the amount which you are spending. They are exempt based on what is actually spent by you. Daily allowance, uniform allowance, daily allowance, uniform allowance, conveyance allowance, helper allowance. What is daily allowances? For your day-to-day expenses, tea, coffee expenses. Uniform allowances for the uniform. Conveyance allowances is for local transportation within the state. And helper allowances, sir, for you need a helper for your office work, etc. For that, they'll give money. Academic allowance means you want to study something in your life, you take the money. Traveling allowances means you are going to some other states for business purpose, then it is traveling allowances. These are all exempt only if you are spending the money. For example, company has given me 10,000 rupees, you have spent 8,000 rupees. How much will be exempt? 8,000 rupees will be exempt. House rent allowance. Next is what, sir? House rent allowance. House rent allowance, important allowance. This house rent allowance, please note, we saw 2 types of allowance. One is cheat you, another one is duck hat. That duck hat is exempt based on how much you are spending, and cheat you is exempt based on the limit. That is 300, 100, etc. based on the limit. Next, apart from that, we have what, sir? House rent allowance, HRA. HRA is exempt under section 10, 13A. HRA is exempt under which section? 10, 13A. How much is exempt? 40% or 50% of your salary. Actual amount of HRA received or rent paid minus 10% of your salary. So repeat. HRA is exempt. How much is exempt? 40% of your salary or 50% of your salary, or actual amount of HRA received by you, or rent paid minus 10% of salary. Sir, what should I take? 40% of salary or 50% of salary? You should take 40% of salary normally, but 50% of salary will be taken by you if the employment is in metro cities. If you are staying in which location, sir? If you are staying in metro cities, your residence is in metro cities. What are metro cities? Delhi, Mumbai, Chennai and Kolkata. But sir, I stay in a city where I have a metro, sir. My city is not covered over here. Yeah. So it is only for 4 cities, which is Delhi, Mumbai, Chennai, Kolkata. If you are staying in these locations, for you it will be 50% of salary, or else it will be 40% of salary. Salary for HRA is what, sir? Salary for HRA is basic plus DA in terms plus turnover commission, meaning that 40% of salary, 10% of salary when you are taking, what is salary over here? Basic plus DA in terms plus turnover commission. Sir, I understood this point, sir. What if I receive any other allowances other than you cheat, duck, hat, HRA? If I receive any other thing, that type of allowances is fully taxable. Those allowances are what, sir? Fully taxable. Hey, shall we go? This first question is to, okay, let us see this question. Mr. Shrikant has 2 sons. He is in receipt of children education allowance, 150 rupees for elder son, 70 rupees for younger son. So for elder son, how much will be exempt? 100 rupees. For younger son, how much will be exempt? 70 rupees. Whatever you are receiving, or limit whichever is less. Both the sons are going to school. He receives transport allowances and tribal area allowance. Tribal area allowance 200 rupees will be exempt. So children education allowance, child 1, child 2, 150 minus 100 into 12 is taxable. 70 minus 70 into 12 is taxable. Transport allowance fully taxable. Tribal area allowance 200 rupees exemption you will get. Okay, just like this we have different questions. We'll jump into which question, sir? We'll jump into HRA. We'll jump into questions of HRA. Say for example, this question says Mr. X is a resident of Ajmer. He receives 48,000 as basic salary during the previous year. In addition, he gets 4,800 as dearness allowances forming part of basic pay, 7% turnover commission, turnover is 86,000 and 6,000 is for house rent allowance. And how much house rent is actually paying? 5,800 rupees. HRA exempt under section 1013A is what, sir? 40% of salary. Why? Because he's staying in Ajmer, not a metro city, meaning it is not Mumbai, Chennai, Kolkata or Delhi. Therefore, it is 40% of salary. Actual HRA received or rent paid minus 10% of salary. Now, what is salary for this purpose? Basic plus DA in terms plus turnover commission. What is the total of this? This is the amount. So, this into 40% or 6,000 rupees which you are receiving, or 5,800 is the rent which you are paying, minus 10% of this. Sir, the last amount comes negative. No, sir. So, how much is exempt? Whichever is less, which is negative amount. Sir, negative cannot be exempt. Therefore, whenever there is a negative amount, you should take it as 0. Sir, can you discuss one more question because negative amount came in this? Yes. Say this: Mr. Rajkumar has the following receipts from his employer: basic salary, dearness allowance, commission they have given, motor car for personal use, house rent allowance. Find out the HRA exempt in the hands of Rajkumar. He has paid a rent of 16,000 and is staying in Kanpur. So Kanpur again is a non-metro city, and DA which they have given is forming part of retirement. So 40% of salary or HRA or actual HRA received or rent paid minus 10% of salary. So that is what is going over here. That is the formula which you have to use. What is salary for HRA? Basic plus DA in terms plus turnover commission. Basic they have given, DA in terms I will take only, DA in terms I will take, and turnover commission because it is not there. But sir, they have given commission of 50,000 per annum. No sir, but we don't know whether it is turnover commission or not. So you are not going to make an assumption, wrong assumption, correct? So HRA exempt is 11,400. HRA exempt per annum is 11,400 into 12. So this is the amount of answer. Now, next comes what's the provident fund. I'll take a break for 2 minutes. Provident fund. What is provident fund telling, sir? Provident fund can be of two types: employee provident fund, also called as EPF, or public provident fund. Public provident fund is not covered in this chapter. We are going to cover what's an employee provident fund. Employee provident fund in this topic is divided into 3 categories. One is called as statutory provident fund, then recognized provident fund, and unrecognized provident fund. SPF statutory provident fund, RPF recognized provident fund, and URPF unrecognized provident fund. Statutory provident fund. What is the statutory provident fund, sir? Normally about SPF they will not ask a question in examination. Sir, what is the reason, sir? Why are you saying it like this? Because let us say there is a fund. Let us name this fund as what, sir? SPF. Now employee is contributing money in this fund. You should ignore employee's contribution because he is going to contribute money from his own salary. Or he has already paid the tax on salary. Whatever contribution is made by the employer in the fund is exempt. Now they are going to receive interest on their contribution, correct? Now please note, this fund is for the benefit of whom? Whatever money is there, who will get that money? Employee will get that money, correct? Employee will get that money. So whatever employee is contributing, whatever employer is contributing on that amount, this fund is going to give them interest on employer's contribution also and employee's contribution also. That is also exempt. And if you withdraw this at the time of your retirement, then whatever lump sum amount you get, that is also exempt. Array, SPF, your contribution is exempt, interest earned by you is exempt, lump sum withdrawn by you is exempt. So why will they ask this question in examination? Everything is exempt only. No, they'll ask something where you have to use your brain. Correct, not correct? In examination, what will they ask? They will ask you to use your brain. That is your recognized provident fund. RPF, recognized provident fund. What is this point telling, sir? Recognized provident fund says employees contribution you ignore, because whatever contribution employee is making is from the salary which is earning, he'll contribute. I am already taking tax from the employee on his salary, therefore I will not take tax on this contribution which is making to recognized provident fund. So whatever contribution is made in recognized provident fund by the employee should be ignored, and for his contribution he can claim a deduction under section 80C, chapter 6 deduction 80C, he can claim the deduction. Whatever contribution is made by the employer, whatever contribution is made by whom, sir? Employer, his contribution is exempt if his contribution is up to 12% of salary. Meaning you take basic plus DA in terms plus turnover commission. If employer ka contribution is up to 12% of these three combined together, if employer's contribution is up to 12% of these three combined together, then it will be exempt. Sir, if it is more than 12%, sir, then whatever extra amount is there, that will be taxable. So if employer is contributing 15%, then how much exemption will be there, sir? 12%, 3% will be taxable. Please note, when you are taking the percentage, it should be on salary. What is salary for this purpose? Basic plus DA in terms plus turnover commission. Now you are going to earn some interest. You are going to earn some interest on what, sir? You are going to earn some interest on your own contribution. So interest on employees contribution will be exempt. How much will be exempt, sir? Up to 9.5% per annum. Whatever contribution employee has made, no, on that this fund is going to give him interest. How much of the interest is exempt? Up to 9.5% per annum is exempt. Similarly, whatever contribution is made by the employer, this fund is going to give interest for that also. This interest is also exempt up to how much, sir? 9.5% per annum. That is exempt. Now, please note, you have contributed money, ignore that. Employer contribution, exempt up to 12% of salary. Interest on your contribution and interest on your employer's contribution, exempt up to 9.5% per annum. Now comes, sir, the money is there in this dabba. In this fund, what are the different money? Your money, employer's money, interest on your money, interest on employer's money. Now this entire thing you are going to withdraw. This entire thing, lump sum amount, if you are withdrawing, no, it will be exempt. It will be exempt. When it will be exempt, sir? If you complete minimum 5 years in service. If you complete minimum how many years? 5 years in service, it will be exempt. Okay, sir. Now please note, this 5 years condition will not be applicable in 3 cases. Which are these 3 cases, sir? Say employee is leaving the job because of his ill health. Because of his ill health, if he is leaving the job, lawmaker says no problem. Or employer is leaving the job because the employer only discontinued the business. Are the company where I am working? No, that company is only getting closed. So when the company is only getting closed, what can I do in my life? Can I work in that company? No. Or you are transferring, you are shifting your company, you are joining a new company and you are transferring whatever amount was there in this old employee ka provident fund to the new employer ka recognized provident fund. In that case also lawmaker says no problem. So in 3 cases, 5 years condition is not applicable. If you are leaving the job because of your ill health, or if employer himself has discontinued the business, or you are transferring the balance which is there in this in the new employer recognized provident fund balance or 80 CCD pension fund. Now on top of all of this, in recognized provident fund, are you understanding? SPF is very easy, but in recognized provident fund there are limits. On top of that, there is one more limit, very important point with respect to interest. Please note, whatever interest you are earning, if the interest on employer's contribution, if the interest is in excess of 9.5%, can I say that interest will be taxable in the hands of employee as salary? Yes, sir. Any interest more than 9.5% will be taxable as salary. Similarly, whatever contribution is made by employee, on that whatever interest is earning in excess of 9.5% will be taxable in the hands of employee as salary. So employee contribution interest accrued in excess of 9.5% per annum is taxable in his hand as salary. Now please see over here. Now we understood, sir, interest more than 9.5% will be taxable in the hands of employee as salary. Now there is one extra point given over here. What is that extra point? Lawmaker says if the employee has contributed in the recognized provident fund in excess of 2,50,000 rupees in a year, then interest on that excess amount shall be fully taxable. What are they telling? What are they telling? They are telling that whatever contribution employee is making, no, it should not be more than 2,50,000. Sir, what if it is more than 2,50,000? If it is more than 2,50,000, then the contribution to anyways you should ignore. But on that extra money which you have contributed, let us say employee contributes 3 lakh rupees. Now, can I say it is more than 2.5 lakhs? Yes. How much more, sir? 50,000 rupees is more. So whatever interest you are earning on this 50,000 rupees, that interest is fully taxable. Meaning on that extra contribution which you have made, this 9.5% criteria also will not work. Sir. Repeat once again. Please note. I have contributed how much? 3 lakh rupees. Now divide this 3 lakhs into 2 arrow marks. 2.5 lakhs and extra amount. How much is extra? 50,000 rupees. On this, let us say this fund is giving me interest of 10%. Okay. So on this 50,000, entire 10% interest will be taxable. And on this 2.5 lakhs, which is there, how much interest will be taxable? 10% minus 9.5, which is 0.5% interest only will be taxable. Meaning the interest in excess of 9.5%. Okay, not okay? So the contribution by the employee should not be more than, should not be more than 2,50,000. For example, I have taken example over here. Employee has contributed to recognized provident fund. How much, sir? 3,50,000 rupees. PF interest is 6% per annum. So taxable interest will be what, sir? 3.5 lakhs minus 2.5 lakhs into 6%, which is 6,000 rupees. Now, employee contribution to recognized provident fund, 4 lakh rupees. Interest paid by the fund is what, sir? 12%. Now, please note, in the previous case, interest was less than 9.5%. So, only the excess amount, whatever is there, no, on that you will have to pay interest. Now, in the present case, what is happening? Interest amount is 12%. So, can I say it is more than 9.5%? So, whatever contribution you are making on that up to 9.5, more than 9.5% interest is there, no, which is almost how much, sir? 2.5%. This will be taxable for the entire contribution which you have made. And for the contribution which is made in excess of 2.5 lakhs, whatever extra contribution is made, say for example 4 lakh is there, minus 2.5 lakhs, how much, sir? 1.5 lakhs. On this entire 12% is taxable. Sir, this is confusing, sir. This is confusing in life. Therefore, they will ask this in examination. Are you understanding? Are you understanding? Something which is easy, they are not going to ask, because examiner knows what is that point where student will get confused and how to play around with them. So I'll repeat once again. See, in RPF, if you are contributing any money, on that money you will get something called as interest. Now this interest, if it is up to 9.5%, then it is fully exempt. Sir, what if the interest is 12%? So can I say the interest, if it is 12%, if the fund is giving you interest of 12%, can I say it is giving more than 9.5%? Yes, sir. So how much more it is giving? Sir, 2.5% more it is giving. So whatever amount you have put into 2.5% is fully taxable. It is fully taxable. Sir, I have understood this point, sir. This is very clear. Now tell me, sir, what is the 2,50,000 point? What is that extra point which you added? Now, what lawmaker says is, in this fund, employee, when he is putting the money, he should not put more than 2,50,000. If he is putting more than 2.5 lakhs, then whatever, see, can he put more than 2.5 lakhs? Yes. But if he is putting, say around, he is putting 5 lakh, he is putting 6 lakh rupees. So can I say he was supposed to put 2,50,000, he is putting 6 lakhs. So 3,50,000 extra he has put. On this 3,50,000, now I will not see what is the rate of interest, whether it is more than 9.5%, less than 9.5%, whatever interest the company is giving you. In our case, it was 12%, that entire amount will be taxable. On that extra money, entire interest will be taxable. Sir, yes, sir. Now something is clear, sir. I will refer the example again. It will be clear, sir. Okay, please refer this example again. Now, unrecognized provident fund. Next is what, sir? If I am putting money in unrecognized provident fund, again, they may ask question on this also, and they have asked question in the previous examination for 4 marks. Unrecognized provident fund. Now, this fund which is there, that is what type of fund, sir? It is unrecognized provident fund. Now, what is this unrecognized provident fund point telling? Whatever contribution employee is making, ignore. Whatever contribution employer is making, that is exempt. Or interest on employee ka contribution, exempt. Or interest on employer ka contribution is also exempt. Yes, sir, repeat. Whatever contribution employee is making, ignore. Whatever contribution employer is making, exempt. Whatever interest is received on employee's contribution, exempt. Whatever interest is received on employer ka contribution is also exempt. Meaning your contribution and interest on your contribution is exempt. Now in case of unrecognized provident fund, taxability will come when you withdraw. When the lump sum is withdrawn from this fund, no, at that time taxability will come. How will it be taxable? Now when you withdraw, no, can I say now this fund, this dabba has 4 money. What are those 4 monies? Your contribution, employer ka contribution, interest on your contribution, interest on employer's contribution. So 4 amounts are there. 4 different categories of amounts are there in this fund. Now when you are withdrawing the lump sum amount from the fund, you should divide whatever money you have got in 4 different categories. Correct? So whatever contribution was made by you, it will not be treated as income and therefore it will not be taxable. Sir, repeat. Lump sum which I withdraw, whatever contribution was made by me will not be treated as income, therefore it is not taxable. Whatever interest I am getting on employee ka contribution, that will be taxable in the hands of employee under income from other sources. Now employer ka contribution and interest on employer ka contribution at the time of withdrawal is taxable under the head salary. This is all about your unrecognized provident fund. Next is what, sir? Superannuation fund. Superannuation fund, approved superannuation fund, unapproved superannuation fund. Approved superannuation fund is like your statutory provident fund. Unapproved superannuation fund is like your unrecognized provident fund. Exactly same it is. Now, employee ka contribution in this fund, ignore. Employer ka contribution, exempt. Interest on employee ka contribution, exempt. Interest on employer ka contribution, exempt. Lump sum withdrawn is also exempt. Here there is one extra point which is giving employer should not contribute more than 7.5 lakh rupees. Employer contribution should not be more than 7.5 lakh rupees in this fund. So what about unapproved superannuation fund? Exactly same as unrecognized provident fund. Your contribution is exempt. Interest on your contribution is exempt. Whatever lump sum you withdraw at the time of your retirement, that amount will be divided into 4 categories and your own contribution is exempt. Ignore because it is not an income. Interest on your contribution taxable under other sources. Employee ka contribution and interest on employer ka contribution. Employer ka contribution and interest on employer ka contribution is taxable in the hands of employee as salary. You okay? Not okay? So I mean this is a question which is there in your institute material. 6 lakh rupees you received, which has employee ka contribution, interest on employee ka contribution, employer contribution, interest on etc. So accordingly, whatever we saw, that is how it is taxable. Next comes is deduction. Deduction, you should be little careful. When you are taking deduction, you should be little careful. Now you have what different types of deduction, sir? You have 3 types of deduction. One is your standard deduction, one is your entertainment allowance, and third one is your professional tax. So these 3 different types of deductions are there. First is what's your standard deduction. This is flat. If once you compute your salary, gross salary, from this 3 deductions should be subtracted. This standard deduction is required to be subtracted by you compulsorily. Compulsorily you should subtract standard deduction. It is available to all types of employees. Standard deduction is available to whom, sir? All types of employees. And how much deduction is available? It depends on what regime you are following. Are you following old tax regime or are you following new tax regime? If you are following old tax regime, that means optional regime or normal provision, then whatever salary you have or 50,000 rupees, whichever is less, is allowed as deduction. Standard deduction is how much, sir? Your salary amount or 50,000, whichever is less. Sir, what if I am not following optional tax regime? What if I am following default tax regime? Then your salary or 75,000 rupees per annum, whichever is less, is exempt. So for default tax regime, the limit is how much? 75,000 rupees. Then employee has received salary from more than one employer. Sir, what will happen then? What if I have received salary from more than one employer? If the employee has received salary from more than one employer, then also you will get deduction only once. Standard deduction is per employee, per person. So it will be given only once. Next is your entertainment allowance. Entertainment allowance is required to be first added in your salary computation. It should first be added in your gross salary computation, and then deduction will be given only if you are a government employee. A deduction will be given only if you are a government employee. How much deduction will be given? The amount of deduction which will be given to you will be 20% of your basic pay, 20% of salary, basic pay or actual amount received, or 5,000 per annum, whichever is less. Note, no education allowance, no entertainment allowance deduction will be given if the employee pays tax under default tax regime. So if you are a government employee, then only you will get the deduction, and if that government employee is opting for default tax regime, then he will not get this benefit. Then we have professional tax. Professional tax is a tax which is collected by the state government on the employment. It is collected by state government. It is allowed as deduction in the year when it is paid, and it should be paid by the employee himself. Sir, what if the employer is paying the professional tax? If the professional tax is paid by the employer, then first add it to your salary, then you complete the deduction. So because employer is paying, first add it to the salary, then you allow it as deduction. How much deduction can I take, sir? 2,500 rupees per annum. Sir, what if I have paid more than 2,500 rupees? Last 5 years I did not pay. Now I am paying. Then you can claim whatever amount is paid by you. Deduction is allowed on payment basis. Further, if outstanding professional tax of earlier years is paid in the current year, then also deduction will be allowed in current year itself. Note, no professional tax deduction if employee pays tax under default tax regime. So if you are paying tax under default tax regime, then you will not get any such kind of benefits. So there is one question which we have solved over here. Very simple question. You can just go through this question. Next comes the last point for our discussion, which is perquisites. Perquisites. Now perquisites is what, sir? Perquisites is extra benefit which is given by the company. It is a non-monetary benefit. Perquisites is what, sir? Extra benefit given by the company. It is a non-monetary benefit which is given by the company. However, sometimes it can be in monetary terms also. Okay. Reimbursement of expenses. You are incurring some expenses. Company is giving, say for example, company is giving a house to you. That is what? Perquisites. Company is giving a car for your transportation purpose. That is perquisites. Now apart from that, sometimes what may happen is company may reimburse the expenses incurred by you. Meaning you have already incurred some expenses. Now company is repaying that money. Expenses is incurred by the company on behalf of employee are also covered under perquisites. They are also covered over here. Now we'll see different types of perquisites now. First type of perquisite is what's a leave travel concession. Leave travel concession is exempt under section 10(5). Leave travel concession is exempt under which section? 10(5). Now leave travel concession benefit you can take only for travel which you are making anywhere in India. You can take leave travel concession exemption only for your travel anywhere in India. Travel benefit given by company for travel anywhere in India. Exempt under section 10(5). What is exempt under section 10(5)? Leave travel concession. So if you're traveling by air, if you're going to some location by air, then whatever actual expenses you have incurred or your economy class ka fare, airfare, whichever is less will be exempt. Sir, what if I am not traveling by air? I am traveling by any other mode. It can be bike, car, train, etc. Whatever mode. If you're not traveling by air, then I will check the place where you are going whether railway facility is available. If yes, then I'll take your actual expenses or first class ka AC ticket, AC rail ticket ka fare, whichever is less. Sir, what if the place where I'm going, the train facility is also not available? Then if the railway facility is not available, then I will check whether any recognized public transport facility is available, bus facility is available. Yes, sir. Then I'll take your actual expenses or deluxe class ka bus fare, whichever is less. Okay, not okay. Now, sir, what if that is also not there? Which location are you going in your life? Are you going to somewhere under the water where no bus is going, no train is going, nothing is going? Yes, sir. Yes, sir. Yes, sir. Then, if recognized public transport facility is also not there, then lawmaker says actual expenses or first class AC rail fare for similar distance, because the place where you are going, nothing is there. So, similar distance. If the same amount of distance, if you travel in first class AC ticket, what is the amount? Whichever is less should be taken by you. Now please note. Leave travel concession. Sir, should I travel alone, sir? Can I travel with my wife, sir? Yes. You can, employee can, this benefit is available for employee, spouse of employee, children and dependent relative. Dependent relative means mother, father, brother, sister. Sir, I cannot take my girlfriend. No. Don't do goobism in life. Okay. Now please note. For how many children is it allowed, sir? for all the children who are born after on or after 1st of October 1998, maximum 2 children's benefit you can take. Now the exemption is available. You can take exemption for 2 journey in a block. One block consists of 4 years, and year means over here calendar year. So in a block of 4 years, you can take the exemption how many times? Only 2 times. So in 4 years, you can travel 2 times to claim this exemption. Then medical facilities is given by company. Medical facility, whether the treatment is happening in India or outside India, that is important. Sir, what do you mean by treatment, sir? Treatment means some medical issues are there with the employee. Now the company is telling, don't worry, you take care, you go to the hospital, I will pay the money for that. So medical treatment. If the treatment is happening in India, I will check which hospital it is happening. Is it happening in government hospital, or is it happening in government approved hospital, or is it happening in government employer ka own hospital? If yes, in all these categories it is happening, then whatever amount you are spending for the treatment is fully exempt. Sir, no sir, it is not happening in government hospital, nothing like this is there, then it will be fully taxable. In all other cases it is fully taxable. Sir, what if treatment is happening outside India? Your treatment and stay is exempt. Your treatment and stay is exempt. But if the for travel purpose, no, it is normally taxable. Treatment and stay will be exempt, and whatever travel expenses you are incurring, no, that will not normally be taxable. Now please note, treatment and stay for whom, sir? Treatment and stay of one person, patient, and one attendant can go with the patient. Yeah, see, just because it is happening outside India, you take your entire family outside India, no, one patient and attendant ka travel expenses. Now how it is exempt as per what limit, sir? Limit given by Reserve Bank of India. So in your question they'll give that limit. Now, sir, treatment can be of only employee. Yeah, no, employee himself or spouse, children, dependent relative. And here please note, medical insurance is exempt, but life insurance, if they give in the question, no, it is always taxable. Now sir, what if my company is giving gifts? If it is a cash gift, fully taxable. Sir, Diwali, no, Diwali, my company gave me a sofa, sir. My company gave me a washing machine, sir. No, so it is a gift in kind. So if the value of that gift, market value of the gift is more than or equal to 5,000 rupees, it is taxable. Less than 5,000 rupees, it will be exempt. Sir, what about loan? Loan given by the company. Loan given by the employer without interest or at concessional rate of interest. If any loan is given by the company without interest or at concessional rate of interest, then I will see whether the loan is given for medical treatment purpose or any other purpose. If the loan is given for medical treatment purpose, then, and if it is for a specified disease, it is fully exempt. But if the loan is given for any other purpose, say marriage purpose loan is given, or any other purpose, say education purpose loan is given, then if the loan amount is up to 20,000 rupees, it will be exempt. Or if the loan amount is more than 20,000, it will be taxable. Sir, how much, what is taxable over here? The interest. Please note, company is not charging interest. No, see, loan amount I will have to repay to the company back. So company is not charging interest to you, or company is charging less interest to you. So only that interest amount will be exempt. How will I calculate that? You see what is the outstanding amount of loan at the end of every month. At the end of every month, what is the amount of loan outstanding? Multiply that with, you take, see what is the rate given by State Bank of India as on first day of previous year. As on 1st of April 2024, what is the rate given by State Bank of India? Subtract from that, what is the rate charged by the company, employer. So that is the benefit which you are getting, correct? No? Multiplied by whatever loan is outstanding at the end of every month. That would be the amount of exemption which you are going to get. Then we have something called as ECHAP. Then we have something called as what, sir? ESOP. ESOP means what, sir? ESOP means shares of the company are given to you at a concessional rate. ESOP means shares of the company are offered to the employees at a concessional rate. Now, what is the perquisites over here? What is the perquisites? What is the market value of the shares minus what is the price at which they have given to you? That is the benefit which you have got. Now, what is perquisites? Extra benefit you are getting. So perquisites will be fair market value as on the date of exercising the option, or minus issue price. Minus what's the issue price? Now, please note. With respect to ESOP, you should also see what is capital gain topic telling. Note, if the cost of acquisition of shares acquired through ESOP for under capital gain, please note, salary topic, this discussion is over. Now I am talking from capital gain point of view. From capital gain point of view, The cost of acquisition of shares which you got through ESOP. What will be cost of acquisition of those shares? The fair market value of shares as on the date of exercising the option. What is the market value of the shares as on the date when I'm taking this option, exercising this option? That will be taken as what, sir? My cost of acquisition of these shares. Now please note, normally if you gift anything, then it is exempt, meaning it is not interest transfer. However, gifting of shares which are acquired through ESOP is treated as transfer. Now, the period of holding of these shares should be taken from the date of allotment of these shares. So, from which date will I take the period of holding, sir? The date when these shares were allotted to you. Next, education facility is given by the company. Now, the education facility is given by given to employee. The company is giving the education facility to me only. I am the employee of the company. Then lawmaker said it is exempt. What if it is given to employees' children? Employees का children, if they are getting, check where the education is happening. Is it happening in the employee का own institute, employer का company का own institute, or the tie-up institute? If it is happening in own institute or a tie-up institute, I will see what is the value. If the value is less than 1000 rupees per month, it is exempt. If the value is more than 1000 rupees per month, it is fully taxable. And other institute, it is fully taxable. Sir, what if any other person is getting the benefit, sir? For example, I am working in Infosys and Infosys is funding my wife's education, fully taxable. Sir, what if company is giving me movable asset? Company is giving me, sir, in my house, no, company has given me a sofa. Company has given me a laptop. Company has given me a beautiful TV, AC, etc. in my house. So, except car. If the company is giving you movable asset except car, check whether the asset which is given by the company, whether it is owned by the company or the company has taken it on rent. If it is owned by the company, the value of perquisites will be 10% of cost of asset. What if it is taken on rent by them? Then the value of perquisites will be the rent which is paid by the company. Note, amount recovered from the employee. Say for example, now the company is giving me an AC which they have taken on rent and they are paying a rent of 500 rupees per month. And company is telling Dilip, see, I am giving this AC to you, you please pay me 100 rupees. So this 100 rupees you will have to subtract. Whatever amount is recovered by the from the employee by the employer should be reduced. So taxable amount will be only 400. And if the company is giving laptop or computer, no problem, it is fully exempt. Sir, what if they sell me those movable assets, sir? If they sell you those movable assets, then the perquisites will be whatever is the WDV of this asset minus the amount which is paid by you. For example, that AC was installed at my home. No, I told the company, you do one thing, you sell this AC to me. Now, I will see what is the WDV of that AC which is given to me. A WDV of that asset given to me minus what is the amount which I paid for that AC. That is perquisites. So, in case of laptop and computer, WDV minus consideration. Now, when you see WDV for laptop, you should compute the WDV by taking depreciation at what rate? 50%. Similarly, for car also it is WDV minus consideration. Please note, here I am talking about car for transfer, selling of car by the company to me. I am not talking about giving of car by company to me. Perquisites will be what's WDV minus consideration. Now, here when you are computing WDV of the car, you should take 20% per annum. And any other assets. For any other assets, what will I do, sir? For any other type of asset, I will calculate WDV by giving depreciation at 10% SLM and subtract the consideration paid by me. Now, please note, when you are calculating depreciation, you should calculate the depreciation for a completed years. What do you mean by completed years? If there is any part of the year, say I have used it for 1 year, 3 months, ignore 3 months, you take depreciation only for 1 year. Sir, what if company is giving you lunch facility? If the value of the meal is less than 50 rupees, exempt. If it is more than 50 rupees, only that extra amount is taxable. If it is refreshment, non-alcoholic beverages, snacks, etc., exempt. And if anything is given to you at remote location, it is fully exempt when you are going outside for some work, etc. Next is what's a rent-free accommodation. Company is giving you rent-free accommodation. Rent-free accommodation means what's a company is giving a house to you for stay. Now, if you are a government employee, they have already decided, government has already decided that this will be the limit based on which I am going to tax. So, if you are a government employee, the taxable amount will be the license fee as decided by the government. So, what if I am not a government employee? Company is giving me a house to stay. I am not a government employee. Then check whether the house which is given by the company is owned by the employer or they have taken it on rent. If it is owned, then it is 5% of salary, 7.5% of salary or 10% of salary. Depending upon where you are staying. Depending upon the place where you are staying, it will be 5%, 7.5% or 10%. Sir, what if it is taken on rent by the company? Then how much ever 10% of salary or the rent which is paid by the company, whichever is less. Now, sometimes it may happen with this house, they may give you furniture also. So for furniture, you should add extra amount. If the furniture is owned by the company, 10% should be added of cost. If the company's furniture which is given by the company is taken on rent by them, then you should add whatever rent they are paying. So for house, what is the value which you are going to take? 7.5%, 5% or 10% of salary. If it is taken on rent, 10% or rent paid, whichever is less. Apart from that, extra thing you are going to add is this for furniture. Sir, how will I come to know? How will I come to know whether it is 5%, 7.5% or 10%? Depending upon the population. If the population is up to 15 lakhs, 5%. If the population where the house is given is up to more than 15 lakhs up to 40 lakhs, 7.5%. If it is more than 40 lakhs, it is 10% of salary. Amount recovered from employee by the employer shall be reduced. Salary means what, sir? For this purpose, what is salary? Salary is BD Bumsy. What is BD Bumsy, sir? Basic pay, dearness allowance, bonus, allowances, which are taxable amount only you should take, monetary benefits and commissions which is given by the company. Any type of commission. Now, please note, while calculating BD Bumsy, you should take salary on due basis only. And you should not include the following when you are calculating that salary for the purpose of rent-free accommodation. What should not be included? Your retirement benefits, perquisites, contribution to any welfare fund, etc., advance salary, arrears of salary. Questions will be very, very easy on these points. I have given good amount of question you can go through. Now, sometimes what may happen, I am getting shifted from one place to another place. At that time, no, lawmaker says if you are shifting from one place to another place, then if you have, if the company has given you the house to you at old place also and new place also, then for 90 days, one of the house will be exempt. You decide which house you want to exempt. One of the house will be exempt and only the other house, the second house, whichever house is there, that will be taxable. Only one of the house will be taxable. Sir, what if a hotel benefit is given? For example, I have traveled to some place, and before giving the house to me, the company told, wait, we are looking for the house. You stay in hotel for 10 days, 15 days, 20 days, etc. Lawmaker says here the perquisites will be 24% of salary or rent charge, whichever is less. Now, please note, if you are going somewhere else for a period up to 15 days and because of that reason hotel is given, it is exempt. Last point, which is important point. I mean, apart from that, all is theory. Car facility is given by the company. What facility? Car. Now, if you're using the car only for office purpose, then are you getting any benefit? Hey, company is giving the car to you and you're using the car only for your office purpose. What benefit are you getting? Only company is getting benefited, no? Therefore, no benefit. Therefore, no perquisites. But if you're using the car only for your personal purpose, company has given the car to you. That car is used by you only for your personal purpose. Hey, can I tell that you are getting full benefit now? Now, lawmaker says, if you are using the car only for personal purpose, if the car is owned by the company, 10% of cost will be taken as perquisites. If the car is taken on rent by the company, rent paid will be taken as perquisites. Now, car is given by the company. Now, sir, is running and maintenance charges also paid by the company? Petrol, maintenance, service cost? Yes, add the value of that also. And if driver is also given, then add the value of driver's salary also. If it is what, sir? Only for personal purpose. Sir, what if company is giving a car to me? I am using it for my personal purpose also and office purpose also. This is where maximum questions should be asked. So if there is any car which is given by the company which you are using it for personal purpose and office purpose, then check whether the car which is given is owned by employee or is it owned by employer. If the car given by the company is owned by employee, then check who is paying the running and maintenance charges. If the running and maintenance charges are paid by the employee, car is mine, I am only paying running and maintenance charges. What benefit am I getting, sir? No benefit, therefore no perquisites. Now the car belongs to me, running and maintenance charges is paid by the company. Now the lawmaker says whatever running and maintenance charge is paid by the company, from that subtract the value of car. What is the value of SAR? If the car is up to 1600 cc, subtract 1800 per month. If the car is more than 1600 cc cubic capacity, etc., then subtract 2400 per month. That will be the value of perquisites. Meaning whatever company is giving, subtract the value of car, you will get value of perquisites. Sir, what if the car is owned by the company? If the car is owned by the company, check who is incurring running and maintenance charges. Sir, car is by company, sir. Running and maintenance charges I am incurring, sir. Employees incurring. Then perquisites will be 700 per month if the car capacity is up to 1600, and if it is more than 1600, 900 per month. Sir, what if it is car owned by the company, running and maintenance charges also by the company? Then 1800 or 2400, meaning 1800 up to 1600 cc, 2400 for less than more than 1600 cc. Now please note, if company also gives a driver, 900 per month should be added for driver. Please note this notes which you are seeing over here is applicable to point number C. Sir, what if more than one car is given? Then you can take the benefit of partly for one car, and other car will be treated as only for personal purpose. Sir, month means what, sir? Completed month. So if you are using for part of the month, ignore it. Now other type of perquisites which are there in this chapter, which is the last point for our discussion. If the company is giving you gas facility, electricity facility, water facility, fully taxable. Sir, gas facility, electricity facility, water facility, fully taxable. Yes. If the company is giving you free servant or a gardener or a watchman or a personal assistant, fully taxable. Or you are getting personal assistant, what else you want in life? Fully taxable. So now lawmaker says, if the company, if the above 2 points, no, if the company is providing it to the employee, then it will be taxable only for specified employee who is a specified employee whose salary is more than 50,000. But if the cost is reimbursed by company, then it will taxable for all the employees. Meaning, wait, sir. If the company is giving a personal assistant to you, okay, when will it be taxable in your hands? If you are a specified employee. But you have taken a personal assistant and I am reimbursing the cost of that, then it will be taxable for all the employees. So anyone who is taking personal assistant for whom I am paying the money, it will be taxable for them. Say employee ka obligation is incurred by the employer, fully taxable. Meaning there is some expenses which you were supposed to incur, I am incurring on your behalf. It is fully taxable. Credit card facility is given by the company and you are using the credit card for your office purpose, no benefit you are getting. You are using the credit card for your personal purpose, it is fully taxable. Club facility is given by the company, it is normally fully taxable, but if it is a corporate club, sports club or health club, then it will be exempt. Employer contribution. Employer ka contribution to RPF, approved superannuation fund, 80CCD pension fund in excess of 7,50,000 rupees. Employer ka contribution will be taxable as perquisites. Meaning, if the company is contributing in these three funds combined together 10 lakh rupees, then exemption I'll give up to 7.5 lakhs. 2.5 lakhs will be taxable in the hands of employee. Transport facility is given by the company. What facility? Transport facility. Now, are you an employee of transport company? Yes, I am an employee of railway company, airline company, then it is exempt. If you are employee of bus, any other transport company, it will be taxable. Transport facility given by company. Other employees, it is always taxable. I am an IT employee, company is giving me transport facility. Now, please note, if the transport facility is from office to home, home to office, then it will be, of course, exempt because you are going to the company only. But apart from that, say wherever you want to go, the company is giving you transport facility, it will be taxable. Following perquisites are always exempt. Which perquisites are? If you are getting a laptop, computer, mobile phone, telephones, tea, coffees, snacks, etc., goods which are given by the company to you at a concessional rate, health insurance, mediclaim, etc., given by the company, they are also always exempt. Okay, yeah. Next starts our PGBP. We'll discuss this PGBP after a short break. Let me meet you after a chota sa break. Till then, enjoy, Panna students. Yes, so welcome back, students. Let us discuss the next topic. What is the next topic, sir? Next topic is profits and gains from business and profession. The last head of income we have discussed already. The income from house property, then capital gain, other sources, then salary. Now the last head of income which we are going to see is what, sir? Income from business or profession. Fantastic head. Now basically what is this topic going to talk about? How to compute your business income. So if you're doing any business, and if you want to compute the business income, then how do I compute the business income, sir? This chapter is going to tell you. So profits and gains from business or profession. So normally, what do you do in accounts? You will prepare something called as profit and loss accounts. You will have income on the credit side and expenses on the debit side. So from your income, you subtract your expenses. Whatever you get is your net profit. That net profit is nothing but your business income. Now, for computing this net profit, no, you should follow income tax law if you want to find the net profit as per income tax law. So, if you want to find your business income as per income tax law, you will have to do what, sir? You will have to do this, whatever this chapter is going to tell you. Now here there are two things, please note. Profits and gains from business or profession. So there is something called as business and there is something called as profession. What do you mean by business? The business and profession, both definitions are inclusive definitions. They both are inclusive definition. Meaning what, sir? Whatever you generally understand by this word called as business is a business. Whatever you generally understand by the word called as profession is a profession. Apart from that, business will include trade, commerce, manufacture. Business will include what? Trade, commerce and manufacture. Similarly, profession will include vocation. Profession will include vocation. For example, Priya Sadis is a business. Then you have A to B is a business. Correct? Then you have Priya Electronics business, Priya Sweets business, Priya Airlines. They are all doing business. Correct? Business. Profession means what, sir? Chartered accountant, doctor, lawyer, actor, engineer, etc. They are all professionals. So profession is basically a degree of qualification. What is vocation then? Vocation is you are doing something because of your skill and talent. That is also profession. Now, while computing two incomes under our taxation, income tax, we can adopt any of the following methods of accounting. There are two methods of accounting: cash system of accounting and accrual system of accounting. This cash system of accounting and accrual system of accounting is required to be adopted by you while computing the income. It is required to be adopted by you when, sir? While computing the income. Income under which head? Lawmaker says if you are computing income under the head other sources, or if you are computing the income under the head business or profession, for computation of those income, you should use any of these following methods for computing the income. Then there is something called as income computation and disclosure standards. This is something which is there, which is required to be used for computing the income. But however, it is not applicable at intermediate level. You will learn it in your final level. Section 28 is the charging section. Section 28 says charging section. It says what, sir? Any profit or gain. So it is because of this section you are paying tax on your business income. What is this section telling? If you are making any profit or gain from any business or profession in the previous year, then that profit or gain will be taxable under PGBP chapter. Any profit or gain you are making from your business or profession in the previous year, then that profit and gain will be taxable under this particular head called as income from business or profession. Then if you receive any amount because of termination of your business or office or modification of terms of your business, then whatever amount you are receiving, that will be taxable under PGBP. What do you mean by this, sir? Say for example, McDonald's. I have taken the franchisee of McDonald's. Now the McDonald's is telling, I'm ending my franchisee. McDonald's is telling, please don't give our technical know-how. Please don't give our recipe to anyone. So for that purpose, we are terminating the contract. We are ending the contract. For that purpose, they are giving me 1 crore rupees. So in this case, what will happen, sir? This income which I am going to get, will be taxable under business. Income from services rendered by an association to its members. So this resident welfare association, etc., they are rendering services to their members. Whatever money, this maintenance charges these members are paying, that is their business income. Export, if you are into export business, you receive something called as duty entitled passbook. You receive something called as duty drawback. You receive something called as cash compensatory support. They will all be taxable under which head, sir? They will all be taxable under business or profession. Any benefit or perquisites arising from business or profession. If you are getting any benefit, say for example, I am a dealer of Puma shoes. I sold Puma shoes worth more than 10 crores. Because I sold more than 10 crores worth Puma shoes, the Puma company is giving me a car. I am receiving a perquisite because of my business. It is taxable under business or profession. Interest salary. This is important. The interest, and I expect a question in the examination because there is an amendment also in this section. Okay, what is this point? Interest, salary, bonus, remuneration or commission which is paid by partnership firm to the partners. Whatever interest, remuneration, salary, bonus the partnership firm is paying to the partners is taxable under PGBP. Please note, I am a partner at a partnership firm. Partnership firm is paying me a salary. It is a salary. Partnership firm is paying me salary, but still lawmaker says it is taxable under PGP. It is taxable under what, sir? Business income. However, there is a limit applicable which is given in section 40B, which you will see later. Amount received for not carrying on any business or not sharing technical know-how or patent. You are receiving any amount. Why are you receiving the amount? For not carrying on any business, or you are receiving any amount for not sharing the technical know-how or patent. Then that will be taxable under this head called as PGBP. Then some received under key man insurance policy. You are receiving any money in our previous class, topic we saw in our income from other sources. If you receive any key man insurance policy amount, if it is received by the employer, it is taxable under business. If it is received by the employee, it is taxable under salary. And if any other person is receiving, it is taxable under other sources. So if the company is receiving key man insurance policy money, then it is taxable over here. Then if you are converting your stock in trade into capital asset, then the market value of that stock in trade will be deemed as the market value as on the date of conversion of that stock in trade into capital asset will be deemed as your business income. Now, normally business are divided into two categories for your set off and carry forward purpose. One is your normal business, meaning any business other than speculation business. What is speculation business, sir? Buying and selling of securities without taking actual delivery. That is called as your speculation business. Now, section 29 time pass section. Section 29 says how to compute your business income. If you want to know that, you please come to me. So, if you want to, section 29 says while computing the income under the head PGP, please take reference to all the sections from section 30 to 43D. When you are computing the income under the head PGBP, when you are computing the income under the head PGBP, please take into consideration all the sections from section 30 to section 43D. Then section 30. Now the first section. Now please note section 30. Okay, when you are computing your business income, the income is given under section 28, which we just now saw, and income is also given under section 41. We will see as and when we are discussing different topics. All the expenses which you can claim as deduction while computing business income, all the expenses which you can claim as deduction is given from section 30 to 37. So now we are going to start our discussion with what, sir? The expenses which are allowed as deduction. Section 30 is the first expenses which is there. Section 30 talks about what, sir? Section 30 talks about rent, rate, taxes, repairs and insurance of building. So if you have a building, now please note, I am doing business. What is my business name, sir? Priya Sarees. I am doing Priya Sarees from a place. Now this place where I am doing business, this place can either be owned by me or this place can be taken by me on rent. Correct, not correct? So place where I am doing my business, this place where I am doing my business, it can either be taken by me on rent or it can be owned by me. Lawmaker says, when this place from where you are doing business, if it is owned by you, of course you will not be paying any rent. So you cannot claim deduction of rent for the place which is owned by you from where you are doing business. Then you will pay rates and taxes, some municipal taxes you will have to pay for this place. For that, can I claim as deduction, sir? Yes, you can claim it as deduction while computing your business income. Please note, what do you mean by I can claim as deduction, sir? When I am computing my profit and loss account and the place from where I am doing my business, if it is a owned place, meaning this place where I have my Priya Sarees, this place, is it owned or rented? You should see. If it is owned, lawmaker says I will not give you the deduction of rent. You cannot claim a rent deduction. Sir, what about the taxes which I pay for this property, rates and taxes? Yes, you can claim as deduction. Sir, what about insurance which I am paying for this property? Yes, you can claim as deduction. Sir, what about repairs which I am making for this property? Lawmaker says if it is a revenue repair, recurring repair, then you can claim it as deduction. But if it is a capital repair, then please add it to the cost of asset and claim depreciation on that. Repairs are of two types. What are those two types of repairs, sir? Revenue repairs and capital repairs. If it is a revenue repairs, it is treated as expenses and accordingly allowed as deduction in the year when it is incurred. But if it is a capital repair, then that capital repair will be added to the cost of asset and depreciation will be given on that. Now, sir, what if the place where I'm doing business is a rented place? If it is a rented place, that means you'll also have to pay rent. No. See, if it is a place which is owned by you, you will not have to pay rent. Therefore, I'm not giving deduction of the rent. But if it is a place which you have taken on rent, if it is a place which you have taken on rent, that means lawmakers are telling, now I'll give you the deduction of rent. Sir, what if I am paying taxes for that building which I have taken on rent? Lawmaker says, no problem, I'll give you the deduction. Sir, what if I am paying I have taken insurance on that building where I have where I am doing my business which I have taken on rent? Lawmaker says, I will give you deduction for that also. Sir, what about repairs? What about repairs? Lawmaker says, if it is a revenue repairs, I will allow. If it is a capital repair, add it to assets, meaning you treat it as deemed building. Whatever capital expenditure you are incurring, you treat it as deemed building, and you can claim depreciation on that amount. You can claim depreciation. Sir, section 31. Next is what, sir? Section 31. Section 31 is insurance and repairs for plant, machinery and furniture. Now, there are different types of plant, machinery and furniture which you may be using for your business. For that, if you are taking any insurance, is it allowed as deduction? Lawmaker says yes. For that, if you are incurring any repair cost, lawmaker says, I will allow if it is a revenue repairs. If it is a capital repair, add it to the cost of asset and claim depreciation. If it is a capital repairs, add it to the cost and claim at depreciation. What do you mean by deduction allowed, sir? Deduction allowed means when you are preparing your profit and loss account, you can claim that expenditure. Next is one of the most important deduction. What is that, sir? Depreciation. What is the next point which is most important? You are telling, sir, depreciation. So if you are a person who is doing business, then you will have assets. Correct, not correct? For that asset, can you claim depreciation? Lawmaker says yes. If I am claiming depreciation, can I take deduction of the depreciation? Lawmaker says yes. Depreciation will be allowed as deduction. What is section 32 telling? Section 32 says depreciation will be allowed as deduction if two conditions are satisfied. If you satisfy these two conditions, depreciation will be allowed as deduction. Sir, which are the two conditions which I should satisfy for claiming depreciation as deduction, sir? Assessee should be owner of such asset and that asset should be used for business or profession. Please note, depreciation will be allowed as deduction if you satisfy two conditions. What are these two conditions? The assessee who wants to claim depreciation, he should be owner of that asset. And that asset should be used for business or profession. Assessee should be owner of such assets and asset should be used for business or profession. Okay, sir. Sir, so tell me, sir, if there is a plant and machinery which I have taken on rent, can I claim depreciation on that? Answer is no. Why? Because you are not the owner. Sir, what if I have taken that plant and machinery? I am owning that plant and machinery, sir. Can I claim depreciation on that? Lawmaker says yes. Now, let us say I have a laptop. I have purchased this laptop in the name of Priya Sarees, but I am using it for my personal purpose. Can I claim it as deduction? No. Assessee should be owner and you should use that asset for business or profession. If you are using it for personal purpose, no depreciation. If I am using it for my business purpose, yes, depreciation. There is a car which I purchased on 14th of February, but registration was done in my name on 10th of May. From which date can I take the depreciation, sir? From 14th of February. From the date of purchase, meaning from the date when you put to use this asset, you can claim depreciation. That point will come in ways later. Under hire purchase system, sir, who can take the depreciation? What happens in hire purchase system? Possession is given on first day and ownership is transferred to me on last day when I pay the final installment. Lawmaker says no problem. Depreciation will be allowed from the date. Depreciation will be allowed from the date when you got the profession, meaning from the date when I got the profession of that possession of that asset which I purchased under hire purchase system, I can claim depreciation. And what about lease transactions, sir? Lease, there will be lessor and lessee. Lessor is going to give the asset to lessee for his use. In this case, who can claim depreciation? Who is the owner of the asset? Lessor is the owner. Correct, not correct? So lessor can claim depreciation. Sir, what if there are joint owners for an asset, sir? Then both the owners can claim it proportionately. Proportionately, you can claim depreciation. Now, please note, whether the asset is actually used or not, it does not matter. Actually used or not, it does not matter. Even if it has been put to use, you can claim depreciation. So there is one AC which I am not using at all in my office, which I have never used at all. So whether active use is necessary for claiming depreciation, answer is no. Active use or passive use, any person who has put to use any asset, whether he is using or not, it does not matter. He can claim depreciation. Then depreciation under income tax law. is allowed from the date when the asset is put to use. Very important. Under income tax law, if I want to take depreciation, from which date can I take depreciation, sir? From the date when asset is put to use. If you want to claim any depreciation under income tax law, from which date can you claim that depreciation? You can claim that depreciation from the date of put to use. From the date of put to use, not from the date of purchase. Please note, I have purchased the asset on 10th of December 2024, but I have put to use that asset on 1st of March 2025. From which date can I claim depreciation? From 1st of March. Though I have purchased it on 10th of April, 10th of December 2024, I can claim the depreciation from 1st of March. So depreciation is allowed from the date when the asset is put to use. Classification of asset. For computation of depreciation, assets are classified into two categories. One is called as tangible assets, another one is called as intangible assets. Under tangible assets, there are further three categories: building, furniture, and plant and machinery. Okay, so whatever type of intangible assets you have, intangible assets. So whenever you are computing depreciation, you are required to divide the different assets which you have under these four categories. Which four categories are? One is your building, furniture, plant and machinery, and intangible assets. So based, you divide all the assets under these categories. For example, if I have office building, it will come under building. If I have furniture, it will come under furniture. If I have laptop, AC, printer, all this will come under plant and machinery. And if I have any intangible assets such as patent, copyright, trademark, they will all come under intangible assets. So accordingly, I will have to divide these items under respective categories for I will have to classify them into respective category for claiming depreciation. Now, under income tax law, the methods of depreciation are basically of two types. One is called as WDV method, another one is called as SLM method. So there are two methods of depreciation. One is straight line method of depreciation, another one is WDV method of depreciation. Sir, what is the difference between straight line and WDV? A straight line method of depreciation gives the depreciation on individual assets separately. Under straight line method, what it says is, say if you have 10 laptops, for each laptop, give the depreciation separately. This is followed under straight line method. Under straight line method, they follow a system called as individual asset systems, wherein for each and every asset, they give the depreciation, they compute the depreciation separately. So what if the rate of all the assets are same? Lawmaker says, I don't care. Even if the rate of all the assets are same, I will compute the depreciation for all those assets separately. And please note, this method can be followed only by two companies. One is your power generation company and power generation and distribution company. Please note, SLM method of depreciation follows individual asset system. What happens in individual asset system? Here, depreciation is given to each and every asset separately. Who follows this, sir? Only power people. Only power people means what, sir? A person who is involved in the generation of business of generation of power, or a person who is involved in the business of generation and distribution of power. Okay, only these two people can opt for SLM method. Sir, can they follow WDV method? Yes, they can also follow WDV method. Now please note, normally under income tax law, if nothing is given, depreciation is required to be computed under which method, sir? WDV method. Normally under income tax law, if nothing is given, under which method you are supposed to compute the depreciation? You are supposed to compute the depreciation under which method, sir? WDV method. WDV method follows a system called as block of asset system. WDV method follows a system called as what, sir? Block of asset system. Here what happens? This is required to be followed by all types of assessing. If nothing is given in the question, WDV method. If you are a power generation and power distribution unit, can I follow WDV method of depreciation, sir? Answer is yes. But if they want to follow SLM, they can always follow SLM. So SLM is just an option to these two people, but WDV is compulsory for all the people. All the people should compulsory follow which method, sir? WDV method for computing depreciation. Now, under WDV method, see, under SLM method, what system they follow, sir? Individual asset system, meaning each and every asset, they'll give depreciation separately. But however, under WDV method, no, they follow a system called as block of asset system. Under WDV method, for computation of depreciation, they follow a system called as what, sir? Block of asset system. Sir, what do you mean by this system called as block of asset system? Under block of asset system, no, all the assets having the same rate of tax and falling under same class. All the assets having the same rate of tax and falling under same class are grouped into one. and for that entire group or for that entire block, depreciation is given. Sir, no, I didn't understand. A block of asset system means what, sir? You are grouping the asset into a block. You are grouping all the different assets into a block which are having same rate of depreciation and which are falling under same class. Block of asset system means what? You are grouping the assets which has same rate of depreciation and which fall under the same class, and you give depreciation for them. That is called as block of asset system. For example, if you see over here, there are different items which are given over here: car, books, plant and machinery, etc. Now I will create separate blocks. How are this block created? Like for example, building is a separate category, furniture is a separate category, car, books, plant and machinery, laptop, this thing and all, they are all separate categories. Now I am going to create different blocks. How will I create blocks, sir? All those things which are classified as building will be falling under the block of building. All those things which are classified as furniture will be falling under the class of furniture. All those things which are classified as intangible assets will be classified under intangible asset. Now all those things which are classified as plant and machinery will be classified as plant and machinery first, and I'll see the rate of plant and machinery. There are some plant and machinery which are taxable at 15%. There are some plant and machinery which are taxable at 40%. So what am I going to do, sir? I am going to put them into that block. Sir. Once again, can you repeat, sir? Block of asset system means you are grouping the asset. You are grouping the asset which has same rate of tax and which fall under same class, into one. That is called as block of asset. Now, sir, what is the different rates of depreciation, sir? Sir, do I have to study the rates of depreciation? Answer is yes. Sir, will they not give the depreciation rate? Once again. Sir, will they not give the rate of depreciation? In my question, sir, will they, when I am solving the questions in the examination, will they give the depreciation rate, sir? Answer is no. They are not going to give you depreciation rate. So you will have to see what are the different assets and what are the rate of depreciation. Normally, for building, if it is a residential building, 5%. If it is a temporary structure, 40%. But for all other types of building, it is 10%. So normally, what is the tax rate for building, sir? It is 10%. What is the depreciation, not tax rate? Depreciation rate for building, it is 10%. Now, if it is a furniture, including electrical fittings, if it is a furniture including electrical fittings, then the depreciation rate will be 10%. Similarly, if it is an intangible assets, if it is what? Intangible assets except goodwill. If it is an intangible assets except goodwill, rate of depreciation is 25%. Meaning, lawmaker says, I will give depreciation for all the types of intangible assets except goodwill. Goodwill means what's reputation? Reputation, correct, not correct? What will you like? What do you like in your life? Will you like it if your reputation decreases, or will you like it if your reputation increases? Lawmaker says reputation is something which no person will like to decrease. So lawmakers under income tax law, they say for goodwill I will never give any depreciation. For other type of intangible assets, yes, depreciation is allowed at 25%, but for goodwill, depreciation will never be given. Then we have plant and machinery. If nothing is given, plant and machinery, the rate of depreciation is 15%. What is the rate of depreciation, sir? For normally plant and machinery, 15%. But there are separate categories of plant and machinery. If it is a motor vehicle, depreciation rate is 15%. But if you are a person who is in the business of renting, hiring of motor vehicle, then it is 30%. Similarly, if you are if it is a ship, vessel or boat, they fall under the if it is a ship, vessel or vehicle, or okay, if it is a ship or a vessel or a boat, the rate of depreciation is 20%. It is an aircraft, 40%. If it is a pollution control equipment, 40%. Computer including computer software and computer peripherals, 40%. Windmills, 40%. Oil wells, 15%. Books including annual publication, 40%. And all other plant and machinery is 15%. So this is the rate of depreciation for different plant and machinery. Okay. So this is something which you have to remember. Normally you just remember this. For building it is 10%, furniture it is 10%, intangible assets 25%, and for plant and machinery normally it is 15%. If it is books, computer including computer software, etc., it is 40%. Okay, okay, sir. Now comes the most important part. How do I compute the depreciation, sir? How do I compute the depreciation, sir? You should take, please note, fantastic method. It is very important. Please follow this carefully. depreciation, normally one adjustment question will be there. The depreciation calculation under income tax law and under accounts is completely different. So please be careful. Computation of depreciation. First, you should take opening WDV of the asset. Whichever asset you are claiming depreciation, you take opening WDV or opening value of that asset. To that, add whatever assets are acquired during the previous year. Add what? All the assets which are acquired by you, purchased by you during the previous year. You'll add what assets? When you are adding the asset, no, you divide this asset into 3 categories. Please note, take opening value of assets. If there is any opening value, you take that opening value. Then add to it all the assets which are purchased by you during previous year. When you are adding the asset which is purchased by you during previous year, divide those assets into 3 categories. Which are these 3 categories? What are the assets which are purchased by you during the previous year and put to use for 180 days or more? Those assets which you have purchased during this year and you have used for 180 days or more. Then second category is all the assets which are purchased by you or acquired by you during the previous year and put to use for less than 180 days. What are the different assets which you have purchased during the previous year and used for less than 180 days? Then third category will be assets acquired by you during the previous year and not put to use at all. Wait. Normally, whatever assets I am purchasing during the previous year will be divided into 3 categories. It is asset purchased and put to use for 180 days or more. Asset purchased during the previous year and put to use for less than 180 days, and asset which are not put to use at all. So you do this, you will get some amount. From this, you are required to subtract whatever money you have received from assets sold by you during the previous year. Please note, you should not subtract the book value of assets sold. No. Whatever sale proceeds you have received, meaning whatever money you have received from assets sold during the previous year. Please note, I will repeat again. You should not subtract the book value of that asset. Under your accounts, you subtract book value. No. Here they are telling you should subtract whatever money you have received from the asset which are sold by you during the previous year. First, so repeat. First, I'll take opening WDV, add asset purchased during the previous year, divided into 2 categories. Used for 180 days or more, used for less than 180 days, used for not used at all. You will get some amount. From that, subtract whatever assets you have sold during the previous year. What should I subtract, sir? The sale value, whatever amount you have received. Now, you will get something that is called as WDV for depreciation. This something which you have got now is called as what, sir? WDV for depreciation. It is on this amount I will give depreciation. Now what happens is this amount is required to be divided. So on WDV for depreciation is given under section 32. WDV for depreciation, you are supposed to divide this WDV for depreciation under 3 categories. Which are these 3 categories? I should divide them, sir. Please note, can I say this WDV for depreciation will have items which I have not used at all? It will have items which I have used for less than 180 days. It will have items which I have used for more than 180 days. Correct, not correct? So opening and more than 180 days items will be there. Items used for less than 180 days, this will be there. And items which is purchased by me but not used at all. So lawmakers are telling, so divide this WDV for depreciation into 3 categories. Asset which is not put to use, asset put to use for less than 180 days, asset put to use for 180 days or more. If you have any asset which is not put to use by you, you have purchased it during this year, but you have not used it at all. Lawmaker says, if you have any asset which you have purchased but not put to use at all, then don't give any depreciation. If you have any asset which you have purchased during the previous year but not at all used, and because you have not used, why should I give depreciation to you? Lawmakers are telling, because you have not used, I will not give depreciation to you. Similarly, if you have purchased any asset and used for less than 180 days, then give 50% depreciation. Meaning whatever it is there, 50% of that will be given. Sir, you are confusing, sir. What is confusing? Sir, under our accounts, no, sir. We gave depreciation based on how many days the asset was used. Here, are we not following that? No. Here, they say directly see whether it is used for more than 180 days or less than 180 days. If it is used only for 1 day also, you will get 50% of depreciation. Meaning what, sir? If the asset is purchased by you during the previous year and put to use for less than 180 days, you will get 50% depreciation. For example, if there is an item taxable at 15%, if you have purchased a plant and machinery which are taxable at what, sir? 15%, and if that is used for less than 180 days, then you will get depreciation of 15% ka 50%. 15% into 50%. We will see a question. We'll see a question. You'll understand this. And if you have any asset which you have used for more than 180 days, you will get 100% of depreciation. Whatever depreciation is there, whatever rate is there. For example, if the rate is 15%, into 100% will be given to you. Now, please note, when you are dividing this WDV for depreciation, when the breakup is given for this WDV for depreciation, you are going to first allocate to asset which is not put to use. Then you are going to allocate the items to asset which is put to use for less than 180 days, and then finally for 180 days or more, and accordingly depreciation is given. Sir, can you please give a question, sir? Can you please explain with an example? Yes, let us say this question. Compute the depreciation of Priya sarees using the following information. Opening WDV asset acquired and put to use by 25th of December 24 and 15th of September 24. So this is used for less than 180 days. This is used for more than 180 days. And this opening asset is also used for more than 180 days because it is used from the beginning. Now sale value of asset sold is 3 lakh rupees. Rate of depreciation is 15%. So I'll take opening, add purchases. I'll get my total item, total value. From that, I'll subtract the sale proceeds. Whatever assets is sold by me, I'll subtract that. Now I got WDV for depreciation. This WDV for depreciation which I have to divide between 3 people. Who are these 3 people? Asset not put to use. Do you have any asset which is not put to use? No, sir. Then how much is WDV for depreciation, by the way? 12 lakh rupees. Then I will give it to whom, sir? Asset put to use for less than 180 days. How much is the asset which is put to use for less than 180 days? 4 lakh. Okay, first I will give it to whom? Not put to use. Then I will give it to asset which are put to use for less than 180 days. Now whatever is left over, how much is left over? 8 lakh rupees are the asset which are put to use for 180 days or more. Now on 4 lakh rupees, I will give 15% into 50% as depreciation. On 8 lakh rupees, I will give 15% into 100% as depreciation. Okay, because these are put to use for less than 180 days, I will give depreciation of half depreciation, meaning whatever rate is there into half. Because the other assets are used for more than 180 days, I will give it full depreciation. So whatever assets are not put to use at all, no depreciation for them. So if you see over here, this 12 lakh rupees which we have not put to use is 0, therefore depreciation is not there. Put to use for less than 90 days is 4 lakh. So 4 lakh into 15% into 50%, 30,000 is the depreciation. Put to use for 180 days or more is the balancing figure, which is 8 lakh into 15% into 100% is the depreciation. So total depreciation which you are going to get in this category is how much, sir? 1,50,000. Sir, how, sir? 1,50,000. You should do total of these 3. 0 plus 30,000 plus 20,000 is 1,50,000. So subtract depreciation amount. Whatever is left over is your closing WDV of this asset. It is what's a closing WDV of the assets. Now please note. We understood one point. What did we understand? If I am purchasing any asset and putting use for less than 1 days, I'll get only 50% of depreciation. Now there is one important point with respect to this. Note, if any asset is purchased during the previous year and is put to use for less than 180 days in that previous year. Oh, sir, repeat. If you are purchasing any asset during the previous year and if you are putting it to use for less than 180 days in that previous year, then only 50% depreciation will be allowed for that previous year. In simple words, what is this point telling? If you are purchasing any asset during a year and the same year if you are using for less than 180 days, then for that same year you will get 50% depreciation. But however, if you are purchasing an asset this year and putting it to use in the next year, then irrespective of how many days you have used it in the next year, you will get full depreciation. So 50% restriction is only in the first year. So in the year when you are purchasing, if you are putting it to use in the same year for less than 180 days, I'll get 50%. But if you are purchasing this year and using it in next year, it does not matter whether you used for less than 180 days or more than 180 days, next year you will get full depreciation. So there are other questions also which you can go through. One more beautiful important concept is there, concept called as additional depreciation. Hey, what is this concept called as? This concept is called as Additional depreciation. Sir, what is additional depreciation, sir? Extra depreciation. Section 32(1) QA says extra depreciation. I will give you additional depreciation or extra depreciation. Who will get this? If you are a person who is involved in power generation business, if you are a person who is involved in power distribution business, if you are a person who is involved in power transmission business. Hey, who gets additional? Hey, who gets this additional depreciation? A person who is involved in power generation business, distribution business, or transmission business. Basically, if you are involved in power business, or if you are a person who is involved in manufacturing business. Who gets additional depreciation? A person who is involved in manufacturing business will get additional depreciation. Sir, how much is this additional depreciation, sir? 20%. Please note, what is additional depreciation? Say normally you are getting a depreciation of 40%. Extra you will get what, sir? 20%. Normally you are getting a depreciation of 15%. Extra how much you will get? 20%. This is additional depreciation. Extra depreciation will be given to you. So additional depreciation is how much? 20%. Additional depreciation will be available only if an assessee has opted for WDV method of depreciation. Who will get this additional depreciation, sir? An assessee who is opted for WDV method of depreciation. Who will get this additional depreciation? That person who has opted for WDV method of depreciation. Sir, if I follow SLM method, I will not get additional depreciation. No. Only if you have followed WDV method of depreciation, you get additional depreciation. What is the rate of additional depreciation? 20%. Then, additional depreciation is available only on plant and machinery. Sir, what do you mean by this? Normally assets are of 4 types. Which are these 4 types of assets, sir? One is your building, furniture, intangible assets, and plant and machinery. Now, on building, furniture, intangible assets, additional depreciation will not be allowed. Additional depreciation will be allowed only on plant and machineries. Then, additional depreciation is not available in following cases. Meaning, in the following cases, additional depreciation will not be given. Normally, additional depreciation is given only for plant and machinery, but still, in these cases, I will not give you additional depreciation. Which case? In case of used plant and machinery or second-hand plant and machinery. If you have second-hand plant and machinery or if you have used plant and machinery, you will not get additional depreciation. Then, if you have any vessel, vehicle, aircraft. If you have what? Vessel, vehicle, aircraft, you will not get additional depreciation. So if you have a car, bike, etc., on that additional depreciation, will it be given to you? No. If you have a second-hand plant and machinery, will you get additional depreciation? No. If you are having any plant and machinery which you are using it under in residential accommodation, so there is say employee quarters in factory. So over there I have purchased an AC and putting it to use over there. Will I get additional depreciation? Answer is no. Then, if you are using any plant and machinery in office premises, if you are using any plant and machinery in normally additional depreciation is given only on plant and machinery. If that plant and machinery is used in office premises, please note, office premises is a place where normally your books or your all your white collar employees are going and sitting. So that is your office premises. In that place, if you are using any plant and machinery, you have bought any plant and machinery and it is used over there, you will not get. But what if it is used in factories, sir? Then you will get. So used plant and machinery, vessel, vehicle, aircraft, residential accommodation, you are using any plant and machinery, office premises, you are using any plant and machinery, you will not get additional depreciation for these items. Sir, and also you will not get additional depreciation on those assets for which you have already claimed 100% deduction under any other provisions of PGBP. So there are few topics which you are going to learn under in future. Those topics says you will get 100% deduction. You will get what's 100% deduction. 100% deduction can be claimed for that expenditure which is incurred by you. If you are already claiming 100% deduction over there, why should you get additional depreciation? Lawmakers are telling no. I will not give you depreciation also, by the way. Now please, next point. Additional depreciation is allowed in the previous year in which plant and machinery is put to use. So when will I give additional depreciation, sir? I will give the additional depreciation to you in that year when the plant and machinery is put to use by you. I'll give additional depreciation to you in which year? In that year when the plant and machinery is put to use by you. Whenever you are putting that plant and machinery on use, that year I will give additional depreciation to you. Sir, what if the plant and machinery is used for less than 180 days? Additional depreciation is allowed in the previous year in which plant and machinery is put to use. However, if the plant and machinery is put to use for less than 180 days in a previous year, then 50% additional depreciation will be given for that year. Meaning, normally, if you are using some asset for less than 180 days, what will happen, sir? If you are using any asset for less than 180 days, you will get only 50% depreciation. Correct? Not correct. You will get 50% depreciation. How? Now, in case of additional depreciation also, normally the rate is 20%. You will get only 10% depreciation. Only 10% additional depreciation for an asset if that asset is put to use for less than 180 days. So only 50% additional depreciation will be given for that year, and balance 50% shall be allowed in next year. And balance 50% will be allowed in what, sir? Next year. So if you have any asset which you are using it for less than 180 days, I will give 50% this year, balance 50% I will give in next year. For example, Priya Sadis, a manufacturer, has purchased a plant and machinery on 15th of August for 5 lakh rupees. Depreciation for previous year 24-25. If the plant and machinery is put to use on 15th of August, because it is used for full 180 days, it will get normal depreciation and it will also get additional depreciation. Normal depreciation is also 100%, additional depreciation is also 100%. What if it is used in 20th of October? So it is used for less than 180 days. In such case, 50% of normal depreciation and 50% of additional depreciation will be given. So basically, whatever depreciation you're getting, 50% of that you will get. Good questions are given over here. I mean, of course, you have solved all this question in the classroom. Next, section 50 talks about what, sir? Section 50 talks about capital gain in case of depreciable assets. Capital gain in case of depreciable assets. So if you have any asset on which you can claim depreciation, then how do I compute capital gain? Very simple logic. 2 points you should remember. Now 3 points you should remember. WDV for asset can be nil but never negative. Under income tax law, an asset can have a WDV, closing WDV, which can be 0, but it should never be negative. It can never be negative. It can be 0, but it can never be negative. Then capital gain will always be short-term capital gain. Whenever you are getting a capital gain for depreciable assets, that capital gain will always be short-term, and cost of acquisition will be WDV before sales. Sir, how will I compute capital gain, sir? What will be the cost of acquisition? Cost of acquisition, when you are taking, you should take cost of acquisition as the WDV before subtracting sale proceeds. Before sale price, whatever amount you have got, that. Now please see. Please see over here. Case number 1. So I have an opening assets of 6 lakhs. Total 5 assets I have. Purchases I made for 2 lakhs. I purchased 2 assets. So total assets I have is worth 8 lakh rupees. And how many assets I have, sir? 7 assets I have. Now all the 7 assets were sold by me for 11,50,000 rupees. I sold it for what amount, sir? 11,50,000 rupees. Now can I say, if I subtract the sale proceeds as 11,50,000, I will get a negative figure over here. What did lawmaker tell? WDV of the assets can be 0 but never negative. So though I have sold the assets for 11,50,000, I will take only 8 lakh rupees over here. So my number of assets which I have now is 0, and value of those assets is also 0. So do I have any assets now? No, sir. Do I have any WDV now? No, sir. So depreciation can I claim, sir? No. So when you don't have assets and WDV, then you cannot claim depreciation. Who will come into picture now? Capital gain will come into picture. Who will come into picture? Capital gain will come into picture. So what will be the capital gain? You take sale price, subtract your cost of acquisition, which is nothing but your WDV before sales. Whatever difference is there, 11,50,000 minus 8 lakh is your capital gain. What type of capital gain? Short-term capital gain. Always it will be short-term capital gain. Similarly, let us say everything same. Now I sold all the 7 assets for 6,50,000. I sold it for 6,50,000. Now please understand this carefully. I sold all the assets for a lower price. The value of the assets were 8 lakh, but I sold it for 6,50,000. Now what will happen? Will I have any assets with me? No, because I have sold all these assets. All the 7 assets were sold by me, so I will not have any assets value. But however, if you see, WDV will be there. I don't have an asset, but I have a WDV. Why do I have a WDV? Because my book value was 8 lakh. I sold it for 6,50,000. Therefore, I have a WDV. Lawmaker says. Now here, Do you have assets? I don't have assets. Do you have WDV? Yes, I have WDV. Now lawmaker says if you don't have an asset, but if you have a positive WDV, I will not allow you to give depreciation. Or you should have an asset to give depreciation, right? So here you don't have assets, I will not give you depreciation. Who will come into picture? Capital gain will come into picture. So your sale price is 650, cost is 8 lakh rupees. Difference is 1.5 lakhs is your short-term capital loss. It is what, sir? Short-term capital loss. Similarly, next case number 3. Case number 3. Let us say I didn't sell all the assets. I sold only 5 assets for 9 lakh rupees. So what will happen over here? 8 lakh is my WDV, 7 assets I have. I sold how many assets? 5 assets. So can I say if I sell 5 assets, there will be still 2 assets remaining? So if I subtract my sale value, if I subtract 9 lakh rupees, can I say this amount will come negative? So I cannot subtract 9 lakh rupees. How much will I subtract? I'll subtract only 8 lakh rupees. Now in this question, what is happening? I have assets with me, but there is no value. WDV of that asset is not there. I have assets, but still there is no WDV for that asset. Lawmaker says if you have assets but not WDV, you cannot claim depreciation. You have assets, I understand that, but you don't have WDV. On what amount will you give depreciation? Therefore, I will not give depreciation. Now, who will come into picture? Capital gain. Who will come into picture? Capital gain. So, your sale price minus cost is your capital gain, which is 1 lakh rupees. 9 lakh you sold it, 8 lakh is your cost of acquisition. Therefore, difference of 1 lakh rupees is your capital gain. Case number 4. I sold assets for 6 lakh rupees. 5 assets I sold for 6 lakh. Now what will happen? I will have a positive WDV also and assets also. Now can I say if I have assets as well as WDV, I have assets, I have WDV, can I give depreciation? Yes. The question of capital gain will not come. When will the question of capital gain come? Either I don't have assets as well as WDV, or I have only assets but no WDV, or I have only WDV but no assets. In these 3 cases only, capital gain will come into picture. If I have assets as well as positive WDV, no capital gain will come into picture. SLM method of depreciation. Which method, sir? Straight line method of depreciation. Whatever we just now learned was computation of capital gain under WDV method. Sir, what will happen in case of straight line method? Here the concept is little different. Under straight line method, the computation of what, sir? Under straight line method, the computation of capital gain is completely different. Lawmaker says under straight line method, you will get capital gain only when you sell a capital asset, only when you sell a depreciable asset at a price more than its cost. Under straight line method, if you want capital gain, then you should sell the asset for a price more than its cost. SLM method follows individual asset system. It follows what systems? Are individual asset systems. So cost of the asset is 100 lakhs. I purchased it on 15th of August 2022. At depreciation, I give a 10% straight line method, and I sold the asset on 30th of December 2024. So as on the year 24-25, what is the WDV of that asset? So I purchased for 100 lakhs, gave depreciation for 2 years. Now the opening WDV or the WDV for 24-25 will be what, sir? 80 lakh rupees. I have sold asset worth rupees 80 lakhs for 72 lakhs. Can I say I sold at a price less than its WDV? I sold at a price less than its WDV. Lawmaker says whatever difference is there, that loss is there, no, whatever difference is there, sale price is 72, cost is 80, the difference of 8 lakh rupees, that 8 lakh rupees which is there, that will be treated as terminal depreciation. It will be called as what, sir? Terminal depreciation, and you can claim deduction of that. It will be treated as terminal depreciation, and you can claim deduction of this. This is terminal depreciation. You can claim deduction of this. It is allowed as deduction in the previous year when asset is sold. It will be allowed as deduction in which year? It will be allowed as deduction in the year in which asset is sold. By the way, it is called as what? Terminal depreciation. It is called as terminal depreciation. It is allowed as deduction in the year when asset is sold. It is allowed as deduction means it is treated as business expenses in the year when asset is sold. Then case number 2, sale price and what is this? Sale price is 90 lakh rupees. Hey, what is the WDV? 80 lakh rupees. Sale price is 90 lakhs. Can I say the asset is sold at a price more than its? Can I say the asset is sold at a price more than its WDV? Yes, sir. Yes, sir. Yes, sir. Therefore, your sale price minus WDV, 10 lakh rupees, whatever is there, no, that is called as balancing charge. That is called as what, sir? Balancing charge. This is deemed as business income. This balancing charge is deemed as business income in the as per section 41(2), and it will be taxable in the year in which asset is sold. It will be deemed as business income. Then we have, what if the asset is sold at a price more than its cost? Now please note, when the asset is sold at 112 lakhs, can I say asset is sold for more than 80 lakh rupees? And can I also say asset is sold for a price more than 100 lakh rupees? So can I say the asset is sold at a price more than its WDV and cost? Yes, sir. Now lawmaker says the difference between the sale price and the cost is called as capital gain, and the difference between cost and WDV is called as balancing charge and is taxable under business income. Capital gain is taxable under capital gain. I'll repeat once again. Sale price is 112 lakhs, WDV is 80 lakhs. 32 lakhs is the gain which I have got. In this 32 lakhs, whatever gain I have got in excess of cost, full value of consideration minus cost, whatever gain in excess of cost I have got, what is the cost? 100 lakhs, that will be taxable as capital gain. It is always short-term capital gain. And whatever gain I have got for value more than its WDV, correct? So 80 to 100 lakhs, that is my business income, taxable as balancing charge under section 41(2). This is your capital gain in case of depreciable assets. Next, 43A. What are the consequences whenever there is a change in exchange rate? See, normally what happens is, if I purchase some assets from a foreign country, if I purchase some assets from outside India, then I may have to pay that person in foreign currency. Now, it may happen that I have purchased asset today, I am paying after 3 months, 4 months, 6 months. Say at the time when I purchased asset, I purchased an asset worth rupees $1 lakh. Okay, at the time when I purchased the asset, value of $1 was 65 rupees. Now tomorrow when I am making the payment to that person, the value of $1 is 67 rupees. So can I say I will have to pay 2 rupees extra? Correct, not correct? So if you see 2 rupees extra, that is almost equal to 2 lakh rupees extra I will have to pay in Indian currencies. I'll have to pay 2 lakh rupees extra. Because why am I paying, sir? Because there is a change in foreign, there is a fluctuation in foreign currency. So, sir, this 2 lakh rupees which I have paid extra, no, sir, what will happen to this 2 lakhs? Lawmakers are telling whatever increase or decrease in exchange rate is there, whatever extra money you are paying or whatever less money you are paying due to fluctuation in foreign currency, that will be added to the cost of asset. And you can claim depreciation on that. So if you are paying extra, for example, in our present case, I paid 2 lakh rupees extra, that will be added to the cost. I can claim depreciation on this. So what if I have paid 3 lakh rupees less? Then subtract it from your cost of asset. So what is this point telling? This question is there. Opening WDV is nothing. I purchased assets on the date of purchase, the value was 65 and there is no sales. At the time when I paid at 67 rupees. I paid at what price, sir? 67 rupees. So can I say I paid 2 rupees extra? Now because I paid 2 rupees extra, I'm making an extra payment. Because I made an extra payment of 2 lakh rupees. Okay, not 2 lakh rupees in this case. I made an extra payment of 1 lakh rupees. I will add it to the cost, and on this entire amount I will give depreciation. Next year when I was repaying, no, I paid 3 lakh rupees less. I paid how much, sir? 65 was the price at the time of purchase. Now the price is 62 rupees. So I paid 1.5 lakh rupees less. I'll subtract it from my cost. Not 3 lakh rupees, 3 rupees less. So it will be subtracted from cost. So whatever fluctuation is there, it should be either added or subtracted from cost. Then we have a concept called as unabsorbed depreciation. Unabsorbed depreciation means what, sir? That portion of depreciation which is not able to be taken care by the profits of the business. Unabsorbed depreciation. What do you mean by this? If the current year business is not, if the current year business income is not able to fully adjust or absorb the current year depreciation, if the current year business income is not able to fully absorb, fully adjust the current year depreciation, then such unabsorbed depreciation or unadjusted depreciation is called as Unabsorbed depreciation. Such unadjusted depreciation is called as what, sir? Unabsorbed depreciation. So if your business income of this year is not able to take care of the depreciation, then it is called as unabsorbed depreciation. Now, what is the impact of this unabsorbed depreciation? Unabsorbed depreciation can be carried forwarded to indefinite period, and it can be set off in future years against any income. Against any income. For example, if you see, what do you mean by? See, for example, my income is 20 lakhs and my expenses is 24 lakhs. So can I say my income is more than expenses? So 4 lakh rupees is extra expenses. This 4 lakh rupees will give me my business loss. It will give a business loss. But if this loss which I am getting, if the business loss is due to depreciation, then it is called as unabsorbed depreciation. So I've given different example over here. If current year income not able to absorb current year expenses, you will get business loss. If current year income is not able to absorb current year depreciation, you will get unabsorbed depreciation. Now next is actual cost. Time passes. They have never asked this point in examination. But anyways, we'll see what is this. Actual cost. Actual cost of asset. What is actual cost of asset, sir? Your cost of acquisition and all the expenses incurred by you for bringing the asset up to the place of put to use, like installation charges, transportation charges, transit insurance, packing cost, testing charges, any duties and taxes, excluding those taxes where you have taken input tax credit, any interest on loan, etc. Add all those expenses. Subtract from that any grant which is given by the government, any money which you have received by selling the trial run products. Whatever you get now is called as your actual cost. Now please note, when you are adding these expenses, any expenses which is paid more than 10,000 rupees in cash should not be added. Then if the stock in trade is converted into business asset, then the market value as on the date of transfer will be taken as market value as on the date of transfer will be taken as actual cost. For example, I'm an electronics dealer. I had an AC. This AC now I converted into my business asset. Can I say I was an electronics dealer, therefore this AC is my stock in trade? Now I converted into business asset, therefore it became what, sir? My business asset. So can I claim depreciation, sir, on this? Yes. What will be the value, sir? Market value as on the date of conversion. Fair market value. Asset acquired by way of gift or will. So if someone is gifting me an asset, for me the actual cost will be whatever is the actual cost to that person, subtract depreciation as if it was used by him for business purpose. Now the amount which is left over is called as your actual cost for your business purpose. Now if any person is purchasing an asset and selling it to you at a higher price, then lawmaker says officer will determine what is the actual cost for that. For example, someone purchased the asset for 10 lakh rupees. Now he is selling that asset to me for 50 lakh rupees. I am purchasing that asset from someone for a higher price. Lawmaker says, no, I will not take whatever price you are telling me, but I will calculate the price myself. If you sell an asset and repurchase the asset, then the actual cost will be your sale price or repurchase price, whichever is less. If you sell any asset to a person, and if you purchase any asset from a person and lease back the asset to the same person, then here your actual cost will be your purchase price or lease price, whichever is less. Actual cost in case of a building. If there is a building which you were using for your personal purpose, now you are putting it to your business use. If there is any building which you were using for your personal purpose, now you are going to use that building for your business purpose. Lawmaker says then actual cost of that building for business purpose will be actual cost of that building. Subtract depreciation as if it was used for business purpose. This subtraction which you do is also called as notional depreciation. You subtract the depreciation as if it was used for business purpose. Whatever amount you get now is the actual cost for business purpose. Now please note, this point which I have just now gave you, this point which I just now told is applicable only for building. Sir, can you repeat? If I have any building which I was using for my personal purpose, now I am going to use it for my business purpose. Lawmaker says whatever cost is there, subtract depreciation for how many years you used it for personal purpose. Now whatever is left over will be actual cost for your business. This provision is applicable only for building and not other items. For example, if I have a car which I was using for my personal purpose, now if I am using it for my business purpose, will this concept of notional depreciation work? Answer is no. Sir, what will happen if I am using any asset partly for business purpose, partly for personal purpose? You can claim depreciation proportionately. You can claim depreciation what, sir? Proportionately. Okay, not okay. Next is our scientific research. Before this, I'll take a chota sa break. So section 35 talks about scientific research. What is scientific research? Or if you are doing any research for your business purpose, there are two categories over here. Either you do in-house research or you give donation to any person who is doing research. So if you are doing in-house research, beautiful. So assessee is doing research for his own business purpose. So in that case, lawmaker says scientific research is allowed at deduction under section 35. Now, expenditure is incurred after commencement of business or is it incurred before commencement of business? Whenever there is a case of scientific research, you should see when the expenditure is incurred. Is it incurred after commencement of business? Yes, sir. Then whatever capital expenditure you have incurred will be allowed as deduction except on land. If you have started business, for example, I am what, sir? I am into making chips or I'm into making namkeens, etc. Okay, now I have started my business. I have started selling the chips. I have made one chips, say one aloo bhujia or one namkeen I have made or one chips I have made. Now I have started selling those chips. Now lawmakers are telling, have you incurred the expenditure after starting your business? Yes, I have started the business. Now I am incurring expenditure. What type of expenditure are you incurring? Capital expenditure, sir. So 100% is allowed as deduction. Whatever expenditure you are incurring, 100% of that expenses will be allowed as deduction except on land. But if you are incurring any expenditure and if that expenditure is a revenue expenditure, lawmaker says, I don't care what type of expenditure it is, 100% allowed as deduction. Sir, in-house scientific research person, whether he is incurring capital expenditure or revenue expenditure, if it is incurred after commencement of deduction business, then 100% will be allowed as deduction except on value of land. Except the value of land, anything else is there, it will be 100% allowed as deduction. Sir, what if I am incurring an expenditure before commencement of business? Lawmaker says, if you are incurring expenditure before commencement of business, you can go maximum how many years before? 3 years before commencement of business. And now your expenditure can be capital or revenue. So whatever expenditure you have incurred 3 years before the start of business, capital expenditure will be allowed as deduction except on the value of land. Sir, what if I incur an expenditure after commencement of business? Lawmaker says, if you are incurring any expenditure after commencement of business, then if it is for material and salary excluding perquisites, it will be allowed as deduction. But if it is for any other expenses, it is not allowed as deduction. Repeat it. I have started business. Please see. So let us say this is the date when I started business. Any expenditure incurred after commencement of business, whether it is capital or revenue, 100% allowed deduction. Any expenditure incurred before commencement of business, I can go maximum how many years before? Only 3 years before I can go. If it is capital expenditure, 100% is allowed as deduction. If it is revenue expenditure, for material and salary only it is allowed, raw material and salary. But any other type of revenue expenditure incurred by you before starting the business will not be allowed as deduction. Sir, can I claim, sir, you said that for capital expenditure also deduction will be allowed. Can I claim depreciation on this item, sir? No. Where any deduction is claimed under section 35 for any asset, then depreciation under section 32 will not be allowed for that asset. Now, sir, what if I am purchasing land and building both together only? I am purchasing land along with building. Then lawmaker says whatever is the market value of land, that on that value no deduction will be allowed. If any building is purchased along with the land, then the cost of such asset, such land and building shall be divided on the basis of fair market value of such land and building, and deduction shall be allowed only for building and not for land. So if you are having any building which you have purchased along with land, then for land deduction will not be allowed. For building anyways deduction will be allowed. You should divide the land value of land and building based on the market value of that land and building. Okay, sir. Unabsorbed depreciation. Next point is what, sir? Unabsorbed depreciation. Sir, what do you mean by unabsorbed depreciation? Unabsorbed depreciation is something which we just now saw. Exactly same as unabsorbed depreciation, you have unabsorbed capital expenditure. If your business income is not able to take care of the capital expenditure incurred by you, then that is called as unabsorbed capital expenditure. This unabsorbed capital expenditure can be carried forward for unlimited years and it can be set off in future years, just like your unabsorbed depreciation. Now, sale of assets. Sir, I have taken deduction for an asset under section 35. I have taken a deduction for an asset under section 35. Now I have sold that asset. I have sold that asset. what will happen, sir? Under section 35 you have claimed deduction, no? Yes. Then in case where you sell that asset for which you have claimed deduction under section 35, you will get a business income under section 41(3). What is the business income? Whatever deduction you got earlier or sale price whichever is less. Whatever deduction you have already claimed earlier or sale price whichever is less will be your business income. Sir, what if the sale value is more than the cost of asset? If the sale value is more than the cost of asset, then the business income will be taken. Sir, please note, please note. Whatever deduction you have got earlier, all the sale price of asset, whichever is less, will be your business income. If the asset is sold at a price more than the deduction given to you earlier or more than the cost of that asset, then lawmaker says, then up to cost, meaning whatever deduction you had claimed earlier, that will be business income. That will be business income, and amount more than cost, sale price minus cost of asset, will be taken as capital gain, just like your depreciation concept in case of which SLA method. Now we have what, sir? Donation to research organization or research associations. So if you are giving any donation, to whom, sir? Any approved research association, any approved institution, any approved college or any approved university. If you are giving donation to them, you are giving money to them for scientific research, social research, statistical research, then 100% is allowed as deduction. Whatever amount you have paid to them, 100% of that will be allowed as deduction. If you are giving money to approved research association, approved institution, approved college, university for scientific research, social research, statistical research, then 100% will be allowed as deduction. If you are giving donation to an approved Indian company whose business is only doing research and expenditure, please note, if I give money to someone, can I say it is my expenditure? So lawmakers are telling, if you are giving money to someone and that someone is an approved research institution, college, university who is doing these types of research, 100% of money can be claimed as deduction. Meaning when you are creating your profit and loss account, you can claim that as deduction. Sir, if it is an approved Indian company which is engaged in the business of research and development, and doing scientific research, then also 100% deduction will be allowed. If you are a national laboratory or IIT or university who is doing approved scientific research, then also 100% deduction will be allowed. Please note, in simple words, if I pay money to these three people, and if they are either approved institutions or approved research they are doing, then whatever money is paid by me, 100% of that will be allowed as deduction. What is important? Note, if the assessee opts for 115 BAC, then only in-house scientific research will be allowed as deduction. No deduction will be allowed for donation paid by the assessee. So deduction under section 35. Now please note, I have paid the money, and later their approval was taken over by government. Please note, the institution should be approved, the company should be approved. Now I gave the money to them. At the time when I gave the money, they had the approval, but later their approval was withdrawn. Deduction under section 35 shall not be denied if approval of the institution is withdrawn after donation is given. Now this section is no more applicable. This section which is there is no more applicable. Please watch a video I have uploaded on the YouTube. You just watch that video in our channel. You can watch it in our channel. I have uploaded a video wherein there are few exclusions from your syllabus. There are few topics which are no more there in your syllabus. You just watch that. One of the section is section 35 AB. This is not applicable from May 25 examination. This section is not applicable for CA Inter students. Okay. Now section 35 AD. Section 35 AD talks about what's a scientific research. There are totally 14 businesses: cold chain business, honey business, sugar business, cross country pipeline business, 2-star hotel, affordable housing, slum redevelopment, fertilizer, new infrastructure, hospital with 100 beds, semiconductor vapor, inland container depot, etc., or iron ore business. If you're starting any of these 14 businesses, then you will get a deduction under section 35 AD. How much deduction will I get, sir? Now, any type of assessee can claim benefit of section 35 AD. Any assessee who is engaged in specified business, who is incurring capital expenditure. If you are any type of assessee who is engaged in above businesses are called as specified businesses. And if you incur any capital expenditure for above businesses except on land, goodwill and financial institution, financial instrument. Please note, if you are incurring any capital expenditure except on land, goodwill and financial instruments, then 100% of that will be allowed as deduction. 100% of that amount will be allowed as deduction. If you are any type of assessee engaged in specified business and incurring capital expenditure, then 100% of that amount incurred by you will be allowed as deduction, except on land, goodwill and financial instrument. Now, what is very important over here, section 35A is applicable only to 14 people, and for them also it is optional. It is not compulsory that those 14 people will have to follow 35AD. Now, the business which they are starting should be a new business, and the plant and machinery for which they are going to get deduction should not be a used plant and machinery, it should be a new plant and machinery. However, they say 20% of the total plant and machinery can be used. And they also say if you are importing any plant and machinery from outside India, though it is an used plant and machinery which you are importing from outside India, I will treat it as new. Sir, how much deduction will be allowed? Now, if you have incurred any expenditure before commencement of business, then you will get it the deduction in the year in which business is commenced. In the year when business is commenced, you will get the deduction. However, if you are incurring any expenditure after commencement of business, then deduction will be given to you as in when you are incurring. Please note, if you are incurring any expenditure, capital expenditure under section 35AD before start of your business, then the deduction will be given to you in the year when business is commenced. But if you incur any expenditure after commencement of business, whenever you are incurring that expenditure, whichever year you are incurring that expenditure, it will be allowed as deduction. Now, please note, no double deduction will be given. If you have claimed deduction under section 35AD, you cannot claim deduction under any other section of income tax law. Then similarly, if you have claimed deduction under section 35AD for any asset, you cannot claim depreciation for that asset under income tax law. Now, very important is that lock-in period. If there is any asset for which you have claimed a deduction under section 35AD, if there is any asset for which you have claimed a deduction under section 35AD, then that asset should not be transferred for a period of 8 years. You should not sell that asset for a period of 8 years. If it is transferred for a period of 8 years, then what are the consequences? The consequences are that if you transfer it within a period of 8 years, then the amount which is received by you on the transfer will be deemed as business income. Whatever money you are receiving will be deemed as business income. Now, please note, you should not sell it within a period of 8 years. Lock-in period is there. If you have claimed deduction under 35AD for any asset under 35AD, and if you sell it within a lock-in period of 8 years, whatever amount you have got is business income. Sir, what if I don't sell it but I use it for my other business? Meaning, I had taken the asset for my specified business. Now I am going to use it for my non-specified business. I am transferring that asset from specified business to non-specified business. I am not selling it to anyone. I have two business. I have hotel business and I have, say, a sari business. So from hotel, the asset which was there, I am transferring to sari business. So from specified business, I am transferring the asset to non-specified business. Lawmaker says, in this case, whatever deduction was given under section 35AD, less depreciation, less how much depreciation, the difference amount will be deemed as business income for the specified business. Hey, please note, hotel is transferring it to sari, no. Hotel business is transferring to sari. For hotel business, there will be a deemed business income. How much will be deemed as business income, sir? Whatever deduction was given earlier minus the depreciation. And for sari business, the actual cost of this asset will be whatever deduction it got the previous the hotel business got earlier minus depreciation. The difference is your cost for the new company. Sir, what if the asset is transferred after 8 years? The value shall be taken as the actual cost for the new non-specified business will be taken as 0. Now, please note, set off of losses of specified business. Specified business loss can be set off only against specified business profit. Specified business loss can be set off only with specified business profit, and this loss can be carried forward for an indefinite period. There is no limit. See, normally business loss can be carried forward for 8 years. But if it is specified business loss, it can be carried forward for indefinite period. Okay. Now, see this question. If you see this question, Mr. A commenced the operation of business of setting up of warehouse for food grains, sugar and edible oil. Food grains are agriculture produce. Sugar is sugar covered under 14 businesses. Edible oil is not covered under 14 businesses. So there are two specified business. This is non-specified business. He started the business on 1st April 24. He incurred a capital expenditure of 80 lakh rupees, 60 lakh rupees and 50 lakh rupees on purchase of land and building. Oh, Land, LG freeze, land, goodwill and financial instrument, you cannot claim deduction. So though he has incurred expenditure for land and building, I will claim deduction only for building and not for land. When did he incur, sir? Before start of business, which is from January 24 to March 24, exclusively for above business. Please note, he started the business on 1st of April 2024. He incurred expenditure before start of business. If you are incurring any expenditure before start of business, that can be allowed as deduction if you capitalize them in your books of accounts. What is he telling? This expenditure was incurred during the period January 24 to March 24, and the same was capitalized in the books of accounts on 1st of April 2024. The cost of land is 50 lakhs, 40 lakhs and 30 lakhs. During the previous year 24-25, he incurred a capital expenditure of 20 lakhs, 15 lakhs and 10 lakh respectively for extension of building. So during the current year, after starting the business also, he incurred some expenditure for that building purpose. Will it be allowed as deduction? Yes. Compute the profits and gains, profit and gains of business and profession for the assessment year 25-26. If he is opting, he is shifting out of default tax regime, meaning he is not following default tax regime. They have given us the profit of these businesses, food grain business, sugar business and edible oil business, before claiming deduction under section 35 AD and before claiming depreciation is 16 lakhs, 14 lakhs and 31 lakhs. How will you compute the income? First, see Mr. A, previous year, assessment year, rupees in lakhs I have written. Particulars, food grain business is a 35 AD business, sugar business 35 AD business and oil business is not a 35 AD business. So because it is not a 35 AD business, for capital expenditure, I can claim depreciation, but no 35 AD section will be applicable. You cannot claim deduction, correct? Now profit before depreciation and 35 AD deduction 16 lakhs, 14 lakhs and 31 lakhs. Deduction under section 35 AD, who will get? Only these two people will get. So expenses incurred before commencement of business for food grain business 80 lakhs minus 50 lakhs. Why, sir? 8 lakhs is total expenditure, 50 lakhs is for land. Only 30 lakhs will be allowed. Sugar, it is 60 minus 40. 60 is total expenditure, 40 is for land. Only 20 will be allowed. Expenses after commencement of business, whatever expenditure they have incurred will be allowed as deduction. So what is their profit before depreciation, sir? It is negative for first two 35 AD business and positive for the edible oil business. Now for edible oil business alone, you will get depreciation. Depreciation will be given on building, land, no depreciation is allowed. So 50 lakhs minus 30 lakhs, that is the value of building, plus 10 lakhs extra building which you have got 10%, you will get depreciation. So income after giving all the deductions and depreciation is negative 34 and 21 lakhs for 35 AD business and 28 lakhs for non-specified business. So there are 2-3 questions in our institute material. I have covered all the questions. Next is 35D. 35D is what, sir? Preliminary expenditure. Preliminary expenditure. Preliminary means what, sir? Expenditure incurred before commencement of business. Lawmaker says if you are a resident assessee, whatever expenditure you have incurred before commencement of business, resident assessee means what, sir? Either you are an Indian company or you are a resident assessee, individual HUF, OPBI, etc. Then whatever expenditure you have incurred before start of business or for starting a new business will be allowed as deduction in 5 equal installment from the year in which the business is started. So expenses incurred before commencement of new business or after commencement of business for setting up a new unit or for extension of existing undertaking is allowed as deduction in 5 equal installment. From which year, sir? From the year when business has been commenced. Deduction if you are an Indian company, actual expenses incurred by you or 5% of capital employed or 5% of cost of project, whichever is higher, should be compared with your actual expenditure. Take whichever is less, that will be the deduction which will be allowed to you. If you are other resident assessee, then whatever actual expenditure is there or 5% of cost of project, whichever is less, will be allowed as deduction to you. Now, sir, capital employed is what, sir? Share capital, debentures and long-term borrowings. Cost of project means what, sir? Amount invested in the fixed assets of that business. Now, preliminary expenses, when I say preliminary expenses will cover only these 6 items. Which 6 items? Preparation of feasibility study report, preparation of MOAO, legal expenses, engineering expenses, marketing expenses, expenses for public issue. Okay, only these items will be covered. Hey, please note, whatever expenses you are getting, no, that will be allowed as deduction in 5 equal installment. 35 DDA, VRS, voluntary retirement compensation. If the company is paying any VRS to any employee, then that expenditure can be claimed as deduction in 5 equal installment. Applicable to all the assessees expenditure incurred in connection with voluntary retirement of employees. Expenditure is allowed in 5 equal installment from the year in which business is commenced. Next is what's your section 35. Section 35 talks about expenses which are specifically allowed as deduction. These expenses are admissible expenses. Which expenses can I claim as deduction, sir? You can claim as deduction for insurance paid on stocks in stores. You can claim, meaning if you have any stocks, okay, Priya Sarees has sarees. I am taking insurance for stocks. Lawmaker says you can claim deduction. You can also claim deduction on insurance. Please note, when you are preparing your profit and loss account, you will have taken insurance on stocks, sarees, bonus given to employees, bad debts expense, etc. All these expenses, is it allowed as deduction? Section 36(1) is giving list of those expenses which is specifically allowed as deduction. You can always claim this deduction. You can claim deduction of health insurance of employee. If you are taking insurance on health of employees, then that is allowed as deduction, provided the health insurance premium you should not pay in cash. What is the condition? Health insurance premium should not be paid in cash. Allowed if it is not paid in cash. What should not be paid in cash, sir? That health insurance premium should not be paid in cash. Insurance premium paid on stock and stores health of employees is allowed as deduction. Health insurance should not be paid in cash. Sir, what if I am paying bonus or commission to my employees? Whatever bonus or commission which is paid, only which is paid to the employees is allowed as deduction. Subject to 43B. What is 43B telling? A 43B is a section which says there are few expenses which will be allowed as deduction only if you pay it within the due date of filing income tax return. There is something called as 43B. Please note, for all these points, no, you can take a reference in the next page, meaning in the future pages, I have given explanation to that. You can always see that explanation. See, bonus and commission is allowed as deduction if it is subject to 43B, meaning what, sir? If it is paid within the due date of filing income tax return. So there is a section called as 43B which will give you the list of all the expenses which is allowed as deduction only if it is paid within the due date specified under section 139(1). 139(1) is that is giving you the due date for filing income tax return. See, normally the due date of filing income tax return is 31st July of assessment year, but in case of company and in case of audit, if your books of accounts are subject to audit, then you will have to file your income tax return by 31st of October. Now what lawmaker says, whatever bonus is there, I will be allowing it as deduction if you are paying that bonus within this date. Within which date? Within the due date of filing income tax return. So in the question, if they have given bonus payable, don't take that bonus. You cannot claim it as deduction while preparing your profit and loss account. If they gave bonus paid, then you check whether it is paid before this date. If yes, then claim it as deduction. For example, the question says that the total bonus by the company is 10 lakh rupees. Now this bonus, in normal cases, it should be paid before 31st of July. Now how much is paid till 31st of July? 5, 2 plus 1, which is 8 lakhs. Therefore, this is allowed as deduction. What is paid till 31st October is allowed as deduction for audit cases. Anything paid after these dates will not be allowed as deduction while computing your business income. Please note, though you have paid a bonus, though your bonus expenses on accrual basis, you told that employees, I'll pay 10 lakh rupees bonus to you. How much have you paid? 8 lakhs. Only 8 lakhs will be allowed as deduction. Okay. Similarly, interest on loan. If you have taken any loan for your business or profession purpose, if you have taken any type of loan for what purpose? For your business purpose or for your profession purpose, then that loan which you have taken will be allowed as deduction. Now the point is, from whom have you taken the loan? If you have taken loan from banks such as Scheduled Bank, Cooperative Bank, Public Financial Corporation, State Financial Corporation, Industrial Investment Corporation or NBFC, it will be allowed as deduction subject to 43B, meaning provided you pay the interest within the due date of filing income tax return. But if you have taken loan from any person other than banks, then that will be allowed as deduction whether you have paid or not. Please note, for loan, what will be allowed as deduction? Interest on loan will be allowed as deduction. If for loan, what will be allowed as deduction, sir? Interest on loan will be allowed as deduction. So whatever loan, whatever interest you are paying to bank, cooperative society, they will be allowed as deduction if it is paid within the due date of filing income tax return. If it is paid to any other person, it does not matter whether it is paid or not, it will be allowed as deduction. Only if you are paying interest to scheduled bank, cooperative society, public financial institution, or state finance corporation, state industrial investment corporation, and NBFC, it will be allowed as deduction only if the interest has been paid within the due date of filing income tax return. Then amortization of discount on zero coupon bonds. Now, whatever discount is there on zero coupon bonds, that is allowed as deduction only if you amortize it on pro rata basis. Employer's contribution to employee welfare fund. So if employer is contributing to the welfare fund of employees, if it is recognized fund, if it is paid within the due date of filing income tax return, that deduction can be taken. If it is a recognized fund, deduction can be taken. What if the fund is not recognized? What if it is not approved? Then no deduction will be allowed while computing your business income. Sir, what about bad debts? If I am doing business and if I have a bad debts, if it is your business related bad debts, always allowed as deduction. If you're doing business, some people may not pay you, so you can claim deduction of that, yes. But if you have given money to someone and because of that reason that person has not paid you money, now that bad debts, is it allowed as deduction? Lawmaker says ille. Only business related bad debts will be allowed as deduction. Okay. Now conditions are there. What are the conditions? That debt which you are treating it as bad today, that should be treated as your income in any of the previous year, and that debt should be written off in your books of accounts. A provision for bad debts is not allowed as deduction. Please note, any provision for bad debts, is it allowed as deduction? Lawmaker says no. Sir, what will happen if I am recovering the bad debts? It is taxable. Recovery of bad debts is taxable. Section 41(4) is telling recovery of bad debts is taxable in the year when it is recovered. Then you are incurring any family planning expenditure. If it is only for companies, this point is applicable, which you are seeing. If you are incurring any family planning expenditure, if you have revenue expenditure, allowed as deduction. If you are incurring any capital expenditure for family planning, then 1/5 is allowed as deduction. It is allowed in 5 equal installment basically. So in case of animals which is dead or permanently becomes useless, you whatever cost you incurred for that animal, purchase of that animal, minus the scrap value will be allowed as deduction. Then security transaction tax allowed if you are in trading business. Now please note, employer's contribution to welfare fund is allowed as deduction only if it is paid within the due date of filing income tax return. But however, employee's contribution to welfare fund is allowed as deduction only if it is paid within the due date of that respective act. Which act, sir? That respective act, whichever fund it is. Say if it is a PF, then within the due date of PF Act. If it is superannuation, within due date of superannuation, etc. Now please note, one amendment is there over here. If employer is making contribution to 80CCD pension fund, employer contribution to 80CCD pension fund, it is allowed as deduction. Now what is the change, sir? The rate has been changed from 10% to 14%. Now how much deduction is allowed? Actual contribution which you are making, or 14% of salary. 14% of salary. Salary means basic plus DA in terms. Explanation is given in next page. You can take reference to this. Now comes the last section for deduction, meaning what are the different expenses. Last is your section 37, which talks about general deduction. What is 37 telling? Any type of business expenses which is not covered under 30 to 36. If there is any expenses which you are incurring for business purpose and which is not covered under section 30 to 36, and which is wholly and exclusively incurred by you for your business purpose. If there is any expenses which is not covered under section 30 to 36 and which is wholly and exclusively incurred for your business expenses, for your business purpose, which is not personal in nature, not capital nature, and it is not an offense prohibited by law, then you can claim that expense as deduction under section 37. Basically 37 talks about all the expenses related to your business. If you are incurring any expenses for your business purpose, and if it is not covered above, then you can claim it as deduction, provided it should not be capital expenditure and it should not be personal expenditure and it should not be an offense prohibited by law. Okay, so if it is a breach of law, you cannot claim as deduction, but if it is a breach of contract, yes. Now, salary can you claim as deduction? Yes. Partner salary also you can claim only when it is a working partner. Sleeping partner salary you cannot claim it as deduction. Director salary allowed as deduction. Leave salary is also allowed as deduction. Insurance premium. Life insurance premium is not allowed as deduction. Life insurance, anything with respect to life insurance is not allowed as deduction. If it is a key man insurance policy, health insurance policy, asset or stock insurance you are taking, always allowed as deduction. Advertisement I am doing, can I take it as deduction? Yes. But if you are doing advertisement in a newspaper pamphlet of political party, not allowed as deduction. If you are incurring any spend for corporate social responsibility, CSR spend you are incurring, you cannot claim that as deduction. You are paying any type of taxes. If it is direct taxes, whether you are paying tax, interest, penalty under direct tax law, it is never allowed as deduction. While computing income under income tax law, you cannot take any kind of expenses related to your income tax. Meaning what, sir? You cannot take deduction of your taxes paid by you, interest paid by you, penalty paid by you. If it is an indirect tax, then whatever indirect taxes you are paying, GST you are paying or interest because you have filed the return late, that will be allowed as deduction provided you pay that money, and any other type of penalty is there, not allowed. All other expenses apart from whatever we have not seen over here is always allowed as deduction under section 37. So whatever expenses are related to your business, where will they go? 37 it will go. If it is not covered above 37 it will go. 43B. 43B talks about what, sir? 43B talks about expenses allowed on payment basis. Flirt bonus are the expenses which are allowed on payment basis. Now, following expenses are allowed as deduction only if you pay within the due date of filing income tax return as per section 139(1). Expenses allowed as deduction on payment basis. Any tax, duties, cess, fees under any law for the time in force. So what are the different expenses covered? Flirt bonus. F for what, sir? If you are paying, if your employer is contributing any money to statutory provident fund, recognized provident fund. So whatever contribution is made to fund, it will be allowed as deduction only if the employer contributes it within the due date of filing income tax return. Then IL for what, sir? Leave salary or leave credit encashment, allowed as deduction only when it is paid. Then I for interest taken, interest on loan taken from scheduled bank, public financial institution, etc., allowed as deduction only if it is paid. Then R for any money which is payable to Indian Railway, allowed as deduction only when it is paid. T for any tax, duties, cess, fees is allowed as deduction at the time only when you pay it within the due date of filing income tax return. Any bonus and commission paid to employees is allowed as deduction only when it is paid. Now, if the above payment is made after due date of filing return, sir. Sir, you said this will be allowed as deduction only if it is paid within the due date of filing income tax return. Sir, what if I pay after due date of filing income tax return? Possible, not possible? Yes, sir, possible. Sir, what if I am paying for these expenses after my return, income tax return is filed? Lawmaker says, if these expenses are paid off after due date of filing income tax return, then it will be allowed in the year when payment is made. Now, please note, in case of loan, interest on loan, whatever interest amount is there will be allowed as deduction only when you pay. Some people, what they do is, they will convert the interest also into loan. Now, lawmaker says, whenever you pay this loan, that interest will be allowed as deduction. Now, very important, there is an amendment, a newly point added. What is this point telling, sir? If you are purchasing from MSME, if you are incurring any expenses, if you are taking any services from an MSME, or if you are purchasing any goods from an MSME, then you should make the payment to them within a specified time. What is that specified time? The number of days you agree with them, meaning I enter into an agreement with MSME that I want to purchase some goods from you, and now I should also enter into an agreement within how many days I will make the payment. Whatever agreed is there, that days should not exceed 45 days. If there is no agreement between us, I should pay them within 15 days. If both is not happening, then what will happen, sir? Then 43B will come into picture. As per section 43B, if amount payable for an expenses to micro small enterprises any amount is which is payable to micro small enterprises should be paid within the number of days which is agreed, or 15 days in case where there is no agreement. If the payment is not made within the above period, then that expenses will be allowed as reduction in the year when it is paid. Okay, for example, micro and small. Micro means a company whose investment is less than 1 crores and turnover is less than 5 crores. Small means a company whose turnover is less than 10 crores and a company whose investment is less than 10 crores, turnover is less than 50 crores. So Priya Sarees purchased sarees worth rupees 1 lakh from Karina Sarees, who is an MSME. The date of purchase is 10th of March. They agreed to make the payment on 15th of April. Is it within 45 days, sir? Yeah. Is it within 45 days? Yes, it is within 45 days. Now, Priya Sarees paid on 1 lakh rupees on 10th of April. Will it be allowed as deduction? Yes. In which year? In the year when that expenditure is incurred. If I have paid after that due date, whatever agreed period is there, then it will be allowed in next year, whichever year I am paying that. Next, expenses which are specifically expenditure which are specifically allowed. Disallowed, sorry, expenditure which are specifically disallowed. Lawmaker says, I will give you a list of some expenses on which you can never claim deduction. I'll give you a list of some expenses for which you can never claim deduction. Which are those expenses? They are covered under section 40. Section 40A1 says, if you are paying any interest, fee for technical services or royalty outside India, or you are paying interest, fee for technical services or royalty to a non-resident or a foreign company in India, where TDS is not deducted by you in the previous year, or after deducting the TDS in the previous year, you have not paid that money to the government within the due date of filing income tax return. Please note. If you are paying any interest, I'll take one example. If you are paying any interest outside India, or if you are paying any interest to a foreign company or a non-resident person in India, for loan, you would have taken loan from them. Therefore, you are paying interest to them. So lawmakers are telling, if you have paid interest to them without deducting TDS, or you have deducted the TDS but not paid the TDS to the government within due date of filing income tax return, then whatever amount of expenses is there, 100% of that will be disallowed. How much, sir? 100% of that expenses will be disallowed. Similarly, if the same thing is happening with a resident, meaning what, sir? If there is any sum which is payable to a resident in India and which you have paid to that resident without deducting TDS, or you have deducted the TDS but not paid the TDS to the government within the due date of filing income tax return, then 30% of that expenditure will be disallowed. So if you are paying to a non-resident, 100% expenses is disallowed. However, that expenses will be allowed in the future whenever you are paying them. Next year, if you are paying, it will be allowed in next year. If you have not deducted the TDS in previous year, or if you have deducted the TDS in the previous year but not paid within the due date of filing income tax return, then it will be allowed in that year whenever it is paid. Okay, not okay. For resident people, it is only 30%. Please note. It will be allowed subsequently in the next year when the TDS is deducted. When the TDS is deducted, or it is deducted in the previous and paid in the next year. So it will be allowed in that year whenever the payment is made. Now, sometimes it may happen that I have not deducted the TDS, but the opposite person, he has filed his income tax return and he has considered this income and paid the taxes on that. So should I deduct TDS again? Lawmaker says no. You take a certificate from that person telling he has already paid the taxes on this income. You will not have to pay taxes again. 40A2, if you are paying any income tax surcharge cess under income tax law, it is not allowed as deduction. Wealth tax is not allowed as deduction. Any royalty fee, this is removed now. This point is now removed. This point is now removed. As I told you, exclusion, I have made a separate video. This point is now removed. Then any salary payable outside India or to a non-resident where TDS is not deducted and deposited within the due date of filing TDS return, within which due dates are within the due date of making the payment of taxes of TDS, 100% of that will be allowed as deduction. So if you are paying salary to any person outside India or to a non-resident, and if you have not deducted TDS on that, and even after deducting, if you have not paid to the government within TDS due date, 100% of expenditure will be disallowed. Now, any contribution to welfare fund of employees, if TDS arrangements are not made, then that will be disallowed. Then 40A5, any tax on non-monetary perquisites which is required to be paid by employees, paid by employer, that also deduction cannot be allowed. Okay. Then we have 40A2 and 40A3. 40A2 talks about unreasonable payment. I'll go over here. Please note, explanation for all the points is given in next page. 40A2 talks about what's an unreasonable payment. If you are making any excess or unreasonable payment to your related person, then that excess amount will be disallowed. Only such excess amount will be disallowed. Who is a relative? For individual, spouse, mother, father, brother, sister, lenient resident is relative. For HUF, members are relatives. For LLP, partners are relative. Partnership firm, partners are relative. Company directors are relative. Holding company, subsidiary company is relative. And any person who has substantial interest in the company will be treated as relative. 40A3 talks about cash payment. If you are making any payment for a single expenditure to a single person in a single day in excess of rupees 10,000 rupees, in excess of how much, sir? 10,000 rupees, by any mode other than cash, it will be allowed as, it will be disallowed. It will be disallowed. If you are paying it by any mode, if you are paying it in cash, if you are paying it by any mode other than account pay check, account pay demand draft, or any electronic clearing system, it will be disallowed. Sir, repeat. A. If any assessee makes payment for a single expenditure to a single person in a single day in excess of rupees 10,000 by any mode other than account pay check, by any mode other than account pay demand draft, by any mode other than electronic clearing system, then such expenditure will be fully disallowed. Please note, if you are paying through cash, bearer check, cross check, then it is disallowed. If you are paying only to these three modes, it is allowed as deduction. The limit is 35,000 in case of a transporter. When you are making the payment to a transporter, the limit will be how much? 35,000. Now, second point where amendment is there in this chapter, PGP chapter. What is the second point, sir? 40B. Remuneration and interest paid to partners by a partnership firm. So if there is a partnership firm, and if that partnership firm is paying what's a remuneration and interest. If there is a partnership firm and if that partnership firm is paying remuneration and interest to the partners, is it allowed as deduction? What do you mean by remuneration? Remuneration means salary, bonus, commission, any other amount which is paid by the company, partnership firm to the partners. Partnership firm, whenever I say LLP is also included. And interest means interest on loan or interest on capital. Now what is the law telling? First point. Remuneration and interest will be allowed as deduction only if it is authorized by partnership deed. Meaning, you should have a partnership deed and that partnership deed should talk about remuneration and interest. Only if you have a partnership deed and if that partnership deed is talking about remuneration and interest, you can claim it as deduction. Sir, what if I don't have a partnership deed? You cannot give remuneration and interest to partners. What if I have a partnership deed but nothing is mentioned with respect to remuneration and interest? Then also you cannot give remuneration and interest. Now please note, remuneration and interest will be allowed prospectively and not retrospectively. Say for example, I had partnership deed, I did not mention anything about remuneration and interest. Now today I came to know I am telling yes, I will be allowed remuneration and interest. So if you add that point today, you should give remuneration and interest from today only. Remuneration and interest. Now please note, remuneration and interest can be paid either to sleeping partner or working partner. Lawmaker says remuneration, which is nothing but salary basically, is allowed only for sleeping partner and not allowed only for working partner and not allowed for sleeping partner. Interest will be allowed for both sleeping and working partner because interest is on the money which they have contributed in the business. Now interest, how much is allowed, sir? As per section 40B, maximum 12% interest you can give. On what, sir? Interest on loan, on interest on capital. How much you can give? Maximum 12%, maximum 12% per annum you can give to each partner. So if the deed does not mention anything about interest, can I give interest? No. If it mentions 15%, how much can you give? 12%. If it is mentioned 12%, 12%. If it is mentioning only 8%, I will give only 8%. So what maximum, how much interest can you give? 12%. If the deed is mentioning less amount, then I will give less amount. Now here comes the amendment point. Now the limit for interest under section 40B has been changed. Before it was up to 3 lakhs of book profit. It was 90% or 1.5 lakhs, whichever is higher. Now it is changed. Please note, very important. So remuneration allowed as per section 40B. How much is remuneration allowed? If your remuneration is based on your book profit, so up to 6 lakh rupees of your book profit, 90% of the book profit or rupees 3 lakhs, whichever is higher, is allowed as deduction. for any amount in excess of 6 lakh rupees in your book profit, then balance book profit which is there, meaning for 6 lakhs I have taken over here, whatever is left over, 60% of book profit will be allowed. So the total remuneration allowed is A plus B is the total remuneration which is allowed. Sir, I didn't understand this. For example, let us say my book profit is 9 lakh rupees. So 9 lakh, I will divide into two categories, 6 lakhs and 3 lakhs. For 6 lakhs, 90% of 6 lakhs or 3 lakh rupees, whichever is higher. So 90% of 6 lakhs is 5 lakh, 40,000 or 3 lakh rupees, whichever is higher is allowed as reduction. And for the balance amount, it is 3 lakhs into 60%, 1,80,000 is allowed as reduction. Similarly, book profit up is 5 lakh rupees. 5 lakh rupees can I divide? Not required to divide, because up to 6 lakh rupees it is how much? Up to 6 lakh rupees it is 90% of book profit. So can I say 5 lakh is within the limit of 6 lakhs? 5 lakhs into 90% or 3 lakh rupees, whichever is higher is allowed as deduction. Sir, what if I am making a loss? Then also you can claim a deduction, or you can give remuneration to the partners of 3 lakh rupees. Because book loss into 90% will be 0 and 3 lakh rupees, whichever is higher. Hey, how do I calculate book profit, sir? You take net profit of the business as per PGBP. As per PGBP, subtract interest as per 40B, then you will get your book profit. Now for computation of business income, you have two methods, direct method and indirect method. Mostly the questions will be on indirect method. What do we do under indirect method, sir? You take net profit which is given in the question. Okay, then subtract all those items which are not required to be included in the computing business, but they have included while computing that net profit. Add all those items which are not required, which are not added but are required to be added. For example, you take the net profit. If there is any income taxable under other head, but they have included in your profit and loss account, you subtract that income because your profit is more by that amount. If they have not subtracted any expenses but which is supposed to be subtracted, you subtract it now. Similarly, add the expenses which is debited to profit and loss account but it is disallowed. Add the losses which is debited to profit and loss account but are taxable under other heads. Add the business income which is not taken into profit and loss account. You will get your business income. Yeah, one last point with respect to this chapter, and this chapter will get over. Presumptive taxation, section 44 AD, 44 ADA and 44 AE. Important is 44 AD and 44 AE. Very important is 44 AE. 44 AD talks about what, sir? If you are a person who is in any business or if you are a non-specified profession, then this section 44 AD is applicable to you. What is 44 AD telling? If you are a resident individual HUF firm, if you are a resident individual or a resident HUF or a resident partnership firm excluding LLP, and if you are doing any business or profession except agency business, except commission business, except 44 AD or 44 AE business, then for you this section is applicable. Which section? 44 AD is applicable. What is 44 AD telling? If your total turnover, if you are a resident individual and doing any business and profession, and if your total turnover is up to 2 crore rupees, then 8% of all your total turnover will be treated as your business income, or 6% of your total turnover will be treated as business income. Please note, 8% of your turnover will be treated as business income, or 6% of your turnover will be treated as business income. Sir, when will I take 8%? When will I take 6%? Sir, when will I take 8%? When will I take 8%? When will I take 6%, sir? 8% you should take normally. 6% you should take if you have received the sale proceeds during of whatever sales you have made during the previous year. You have received the money of that through account pay check, account pay demand draft, or any other electronic clearing system, and it is received within the due date of filing income tax return under section 139(1). For example, 18 crores. 18 lakh 1.8 crores is the sales which I have made. Now I have received in cash. I'll take what, sir? 8%. I have received through electronic clearing system 6%. Account pay demand draft 6%. NEFT 6%. Now for me the due date of filing income tax return is 31st of July. Anything I receive after 31st of July, I should always take 8%. Sir, what if I have not received anything? 8%. You'll get your business income. Now please note. No deduction under section 30 to 37, meaning this amount which you get over here, this amount is your business income directly. You cannot claim any extra expenses deduction from 30 to 37. Can I show higher income, sir? Yes, of course, you can always show higher income. You can show income more than 8%. If you want to show 10%, 12%, 18%, you can show that. Sir, what if I want to show lower income? That you cannot do. If you want to show less than 8% or less than 6%, then you will have to get your books of, you will have to maintain the books of accounts and get it audited by a chartered accountant. Okay. Then can I claim deduction under this income, sir? Yes. Chapter 6A deductions. Can I claim chapter 6A deduction? Not the deduction under PGP topic. No. Chapter 6A deduction, can I claim against this income? Answer is yes. Sir, can I set off my losses against this income? Answer is yes. Sir, is there any lock-in period? Yes. Once you follow this option, for the next 5 years, you should follow the same option. If you don't follow, say for example, year 1, I followed 44 AD. For the next 5 years till year 6, I should follow 44 AD. But if in any year I come out of 44 AD, for the next 5 years, I cannot follow 44 AD. For example, year number 3, I opted out of 44 AD. For the next 5 years now, even if I want to follow 44 AD, I will not be able to follow. 44 ADA is presumptive taxation for whom, sir? For specified profession. Who are specified profession? I lift come. I lift come means what, sir? Chartered accountant, cost accountant, or you are an advocate, or you are an architect, or you are what, sir? Interior designer, legal professions. I for IT professions. F for what, sir? Film artist. T for technical profession. CO for company secretary, medical profession, or engineering. So if you are professional, by the way, then and you should be a resident individual, or you should be a resident partnership firm excluding LLP. And if you are doing any of the specified profession, and if your gross receipts is up to rupees 50 lakhs, then gross receipts into 50% will be your business income. Your gross receipts into 50% will be your business income. Please note, gross receipts into 50% will be your business income. You will not get any deduction. You will not get any deduction from 30 to 37. Can you claim higher income? Yes. If you want to declare a lower income, can you do so? Can you do that? Answer is yes, but you will have to get your books of accounts audited. Deductions under chapter 6A and brought forward business loss can also be adjusted with this income. Please note, this limit is how much? 50 lakhs, but this limit will be 75 lakhs if your total receipts and total payments are 95% in online modes. If your total receipts and total payments are 95% in what modes, sir? Online modes. Similarly, here normally the limit is how much, sir? 2 crores, but this limit will be 3 crores if the total receipts and the total payments you are receiving is in online modes through account pay check, account pay debit draft, or electronic clearing system. Meaning not even one, total receipts ka 5% can be in cash, total payments ka 5% can be in cash. If everything else is in what, sir? Online modes. If you are receiving it directly in bank account, then 75 lakhs will be the limit over here. 3 crores in case of business. Most important is 44 AE. 44 AE, presumptive taxation for goods carriage business or a transporter. If you are a transporter, then this section is applicable to you. All the assessees to whom is this section applicable? All type of assessees who are in the business of paying, hiring, leasing, renting of goods carriage, up to 10 goods carriage at any time during the previous year. Up to how much, sir? 10 goods carriage at any time during the previous year. So if it is a heavy goods vehicle, then how much will be? Please note, they are directly talking about the business income over here. You don't have to do any percentage, etc. Now, if you have up to 10 goods carriage, if you are in the business, if you are a transporter, and if you have only up to 10 trucks, not more than 10 trucks at any time during the previous year, and I'll check whether it is heavy goods vehicle or other vehicles, normal goods vehicle. If it is heavy goods vehicle, then heavy goods means what, sir? Those vehicles who can carry, whose gross vehicle weight is more than 12,000 kgs or more than 12 tons. Then for them, rupees 1,000 per ton will be the value. It will be the income. How much will be income? Rupees 1,000 per ton per month or part thereof. Even if it is a part of month, I am going to treat it as full month. Similarly, if it is other vehicles, if it is a chota vehicle, less than 12,000 kgs vehicle, then for them 7,500 rupees is directly business income per month or part thereof. Now please note, month when I am taking, it should be considered from the date when the asset is purchased. I have given one example over here. Dilip is a goods carriage is in the goods carriage business. He has two heavy goods vehicle of 15 tons each and four other vehicles. Four other vehicles I have. Now compute his business income. This two heavy goods vehicle were purchased by me on 20th April and other vehicles were purchased by me on 28th July. For heavy goods vehicle, so there are two heavy goods vehicle, which one I purchased in 20th July, another one I purchased in 20th April one I purchased, and 28th July I purchased second one. So the one which I purchased in 28th July for entire 12 months, I'm going to show the income. For 28th July, I'll calculate from July month. So heavy goods vehicle 1,000 rupees per vehicle, 15 tons, 15 because 15 tons into 12 months is this amount. Heavy goods vehicle number 2, 1,000 into 15 into 9 months is for 2. Other vehicles 7,500 4 months into 11 months is 3,30,000. So total amount of income is how much, sir? Under 44A, 6,45,000 rupees. So there is one more question. Mostly asked question in the examination is this question. Okay. So this is all about your which chapter, sir? This is all about your business income chapter. Okay. I'll take a break and we will discuss the remaining topics in our next after break video. Let me meet you in my next, of course in this video only. Let me meet you after 1-2 seconds break. Till then, bye bye, take care, enjoy. Welcome back, students. Let us continue our discussion, and we are in the last part of our discussion wherein we'll be discussing all the other topics of your income tax law. So we'll be starting with what, sir? What is left over now? Clubbing, that is income of other person included in assessee's total income, then set off and carry forward deductions. Then we have total income topic and TDS, TCS, Advance Tax and return of income. So these are the topics which are left over now. These topics we'll discuss in the remaining part of this video. Now, clubbing of income. Clubbing of income, directly I'm in this summary material you can see over here. I will study it from here only. Now please note, so here we have this material. Explanation if you need, that is there in the next page. Okay, so these points we will be studying in this manner. Now, section 60 says if you are transferring income without transfer of an asset. If you are just transferring income, I have an FD of 10 lakh rupees. I am not giving the FD to anyone, but the interest which I am earning from this FD, I am transferring it to, say, my brother's son. Lawmaker says, though he is the person who is going to receive this, it will be taxable in my hands. Okay, transfer of income without transfer of asset. If an individual is transferring the right to receive income from an asset without transferring the ownership of such asset. So without transferring the ownership of an asset, if I am transferring that asset itself, if I am transferring what, sir? If I am transferring the asset without transferring the ownership, then lawmaker says the income which is there, I will be taxable in my hands. So if you are transferring any income without transferring the asset, then such income shall be clubbed in the hands of the transferor. Now, what are the conditions? The owner should be with the transferor only the income should be transferred, and this point is not applicable if both income and ownership is transferred. Now, then we have something called as revocable transfer. Revocable transfer means what? It is a type of transfer wherein I am transferring something to someone, and when I am transferring something, okay, I am transferring an asset to someone, and upon transfer of that asset, I am putting a condition that in future, if I want to take back this asset from you, I will take it back. So revocable transfer means what, sir? If an assessee transfers an asset with a power to revoke or cancel the transfer, then the income of such asset shall be taxable in the hands of transfer only. So I gave you a house property with a condition telling that I will take back this house from you in a future date if I want to take it back. So this is called as revocable transfer. So what are the conditions? The transfer should be revocable and the power to reclaim the asset should be there. Now, when will this point not be applicable? If it is a irrevocable transfer. If the transfer is what, sir? Irrevocable, or if the transfer becomes revocable upon death of the transferee, or it becomes revocable upon death of the transferee. So whomever I have transferred, I tell him that, see, sir, this asset, I will not take it back. Or I transfer it to someone telling that, see, I will not take it back unless until you are alive. If once you die, I will take it back from you. Okay. So this is irrevocable transfer, and the transfer becoming revocable upon death of the transferee. Then Irrevocable transfer, it is section 62 talks about irrevocable transfer. It is an exception to section 61. So transfer, if the transfer is revocable, then the during the lifetime of the transferee, then clubbing provision shall not apply. If the transfer is irrevocable during the lifetime of the transferee, it is not, the clubbing provision shall not apply. Then clubbing of spouse's salary. Spouse's salary means what, sir? Whatever salary, say in my case it will be my wife is receiving from where, from a concern where I have substantial interest. So there is a company where I have substantial interest in this company. Now this company is paying money to my wife. Okay, this company is paying money to my wife, and my wife does not have any professional or technical qualification to receive that money. Lawmaker says, I'm going to club this money which is received by your wife in your hands, Mr. Dilip. So if an individual has a substantial interest, that is 20% or more voting rights or profit sharing ratio, and the spouse of such individual receives any salary, commission, remuneration. So if an individual is having substantial interest and the spouse of that individual is receiving any salary, commission, remuneration, then such income shall be clubbed in the hands of individual. Whatever income is received by whom, sir? The spouse will be clubbed in the hands of individual. Transfer of asset to spouse. So if I am transferring any asset to spouse, if an individual is transferring any asset to his or her spouse without adequate consideration, without what, sir? Without adequate consideration, then whatever income is received by the spouse on that asset will be taxable in the hands of the individual who is transferring that. So transfer must be without consideration, and the spouse must not be living apart, meaning there should be no divorce case, and they should also not live separately. So if the transfer is due to divorce, then no clubbing will happen. And if the spouse is reinvesting that money, I have given some money to spouse reinvest that money, and now by reinvesting that money somewhere she is earning money, that will not be clubbed. Transfer of asset to son's wife. Just like our spouse, if I am transferring it to my daughter-in-law, son's wife, if an individual transfers any asset to his or her son's wife without adequate consideration, then the income arising from transfer of such asset will be clubbed in the hands of the transferor. The transfer must be without adequate consideration. The asset must be transferred directly to the son's wife. Then transfer to a trust. Now if I am transferring any asset to a trust for the benefit of my wife, then also clubbing will happen. If an asset is transferred to a trust or any other person for direct or indirect benefit of my spouse, then the income of such asset will be clubbed in the hands of transferor. The asset is not directly given to spouse, but it is meant for the benefit of spouse. See, previous cases, what did we see? That I am directly giving it for my to my spouse. Now here they are telling you are not directly giving it to the spouse. You are giving it to a trust, or you are giving it to any other person and telling that please use it for the benefit of my spouse. So in that case also clubbing will happen. Same provision is applicable if you are transferring any asset to a trust for the benefit of son's wife. Same to same provisions are there. Next, section 64(1) capital A talks about clubbing of minor's income. So whatever income a minor child is earning, if you have a minor child, a child whose age is less than 18 years, if you have a minor child, then whatever income is earned by that minor child will be clubbed in the hands of the parents. Which parents are? That parent who has a higher income. Sir, what if both the parents have same amount of income? Then it will be please note, while calculating higher income we should take before considering this income. Sir, what if both the parents have the same amount of income? Then you can club it with anyone, but what is important is once you club it with one of the parent, for all future years it should be clubbed in the hands of same parents. So parent will get an exemption of 1500. So under section 1034 section 1034A, they'll get an exemption of what, sir? They'll get an exemption of 1500 per month, in whosever hands it is getting clubbed. However, in three cases clubbing will not happen. Which are the three cases, sir? In case of what, sir? In case the minor child is earning the money because of his own skill and talent, or if he is earning the money because of his manual work, or he is a ATU disabled minor child. Then, sir, HUF case also it is applicable, yes. So conversion of self-acquired property into HUF property. So I have a property which I purchased. Now I am giving it to my HUF. Now whatever income HUF is earning from that property, that income will be clubbed in my hands. So this provision will be applicable only till partition. Once the partition is over, clubbing will happen in my hands. Clubbing will happen only with respect to my wife's income and my minor child's income. So if you see over here, explanation is there, stories are there over here. So I'm transferring I have an FD, I'm transferring the interest income of that FD to a person without transferring the asset, so that interest income will be clubbed in my hands. Revocable transfer, I transfer my house to someone, telling that I will take it back from you whenever I want in future date. Now this is revocable transfer. Transfer of asset to spouse or son's wife, for both of them this is applicable. I'm transferring an asset to my wife is giving that asset on rent and she's earning some rent. This money is taxable in my hands. I'm transferring shares of Reliance Industry. My wife got dividend, that is clubbed in my hands. My wife got capital gain, that is clubbed in my hands, meaning whatever income she's generating from the transferred asset. Now please note, I gave an FD, my wife sold that FD, closed that FD. By closing that FD, she purchased a house. Now whatever rental income she is getting on that house, that is also going to be clubbed in my hands. Please note, I gave an FD to her, but she has converted that FD into house. Lawmaker says no problem. Whatever asset you have transferred, irrespective of what form it is converted, whatever income is generated from the asset transferred by you, or the money value of the asset transferred by you will always be clubbed in your hands. Now say one more case, I gave an FD to my wife of 100 lakh rupees. She closed the FD and got 100 lakhs. She invested her own 50 lakhs and purchased a house or a car. Now from this she is earning a income of 6 lakh rupees. Now lawmaker says, see over here what is happening. Dilip's money is only 100 lakhs. So though she is getting 6 lakh rupees, entire 6 lakhs will not be clubbed in the hands of Mr. Dilip. 6 lakhs into 100 divided by 150. So why sir, 6 lakhs is the total income received, 100 is the amount invested divided by 150. What is 150 sir? 150 is the total money invested by her. Dilip's money by total money. That proportionately it will be taxable. Now very important point is, if the money which is given by me to my spouse, if it is invested in any business by the spouse, if the money which is given by me to my spouse is invested by the spouse in any business, then clubbing will happen only when the amount which is given by me is there in the capital of that business as on the first day of the previous year. If it is there in the capital of the business as on the first day of the previous year. So yeah, say there is a company wherein I have substantial interest. Substantial interest means what's a 20% or more. This 20% or more can be of assessee and his relative combined together. So a relative includes spouse, brother, sister, lenient resident, lenient dissident. Now if the spouse does not have any professional or technical qualification, then whatever money the concern is paying, that will be taxable in the hands of spouse. Sir, if both of them have substantial interest, then clubbing will apply sir. Yes, clubbing will apply in sir, if both of them have substantial interest and both of them have no technical qualification, then it will be clubbed in the hands of that that person who has higher income before clubbing this income. Sir, what if they both have same amount of income? Meaning what sir? If both of the spouse have substantial interest and if both of them are receiving money from the concern, and if they don't have any other income, then clubbing shall not be applied. When they are not having any other income at all, clubbing provision shall not apply. An income of minor child will be clubbed in the hands of the parent who has a higher total income. It will be not clubbed in following cases: skill and talent, manual work, and ATO disability. Section 1034 I told. Section 1032 is exempt. The minor child in whosever parents hands the minor child's income is exempt. Income is clubbed. That parent will get an exemption of 1,500 per child as exemption. Now minor includes minor married daughter, minor married son over here. Minor includes own child, stepchild, legally adopted child, and divorce case, it will be clubbed in the hands of that parent who is maintaining the minor child. Next is what sir? Our set off and carry forward chapter. Next chapter is what sir? Set off and carry forward. Set off, aggregation, set off and carry forward of losses. Now see, set off means what sir? You are adjusting loss against income. Set off means adjustment of loss against income. There are two types of set off. One is called as intra-head set off, another one is called as inter-head set off. Intra-head means what sir? You are setting off the losses of one head with the income of the same head. Inter-head means you're setting off losses of one head with income of another head. Intra-head means what sir? Loss of a particular head is adjusted with the income of same head. For example, house property 1, I'm getting a loss. House property 2, I'm getting an income. I will do the adjustment and take the net income from house property. This is called as intra-head set off. So one house property is giving me loss, another house property is giving me income. I'm adjusting those and getting the final amount. Inter-head set off is what, sir? Loss under one head is adjusted with income under other head. So salary income is adjusted with house property loss. No, sir, I didn't understand. Interhead means I am now setting off with two different heads. I am doing adjustment with two different heads. So I have a loss under the head house property. Okay. And I have an income under the head salary. So house property loss I am adjusting with salary income. That is called as interhead set off. Carry forward means what, sir? If the current year loss is not able to be set off completely, if you are not able to adjust the current year loss completely, then that current year loss you can take it to future years. That current year loss you can take it to future years and you can adjust in that future years. That is called as carry forward. Loss that cannot be adjusted in the current year will be carry forwarded for future and will be adjusted in future years. Now we will see what are the different cases when I can make intra-head set off. Now please note, there are different heads of income and accordingly what are the rules for set off. Salary, can I say no set off concept will come, because I'm never going to get any loss under salary head. Am I going to get loss under salary head? No. Therefore, the question of setting off one salary income with another salary income will not come. Correct. House property loss. Sir, house property, one house property can have a loss, another house property can have income. Can I do the adjustment, sir? Lawmaker says yes. So loss of one house property can be adjusted with profit of another house property. Then what about business, sir? Now business are divided into three categories. For the purpose of set off and carry forward, business are divided into three categories. Which are those business, sir? Normal business, speculation business, and 35AD business or specified business. What lawmaker says? Normal business loss can be set off with any type of business income. Whatever normal business you are doing. Normal business means all types of business except speculation business and specified business. Normal business loss can be set off with any type of business income. Then speculation business loss can be set off only with speculation business income. 35AD business loss, specified business loss can be set off only with specified business income. So business income, business or profession, normal business loss can be set off with any business income. Speculation business loss can be adjusted only with speculation business income, and 35AD or specified business loss can be adjusted only with specified business income. Sir, what about capital gain, sir? Capital gain, long-term capital gain can set off short-term as well as long-term capital loss, and short-term capital gain can set off only short-term capital loss. So under capital gain, if you want to adjust, long-term can eat everyone, but short-term can eat only short-term. Income from other sources. Income from other sources. See, normally income from other sources, losses will not be there, because all the incomes which you are getting, that only will be taken over here. But however, if you are getting any loss because of owning and maintaining racehorse, that loss can be set off only with the income of owning and maintaining racehorse. So if you're owning and maintaining racehorses, and if you're getting loss from owning and maintaining racehorse business, then that loss can be adjusted only with owning and maintaining racehorse income. Next is intra-head. What is more important than interhead? What is intra-head? What is more important is interhead. Adjusting loss of one with profit of another. What is more important is adjusting loss of one with profit of another. Now, for salary, possibility is not there. So we have completely ignored salary only. Salary loss of one salary you are adjusting with other incomes. No, not possible. Salary will not have a loss. Now I may have loss of house property. So house property loss, can I adjust with other income, sir? Answer is 100% yes. You can adjust house property loss with other income. However, there is a restriction. What is the restriction? You can adjust maximum 2 lakh rupees per annum. How much you can adjust, sir? Maximum house property loss which can be adjusted with the incomes of other heads is how much, sir? 2 lakh rupees. Now, whatever excess loss is there, that you can carry forward. And how many years can I carry forward the house property loss, sir? For 8 years. Sir, what about business loss? Business loss, lawmaker says business loss you can set off with any income. Business loss you can set off with any income except salary. Sir, that means business loss I can set off with house property. Yes. Business loss I can set off with other sources. Yes. Sir, business loss I can set off with other business incomes. Yes. Business loss can I set off with capital gain? Yes. Except salary, all the other types of income you can adjust. What's a business loss? Now the unadjusted business loss which is there, that will be carried forwarded by you for a total number of 8 years. Sir, what about speculation business loss? Speculation business loss cannot be set off with other business income, and it cannot be set off with other incomes also. Speculation business loss will have to be set off only with speculation business income. And if you want to carry forward it, you can carry forward it for how many years? 4 years. Similarly, specified business also same point. It can be set off only with specified business income. And if you want to carry forward, you can carry forward it for maximum how many years? Indefinite period. Specified business, 3580 business, no limit is there. Capital gain loss. Sir, what if I have a long-term capital loss? If you have long-term capital loss, you can adjust only with long-term capital gain. Sir, can I not adjust with other incomes? No. Sir, this loss can be carried forwarded. If it is not adjusted, you can carry forward for total 8 years. Similarly, short-term capital loss. If you have a short-term capital loss, it can be adjusted with long-term capital gain or short-term capital gain. If it is unadjusted, then the unadjusted loss can be carried forward for a total period of 8 years. Income from other sources. Whatever income from other, normally you cannot have loss under other sources. However, owning and maintaining loss, if you have, you can adjust with same people. Income from other sources, loss can be set off with other incomes, other taxable income from other sources. See, loss of owning and maintaining racehorse can be set off only with owning and maintaining racehorse. Then if it is not fully set off, you can carry forward for a maximum period of 4 years. Casual income and exempt income cannot set off any type of losses. So casual income is, that is lottery betting, gambling income. Your exempt income, agriculture income from a land in India, etc. Against those incomes, no, you cannot set off any type of losses. It's okay. Okay. Now, sir, what about carry forward, sir? Once the loss is what, sir? Once the loss is fully adjusted in the current year, whatever remains unadjusted in the current year will be taken to the future years. Whatever losses is not adjusted in the current year will be taken to the future year, and that loss which is taken to the future year is called as carry forward of losses. One thumb rule you should know. What is that thumb rule, sir? Once a loss has been carry forwarded, in the future years, it can be adjusted with same head of income only. Sir, repeat. Once a loss is carry forwarded, in the future years, it can be set off only with the same head of income. Please note, current year intra and inter provision is there. Current year loss can be adjusted with other current year income, but once a loss is carry forwarded to future years, it can be adjusted only with the same head of income. Okay, not okay? Now, losses. Let us say it is a house property loss. If it is a house property loss, and if you are not able to adjust completely for current year, then you can take it to future years, and in future years you can adjust it with whom, sir? House property income. And you can adjust only with house property income. And if I want to carry forward, for how many years can I carry forward, sir? You can carry forward for 8 years. Please note, when you are earning an income, you file something called as income tax return. When you are earning an income, you file something called as income tax return. And therefore, when I am making loss, I have not made any income, I have made a loss. When I have made a loss, should I file a return of loss also? Should I file a return of loss also? Lawmaker says yes. Lawmaker says yes, you will have to file a loss return also. What is this point telling, sir? Last point says filing of loss return. Is it mandatory? Filing of loss return for carry forwarding house property loss is not mandatory. Meaning house property loss can be carried forward even if you don't file income tax return or loss return. Sir, business loss. Normal business loss can be adjusted with any type of business income. Normal business loss can be adjusted with any type of business income. Then this can be carried forwarded for how many years, sir? For totally 8 years. And should I file my loss return to carry forward this loss? Answer is yes. You'll have to file your loss return. Then speculation business loss. This, if it is not adjusted completely in this year, you can carry forward to the future years. And in future years, you can adjust only with speculation business income. And you can take it in future for how many years, sir? You can take it for 4 years. And in future, if you want to take this loss in the future, should I file loss return? Answer is yes. You will have to file your loss return. Similarly, specified business loss. Specified business loss can be taken in future year and it will be adjusted only with specified business income, and there is no limit for how many years you can take it forward. It is for indefinite period you can take it forward. And filing loss return is mandatory, meaning if you have a speculation business loss and if you want to carry forward those losses, then you will have to compulsorily file the return. Then long-term capital loss can be carried forward to the future and adjusted only with long-term capital gain, and it can be carried forward for how many years, sir? For a total period of 8 years. And for carry forwarding these losses, you will have to file a loss return. Short-term capital loss can be adjusted in future years against short-term or long-term capital gain. It can be carried forward for a total period of 8 years, and if you want to carry forward these losses, you will have to file something called as your loss return. Then if you have a loss from owning and maintaining racehorse business, then that the loss from owning and maintaining racehorse business can be carried forward and adjusted only with income from owning and maintaining racehorse. And for carry forwarding these losses is filing of loss return mandatory, sir? Answer is yes. If you have any unabsorbed depreciation, then that unabsorbed depreciation can be taken in to future years, and there is no limit for how many years you can take. And once you take it in future years, you can adjust it with any income. You can adjust it with any income except salary. And filing of loss return is not mandatory for carrying forward of unabsorbed depreciation. Now, additional points which you have to keep in mind when you are making sure that there is a question on this topic or when you are studying this topic. What are those additional points, sir? Order of set off. First, you should always do intra-head set off, meaning first you solve your own house problem. First, you should solve your own house problem. After solving your house problem, you should solve the problems of your neighbors. Okay, meaning first house property loss should be adjusted with house property income. Even after adjusting that, if there is any loss left over, that loss can be adjusted with income under other heads. Okay, not okay? So first intra-head set off should be done, then inter-head set off should be done. Once you do inter and intra-head of the current year, then you can then you can adjust the loss of the previous period. Then you can do the adjustment of last year losses. Similarly, business loss and speculation business. Business loss can be set off with any head except salary, while speculation loss can be set off with only speculation profits. Unabsorbed depreciation can be carried forward for indefinite period, and it can be set off with anyone except salary. Set off of house property loss. Maximum house property loss which you can set off is how much, sir? 2 lakh rupees. Only 2 lakh rupees. Balance will be carried forward. Long-term capital loss can be adjusted only with long-term cap gain, and short-term capital loss can be adjusted with short-term or long-term. Deemed business. Deemed business means what, sir? Deemed income, undisclosed income. Those deemed incomes, no loss can be set off against unexplained income under section 68 to 69D. Casual income or exempt income losses can never be set off with anyone. Income from other sources cannot. Losses under income from other sources can never be set off against except what, sir? Owning and maintaining racehorse losses. Except owning and maintaining racehorse losses. So yeah, there is this full story over here. You can just go through over here. I mean, classroom explanation I have given. What is important is the flow of setting of the losses. Next is what's our deductions. The next topic for our deductions under chapter 6A. So there are total 80 C to 80 U deductions are there. Now please note, deduction. Why is deductions under chapter 6A important, sir? See, all the heads of income combined together, you will get something called as gross total income. From that gross total income, if you subtract deductions under chapter 6A, you will get something called as your total income. And this is the total income on which you are going to pay taxes. So you know how to compute your gross total income because we have discussed all the heads of income. Now you want to subtract deductions. Please note, how do I compute? Let me just draw this for you. How do I compute the total income, sir? See, first I will take income from salary. This is the specific format. First head is income from salary only. Then I'll take income from house property. Then I'll take income from business or profession. Then I'll take income from capital gain. Then I'll take income from other sources. Okay, income from other sources. So this is all the 5 heads of income I am going to take. Now after that, what did we study? Which is the next topic we studied? Set off and carry. Clubbing of income. Now all the clubbing which you are doing, that clubbing will be done under which head? Under income from other sources only. All the clubbing which you are doing, that clubbing will happen under which head, sir? all the clubbing which you are doing, that clubbing will happen under income from other sources only. Okay, all the clubbing which you are doing in your life, that will happen under income from other sources. Then you will do set off and carry forward. So it can be set off within the same head or between two different heads. Set off and carry forward you will do. Now whatever is left over, that is called as your gross total income. From this gross total income, you are required to subtract deductions under chapter 6A. Once you subtract these deductions, whatever is left over now is called as your total income. We'll have to subtract deductions, and whatever is left over now will be called as what, sir? Total income. This will be called as your total income. Now, what is important? What is important? Can I say your total income, your gross total income will have all the heads of income? Yes, sir. Therefore, lawmaker says when you are giving deductions under chapter 6A, the deductions under chapter 6A is not available against these incomes. These deductions under chapter 6A, please note, these incomes will form part of your total income. When you are computing your total income, this will be included. But chapter 6A deductions will be not available against this income. Which incomes are? Long-term cap gain under section 112, long-term cap gain under section 112A, short-term capital gain under section 111A, and casual incomes such as winning, lottery, etc., etc. Of course, needless to say, undisclosed incomes are also covered over here. Okay, deductions will not be allowed against these incomes. Against these incomes, deductions will never be allowed. So, whenever you are taking your gross total income, subtract these incomes. Now, whatever is left over, that is the maximum amount of deduction which can be taken by you. Now, please note, we are going to learn deductions chapter, correct? We are going to learn deductions chapter. One thing you should be knowing, that under default tax regime, you will not get any deduction under chapter 6A except these deductions. Under default tax regime, you will not get any deductions except these deductions. Which are the deductions? Except 80CCD2 deductions, which is employer contribution. 80CCH 2 deductions, which is Agnipath scheme, employer's contribution in Agnipath scheme. Then 80JJAA, new employee deductions. These deductions are only available if you follow 115 BSc. If you follow 115 BSc, all the other types of deductions are not available to you. Next is what, sir? Let us start one by one all the different types of deductions. Section 80C. 80C is available to an individual or an HUF. 80C says if you make investment in life insurance premium or employee provident fund, public provident fund, national savings certificate, 5 years FD you are taking, Sukanya Samriddhi account you are putting money, home loan you are taking, tuition fees you are paying up to a maximum. Tuition fees means school fees. In school fees, one of the part of the school fees will be tuition fees. Up to maximum 2 children you can take the advantage, or you are putting money in equity linked savings certificate. In all these cases, if you are putting money in all these cases, and if you are an individual in HUF, you can claim the benefit. You can claim the benefit of how much, sir? Maximum 1.15 lakh rupees. Under 80C, how much deduction can you claim, sir? Maximum 1,50,000 rupees. Now please note, there is a section called as 80CCE, which says the total deduction of 80C, 80CCC, 80CCD1 shall be restricted to 1.5 lakhs. Now please note, life insurance premium, very important. Life insurance premium, there is an important point. Now, if you have, when the premium has been taken by you, have you taken the premium before 1st of April 2012, or have you taken the policy? When have you taken the policy? Have you taken the policy on or after 1/4/2012? If you have taken the policy before 1/4/2012, then the premium amount should be maximum 20% of sum assured. If the premium amount is more than 20% of sum assured, then only 20% of sum assured is the deduction which you are going to get while computing deduction under section 80C. However, if the policy is taken on or after 1st of April 2024, the premium should not be more than 10%. If the premium is more than 10%, you will get how much ever premium you are actually paying, or 10% of sum assured, whichever is less, as deduction under section 80C. Very important point. Okay. So life insurance premium should be less than 10% of sum assured if the policy is after 1st of April 2024. Now the public provident fund, whatever account is there, it has a lock-in period of 15 years. So whatever money you put in this account, you cannot withdraw it for a period of 15 years. National savings certificate, whatever amount you have reinvested, whatever interest you get, that interest will be taxable from national savings certificate only. That interest will be taxable under other sources, and if you reinvest it, you can claim it as deduction. Tuition fees is available only for education within India and for maximum 2 children. 80CCC, not that important. 80CC is what's a contribution to life insurance companies pension fund. Pension fund of any insurance company. Any insurance company is giving their pension fund, then you can claim deduction over here. How much deduction can I claim, sir? Deduction is available only for individual. Up to 1.5 lakh rupees deduction is allowed. And whatever amount you receive upon maturity will be taxable in your hands. 80CCD1. What is 80CCD, sir? 80CCD is pension scheme of central government, or also called as national pension scheme. So this is benefit is available to individual and salaried employees. Now how much benefit individual can take, 10%, salaried employee can take 10% of salary, and other people can take a benefit up to deduction up to 20% of gross total income. This is the maximum amount. Actual contribution or 10% of salary, whichever is less, will be allowed for salaried employed. Actual contribution or 20% of salary will be allowed for other people. Okay, here also maximum deduction is what's, sir? 1.5 lakhs, and there is a lock-in period of 60 years, meaning up to 60 years you will not get pension. Only after that you are going to get the pension. Now, if you are contributing in central government pension scheme, lawmaker says I'll give you extra deduction of 50,000 rupees. This extra amount is over and above 1.5 lakhs, which you are getting over here. 80CCD2. 80CCD2, see please note, 80CCD1 is your own contribution. 80CCD2 is your employer contribution. So 80CCD2 is applicable only for salaried employees for their employer's contribution. How much, sir? 10% of salary is allowed as deduction. Now there is an amendment over here. This amendment says now it is 14% of salary. Okay, now please note there is an amendment in this point, very important. Make sure that you remember this amendment because they may test you. This will be just 1 or 2 marks question in your total income question. It will be there, but because of this one mistake, your entire answer will be wrong. Okay, 14% of sum assured. Same to same we studied under PGBP chapter also, business income chapter also, that 14% from 10% they have increased it to 14% now. So irrespective of who you are, central government employee or state government employee, or whether you are a normal employee, 14% of sum assured deduction will be given for employer ka contribution. Now 80CCC is the father of 80C, 80CCC, 80CCD1. It says the maximum limit deduction allowed for all these people combined together is 1.5 lakhs. 80D. 80D is what, sir? Sir, what is 80D? 80D talks about health insurance premium. D for medical. So 80D says if you are taking health, if you are taken any health insurance, and if you are paying health insurance premium for yourself, your family members, or your parents, you can claim benefit over here. This provision is applicable for individuals and HF. If you are taking the policy for yourself and your children's, you can take benefit of 25,000. If you guys are senior citizen, yourself or your spouse or your children, anyone among them are senior citizen, then the limit will be increased from 25,000 to 50,000. Similarly, for parents, you can take the separate benefit of 25,000, and if parents are senior citizen, they will get a benefit of 50,000 instead of 25,000. So again, here there is a you can also take the advantage of preventive health checkup, which is covered in this limit only of 25,000. Payment should be, if you are making the payment for health insurance premium, medical insurance premium, that should be compulsory a non-cash payment. It will be allowed as deduction only if it is by any mode other than cash. And for additional 50,000 if the parents are more than 60 years. Then 80DD, if you are maintaining a dependent person, who is disabled, then you will get a deduction of 75,000 for normal disability and 1,25,000 for severe disability. Severe disability means disability is 80%, more than 80%. Okay. 80DDB, if dependent person is having some specified disease such as cancer, AIDS, etc., then you will get a deduction of 40% of whatever maintenance charges, or 1 lakh rupees, whatever amount you are incurring. Please note, this is dependent is disabled and you are maintaining that person. Here you are treating that person. You are treating a person who is dependent on you and having some specified disease. They both are not same. Disabled means what, sir? A blind person is a disabled person. Handicapped person is a disabled person. Now he may not, you may not be doing any treatment for that person. He's just a blind person. He's sitting at home. No problem. 80DD is applicable. If there is a person who has cancer and you're treating that cancer. In that case, 80DDB will be applicable. 80E is applicable for interest on educational loan. If you are taking any educational loan for your higher education, if you are taking your higher education loan, then up to 1,50,000 deduction will be allowed. Now the loan can be taken by you for yourself or for your children's or for your spouse or for your dependent relative. Loan should be between 1st of April 29. Sorry, where is this? Yeah. Full interest is allowed as deduction. Loan can be for self, spouse, children, or legal guardian child. And whatever interest you are paying for a period of 8 years will be allowed as deduction. Then 80EEB, interest for electric vehicle loan. If you have taken electric vehicle loan up to 1.5 lakhs interest is allowed as deduction. The loan should be between this period. Donation. 80G talks about donation. If you are making any donation, then that donation will be allowed as deduction depending upon whether it is falling under 50% category or 100% category. I will discuss this donation later. Okay. When you are making the donation in cash, maximum you can make the donation in cash is only 2,000 rupees. 80 GGA, GGB. 80 GGA and GGB talks about you are donating money for scientific research or for rural development. In that case, if you are an individual who is not having any businesses, you can take 100% deduction over here. If you are donating money to political party, even in such case, you can take deduction, 100% deduction. It should be a non-cash expenditure. And if an individual has taken any house on rent, then he can claim deduction under section 80GG. How much is the limit? We will see. 80JJAA is for new employee. That also we will see. QQB, RRB, royalty. Royalty, if you are receiving any royalty because you are an author or because you are receiving royalty because of patent, then you will get maximum deduction of 3 lakh rupees or the actual amount of royalty received, whichever is less. 80 TTA, if you have deposited your money, if you have deposited money in your saving bank account, the saving bank account will give you some interest. That interest is allowed as deduction under section 80 TTA. How much, sir? 10,000 rupees is the maximum interest allowed as deduction. If it is FD interest or recurring deposit interest not covered, only saving interest is covered. Then 80 TTA, interest on bank deposit. For senior citizen, it is applicable. If a senior citizen has any bank deposit, then up to 50,000 rupees is allowed as deduction. 80U, if you yourself are a disabled person, then you can claim deduction under 80U. If it is a severe disability, 1,25,000, and if it is a normal disability, 75,000 deduction can be claimed by you. 80DD is dependent is disabled. 80U is you yourself are disabled. Now, yeah, deductions are not available against these incomes, etc. What are the most important deductions? Are ATC, ATCCD, DEG, JJAA, TTA, and ATU. LIC premium, we saw what is LIC premium. Here I have given normal cases more than 10%, etc. Then contribution to PF these are all covered under employee provident fund, repayment of housing loan, national savings certificate, tuition fees. All these are covered under ATC. ATCCC covers only pension scheme of any insurance company. ATCCD covers pension scheme of central government, that is central government pension scheme, national pension scheme, Atal Pension Yojana. Then 80D covers medical insurance, central government health scheme, preventive health checkup, and medical treatment. Then 80DD is covering if you are maintaining a dependent person who is disabled. 80U covers those cases where you yourself are disabled. 80DDB, irrespective of the medical treatment, with respect to medical treatment of specified disease, you get how much, sir? 1 lakh rupees for senior citizen, 40,000 rupees for normal individuals. 80E is for interest on education loan. 8 years continuously it is allowed from the date when you are started paying interest. 80E and 80EE and 80EEA not applicable, I mean not required for examination. 80EEB for electric vehicle loan, maximum 1,50,000 you can claim deductions. Now 80G for donation. Sir, I am giving donation, sir. I want to be a nice person in my life. I want to give donation, sir. Lawmaker says if you give donation, I'll give you deduction under section 80G. How much deduction? To whom the deduction is allowed? Deduction can be allowed to any person who is making donation, and any person who is giving donation will get the deduction. Deduction is what, sir? No limit cases or limit based cases. Meaning, if you contribute money in PM drought fund and any of the central government fund, prime minister fund or CM fund, national fund, etc., then there is no limit on how much deduction will be given to you. Lawmaker says if you are contributing money to PM drought fund, there is no limit on how much you can contribute. You can contribute anything. How much ever you are contributing, 50% of that will be allowed as deduction. But if you are contributing in any central government fund, any state government fund, or any prime minister fund, or any chief minister fund, or any national fund, or Swachh Bharat, Clean Ganga, or army funds, then whatever amount you are contributing, 100% of that fully allowed as deduction. Okay, without any limit. But there are few things which are limit based, meaning contribution there is no restriction, but amount of deduction which I am going to give you will be restricted. Now here also in limit based also we have 50% and 100%, meaning whatever you are contributing or limit, multiply by 50%, whatever contributing or limit whichever is less, multiply by 100%. Now 50% will be given in case of minority, if you are contributing money for any benefit of minority people, or in case of any trust or temple, mosque, church, or housing accommodation. And 100% deduction will be given for family planning and Indian companies who are in Olympics. Please note, deductions, how much deduction will I get? How much ever you have contributed, or 10% of adjusted total income, whichever is less. What is adjusted total income over here? What is adjusted total income? Take your gross total income, subtract all the incomes against which your deduction is not available, and subtract all the deductions except ATG deduction. You will get your adjusted total income. Please note, donation can be in cash. Donation in kind is not covered over here. Only the donation which you are making in monetary form is covered. And if you are making any donation more than 2000 rupees, it should be by any mode other than cash. It can be account paycheck, account pay demand draft, any other electronic clearing system. ATGG is with respect to rent paid. Very important. There is an MCQ question in your RTP. If you see your current year's RTP, there is an MCQ question, very good question. First question of MCQ talks about this. If you see, nowhere in the MCQ when you are reading, you will understand that even this point is there in the question. Meaning, while reading the question, you will never understand that whether these types of deductions are there or not. So for you, understanding, knowing some deductions are very important. ATGG, rent paid for house property. Of course, RTP I am going to upload very soon. You will get RTP also. Rent paid for house property. If you are an individual who is not getting HRA and who is not having any house at a place of your employment and who is not covered under self-occupied, who has not claimed any self-occupied property benefit, then you will get a deduction of 5,000 per month, or 25% of adjusted total income, or rent paid minus 10% of adjusted total income. Adjusted total income means your gross total income, subtract all the incomes taxable at special rates except casual income, and subtract all the deductions except ATGG, you will get your adjusted total income. Uska 25% or uska 10% for calculation of last point. Now deduction will be, now please note, when I say you should not have a house, you should not have, your spouse should not have, minor child should not have house at the place where you are doing employment, and a declaration is required to be submitted in form 10BA telling I have paid this amount of rent, etc. ATGGA, if a person who is not doing business is giving money for scientific research or rural development, whatever amount he is giving will be allowed as deduction. He should give it by any mode other than cash. And if you are contributing to political party, ATGGB for Indian companies. If all other type of associates are contributing, ATGGC. ATJJAA. What is ATJJAA, sir? ATJJAA is the deduction which is given for new people whom you have employed in your company. If you are employing new people in your company, lawmaker says it is a good thing. You are giving job opportunities. So this deduction ATJJAA can be taken by any person who is engaged in business and whose books of accounts are audited, meaning whose turnover is more than 1 crore or 10 crores. Now, how much is the deduction? 30% of additional employee cost which you are incurring will be allowed as deduction for a period of 3 years continuously. Sir, additional employee cost means what, sir? If it is a new business, then all the employees which you added during the current year is previous year is your additional employee cost. If it is a existing business, then whatever increment is there in the number of employees when comparing from last year to current year. Additional employee shall not include employee whose salary is more than 25,000, employees who work for less than 240 days, and employee who does not have any who is not participating in recognized provident fund. 80 TTA interest on saving account, maximum 10,000 is allowed as deduction. 80 TTB for senior citizen, maximum 50,000 for deposits is allowed as deduction. Royalty income 80 QQB, if the royalty amount is less than 15% of book value, then whatever royalty you have received or 3 lakh, whichever is less. If royalty is more than 15% of book value, royalty at 15% of book value or 3 lakh, whichever is less, is allowed as deduction. Okay, so this is all about your deductions chapter. Now let us go to our one more topic is there under deductions. What is that, sir? Section 10AA. Section 10AA is what, sir? Tax holidays for SEZ. If you are an SEZ unit, unit located at the SEZ area, then for a period of 10 years, your income tax, for a period of 15 years, you will get some, for a period of any assessee, for a period of how many years, sir? 15 years, the deduction will be allowed. See, any assessee who is engaged in manufacturing or production business or provision of services at an SEZ area will be allowed as deduction under section 10AA. If you are a person who is doing manufacturing activity or who is providing any type of services, from which location, sir? From SEZ location. You are doing manufacturing at SEZ area or giving services from SEZ area, your profits will be exempt. How much profit will be exempt, sir? For first 5 years of your business, 100% of your export profit will be exempt. For the next 5 years of your business, from 6th year to 10 years, 50% of your export profit will be exempt. And for last 5 years, because up to 15 years it is allowed, 50% of export profit or amount credited by you to reinvestment reserve, whichever is less, will be exempt. Export profit is what, sir? Export profit is your business income into export turnover divided by total turnover. Of course, whatever your business income is there, complete total business income into export turnover divided by total turnover. Okay. Now all the other things are, not that important. Mr. Rudra, you see this question. Mr. Rudra has one unit at SEZ because this is one question which they normally ask in the examination. Mr. Rudra has one unit in SEZ and another unit is domestic tariff area. One is in SEZ area, another one is domestic tariff area. He provides you the following information. Mr. Rudra's total turnover they have given and the turnover of domestic tariff area they have given. Therefore, can I say this minus this will give me the turnover of SEZ unit? Yes. So 6 lakhs minus 2 lakhs, 4 lakh rupees. Export is 5.6 minus 1.6, 4. Net profit is 80 minus 20, which is 60. So we need only for SEZ unit. So total sales is 4 crore rupees and export sales is 4 crore rupees, meaning all the sales which is made by them is export sales only. Proceeds from sales in SEZ received in convertible foreign currency. Now, what do you mean by export turnover, sir? Export turnover means the amount received in convertible foreign currency within the time limit given by RBI. Correct? So, what is export turnover? The total turnover of total export sales is 4 crore rupees. But will I take this total? No. They say proceeds of export sales in SEZ received in convertible foreign currency by 30th September 24 is 3 crore rupees. He has exercised the option of shifting out of default tax regime. Calculate the eligible deduction under section 10AA if he has started the business in 2015 and if he has started the business in 2019. Now please see. 60 lakhs is my total turnover of SEZ unit, total profit of SEZ unit into my export turnover divided by my total turnover. So this is the amount of profit which is called as export profit. What is export profit? Export profit is total profit of the business into export turnover divided by total turnover will give me export profit. Now, if you have started in 2015, then it will be more than 5 years. Therefore, you will get 50% of your export profit as your deduction. If you have started in 2019, that means you have recently started, you will get deduction of 45% of your export turnover. Meaning you should see which year it is. If it is up to 5 years, then 100%. Then if it is more than 5 years, then 50% of export profit will be allowed as deduction. Next point. Just a second before we take discuss this next point. Now we'll start the discussion on total income topic. Total income topic. So there are two topics which we have to see in total income. One is your AMT and one is 115 BAC. What is AMT, sir? Alternate minimum tax. Now what is this alternate minimum tax provision telling? It says section 115 JC alternate minimum tax. It is applicable to all types of associates except company. Because for company something else is applicable which you learn in your final level. So it is applicable to whom, sir? All type of SSCs except company. That means it is applicable to individual HUF firm, LLP, AOP, BOI, artificial judicial person. Section 115 JC talks about what, sir, how much tax you have to pay. So this is the minimum, alternate minimum tax. This is the minimum amount of tax which you have to pay. So normally, how much tax will a person have to pay, sir? It will be the tax calculated as per normal provisions of income tax law, meaning whatever you have studied till now, or alternate minimum tax as per 115 GST, whichever is higher. This is the minimum amount of tax which you have to pay. Sir, what is this alternate minimum tax amount, sir? It is your adjusted total income amount. You take your adjusted total income, multiply it by 18.5%. You take your adjusted total income and multiply it by 18.5%. That is the amount of tax which you have to pay. Sir, what is my adjusted total income? Your adjusted total income, what is this adjusted total income, sir? You take your actual total income, whatever you have computed till now. So add all the incomes, subtract the deductions, etc. You will get your total income. From the total income, subtract section 35 AD deduction. If while computing total income, if you have taken 35 AD deduction, now please subtract the deductions. Then subtract 10 AA deduction. Just now we saw what is 10 AA deduction. So if you have taken deduction under section 10 AA, please subtract that. And also subtract the deduction under section 80 JJAA QQB RRB. You subtract from your total income which you have got, subtract these deductions, you will get your adjusted total income. From this adjusted total income, subtract section 35 AD. What, sir? Section 35 AD asset, whatever. See, 35 AD deductions you are adding back. Please note. Wait. I told subtract, I think, correct? Now, what they are telling is take your total income. While taking total income, you would have taken some deductions. You would have taken, you would have subtracted few things. Now, I just want you to add it back. What are those few things, sir? To this total income, add back deductions under section 35 AD, deductions under section 10 AA and 80 JJAA QQB RRB. Add back these items, you will get some amount. From this amount, subtract the depreciation for 35 AD asset. See, 35 AD says 100% of capital expenditure is allowed as deduction. Now, if I would have not taken deduction under 35 AD for that capital expenditure, I would have got at least depreciation. No? So, lawmakers are telling take that depreciation. So, you will get some amount now that is called as adjusted total income. This adjusted total income ka 18.5% is the deduction which is going to be allowed to you under 115 JC. Now, this provision shall not apply to an individual HUF, AOP, BOI whose adjusted total income is less than 20 lakhs, and it is also not applicable to an assessee who has opted for 115 BSc. Now, please note. You will get alternate minimum tax credit. You will get AMT credit. What is AMT credit? Please note. Actually, if you see it, this is the tax which I have to pay as per normal provision. Whatever tax is there, that is what the tax I have to pay. Correct? No. But I am paying alternate minimum tax if the alternate minimum tax is higher. So lawmaker says if the alternate minimum tax is higher, then the difference between alternate minimum tax and normal provision tax, that difference will be treated as AMT credit. AMT credit is your alternate minimum tax which you are paying and normal tax which is supposed to be paid by you. That is AMT credit. This credit will be available for next 15 years. So in next 15 years, whenever your normal tax is more than your alternate minimum tax, then difference of this can be paid through using this AMT credit. AMT credit can be utilized in the year when normal tax is more than alternate minimum tax. It can be utilized to the extent of alternate minimum tax available or shortfall from alternate minimum tax and AMT. Next is your optional tax regime or default tax regime. Optional tax regime versus default tax regime. So there is a face-off between two people, optional tax regime and default tax regime. Now, what is better? What is which is not better? What will happen if I follow default tax regime? All those provisions are discussed completely over here. Okay. Now, comparative analysis of normal provisions of and section 115 GSC. That is comparative analysis of optional tax regime and default tax regime. So tax rate under optional tax regime is what? Up to 2.5 lakhs 0, 2.5 to 5 5%, 5 to 10 20%, more than 10 30%. Limit will be 3 lakh for senior citizen, 5 lakh rupees for super senior citizen. Then under 115 BSc, what is the tax rate? Up to 3 lakhs no tax, 3 to 7 5%, 7 to 10 10%, 10 to 12 15%, 12 to 15 20%, and more than 15 30%. Now, surcharge is applicable in both the cases when the total income is more than 50 lakhs. How much is the surcharge? If the total income is more than 50 lakhs up to 1 crore, it is 1 crore. It is 10% of tax amount. It is how much, sir? 10% of tax amount. If the total income is more than 1 crore up to 15 crores, it is 15% of tax amount. If the total income is more than 2 crores up to 5 crores, please note, 50 lakhs to 1%, sorry, 50 lakhs to 1 crore, it is 10%. 1 crore to 2 crores, 15%. If your total income is from 2 crores to 5 crores, it is 25%. And if the total income is more than 5 crores, it will be 37%. However, the limit of 37% is not available in case of default tax regime. For default tax regime, if the total income is more than 50 lakhs up to 1 crore, they will have to pay a surcharge of 10%. Hey, we have done all the questions in our first chapter only, tax rate chapters. If it is 1 crore to 2 crores, 15%. More than 2 crores, 25%. Dividend. Now, please note, we all know this. For dividend income, not 25%. Problem is there. Mistake I have written. For dividend income, for which income, sir? For dividend income and for income taxable under section 111A, long-term capital gain under section 112 and 112A, the maximum amount of surcharge which you can levy is how much? 15%. Then, sir, will I get rebate? Yes. Rebate will be given for normal provision. How much? When the total income is up to 5 lakh rupees. Rebate is tax amount or 12,500, whichever is less. Now, rebate also will be given under default tax regime under section 87A. If the total income is up to 7 lakh rupees, rebate will be given. How much, sir? Tax amount or 25,000, whichever is less. Now, what if the total income is slightly more than 7 lakhs? Then the extra tax which you are paying, first I'll calculate the extra income which is there and calculate the tax amount on the entire total income. If the extra income is more than extra tax, then the difference will be given to you as rebate. Health and education says, needless to say, will be applicable 4% of tax. Now, sir, what will happen if I select default tax regime? Sir, if I select default tax regime, if I select which regime, sir? Default tax regime. If I select 115 BSc, what are the things which I am going to forgo, sir? What are the different things which will be taken from me? Chapter wise, we will see. Income from salary following will not be available to you, meaning you cannot claim leave travel concession benefit under section 10.5. Under section 10.5, if you're traveling by air, economic class fare, if you're traveling by any other mode, first class AC ticket, etc., that benefit will not be given to you. Leave travel concession benefit will not be given to you. HRA exemption under section 1013A will not be given to you if you follow 115 BSc. Then allowances exempt under section 1014, you cheat, duck, hat, that allowances will not be given to you. That benefit of that allowances, for example, hostel allowance 300 rupees, that will not be given to you if you follow 115 BSc. However, transport allowance, traveling allowance, daily allowance, and conveyance allowance, these are the 4 allowances for which you will get the deduction. Transport allowance only for handicapped employees. Now, sir, will I get a deduction under section 16? No, you will not get any deduction under section 16 except standard deduction. Only standard deduction will be given. How much, sir? For optional tax regime people, it is 50,000, and those who are opting for 115 BSc, the standard deduction is increased by 25,000 more. Income from house property. Under income from house property, if it is a self-occupied property, you cannot claim the deduction of interest under section 24B, self-occupied property. For let out property, no change is there. You can follow whatever we have studied. If you are a person having business income, then for business income, you cannot claim additional depreciation. The concept of additional depreciation will not be applicable to you if you are following 115 BSc. If you have given any donation to for scientific research, that donation benefit you cannot take. Hey, please note, I am talking about donation to scientific research, not in-house scientific research. In-house scientific research will be allowed. No deduction will be given under section 35 AD. Then for capital gain, there is no change. There is no change. Same thing, whatever you have studied is applicable. Then for family plan, no, here there is a change. Family planning deduction which is there, the family planning deduction which is there, the family pension deduction will be, family planning pension deduction will be 1/3 of pension or rupees 25,000. So whatever family planning, family pension you are receiving, for that family pension you will get a deduction of 1/3 of total pension or rupees 25,000, whichever is less. And when you are clubbing your minus income, you cannot claim the benefit of 1032 exemption 1,500 will not be given. For MLA MP daily allowance constituency allowance, normally it is exempt, but here it will be fully taxable. Under set off and carry forward, house property loss cannot be set off under incomes of other heads, and no set off of brought forward losses if those losses are because of above reasons, meaning if those losses are because of depreciation or in type of gross forward losses. Deductions under chapter 6A, you will not get any deductions under chapter 6A except 80CCD2 and 80JJAA. Sir, what about 10AA? 10AA benefit also will not be given to you. Okay, important point. Income which are taxable at special rates will continue to be taxed at special rates, and 115 JC will not be applicable, meaning alternate minimum tax provision will not be applicable if you are a person who is opting for default tax regime. Okay, so this I think is all about your default tax regime provision. This is all about your total income topic. One last chapter is left over: TCS Advance Tax and return of income. Last chapter, 4 marks question will come from this topic. Advance tax. What is advance tax, sir? Advance tax means what, sir? Paying the tax in advance. Normally, whatever income you earn in the previous year, normally what we have studied in our life, whatever income you are earning in previous year, on that income which you are earning in previous year, you will have to pay tax in assessment year. So income is earned in previous year, tax is paid in assessment year. But however, advance tax says you earn income in previous year only and pay also the tax in previous year, meaning advance tax says pay as you earn. Advance tax says what, sir? Pay as you earn, meaning you estimate your total income. On that estimated total income, you first estimate your total income. On that estimated total income, you just compute your advance tax liability. Advance tax liability you compute, and whatever amount is there, that is required to be paid by you in 4 installments. 4 installment. When are these installments, sir? 15th of June, 15th of September, 15th December, 15th March. Please note. What is advance tax topic telling? See, normally income you earn in previous year and the tax is paid by you on that income in which year, sir? Assessment year. Correct. Now, advance tax provision says whatever income you are earning in previous year, no, on that income also you pay tax in the previous year itself. So here they follow a concept called as pay as you earn. As and when you are earning the income, pay the tax also to me. And why to wait till assessment year? If you wait till assessment year, problem is there. If you wait till assessment year, what is the problem, sir? If you wait till assessment year, then you will have to worry, okay, how much is my tax computation? And you will have to do all those things. And the amount will become so huge, you will feel like not paying only. So they are telling, as and when you are earning, you please pay the tax to me. So here, sir, how will I know what is the tax, sir? Because the income is going to, I will know my income only as on the last date of the previous year. No, sir. Yes, lawmaker says no problem. You estimate your total income. Sir, how will I estimate? Are just see how much you earned last year? Are current year you will always try to earn more than what you have earned last year? No? Yes, sir. Yes, sir. Yes, sir. So estimate your total income. On that estimated total income, you compute the tax. So tax liability, how will I compute, sir? Let us say my estimated total income is 15 lakh rupees. So under old regime, if I follow this, my tax amount will come to 2,73,000 rupees. Along with cess, my tax amount will come to 2,73,000. Now this tax which I have calculated, no, this is my advance tax liability. This is the tax which I have to pay to the government in advance. Now how should I pay, sir? I should pay this tax in 4 installments. When should I pay? 15th of June, 15th of September, 15th of December, 15th of March, 15 June, 15 September, 15 December, 15 March, 15%, 45%, 75%, 100%. So this 15th of June, you pay 15% of your advance tax liability. Total, how much you should pay? 49,500. By 15th of September, pay 45%. If you have already paid 15%, then subtract that, the remaining amount you pay now. By 15th of December, you pay 75%. If you have already paid 45% before, you subtract that and pay the balance amount. So by 15th of March, you should pay 100% of your advance tax. Please note, one point you should note, whatever you paid till 31st of March of previous year, that is called as what, sir? Advance tax only. Advance tax means the tax which is paid in the previous year. Advance tax is tax payable on advance tax is payable. When should I pay advance tax, sir? You should pay advance tax only when your advance tax liability is 10,000 rupees or more. In case of senior citizen, who does not have a business income, he does not have to pay any advance tax. If you are a senior citizen who is not having a business income, then for you the provisions of advance tax will not be applicable. See, normally you will have to estimate your total income and pay the taxes. Some incomes cannot be estimated. Which incomes are? Casual income, capital gain income, and business income which you are earning for the first time. So for these incomes, you pay the advance tax from the date when you started earning this. Then section 44 AD and 44 ADA people, meaning those who are those who have opted for presumptive taxation, they can pay their full advance tax in one installment only, which is 15th of March, last installment. How do I compute my advance tax liability? Very important. First, you estimate your gross total income. Subtract from that deductions under chapter 6A if it is applicable. Meaning depending on which system you are following. If you are following default tax regime, then mostly this will not be there. You compute your estimated total income. On that estimated total income, compute the tax. Please note the tax computation should depend on whether you are following default tax regime under 115 BAC, or if you are following normal provisions, compute the tax as per normal provisions. So first you should compute what's the tax on your estimated total income, add surcharge if it is applicable, then add health and education cess if it is applicable. That is the total tax on your estimated total income. From this, if there is any TDS which is deducted and paid to the government, subtract that. TCS which is collected and paid to the government, subtract that. And any tax which is paid by you during the previous year because of any other reason, subtract that. You will get the advance tax liability. You will get what's the advance tax liability. This advance tax liability is required to be paid by you in 4 installments: 15 June, 15 September, 15 December, 15 March. 15%, 45%, 75%, and 100% is what you are supposed to pay. Now please note, my total tax liability is 3 lakh rupees. TDS deducted but deductible but not deducted, meaning they had to deduct TDS of 1 lakh rupees but they have not deducted. Will I subtract it from my total tax liability? No. TDS deducted but not remitted, meaning they have deducted the TDS but not paid to the government. Then how will I government come to know whether this TDS I am supposed to receive or not? So will I deduct this? Lawmaker says no. So whatever TDS is deducted and paid to the government, only that you can subtract from your total tax liability. That will give you your advance tax. Now this is required to be paid by you to the government in 4 equal installments. So there is one beautiful question which I have taken over here, and I have asked you to compute advance tax under new tax regime and old tax regime. Very nice question I have taken. So first, what will I do, sir? I'll compute the gross total income under both the regimes, and then I'll take the total income under both the regimes. I'll first compute what's my total income under both the regimes. Then I'll compute the tax liability under both the regimes. So my tax liability under old regime is 86,010 rupees, rounded off to the nearest multiple of 10, and under old regime it is 47,940 rupees. Now this tax, I had a TDS credit of 15,000, TDS credit of 15,000. I'll subtract. So balance amount is my advance tax liability, which I have to pay in 4 installments: 15%, 45%, 75%, and 100%. Now comes your return of income chapter. Before return of TDS, advance tax, CDS, TCS, and return of income. Return of income chapter. Who is required to file income tax return, sir? Who is required to file income tax return? Section 139 says company and partnership firms should always compulsorily file income tax return even if they are not earning any income. And every person whose total income is more than basic exemption limit should file his income tax return. Every person who is holding as a beneficial owner or who is having any signing authority or who is a beneficiary of an asset which is located outside India. Located where, sir? Outside India, he should also file his income tax return. And every person whose total income before giving the deductions under chapter 6A and before giving exemptions under capital gain is more than basic exemption limit, he also should file his income tax return. And every person who has deposited more than 1 crore rupees in his bank account, current account, who has incurred more than 2 lakh rupees expenditure for foreign travel, who has incurred more than 1 lakh rupees expenditure for his electricity, they also required to file income tax return compulsorily. Sir, what is the due date of filing income tax return? For companies, it is 31st October of assessment year. Assessment year ka 31st October. And for any person other than company whose books of companies whose books of accounts are subject to audit under income tax law, then for them also it is 31st October. They should file their income tax return by 31st October. Sir, what if I am a case of transfer pricing? They will not ask you this, but for them it is 30th November. So normally the due date of filing income tax return is what, sir? 31st of July. For everyone it is what? 31st of July. If you are an audit case or if you are a company, then it is 31st of October. Sir, what will happen if I don't file my income tax return? If you don't file your income tax return, then you will have to consequences for delay in filing of income tax return. If you file your income tax return late, then there are two consequences which are there. One, you will have to pay interest under section 234A, and you will have to pay late fees under 234F. Interest is how much, sir? Interest is calculated at 1%. From which date? From the date succeeding, so commencing from the date immediately after the due date till the date of filing income tax return, meaning you should calculate this on monthly basis. So you should take per month or part thereof. For example, 31st July is the due date of filing return. I filed my return on 15th of September. So will I calculate the interest for 45 days? Answer is no. You will calculate interest for 2 months. Now 1 month of August and 1 month of September. Though it is only 15 days of September, even if it is 2 days of September, you will take it as full September month. Late fees will be 5,000 rupees for delay in filing of income tax return. But however, if your income is less than 5 lakh rupees, then for you the late fee is 1,000 rupees. Government may specify few people to file their income tax return. Now, sir, filing of loss return, is it mandatory? Yes. Even if you're earning if you're not earning income, if you have any losses during the year, then filing of loss return is important if you want to carry forward those losses. So business loss, 35AD business loss, capital loss, short-term or long-term loss from owning and maintaining resource business, these losses cannot be carried forward until you file the loss return. Loss of house property and unabsorbed depreciation can always be carried forward. It does not matter whether you have filed the return or not. Section 139(3) does not prohibit for set off of losses. They only say that you cannot carry forward the losses if you file the return late. Sir, whatever previous year losses are there, can I carry forward them even if I don't file my current year return? Yes, you can always carry forward them. Belated return. Sir, I have not filed the return within the due date, that is 31st of July and 31st of October. Then what will happen, sir? You can file it later. What is the last date to file the belated return? If the return is not filed within the due date, then he can file a belated return before 3 months before the end of assessment year or before completion of assessment, whichever is earlier. So 3 months before end of assessment year. For example, for previous year 24-25, the assessment year is 25-26. When is the assessment year going to end? 31st of March 26. 3 months before this is 31st December 25. You should file your belated return by this date, or if assessment is completed before this date, then that date of assessment. Sir, what is the consequences of belated return? This is a theory question which they normally ask in the examination. You will have to pay interest, you will have to pay late fees, and losses cannot be carried forward by you. Revised return. Sir, I have filed my return. Now I want to do some revision. I want to make some changes. Lawmaker says you can file something called as revised return. This revised return is required to be filed by you 3 months before the end of the assessment year or before completion of assessment, whichever is earlier. Then defective return or incomplete return. Normally what happens is, whatever income tax return is filed by you, the system is going to verify whether there are some mistakes in this return, whether there are some defects. That mistakes will be intimated to you, and they will give you an opportunity to rectify those defects within a period of 15 days. Okay, if the defect is not rectified by you within a period of 15 days, then it will be assumed that you have not filed your income tax return at all. Updated return. Updated return means what, sir? If you have not filed return for last 2 years or last 1 year, etc., if you have not filed return, I will give you an opportunity to file the return by you. Or if you have already filed the return for last 2 years or last 1 year, and now you want to increase your income, then I will give an option to you. Any person may furnish updated returns at any time within 24 months from the end of relevant assessment year. Now, the provisions of the updated return will not be applicable if the updated return, the new return which you are filing, is a loss return, meaning you cannot reduce your income. If you want to show profits, then only updated return provision will come. Then the updated return is decreasing your tax liability, or it is making sure that you get refund, etc., meaning updated return can be filed by you only if you want to pay more taxes, in simple words. How much is the tax which I have to pay under updated return, sir? Whatever tax is calculated by you, if you file updated return within 12 months from the end of the assessment year, then you will have to pay a penalty of 25% of tax. If you file updated return after 12 months, it is 50% of tax. Now, normally under income tax law, they follow a process called as self-assessment. Self-assessment is what, sir? You will have to assess your own income tax liability and pay it to the government. So whatever income tax you are paying is the income tax calculated by you yourself, and you are paying the income tax to the government. Now, whenever you are calculating income tax, you should always make sure that you also pay interest under 234A, interest under 234B, interest under 234A for delay in filing of return, interest under 234B for not paying the advance tax properly. Now the last point for the discussion is what, sir? TDS, TCS and advance tax. Advance tax is already discussed by us. TDS, TCS will see and conclude our marathon. Okay. Deduction of tax and advance tax, etc. Now, basic point before we start this discussion. Now, TDS is there. No, TDS is required to be deducted at the time of making the payment of that money or at the time of crediting the account of that pay, whichever is earlier. Now, normally it is at the time of paying the money or at the timing of crediting, whichever is earlier. But in these cases, TDS is required to be deducted only when you are paying this money. In case of salary, payout from employee provident fund, dividend, winning from lottery, betting, gambling, or amount from life insurance maturity amount which you are receiving, compensation for compulsory acquisition, and cash withdrawal more than 1 crore rupees in a year. Now, normally TDS will be deducted at the rate which is given, but however, whenever you are making a payment to a non-resident or foreign company, along with whatever rate is mentioned, you should also add surcharge and cess if it is applicable to the normal TDS rate. If the PAN is not given, no, normally PAN is required to be given if TDS is required to be deducted. If PAN is not given, then TDS will be deducted at a higher rate, whatever rate is specified, or 20%, whichever is higher. Now, if the amount is inclusive GST, TDS should be deducted on amount exclusive GST. Section 192. Section 192 talks about what, sir? TDS. Section 192 talks about TDS on salary. So, whatever salary an employer is receiving, on that salary, TDS is required to be deducted by the employer. The employee can be resident or non-resident. The TDS is required to be deducted, meaning that employer will have to compute the tax of that employee for the entire year and divide it by 12. That is the amount of TDS which is required to be deducted every month. Section 193, TDS on interest. So if you are receiving any interest, on that TDS will be deducted at the rate of 10%, at the rate of 10%, and TDS will not be deducted if the interest amount is less than 5,000 rupees. Then section 194A, TDS on interest other than interest on securities. If you are receiving any interest other than the interest on securities, meaning if you have given money to someone, loan to someone, then TDS is required to be deducted by any person other than individual and HUF, and individual and HUF will have to deduct TDS if their books of accounts are subject to audit. So how much is the TDS, sir? The tax rate is 10%. Please note, for TDS rates, no, there is a change in 4-5 rates. They have reduced from 5% to 2%, etc. Please go through my amendment video once, okay, for that rates change. So tax should be deducted at 10%. No TDS is required to be deducted if the TDS is if the interest amount is less than 5,000 rupees, and no TDS is required to be deducted if the payment is made if you are paying the interest to a bank account, or if you are paying the interest to partners. Partnership firm is paying the interest to partners. 194C, TDS on contract and subcontracts. So if you enter into contract with someone, then whatever payment you are making to that contractor or a subcontractor, for that TDS is required to be deducted. By whom, sir? Any person other than individual and HUF, and individual and HUF if their books of accounts are subject to audit. Sir, how much TDS is required to be deducted? Once again, I'll just take this call. Section 194C talks about what, sir? Section 194C talks about it talks about what, sir? Payment to contractors, subcontractors. So TDS is required to be deducted by a person, by any person other than individual and HUF, and individual and HUF will deduct the TDS if their books of accounts are subject to audit. Now, what is the rate of TDS, sir? 1% in case you are paying to an individual or HUF. If the contractor is an individual or HUF, if the contractor is any other person, then 2% is the rate of TDS. Now, when will TDS not be deducted? If you have entered into a single contract and the price of that contract is less than 30,000 rupees, and if you have entered into multiple contracts, then in a year, then the amount which you have paid, total amount is less than 1 lakh rupees. No TDS by an individual or an HUF if the contract is for personal purpose. If you're taking any work for personal purpose, no TDS is required to be deducted. And if you're taking services from a transporter who is having less than 10 trucks, then you don't have to deduct TDS. Then 194H, in case of commission, here the rate is changed. Okay, but you please rewatch that video. Commission 194H, for commission, the TDS is required to be deducted by any person other than individual NHF, and individual NHF has to deduct TDS if their books of accounts are subject to audit. The TDS is required to be deducted whenever they are paying commission to any person. The rate of TDS is 5%. Actually, now it is now in the sense, please note, in the middle of the year there is a change. So for half of the year it is 5%, after that it is 2%. So I am telling you, please watch that amendment video. So no TDS is required to be deducted if the commission is less than 15, or if you are not watching amendment video, no problem, just watch, see the amended notes which is there. So commission and brokerage is less than 15,000, TDS is not required to be deducted. 194I is for rent. So if you have taken any land, building, plant, machinery on rent, TDS is required to be deducted by you. Who should deduct? Any person other than individual NHF, and individual NHF has to deduct TDS if their books of accounts are subject to audit. The rate of TDS will be 2% in case of plant and machinery and 10% in case of land, building and furniture. No TDS is required to be deducted if the amount is less than 2,40,000 rupees. Now, rent means, okay, these stories they have given. No TDS is required to be deducted if the rent is what, sir? Less than 2,40,000 rupees in a year. 194 IB, if an individual and HUF are taking rent for house and rent for their personal purpose, then they will have to deduct TDS at the rate what, sir? At the rate of 5%. Now it is changed to 2%. They'll have to deduct TDS at the rate of 2%. If the rent is less than 50,000 rupees, if the rent is more than 50,000 rupees. So TDS is required to be deducted at this rate. Please note, which individual and HUF, if I am taking any house on rent for my personal purpose and the rent is more than 50,000 rupees, you should deduct TDS. When should you deduct? At the time when you are paying last month rent for the previous year, or when you are paying the rent for the last month of your tenancy, you should deduct the TDS. Please note, this limit is 50,000 per month. Monthly rent is less than 50,000, no TDS. 194J, professional charges. TDS on profession or technical. TDS on professional, TDS for professional technical services. So if you are taking any professional services, technical services, paying any remuneration or commission to the director, or any royalty or non-competing fees to any person, then TDS is required to be deducted by any person other than individual and HUF. Individual and HUF will have to deduct TDS if their books of accounts are subject to audit. The rate of TDS is what's at 10%. The rate of TDS will be 2% for technical services if you are paying the money to a BPO, call centers, etc., or if you are paying royalty for distribution of cinematographic films. Now please note, the limit is 30,000 rupees for each item except director fees. For each item it is separate 30,000 rupees, and it is applicable, TDS is required to be deducted by individual and HF also in first two cases. Other cases not required to be deducted. 194M, if I am taking any services from a contractor, if I am giving commission to some person, and if I am taking any professional services for my personal purpose by an individual and HF who are not covered under 194C, H and J, then I will have to deduct TDS at 5% if the total value of the service is more than 50 lakh rupees in a year. 194N, if you withdraw cash from the bank more than 1 crore rupees in a year, or more than 20 lakh rupees in a year, then TDS is required to be deducted at the rate of 2%. 5% will be the rate of TDS if it is a defaulter. So cash withdrawal is less than 1 crore in a year, TDS will not come. Only in case of defaulter, the limit of 20 lakhs and 1 crore is there. Now the concept of grossing up, meaning whenever the income is given, the net income is given to you, please add back the TDS amount and take the gross income for your computation. If you want to deduct the TDS at a lower rate, then please obtain a lower deduction certificate from the assessing officer. Then self-declaration you can give under 15G and 15H if no TDS is required to be deducted under these sections. Then TDS, whenever a TDS is deducted, that means you have received that income. TDS credit will always be available for you at the time when you are filing your income tax return. Now, what is the due date for depositing the TDS? For April to February, it is 7th of next month, and for TCS, it is 7th of next month. For the March month, for TDS, it is 30th April of next financial year, and 7th of April it is for TCS it is 7th of April of next financial year. Due date of TDS and TCS. Now please note, this is the date when you are required to deposit or pay the taxes to the government, TDS, TCS. When should I file the TDS, TCS return? So for quarter ended April to June, 31st July. For quarter end, so meaning whenever the quarter is ending, last date of next quarter. So April to June it is 31st July, July to September it is 31st October, October to December 31st January, and January to March last month it is 31st of May. Very important, 31st of May. However, July this TCS return which is there, no, TCS return is required to be done by 15th July, 15th October, 15th January, and 15th May. So there are some returns which you have to file. TCS returns for salary it is 194Q, and for 194, sorry, for salary it is 24Q, the TDS return name, and for any other cases it is 26Q, 24Q for salary, 26Q for other cases. All other things are not required for you. Consequences for failure to deduct tax. What will happen, sir? If you don't deduct the TCS, if a PA does not deduct the TCS, or after deducting does not pay to the government, then he will be called as assessee in default. He will be called as assessee in default, and he then the payer shall not be regarded as, okay, he will be called as assessee in default, and he will have to pay a penalty of 100% of tax amount. Now, when will you not be called as assessee in default? If the opposite person has filed his income tax return, and he has considered this income and also paid the tax on this amount. Interest liability, if you don't pay the TDS within the due date to the government, you'll have to pay interest at 1% per month if you have deducted late. If you have paid late to the government, the interest is 1.5% per month or part thereof. Once you have deducted TDS, you will have to give something called as TDS certificate. For specified TDS, for specified people, the TDS rate will be, now who are the specified TDS? Not relevant for this level. If the TDS rate will be what, sir? 5% or twice of the TDS amount, whichever is higher. Now, what is tax collected at source? Sir, tax collected at source. For liquor, it is 1%. For 10 leaves, it is 5%. Meaning, tax collected at source, what, sir? I am giving you services. I am giving you goods. At the time when I am supplying goods and services to you, I will collect extra money from you, which is called as TCS, tax collected at source. Alcohol, if you are purchasing 1%. 10 leaves it is 5%, timber it is 2.5%, and then any other cases, one second. Okay, for alcoholic liquor for human consumption 1%, 10 leaves it is 5%, timber 2.5%, forest produce except timber 2.5%, scrap and mineral oil it is 1%. Now, who should collect TCS on above items? Any person other than individual HUF, and individual HUF if their books of accounts are subject to audit. TCS will be collected for the TCS will be collected by any person other than a buyer who is using it for personal purpose. So if you are purchasing alcohol for your personal purpose, you will not have to pay TCS. Then if you have taken any place on lease or rent, parking lot or toll plaza or mine or quarry on lease or rent, then 2% TCS will be collected. Then if you are purchasing any car whose value is more than 10 lakh rupees, 1% TDS will be collected. Then if you are remitting more than 7 lakh rupees outside India, or you are going outside India for tour purpose, then TCS will be collected. If the amount is up to 7 lakhs, then it is 5%, more than 7 lakh 20%. So if you're going outside India and spending up to 7 lakh rupees, 5% TCS will be collected, and more than 7 lakhs, 20% TCS will be collected. Now the rates have been reduced. Now if you sell goods, then 0.1% of consideration will be collected as TCS if it is more than 50 lakh rupees. Now this will be applicable only if the person who is involved over here has turnover more than 10 crores in the last year. Time limit for collection of TCS is what, sir? We have discussed anyways above. Interest is what, sir? Interest will be applicable if you have not collected and deposited to the government, 1% per month or part thereof. And if no PAN is given, then twice the rate or 20%, whichever is higher, will be the TCS rate. This is all about this fantastic topic. Which topics are called as income tax. I think I have tried to cover this almost in 8 hours time. Okay, I hope you enjoyed learning this with me, and this is complete exhaustive revision. Okay, this can be used for you for daily revision purpose, correct? Daily basis, if you want to revise while you are traveling, if you want to revise, definitely you can use this. All the very best for your examination. I hope you get great marks in your examination. Please stay tuned for the marathon of GST, and also the other topics such as I'll be doing RTPs, etc. You please stay tuned with the channel. The videos are going to come very soon. All the very best for your examination. Let me meet you in my next video. Until then, tada, bye bye, take care, enjoy students.